Hello all, welcome to the CMA Final DT Marathon Part 3. This is your tax guru CSCMA Manidhi. So before we go into the Part 3 topics and all, first of all, I really appreciate your efforts. Like there is tremendous response for the Part 1 and Part 2. Like Part 1, it's already like about 12,000, 13,000 views, and Part 2 roughly around 5,000 plus views. You have to watch them, you have to share with your friends, but as a professional, not as a student. Okay, then sir, see in Part 3 what we gonna cover. Sir, in Part 3 we gonna cover like business restructuring topic, NR taxation, advanced tax, appeals and ICDS. Sir, business restructuring and NR taxation. So okay, so these two are like 4A and 4B. Okay, so very important topic, sir. I'm gonna say you NR taxation. Watch this lecture, NR taxation, and I'm sure that you're gonna get ultimate confidence over NR taxation. So okay, so I've seen this, I've received this feedback even past also. Many CFNL students also came and said like, sir, we did not even understand in CFNL, but here we got proper clarity over NR taxation. So that much clarity you'll get, and definitely you can get here like out of 14, 12 marks or even 14 out of 14 also you can get from this question. So don't skip this part, watch this. Then advanced tax covered extensively, sir, like explaining the concept, sir. I give the concept and logic, so you'll not forget easily. Appeals is been covered and even ICDS also has been covered. So these three topics like 5A and 5B. So overall with this part, like three parts, we covered 2A and 2B. Like question number 2, what like PGBP assessment of companies, that part. 3A and 3B tax planning. 4A and 4B business restructuring and NR taxation. 5A and 5B like advanced tax, ICDS, appeals. 6 to 7 are related to transfer pricing, DTA. Now what else you need? Sir, there may be assessment of trust could be asked like at question number 2. There is a small chance of asking even assessment of trust also. If you want the simplified summary of trust, and if you want the MCQ series to be launched quickly, I am giving you a target for this video, sir. If you get or if you make sure that there are 500 comments, because I know that more than 1000 plus students are watching the marathons currently, my rough estimate. So out of them, at least 500 students, if you comment also that, okay, comment what you have to comment like, sir, okay, MCQs and trust. So whatever you put, comment you put, okay, or put your location, okay. Once it reaches the 500 comments, then I'll record and upload the MCQs video and assessment of trust. So how quickly you get this done, that much quickly I'll give you the trust and MCQs video. So okay, sir, it's not like I'm asking you like pressurizing you and all to get comments and all. You comment, it's okay. Or if you are any of your friends, 2-3 people are there and they are also watching it, ask them also to comment. That's what you do. It's okay. Whether, okay, don't take that stress whether 500 will reach or not, will we get this videos and all or not. You do your job, easily they'll reach 500 comments, I know that, okay. And I'm gonna release you the trust and MCQs video. But if you do this quickly now, I'll release that much more quickly, okay. So once again, sir, don't forget to like, share and comment. I'm like truly want to see your success. Once you clear the exams also, don't forget to attend our BCCA felicitation ceremonies and all, okay. That's the only time where we'll get to see each other face to face or to meet face to face in that joyful time, in that happy moments, okay. If you come and visit us, definitely we feel so much happy and feel delighted.
See, it consists of, actually there is no chapter called business restructuring. However, CMA Institute has made this chapter means it brought some provisions from capital gains, some from PGBP, some from set off and carry forward of losses. From all these, it made concepts from all these three chapters and made it as a chapter called business restructuring. So when the business is going to be restructured, what is the impact of capital gains? What is the impact of PGBP? What is the impact on set off and carry forward of losses? So what are called business restructurings? An amalgamation is a business restructuring. Demerger, slump sale, conversion of sole proprietary business to company, conversion of firm to company, conversion of private limited company to unlisted company, private limited or unlisted company to LLP. So these are restructurings. amalgamation, demerger, slump sale, conversion of sole proprietorship to company, firm to company, or a private limited or unlisted company to LLP. So out of this, so many, sir, even we already covered one part related to this chapter in PGBP itself, depreciation related. Depreciation when there is a succession. Succession means what? When there is an amalgamation, demerger kind of thing, how the depreciation has to be apportioned. So okay, if you remember, sir, it has to be apportioned between predecessor and successor in the ratio of number of days used. So that concept we already covered in the PGBP itself. So now from any of these concepts, the question may come. So first, they have defined amalgamation. It's okay to get tax benefits mostly. An amalgamation which is happened should satisfy the definition mentioned here under Income Tax Act. What is called amalgamation? Merger of one or more companies with another. Merger of one or more companies with another. See, A Limited merges into B Limited. Now what? A Limited will be discontinuing. A B Limited is going to be continuing. So the one which is going to dissolve is called amalgamating company. The one which is going to survive and continue is called as amalgamated company. One company, merger of one or more companies with another. Merger of one or more companies with another. So I still remember a classic example from my FR class. So okay, where then the faculty said to remember this. When you add sugar to milk, when you add sugar to milk, let's say sugar is a company, milk is a company, sugar gets dissolved into milk, sugar will not have any identity. Because of sugar, yes, milk value may increase, but sugar identity cannot be seen anymore. It gets completely dissolved into milk. Then sugar is called as amalgamating company. The milk, which one is continuing, is called as amalgamated company. Okay. Then merger of two or more companies to form one company. Sir, here none of the companies will survive. None of the companies will survive. They'll both will merge and form a new company. A Limited, B Limited. Now in this case, both are amalgamating companies only. The newly formed C Limited is called as what? Sorry, these are amalgamating companies, and the newly formed is called as what? Amalgamated company. Okay. And if in case of transferor, transferee, this is called transferor company. This is called transferee company. Okay. For this, the classic example again is like with the same milk, sugar. If you add decoction also, okay, then so to the milk, sugar added, milk, then you added decoction also, then it gets a new substance, altogether new name, which is called tea or coffee. So two entities merged and they lost their individual identities and formed as a new entity. Then it is like what? Merger of two or more companies and to form one company. So first one is what? One company merges into another, and the newly formed, and the amalgamated company is continuing. The amalgamating company is dissolved. The second one is like what? Two or more companies will amalgamate. These two companies which amalgamated will discontinue. The newly formed company will continue its business. Okay. So merger of two or more companies to form one company. Then when all the assets and liabilities of the amalgamating company immediately before amalgamation becomes the assets and liabilities of amalgamated companies. All the assets and liabilities of amalgamating company. All the assets and liabilities of amalgamating, which are called amalgamating. This A Limited here, A Limited and B Limited here. The assets of A Limited or A and B Limited here will become the assets and liabilities of amalgamated company. So all the assets and liabilities of A Limited has to be taken over by B. All the assets and liabilities of AB has to be taken over by C. Understand, sir? First one is what? One company merges into another. Two or more companies merges and form a new company. Third one, when all the assets and liabilities of the amalgamating company before amalgamation or amalgamation becomes the assets and liabilities of the amalgamated company, and at least 75% of the shareholder in terms of value, not voting rights, in terms of value, both equity and preference together, sir. We don't check only equity, together both equity and preference. 75% of the shareholders in terms of value shall become shareholders even in the amalgamated company. Sir, 75% of shareholders shall become. Their voting need not to be 75% in the new company. Understand, sir? See, look at this example, sir. X Limited has A, B, C, D, E, each having 20, 20, 20. Now, when it merged into Y Limited, it allotted shares to 4 people only, A, B, C, D. To E, it's not allocated. E has taken a cash settlement and left. Okay, then in such case, how much percentage of shareholders are continuing in Y Limited? 80 only. Sorry, in Y Limited, they got only 1 share for 2 shares in X Limited maybe. Y Limited has given maybe only 1 share for every 2 shares held in X Limited. Then their shareholding in Y Limited might be consolidatedly only 40% only. Still not a problem. What we are asking is like, in amalgamating company, out of 100% shareholders, at least 75% should become even shareholders in what? Amalgamated company. Okay, they need not to have the same shareholding 75% also. Understand, sir? So why? Because Y Limited already have some other shareholders, right? Okay, so they cannot give only to these people only 75%. So understand that one. Okay, so what are the 4 conditions for amalgamation? One company merges into another. 2 companies merges to form a new company. Third one, all the assets and liabilities are transferred. At least 75% of shareholding, both equity and preference, will become shareholders in the even amalgamated company also. These are the conditions for amalgamation. However, the following are not mergers. What are those? Where one company acquires the property of another by purchasing it. Sir, you will not purchase the total company. You'll buy individual assets of the company. You buy their factory, you buy their land, you buy their some other investments. So you'll buy some of those assets choosily, and most of the business you only got. And maybe the market believes like you purchased that or you acquired that business, but you only acquired certain properties of the business. You didn't took the total assets or the liabilities. Total assets also you didn't took, and even liabilities not even touched. In such cases, where one company acquires the property of another by purchasing them, then that is not amounts to merger. Then a merger where property is being distributed to another company after first company is being wind up. So what is this? A Limited has 100% shareholding in B Limited. Okay, now B Limited is what? Subsidiary, right? Now B Limited winding up. When B Limited winding up, all the assets and liabilities will be given to whom? A Limited. But still it does not amount to what? Amalgamation. Because why? A merger where property is being distributed to another company after first company is being wind up. So what they do? B Limited wind up. So what of the money they got? They settled their liabilities and the total money again given to A Limited only. But this is not called as what? Amalgamation. Sorry, amalgamation. Most of the cases, the amalgamating company business will be continued by the amalgamated company. Here what the B Limited is winding up. The business is dead. Okay. Then all the assets and liabilities, whichever is realized, that is given to its holding company. Here there is no amalgamation. It need not be called as what? Merger. A Limited, sir, effect of amalgamation on amalgamating company. So amalgamating company is what? Transferor company. Which is transferring is called as amalgamating company. Effect of amalgamation on amalgamating company. Sir, here mostly from capital gain side only we'll see. Mostly. So here in amalgamation, which company is selling, which company is buying? Amalgamating company is giving their assets like selling. Amalgamated company is taking the assets like buying. So for whom capital gains will come? Amalgamating company has the capital gain situation. So the capital gains we are discussing from whose perspective? Amalgamating company. So now A Limited amalgamating with B Limited. And A Limited has transferred the assets to B Limited. A Limited amalgamating with what? B Limited. And A Limited has transferred the assets to B Limited. Now our question is what? Whether this transfer of assets by A Limited to B Limited attracts capital gains. Understand the point, sir? Whether this transfer of assets by A Limited to B Limited in the course of amalgamation, it is giving some assets, right? Is it giving freely? It gets the shares in new company, right? So purchase consideration is there, right? So then if that is the case, when assets are transferred in the course of amalgamation, will it attract capital gain? That's the question. See, amalgamating company transfers the capital asset to amalgamated company. We need to check whether amalgamation is as per 2(1)(b) or not as per 2(1)(b). What is called 2(1)(b)? 4 conditions. They should have one company merges with another, or two companies, two or more companies merges and form a new company. All the assets and liabilities has to be transferred. At least 75% of shareholders in terms of value shall become shareholders even in the amalgamated company also. Whether all those 4 conditions are satisfied, not satisfied. If they are satisfied, and the amalgamated company is a Indian company. So amalgamated company is what? The newly company. The continuing company should be what? Indian company. Amalgamation condition satisfied, and amalgamated company is an Indian company. Then such a transfer of assets in the course of amalgamation need not to be treated as transfer as per capital gains. Since it is not a transfer, no capital gains will attract. No capital gains will attract. So to exempt the capital gains, what condition should be satisfied, sir? The amalgamated company should be Indian company and the amalgamation condition should have been satisfied. What are those conditions? All the assets and liabilities has to be transferred. More than 75% of shareholders shall become shareholders even in the amalgamated company. So what if the amalgamated company is not an Indian company? Then it is a transfer, capital gains will attract. Sir, if amalgamation is not as per 2(1)(b), I mean the 4 conditions not satisfied, then also it is a transfer, capital gains will attract. So we need to be clear about when it is not a transfer. If it is not, I mean, if these conditions are not satisfied, then it is a transfer, capital gains will attract. So when it is not a transfer, when the amalgamation 4 conditions are satisfied and amalgamated company is an Indian company, then it is not a transfer. Okay, so now, sir, if it is a transfer capital gains, then we'll do normally only. Whatever is the amount paid, that will take it as sale consideration. Okay, depending on the assets. Okay, some assets will take the cost of acquisition, repairable assets, WDV. Normal way capital gains only will do if capital gains attract. So our focus is not more on if capital gains attract. Our focus is in the course of amalgamation. If amalgamations happens, what? Okay, and most of the amalgamation satisfies all the conditions. In such cases, what to do only our main focus. Instead of if it is not satisfying amalgamation conditions, if it is not an Indian company, what happens? What happens? The normal kind, how you compute capital gains only, for them also you need to calculate capital gains also. So for this part, we don't have much questions or coverage in the syllabus. Our focus is more on what? If it is not a transfer, no capital gains attract, then there are other steps also. What are the other steps? Sir, A Limited amalgamated with B Limited. It transferred assets to B Limited. It is not a transfer, right? Assuming if B Limited is an Indian company and all the other amalgamation conditions are satisfied, then it is not a transfer. No capital gains will attract. But the point is, for B Limited, so now the assets are with A Limited or B Limited? B Limited. B Limited, did it purchase the assets? Sir, it's not treated as a transfer. So if it is a transfer, in the course of amalgamation, it got the assets. It didn't acquire them actually. In the course of amalgamation, it got. Now, it became owner, but it didn't acquire those assets individually. Then what should be the cost of acquisition to the amalgamated company for the assets which were received from amalgamating company? That is the main thing. What is cost of acquisition for such assets received from A Limited? A Limited is nothing but what here? Amalgamating company. Amalgamating company taken over the assets of amalgamating company. Then what is the cost of acquisition of those assets? What is the cost of acquisition of those assets? We need to check whether they are non-depreciable assets, depreciable assets, stock in trade. Non-depreciable assets, depreciable assets, stock in trade. First, non-depreciable assets. What are called non-depreciable assets? Land. Mostly land only there. Non-depreciable assets are debtors. If anything is like debtors is there and all, but they are not capital assets. We are talking about only capital assets because capital gains will attract only if they are capital assets. What are called capital assets? Capital asset means any asset held by the assessee, whether it is related to business or not, it can be called as capital asset. It's okay. Let me go back and show you the capital asset definition also. Capital asset means what? It can be any property of any kind and any securities held by foreign institutional investors or investment fund under 115 UB. This was added. Any securities held by foreign institutional investors or any investment fund. Securities of held by investment fund or called as what? Capital asset. But capital asset excludes what? Stock in trade, personal effects, rural agriculture land, specified gold bonds and deposit certificates or special bearer bonds. Excludes stock in trade, personal effects, rural agriculture land, gold bonds and deposit certificates, special bearer bonds. Sir, here it need not to be only the immobile property, sir. It could be anything. When amalgamated company taken over the assets in its books, for what value those assets has to be recognized. That's the question here for tax purpose. What is for non-depreciable assets? We need to check amalgamation satisfies the amalgamation conditions and amalgamated company is an Indian company. Then cost of acquisition will be if they are before 1st April 2001. The general cost of acquisition for assets which were acquired before 1st April 2001. What will do? If any capital asset acquired before 1st April 2001, what will do? The original cost of acquisition or fair market value as on 1/4/2001, whichever is higher can be taken as cost of acquisition. Where it is there? In capital gains, the general cost of acquisition will take is what? When the asset is acquired, we'll check. If the asset is acquired before 1st April 2001, then we can take what? The fair market value as on 1/4/2001 or actual cost of acquisition, whichever is higher. But if it is an immobile property, we'll check even extra point also. What? Immobile properties will have stamp duty value. So the fair market value, if it is higher also, it shall be restricted to stamp duty value. You cannot take something more than that of stamp duty value. Let's say, for example, originally purchased for 10 lakhs. Fair market value 15 lakhs. So original cost of acquisition are 15 lakhs, which is higher 15 lakhs, but it is restricted to stamp duty value. If stamp duty value is only 12 lakhs, then you can take cost of acquisition as only 12 lakhs. Okay. So two steps way. Step one will do what? Original, not two steps also. First we will do fair market value or stamp duty value, which is lower. Fair market value or stamp duty value, whichever is lower, take that one. And then compare it with the actual cost of acquisition, whichever is higher, you need to take as the cost of acquisition. It's okay. Let me tell it like two steps for you, sir. Fair market value of what? Immobile property. 15 lakhs. Stamp duty value, 12 lakhs. Cost of original purchase price, 10 lakhs. Now what to do, sir? Step one, you take like fair market value or stamp duty value, whichever is lower. So whichever is lower now what? 12 lakhs. Then step two, you take step one or purchase price, whichever is higher. So 12 lakhs or 10 lakhs, which is higher? 10 lakhs, so 12 lakhs. So 12 lakhs has to be taken as what? Cost of acquisition. Okay, let me change the example, sir. Fair market value 15 lakhs. Stamp duty value 12 lakhs. Purchase price 13 lakhs. Purchase price 13 lakhs. If that is the case, again, what is step 1, sir? Fair market value or stamp duty value, whichever is lower. Lower means what? 12 lakhs. Then step 2, what we have to do? Step 1 or purchase price how much? 13 lakhs, whichever is higher. So 13 lakhs will be the cost of acquisition. 13 lakhs will be the cost of acquisition. So you need to do how sir? 2 steps. If the property acquired before 1st April 2001 is an immovable property, sir, it is a normal movable property only, then take fair market value or original cost of acquisition, whichever is higher. Sir, this fair market value on which day? 1st April 2001. Stamp duty also on 1st April 2001. Okay, and this applies only for the assets acquired before 1st April 2001. So in the coming years, sir, they'll remove this fair market value coming provision also, because there some capital gain is missing to tax. You see, you purchased in 1993 for 5 lakhs. By 2001, it became 20 lakhs. Now you're taking cost of acquisition as how much? 20 lakhs. The first 15 lakhs is missing from taxability rate. Okay, so since slowly they are removing, sir, at first, capital receipts are not taxable. But slowly they are made. Majority of capital receipts are taxable now. Indexation also has been removed. So now slowly, next what they'll do, that fair market value comparison on 1/4/2001 also will be removed. So grossly it will be easy only for us also. But client will have more taxability, that is another way. But for us to learn, it is more easy only. It will happen. Sir, if it is acquired on or after 1st April 2001, then what to be taken? Cost of acquisition to previous owner plus cost of improvement. On or after 1st April 2001, you should take what, sir? Cost of acquisition to previous owner plus cost of acquisition to, cost of acquisition of previous owner plus cost of improvement. Sir, even this also, sir, amalgamated company didn't purchase. Who purchased that asset? Amalgamating company purchased. So amalgamating company's cost of acquisition only we gonna compare. So in simple, in amalgamation, with respect to non-depreciable assets, the cost to old owner only, the cost to new owner also. Cost to old owner means whom? Cost to amalgamating company will only be taken as cost of acquisition of amalgamated company also. So even to the amalgamating company also, what will take cost of acquisition if it is acquired before 1/4/2001? Fair market value as on 1/4/2001 or actual price, whichever is higher. The same way you are taking even for the amalgamated company also. So if amalgamation conditions are satisfied, okay, and amalgamated company is an Indian company, in simple, we are doing like what? Both the companies are like same only. As if the previous company is only selling. How much will be the cost of acquisition to previous company? That only will be the cost of acquisition even to the new company. Okay, such amalgamation is an organic amalgamation in their way. So that's why they are thinking like what? So they'll not, even though the name changed, assets transferred from one place to another, they still change. Look it as what? It's not a change only. The previous owners of cost of acquisitions only will be taken as the cost of acquisitions of new owners also. Even period of holding of new owner also has to be, so period of holding of new owner to be counted as what? The period held by new owner and even the period held by previous owner. Previous owner means whom? Amalgamating company. Then depreciable assets, what value we have to take? Well, we already discussed this one, sir, in PGPP. For depreciable assets, what value we have to take? Written down value. Written down value of the block. Amalgamating company దే తీసుకుంటాం మనం. Amalgamated మనకు అక్కర్లే. We want only amalgamating companies only because those assets has to be included in the amalgamated company. But at what price you will take them into their block value? Written down value. Written down value, let's say, sir, okay, now I'll ask much more clearly. 1st January 2026 amalgamation happened. So now you will take written down value only. Written down value on which day you will take? Amalgamate అయిన రోజు తీసుకోవాలి. You will calculate again block value on 1st Jan. And then it's okay. So how much will take? Let's say, sir, the WDV plant and machinery is only there 20 lakhs. Is on when? 1st April 2025. Now on 1st April 26, A Limited amalgamated into B Limited. Now I want a simple question. In B Limited books, what value will take? In B Limited books, what value will take? WDV of plant and machinery is how much? 20 lakhs on 1st April 2025. Okay. When the succession happened? 1st January 2026. Now the assets went from whom to whom? A to B. Now in B's books, these assets has to be recognized, right? So at what value for tax purpose, these assets has to be recognized? Tell the value. You calculate and tell the value. 25 lakhs only you will take, 20 lakhs only you will take, then tell that value. The books of B Limited. Sorry, you are able to understand the question right first. A Limited, this A Limited amalgamated into B Limited. In the year starting day, of amalgamation, the book value of assets is plant and machinery 20 lakhs. Now they amalgamated on 1st January. At what value the asset should be there in the B Limited? You calculate depreciation for the full year. How much? But you need to apportionate between predecessor and successor. Okay, 365 days. How many days used by successor? Jan, Feb, March, 90 days. So here how many days? Successor 90 days. Predecessor how many days? 275. So 3 lakhs into 275 by 365. 2 lakh. 3 into 275 by 365. 2 lakh. 26,000. 0 to 7. So okay, from this 20 lakhs, subtract this depreciation. How much? 17 lakh. 7. 972. So this is the value which B Limited will take in its books. Okay. Now they have to calculate depreciation for the part year. Okay, in the year of amalgamation. How much? The balance. 3 lakhs into 90 by 365. How much? 73,972. So the closing will remain 70 lakhs in the books of B Limited. On the day of amalgamation, B Limited has to take its value at how much? 17 lakhs, 73,972 only. Then the depreciation, if you subtract, you will get 17 lakhs. Okay. It's not like B Limited will take over the assets at 17 lakhs. If it has taken over at 17 lakhs, how can it claim 73,000 depreciation? B Limited claiming depreciation, right? If it is claiming depreciation, first before depreciation only it should have claimed the value in its books. So how much should have claimed? 17 lakh 73,972 will be the value taken by the amalgamated company. On that again they'll claim depreciation of how much? 73,972. So now you'll have a question. Sir, this is like newly came na. They are used for less than 180 days only. Can we claim normally again? Sir, when there is an amalgamation, you should calculate depreciation as if there is no succession. Because here all the amalgamation conditions also being satisfied. If amalgamation conditions are not satisfied, then do in the way you what? Okay, I mean then you will take like what? Whatever the amount paid by this B Limited, that amount will be taken as the asset value and consider them as new assets purchase only and claim depreciation if they were used for more than 180 days or less than 180 days or based on that. But here what? All the amalgamation conditions are satisfied. So okay, so for the predecessor, how much ever depreciation is relatable, such depreciation subtract from the opening WDV, then the closing you get before successor depreciation is the value which has to be taken in the books of successor. Okay, then again successor will charge the depreciation, then you will get the closing WDV after depreciation for that year. Okay. So now see sir here. Assuming what? Amalgamation condition satisfied and amalgamated company is an Indian company. What? Actual cost to be taken is WDV of block of amalgamating company minus depreciation share for the year of amalgamation to, write down this sentence also sir, to predecessor. You will not subtract the total depreciation, you will subtract only the share related to whom? Predecessor. Depreciation share for the year of amalgamation to predecessor. So okay, then depreciation for the year. What we have to do sir? Depreciation for the year apportionate to predecessor and successor in the ratio of number of days used. Depreciation that we already know. Okay, the only thing you didn't have clarity is this part. Now this part is also clear, right? Okay. Then if it is stock in trade, sir, in the course of amalgamation you will take all assets. Stock also has been taken. Then cost to amalgamated company is nothing but original cost to previous owner plus if any improvements made by new owner, nothing but whatever is the cost to previous owner, same value take it into the new owner also. If he has incurred any extra cost or extra improvements, that also you add to the stock in trade also. Understand sir this part? Okay. If amalgamation is not as per 2(1)(b) or amalgamated company is not an Indian company, then what we'll do sir, for non-depreciable assets cost of acquisition is nothing but new cost. Which is new cost? The amount paid. Whatever is the amount paid for this depreciable asset, they'll fix, right? If you remember the inter-level basic amalgamation problems at least also, they'll fix consideration for what value the assets has been taken over. Book value 20 lakhs, taken over 23 lakhs. So how much ever is the taken over value, that will be taken as the purchase price. If at all, what in what cases sir, if the amalgamation is not as per 2(1)(b) and amalgamated company is not an Indian company, whatever is the price fixed in the amalgamation, that price will be considered as what? The purchase value for non-depreciable assets. Even for depreciable assets also, what will be the new actual cost? How much ever is the amount given for those depreciable assets, that will be taken as what? New cost. That will be taken as the new cost. No, not minus, it's not. So I also thought like arrow. Make it like an arrow. So I mean here new cost only will take. If condition satisfied now, what will take? Previous owner cost only we are taking mostly. But here what will take? New cost will take. What is the new cost? Whatever is the new amount they are paying, that is called as the new cost. Okay. Now depreciation related example sir. Okay. So this case, A Limited amalgamated on 1st December 2025 with what? B Limited. 1st December 2025. Plant and machinery depreciation rate is how much? 15. They have a opening block value 1 crore Editions more than or equal to 180 days, which were acquired on 1st May, 20 lakhs. Editions less than 180 days, which were acquired on 1st November, 10 lakhs. Total is 1 crore 30 lakhs. Now, what I want is like calculate the depreciation that has to be given to A Limited, predecessor, and the depreciation chargeable to successor. And additionally, at what value B Limited has to take over the assets in its books, assuming all the amalgamation conditions satisfied, and it is an Indian company. Calculate the depreciation to be taken for predecessor, successor, and what value successor has to recognize the assets in its books. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different answers. Okay, we'll lock with 10 and we'll go. Okay, and then this is not the first time we are solving this. We already did 2-3 questions on apportionment of depreciation between predecessor and successor. There, Rohit got another answer, 12,18,189. Okay, this is almost similar. 187, 188, 189. Okay, fine. Then we'll see. Sir, how it has to be apportioned, sir, depreciation? Based on the ratio of number of days used. Okay. First, we'll calculate depreciation as if there is no succession. Opening block 100 lakhs, on that how much? 15 lakhs. Additions more than 180 days, 20 lakhs. 20 lakhs into 15%, 3 lakhs. Additions within 180 days, 10 lakhs. Since these are used for less than 180 days, restricted to 7.5 only, 75,000. This is as if there is no succession. Now take this depreciation and apportion it between predecessor and successors in the ratio of number of days used. Sir, the opening block is there throughout the year. So A Limited has used for, sir, how many days, sir, from succession? 31 days in December, January 31 days, February 28 days, March 31 days. So total B Limited has how many days? 121. Out of 365, 121 days used by B Limited, 244 days used by A Limited. So 15 lakhs into 244 by 365. You'll get how much? 10 lakh 2,740. Then 15 lakhs into 121 by 365. You'll get how much? 4 lakh 97,260. So this one done right for everybody. Then additions. Additions related, what is the depreciation, sir? 3 lakhs. But you cannot apportionate it using 244 and 121. Why? Because how many days this asset has been used? This asset only acquired on 1st May. So you cannot apportionate it by taking the basis of 244 and 121. You need to first figure out how many days this asset has been used. 365 is the total year, sir. It was not there in April. If you subtract 30, how many days this asset has been used? 335 days only used. So within this 335, we need to find out the ratio. So the success are common, 121 days only. So 335 minus 121. How many days, sir? 214 days. So now what you will do? This 3 lakhs into 214 by 335. This 3 lakhs into 121 by 335. You'll get how much as the depreciation, sir? 1,91,642. Here 1,08,358. Then the last one, 75,000. When this is purchased on 1st November 2025. That means for the 121 days, extra 1 month. So total how many days this was used? 151 days this one used. Okay. So I'm writing here number of days each asset has been used also here. It is used for 365 days. It is for 335 days. Whereas this is for 151 days. Out of 151 days, A Limited used 30 days, B Limited used 121. So 75 into 30 by 151. How much? 14,900. Here 60,100. So what is the total depreciation? 12,09,282. 6,65,718. So what is the depreciation to predecessor, sir? 12,09,280. So okay, here there is one correct answer. 12 lakh. Who given this answer? Prasad. Okay. 12,09,280. So I got 13 lakhs. You all are out of coverage area. అయితే మార్కులు వేస్తారా ఏంది ఏంటి ఓకే సో వెన్ దర్ ఇస్ అన్ అమాల్గమేషన్ యూ నీడ్ టు అపోర్షనేట్ as if there is no succession, but based on ratio of number of days used means you cannot take the total block and apportionate. You need to apportionate it what? Openings wise separately, additions separately, additions also more than 180 days separately, less than 180 days separately. Why? Because all the assets were not used for the same period in the year. Okay, so the ratio of number of days is not common for all the assets. Since the ratio of number of days is not common, we have to take them separate as the base. Got it? Everybody understood, sir, now? Okay, but realize we got in the class itself 3, 4, 5, 6, 7, 10 different answers. So Mauli, where you got like number of day wrong? Sorry, you got 12,18. Huh? Here also 244 you took. Okay. Then what else? Mac, where you went wrong? Calculation mistake. Days wise correct only. Yeah? Days also gone. Then who got this 12,09,452? 12,09,452. Okay, Shruti set. You're almost close. So maybe the days wise mistake. For you? No need. Saying 600 difference, right? So counting mistake. ఆ రోజు యూజ్ చేసినట్టే కదుకుంటే అలాంటివి ఏం లేవు. డోంట్ మిక్స్ ఐడిటీ హియర్. So, okay, so what will be the value of, what will be the B limited price, sir? So total 1 crore 30. From there subtract this 12,09,282. From 1 crore 30, if you subtract 12,09,282, what is the value of B limited? At what value B limited has taken over? 1 crore 30 minus 12,09,282. They clearly said in the provision, ratio of number of days used. When they said in the provision days, how can we take in months? Income Tax Act is not written by SI. Whatever they wrote, we need to follow. We don't have the luxury to change it as per our convenience. There will be difference when you take ratio of number of days instead of days. If you take month, how do you apportionate if it is in the middle of the month? The succession is happened, or in the middle of the month asset has been purchased. Then again, you need to take further assumption. Part month has to be taken as full month, or has to be ignored, or part month has to be considered like how. So total, again, that process will become big. Okay. Sir, understood, sir, this one? Okay. It's okay. So what is the actual cost of depreciation all assets to be taken by B limited? WDV of previous owner 1 crore 30 lakhs. From there subtract 12,09,282. Cost to B limited is how much? 1 crore 17,90,718. Depreciation to B limited is how much? 6,65,718. Subtract. Then the closing WDV is how much? 1 crore 11,25,000. Then effect of amalgamation to shareholder. Sir, why shareholder also has effect? Sir, shareholder, his shares are being exchanged. Let's say you have shares in A limited, but A limited amalgamated into B limited. Now which share you'll have? B limited. Your A limited share is lost and you got B limited share. So which also come under the definition of transfer. Which also comes under the definition of transfer. So you got exchanged with A limited share to B limited share. So it is also comes under what? Transfer. No capital gains has to be calculated even for shareholder. But what? If amalgamation conditions are satisfied and amalgamation company is an Indian company, if shareholder gets only shares in the amalgamated company, then it is not a transfer, no capital gains. If instead of shares some cash or other asset has been given, then it is a transfer, capital gains has to be computed. Sir, if it is not a transfer, let's say, sir, you are give away your A limited share and you got what? B limited share. Now you didn't purchase the B limited share. What you purchased actually? A limited share. But what you are having is B limited share. So what is the cost of acquisition for you for B limited share? The previous company acquisition, the previous share purchase price only will be taken as the new share acquisition price also. Cost of new share will be the cost of acquisition of old share. The period of holding of new share shall also be taken as period of holding of, shall also count the period of holding of old share also. Understand, sir? So even for a shareholder also, when the shares got exchanged in the course of amalgamation, it is not a transfer, no capital gains will come when amalgamation condition satisfied. Amalgamated company is an Indian company and he didn't receive the consideration in cash or some other thing. He got only the shares in amalgamated company. Okay. Sir, if amalgamation conditions are not satisfied, then that is exchange of shares only, it is a transfer, capital gains will attract. Then amalgamation of foreign company. Sir, why foreign company amalgamates for us? Sir, a foreign company amalgamates with another foreign company. But in the process, this foreign company has capital assets or shares investments in India. So in the process of amalgamation, Indian assets are being transferred. So what they are saying, amalgamates with another foreign company and the capital assets transferred, they are nothing but shares held in Indian company, or they are shares of a foreign company only. But that share of a foreign company will derive its value directly or indirectly, substantially from the shares or share of an Indian company. Sir, this is, let's say, A incorporation, B incorporation. So A incorporation amalgamated into B incorporation. You are not transferring directly the Indian share. You are transferring C incorporation share. This A incorporation has shares in C. Now when it is amalgamating, A is giving all the assets to B, right? So even the shares held in C incorporation also given to B. But now C incorporation shares are getting their value only from an Indian company share. Understand what? So the C incorporation has a 100% subsidiary in India called R Limited. The C incorporation has a 100% subsidiary in India called as what? R Limited. Now based on R Limited performance only, C Limited. C incorporation will not do any business. It just invested in R Limited. Okay, it's just pulled money and invested in R Limited. It doesn't do any business. Then what if R Limited share price increases? Then C incorporation share price also increase. So both are proportional. So see, share of a foreign company only, share of C incorporation, but which derives its value directly or indirectly, substantially from the share or shares of Indian company. So this is like classic example of Vodafone case law. Provided the following conditions are satisfied. When more than or equal to 25% of shareholders in amalgamating foreign company shall become shareholders of what? Amalgamated foreign company. Minimum how much, sir? 25% or more shareholders shall become the shareholders in the amalgamating company also. And then such a transfer shall not attract capital gains in the foreign country. Let's say this transaction, sir, this amalgamation happened in UK. Okay, in UK this amalgamation is not a transfer and no capital gains will attract. Then, see what are the conditions? Second condition is what? Such a transfer shall not attract capital gains in the foreign country where amalgamation company incorporated, where Vodafone incorporated UK. So in UK this transaction is not taxable and 25% of the shareholders are continuing even in the amalgamated company, then it is not a transfer. If only 5% shareholders are continuing, then it is a transfer, capital gains has to be calculated. If none of them are continuing, all the Hutch company shares or Hutch company shareholders got settled with money only, they didn't get any shareholding in Vodafone, then it is not a transfer, capital gains has to be computed. Okay, see, A Incorporation USA amalgamates with B Incorporation UK. Okay, in the process, what it do? It transfers M Limited share. M Limited share. M Limited share means what? Directly Indian company share is being transferred. That is first one. Second one, A Incorporation amalgamates with B Incorporation, but it transfers X Incorporation share. But X Incorporation is a Singapore company which owns D Limited. So now the D Limited share value based on it, substantially X Incorporation share value also gets impacted. So directly not Indian company share transfer. Foreign company share only got transferred. But that foreign company share value is derived from an Indian share. Then also it comes under here. But however, if at least 25% shareholders voting power is continuing and such transfer is not taxable in the country where the amalgamated company is incorporated, that is not a transfer. Okay. So you can take break, sir. Post break again we'll continue with this. Section 72A, set off and carry forward of business loss and unabsorbed depreciation. Amalgamation of a company owning industrial undertaking, a ship or a hotel with another. So nothing but wherein a company amalgamates with another, which is an industrial undertaking, a ship, a hotel with another, a banking company with a specified bank, one or more PSUs with another, one or more PSUs. Sir, this one, sir, understand little clearly. Erstwhile PSU. Sir, erstwhile PSU, previously it used to be PSU. No, not. That means what? Government has disinvested. So government has reduced its stake from 51% to somewhere 30%, 20%. So it's an erstwhile PSU. But usually, sir, when government start disinvesting, see, we can see when the Vizag Steel is being privatized, I mean, when the central government announced like we are thinking of privatizing the Vizag Steel, then there is a lot of negativity or from the people as well as from the oppositions and all. So usually why even the employees will also be not accepting or will not be welcoming such kind of things, because when private people came now, so they know they have to work more, they need to put extra efforts and all, so they cannot have all those perks, benefits, enjoyments and all once it was into the private control. That's why usually they'll resist when the central government is trying to disinvest. So what central government will say usually, when an PSU amalgamates with erstwhile PSU amalgamates with one or more companies, if share purchase agreement under strategic disinvestment restricts immediate amalgamation. I mean, when central government is disinvesting, it made an agreement like what? That you should not amalgamate with some other companies for a cooling period. It may be 5 years, 6 years, some period. Okay. So here, this erstwhile PSU amalgamated with one or more companies. If share purchase agreement under strategic disinvestment restricts immediate amalgamation and it is happened within 5 years from the end of the previous year in which restriction ends. So the amalgamation of an erstwhile PSU happened when within 5 years from the end of restriction period. That also. Sir, here what is not covered? Industrial undertakings covered, ship covered, hotels covered, banks covered, PSUs covered. A trading company, a service-oriented company is not covered here. Okay, so understand these points. Amalgamation of a company owning industrial undertaking, ship, hotel, a banking company, one or more PSUs. Okay, but what is not covered? A trading company not covered. A service-oriented company not covered. Industrial undertaking now mostly it is into what? Manufacturing, ship. It owns a shipping company or a hotel related. Only the hotels related is the service covered. Rest all the other companies like let's say BCCA kind of. Okay, which is providing the coaching services and all. So these companies nowhere mentioned here. Banking companies mentioned and PSUs mentioned. So when they got amalgamated with another, the accumulated business loss, okay, other than non-speculative, accumulated business loss other than non-speculative and unabsorbed depreciation of amalgamating company, okay, can become loss or can be claimed as depreciation for amalgamated company also for another 8 years. So understand, sir, the loss of, sir, be clear here, there is an amendment also. Okay, first listen, then you can understand the amendment also. Sir, A Limited amalgamated into B Limited. The amalgamation happened in 25-26. Okay. Now A Limited has accumulated business loss. From past there is a loss. So A Limited has assessment year 21-22 related loss is also there, 30 lakhs. Now A Limited is amalgamating into what? B Limited. Now the losses of A Limited can be carried forward by whom? B Limited. How long B Limited can carry forward? B Limited can carry forward fresh 8 years. That means from 25-26 is what previous year. Assessment year is what? 26-27. From here another 8 years this loss can be carried forward. Not from the original year of loss. That used to be the provision. Now for this they made an amendment. Amendment made and said like what? You cannot carry forward fresh 8 years. You can only carry forward 8 years from the first year in which loss was reported. When the loss was first reported? 21-22. So from there 8 years only. Okay, not from succession day another 8 years they can carry forward. So usually business loss can be carried forward for how many years? 8 years. But here actually there was it was not properly framed 72A when it was originally framed. So it gives a chance of what? They can carry forward the loss for fresh 8 years from the date of amalgamation. Okay, instead of already 7 years might have lapsed. Now only 1 year pending. But now since succession is happened, amalgamation is happened, they can carry forward for another fresh 8 years. So overall they are getting benefit of 15 years benefit, loss carry forward. Okay. So the company is using that as an means for tax avoidance. The companies which are having so much of accumulated losses and all, they are amalgamating with another company so that they can carry forward all these loss for an extra period of time. Okay. Now to control this, they have changed the provision and said like what? You cannot carry forward fresh 8 years. from the year in which loss was originally reported. From there only 8 years. So let's say already 5 years completed. Now from succession only 3 years are there. Then you can carry forward another 3 years only. Already 7 years left. Then you can carry forward only another 1 year only. If already 6 years left, then you can carry forward another 2 years only. Okay. See, the first one is before amendments are this one. This is what before amendment. What? A Limited has loss in previous year 21-22. That means what? Assessment year 22-23. Normally it can be carried forward for how many years? 8. 8 means what? 22-23 year loss plus 8 years. 23-24, 24-25, 25-26, 26-27, 27-28, 28-29, 29-30 and 30-31. So normally carry forward can be made up to assessment year 30-31. Okay, but amalgamation happened in the previous year 25-26. That means assessment year what? 26-27. Before amalgamation, this loss can be carried forward for another 8 assessment years from 26-27. That means what? 27-28, 28-29, 29-30, 30-31, 31-32, 32-33, 33-34, 35-36. Till 35-36 can be carried forward before amendment. Now what amendment says? The business loss or unabsorbed depreciation can be carried forward and set off by amalgamated company. Unabsorbed depreciations are previously also any number of years. Unabsorbed depreciation has no limit. Only for depreciation there is a limit of what? 8 years. Unabsorbed depreciation can be carried forward for any number of years. Normally also the same provision, right? Unabsorbed depreciation we can carry forward for any number of years. So even with amendment also unabsorbed depreciation remains same only. It can be carried forward for any number of years. But business loss can be carried forward to max of 8 assessment years succeeding the year for which such loss first computed for a predecessor entity to the predecessor. When the first year the loss was reported, from there count 8 successive assessment years. Okay. And this provision applicable for amalgamations which were taken place on or after 1st April 2025. If the amalgamation is happened before 1st April 2025, then the old provision is only continuing. From there fresh 8 assessment years. From 1st April 2025 if amalgamation happened, then they will not get fresh 8 years. From the year originally the loss reported, from there 8 assessment years only. Okay, look at the examples now. Company A has a loss of for assessment year 16-17. Sir, loss for assessment year 16-17. See how it was matched. See, company has a loss related to what? Assessment year 16-17. Sir, 16-17. How long it can be carried forward? 8 years means 17-18, 18-19. Leave first year leave and count 8. 17-18, 18-19, 19-20, 20-21, 21-22, 22-23, 23-24, 25-26. Now what happened? They had a merger in 1st November 2020. Okay, now company B can carry forward it for how many years? Fresh 8 assessment years. So 8 assessment years from where? In year which merger happened? 2021. Assessment year 21-22. Again it got fresh 8 assessment years. Now company B again merged on 1st March 2025. Sir, when this provision applies? 1st April 2025. So again the second merger happened on 1st March 2025. Now even company can C also can carry forward this company A loss which came to B, and that also can be carried forward for another 8 assessment years. See, here 8, here 8, here 8, here 8. So total 24 years they can carry forward the losses if they frame amalgamation in such a way. Or at least here 7 years, here 7 years, here 8 years. Minimum how many? 22 years they can carry forward the loss if they can properly structure the amalgamation. Okay, so this is an undue benefit, right? The law does not originally intended that thing, right? But the business is exploiting the loophole in the law and they were carry forwarding the losses. In such a way they are framing the amalgamations. Now the amended loss is what? Company A has loss on 16-17. Same. Merged on 1st November. Already carry forwarded. Now company B merged into company C on 1st May. 1st May 2025. Sir, now what? Not when the from company B. Which is the entity having the first loss reported? BIA na. A is the entity which reported loss first time. So count number of years for company A. 17-18, 18-19, 19-20, 20-21, 21-22, 22-23, 23-24, 24-25. This happened in 26-27. Already 8 years lapsed. So now even with this merger it cannot carry forward anything because the loss is related to 16-17. Already 8 years completed. Now with this new merger they cannot even carry forward for a single year also. Okay, sir, look at the wording here. Which such loss first computed for predecessor entity? First computed, sir, we are not even taking company B related. It is first reported by whom? Company A. So for company A we should count how many years? 8 years. So for company A, if you count 8 years, by 25, 26, 27, already 8 years lapsed. So nothing they can carry forward now. But before amendment, still they can carry forward for another 7 years or 8 years. Now just 1 year before if they amalgamate, again they can. So this chain continues only. Forever they can carry forward the losses also without amendment. If they can properly plan the amalgamation. But with the amendment, they have addressed such thing also. Okay. So but to carry forward these losses and set off these losses, sir, there are certain conditions. What are those? Amalgamating company should be into the same business at least 3 years in which the loss or depreciation was occurred. To carry forward and set off the losses, the amalgamating company should be into the same business for minimum of 3 years. And amalgamated company also shall continue the same business for another 5 years. It must continue the same business for at least 5 years from date of amalgamation. And then amalgamating company should hold at least 75% of the book value of fixed assets minimum 2 years prior to amalgamation. Out of the total assets, before amalgamation or on the date of amalgamation, at least 75% should have been held for the last 2 years. And even amalgamated company also shall hold more than or equal to 75% of the book value of assets of amalgamating company for at least 5 years. Sir, successor has to continue the business for 5 years, has to maintain 75% of the assets also for 5 years. Whereas predecessor, sir, business should be carried out previously 3 years at least, and the asset should be held at least 2 years. How much, sir? 75% of the total asset should be held even by the predecessor for at least 2 years. If any conditions are not met, then the loss or depreciation which was set off. So first year you continue the business, second year you continue the business. In first to second years, the predecessor's loss, depreciation you have set off. But in third year you are not continuing the business. Then what happens? If any conditions are not met, the loss or depreciation set off in previous year will be treated as income and taxed in the year in which conditions are violated. So now 35DD. Expense incurred in case of amalgamation or demerger. This we already discussed this in PGBP also, and once again, sir, with respect to amalgamation and demerger, if any expense is incurred. If SSE is an Indian company, then expense incurred on amalgamation, on satisfying the amalgamation conditions only, sir, and demerger, and no deduction for this expense is claimed under any other section, then deduction can be claimed. How much, sir? 1/5 in the year of expense and balance in 4 immediately succeeding previous years equally. Sir, this is for whom? Not for the predecessor, for the successor company. Predecessor company, it won't be there for 5 years. So it's for whom? The newly formed company, successor company has any amalgamation expenses, it claims the expenses as deduction not in 1 year, can claim deduction in 5 equal installments. Okay, then other provisions. If amalgamation is as per 2(1)(b), amalgamating company is Indian company, then if any unabsorbed scientific research expenditure, then VRS expenditure, sir, why VRS, can be taken in 5 installments. So let's say you claimed only 2, other 3 pending. Preliminary expenditure, that also 5 installments. Let's say you claimed only 2, other 3 are pending. Capital expenditure on promotion of family planning or telecom spectrum license. Sir, telecom spectrum license, how do you claim? Over the tenure of the license, you will be amortizing. So that parts, if any are still pending on the date of amalgamation, unamortized amounts are there, that can be taken as deduction even by the amalgamated company. Okay. So now we can solve questions, sir. Come to workbook. So read this question and just write it like a chart. Who is the first owner, from whom to whom transferred, and then from whom to whom it is transferred. Finally, who is the owner? Like that, first to find out the chain. In this question, the asset was transferred multiple times. You just establish the chain. First purchased by whom, second given to whom, third whom, like that the chain established first. Sir, here on the amendment is there now, so amendment has to be focused. There's a chance of testing from the amendment also. Okay, there, we don't have any questions, but I explained amendment also properly. So it is important point for exam. Sorry. So look at the questions. Joseph has 1,000 equity shares of X Limited that he acquired on 17th August through will of his father. So he didn't purchase. How he got? Father. Father acquired such shares on 17th July through gift from his father-in-law. So he also didn't purchase. Came from whom? Father-in-law. Okay. Now father-in-law is Z. Z acquired when he such shares? 2,000 for 20. Okay. Fair market value of such shares is like 18. Okay, given. Now what happened? 31st March 2014, X Limited amalgamated with Y Limited, and the amalgamated company issued its 3 shares. See, now what happened? First year, X Limited amalgamated with Y Limited. Okay. Now how you got X Limited share? X Limited share is held by Joseph. But how Joseph got? Through will of his father. How his father got? From his father-in-law, Z. So originally acquired by whom? Z. Z acquired when? 18th August 2000. For how much? 20. Sir, before 1st April 2001, what we have to take? Fair market value as on 1/4/2001 or original cost of acquisition, which is higher? 20. So 20 is only the cost of acquisition of father. Father's cost of acquisition is only Joseph's also. So Joseph's cost of acquisition is also what? 20. Because the cost of acquisition of previous owner. Now, how many shares he has? 1,000 shares purchased for 20. Now what happened to this 1,000 shares? X Limited amalgamated with Y Limited and issued 3 shares for every 2. So for 3 shares for every 2, now 1,000 by 2 into 3. How many shares he got? 1,500 shares has been got. Now Joseph sold 1,000 shares only, not 1,500. He still has how many shares? 1,000. So how many shares? For what price he sold? 1,000 into 38. So 1,000 into 38 now how much, sir? 38,000 is the sale consideration. But the cost of acquisition is how much? 20, yeah? Sir, cost of acquisition for share 1,000 shares is 20. But do we had only 1,000 shares in Y Limited? For losing 1,000, he got how many? 1,500. So 1,500. So what we have to do? 1,000 into 20 divided by 1,500. You do how much you will get? 13.33 is the cost of acquisition for share in Y Limited. Because for 1,000 shares he got 1,500. Now the 1,000 cost has to be apportionated to 1,500. If 1,000 is 20, 1,500 is how much? 13.33. So now how many shares he sold? 1000 only. So 1000 into 13.33 if you do, you will get the cost of acquisition as how much? 13,333. Then the long-term capital gain is 24,667. So okay, don't ask me about indexation. Indexation is no more applicable. Okay, sir. Then we are moving on to next question. So read question number 2. So question number 2 is a full-fledged question, sir, regarding amalgamation. So we need to do it in 3 situations also. First, try to understand the question. Read it for 2 minutes. Try to understand the question. Then we'll solve it. So read the question now. Examine how do you treat the following items when X Limited is merging with Y Limited. Sir, one correction, sir. This 35DD, what we said. Expense incurred in case of amalgamation or demerger. Whoever the company, sir, there is no clarity about whether it is amalgamating company has to incur or amalgamated company has to incur. Okay, let's say for example, A Limited merged into B Limited. But the expense of amalgamation is met by A Limited to the tune of 30 lakhs. Now, can the A Limited claim the total 30 lakhs in 1 year? This provision says like what? Only in 5 installments you can claim. But from next year, A Limited will not be there. It dissolves. Then what happens? Even this expense also can be claimed by whom? B Limited for the balance 4 installments since it is a succession happened. Understand, sir? So it could be claimed by A Limited or B Limited, whoever incurs the expense. But if this amalgamating company is no more, is not going to be there in the next years, then such expense can be claimed by the successor company. Okay. So here understand. Expense incurred on amalgamation or demerger, no deduction claimed under any other section. Deduction is what? 1/5 in the year of expense, balance in immediately succeeding previous years equally. Now coming back to the question. Examine how do you treat the following items when X Limited is merging with Y Limited. First one what? 72A also not satisfied. I mean no set off carry forward. 21B also not satisfied. Okay, first we'll go with X Limited is amalgamating with whom? Y Limited. X Limited business profit before adjusting losses and expenses how much? 60. Expenses on merger not available for deductions are why? Amalgamation conditions are not satisfied. Look at the point here. Only if amalgamation conditions are satisfied, then we'll get the deduction. Since amalgamation, sir, in the first option we are doing, this cannot be claimed as deduction. But VRS compensation, no restriction. How many installments? 5 installments. It is related to which year? 22-23. Current year is what? 25-26 previous year. So 22-23 first year, 23-24 second year, 24-25 third year. This is 25-26 only fourth year. So still here installment being claimed. How much installment allowed, sir? 4 lakhs by 5. How much can be claimed? 80,000. Okay, so business income is how much, sir? 60,000. From there, you can claim VRS up to 80,000, but the profit is only up to 60. So you claim 60 only. Profit became how much? 0. And still there is a VRS compensation to be made, 20,000. Then sale consideration of non-depreciable assets and indexed cost of acquisition or cost of acquisition is how much? 12 lakhs. Sir, with respect to assets, what do you have to do? Capital gain has to be computed because it doesn't satisfy the condition of amalgamation. So capital gain also has to be calculated. How much? 20 lakhs sale value, 12 lakhs cost of acquisition. How much is the capital gain? 8 lakhs. And for depreciable assets, 10 lakhs is the cost of acquisition. WDV how much? 7 lakhs. So if you subtract, how much is the capital gain? 3 lakhs. This is short-term capital gain. Okay. Then non-speculation business, can it be carried forwarded? Non-speculation business losses, can it be carried forwarded? What they said, 72 is not satisfied. So no loss can be carried forwarded. Unabsorbed depreciation can be carried forwarded, sir. No, sir. Unabsorbed depreciation also we cannot carry forward if 72A conditions are not satisfied. Even from predecessor to successor also, either business loss or unabsorbed depreciation. You can transfer it to successor only. The conditions are transferred. The conditions are transferred. Where it is possible, sir, return of income related, where we said even though it is belated return, unabsorbed depreciation can be still carry forwarded. But in the case of amalgamation, unabsorbed depreciation cannot be carry forwarded. If it is eligible to carry forward, indefinite period. But it cannot be carried forward if amalgamation conditions are not satisfied. Not only business loss, even unabsorbed depreciation also cannot be carried forwarded if amalgamation conditions are not satisfied. And one more point, unabsorbed depreciation. If you remember assessment of companies chapter, there for closely held companies, there used to be loss and unabsorbed depreciation, but later on there is a change in shareholding. Even though there is a change in shareholding, what I said, loss cannot be carried forwarded, but unabsorbed depreciation can be carried forwarded. What year? Business profit 60,000. VRS 1/5 80,000. Still business loss is of how much? 20,000 is there. Okay. Now computation of capital gain. What is the capital gain here? 20 lakhs is the sale consideration. From there, indexed cost of acquisition 12 lakhs. If you subtract long-term capital gain or short-term capital gain is how much? 8 lakhs. Then sale consideration of depreciable assets is how much, sir? 10 lakhs. WDV of depreciable assets is how much? 7 lakhs. So from 10, if you subtract 7, what is the long-term, short-term capital gain, sir? 3 lakhs. Now if you see here, sir, in the year of loss, you cannot carry forward these losses to successor. But this can be set off with whom? Predecessor himself, right? Sir, these losses cannot be carried forward to successor. Why? Because amalgamation conditions are not satisfied. But if these losses, if there is profit with the predecessor only, then with the predecessor this can be set off, right? Okay, so now what happening? See, with the long term, this long-term capital loss has been set off 2 lakhs. With the short term, this business loss 20,000 has been set off. So how much we are having, sir? Then the long term capital gain still 6 lakhs is there, and this unabsorbed depreciation is also set off. Then how much is there short term? 1 lakh 30. Sir, this non-speculation loss alone can't be set off. Why it can't be set off? Business loss, once it is carried forwarded, it has to be set off within the same head only. A carry forwarded loss is eligible only for intra-head set off. That's why if you have business loss related to 22-23, it can be set off only with the current year business profit. If you have any business profit here, nothing. So you cannot set off anything, this 3 lakhs leave. Now coming to this unabsorbed depreciation. Sir, what we discussed about unabsorbed depreciation in PGBP, even though it is brought forwarded, it has to be treated as current year expense. Since it is like a current year expense, it is eligible even for inter-head adjustment also. So this 1,50,000 claimed from short term. Then long-term loss. Sir, long-term capital loss can be set off only with long-term capital gain. That's why this 2 lakhs has been set off. So current year business loss set off with short term. Current year unabsorbed capital depreciation also set off with short term. Sir, why with short term only set off? Sir, these two can be set off even with long term also. Na? Yes, they can be set off even with long term also. But short term has more tax rate. It is better for us to adjust with short term only than that of adjusting with long term. Are you able to understand, sir, here? Then Y Limited. Sir, for Y Limited also the given income, sir, how much? 30 lakhs. Then, for what value the depreciable assets are sold here? 10 lakhs, right? And amalgamation conditions are not satisfied. That means new entity Y Limited will be assumed as taken over these assets for how much? 10 lakhs. If amalgamation conditions are satisfied, then what we'll do? WDV minus depreciation share of predecessor, that will take as the cost of acquisition of Y Limited. But here amalgamation conditions are not satisfied. So whatever is the sale consideration, that will be taken as the purchase price of whom? Y Limited. So Y Limited, 10 lakhs purchase price, 15% is the rate. And when the amalgamation happened, sir, it happened on 1st January. So Y Limited used for less than 180 days. That's why 10 lakhs into 15% into 1 by 2, 75,000. PGBP income is 29 lakh 25,000. Long term 3 lakhs if you subtract, total income is how much? 32 lakh 25,000. This is in which case, sir? When both the conditions are not satisfied. Now second one. Condition under section 2(1) satisfied, but 72(a) does not satisfy. I mean, amalgamation condition satisfied, but set off carry forward conditions are not satisfied. What are the extra conditions in set off and carry forward, sir? Same business has to be carried forward for another 5 years. The same assets has to be continued at least 75% for another 5 years. Those conditions not satisfied. Okay, let's see. Sir, in second case, what happening? Conditions of 2(1) are satisfied. When conditions of 2(1) are satisfied, then amalgamation condition satisfied. So it is not a transfer. No capital gains will attract to X Limited. So now see at X Limited. First business income how much? 60,000. Then share of merger expense also they'll get. Why? Why share of merger expense? Because amalgamation conditions satisfied. That can be claimed in 5 installments of 40,000. VRS 80. Now the business loss is how much? 60,000. And even they can claim depreciation also here. Sir, why not previous case depreciation? Sir, depreciation in the previous case, you are assuming like the assets has been sold. When you sold the assets, you cannot claim depreciation because you can claim depreciation only when the block is continuing. When the block ceases to exist, you cannot claim depreciation. In the previous case, since it does not satisfy amalgamation conditions, there the block ceases to exist, so we lost depreciation. But here block continues to exist only because amalgamation conditions are satisfied, so you can claim depreciation also. So 7 lakh into 15 into 275 by 365. Why 275 by 365? 275 days used by predecessor, balance used by successor. So merger expense 40, VRS 80, then depreciation we are keeping separately. Why? Because the profit is not enough to charge depreciation, so we are keeping this separately as unabsorbed depreciation only. Now, no capital gain at all, sir. Why? Why? Because there is no transfer, no capital gain at all. So these losses cannot be set off because there is no capital gain. Now, the question is, does 72(a) condition satisfied or not satisfied? Not satisfied. So this long-term capital loss, this unabsorbed depreciation, non-speculation business loss can be carried forward or not is the question. See. Since the 72(a) conditions are not satisfied, what happens to the Y Limited, sir? Again, business income how much? 30 lakhs. Depreciation is differing. See, sir. Previously, we calculated depreciation on 10 lakhs. Now, we will not calculate on 10 lakhs. Okay, sir. Actually, here 7 lakhs into 15 into 90 by 365. Okay, you'll get the same answer. But actually, how it should be, he should not recognize it as 7 lakhs. For what value he should recognize, sir? 7 lakhs minus 60,000. How much the value you have to recognize? 6 lakh 40,000. But depreciation computation is correct only. Why? Because he is calculating only for the 90 days period only. Sir. Total year, full year depreciation will be how much? 7 lakhs into 15%. 7 lakh into 15%. How much? 1 lakh? 5,000. Okay. Here already how much depreciation came? Predecessor. 79,110. Subtract. How much balance is there? 25,890. That only claimed by successor, right? Sir, able to understand, sir? If there is amalgamation condition satisfied, the depreciation has to be apportioned between predecessor and successor in the ratio of number of days used. Okay, so total depreciation they can claim if there is no amalgamation is how much? 1 lakh Total depreciation they can claim if there is no depreciation. Succession is how much? 1,05,000. Predecessor already claimed how much? 79,110. Then successor will get how much? 25,890. Clear? Now the PGBP is how much? 29,74,000. And long-term capital gain 3 lakhs. Total is how much? 32,74,000. This is second case what? Amalgamation satisfied. 72A not satisfied. Now third case, both satisfied. Then again, X limited no capital gain. Why? Amalgamation condition satisfied, no capital gain. Business income remains same only, sir. 60,000. Merger 40. VRS 80. So 60,000 and depreciation 79,110. So X limited no change at all. But what extra thing is now? Since 72A condition satisfied, we can carry forward the losses. See, business income 30 lakhs has been. Business income 30 lakhs of Y limited. From their depreciation, just like as previously, only 25,890. Now what is happening? The losses of X limited can be carried forward to Y limited. First we need to adjust what, sir? Current year depreciations. Current year loss and current year depreciation. Current year 60,000, 79,110 adjust. Then brought forward business loss. Then brought forward depreciation also you can adjust. So how much you can adjust, sir? 23,85,000. Sir, what about long-term capital loss here? This long-term capital loss you cannot carry forward because 72A talks about only what? Unabsorbed depreciation and business loss only. It does not talk about capital loss being carry forward. So which two you can carry forward? Business loss you can carry forward and set off to successor, and business brought forward depreciation also you set off. Then the PGBP income is 23,85,000 plus long term 3 lakhs. Successor income is 26,85,000. Sir, 72A has been satisfied. Because of that, what is happening? X limited has 79,110 loss, unabsorbed depreciation for current year depreciation, and 60,000. Okay, now what is happening for Y limited? 25,890 you adjusted already. This 60,000 also you can adjust because 72A conditions has been satisfied. Then this 79,110 also has been adjusted, and even brought forward loss. How much is the brought forward loss, sir? 3 lakhs. And then brought forward depreciation 1,50,000 also can be set off. Then the balance is how much? 23,85,000, which is not eligible for set off. Long term capital loss. Why? Because the provision 72A will talk about only what? Business loss and unabsorbed depreciation. It does not permit to carry forward to the successor other losses. Only these two are permitted to carry forward. Understand, sir? Okay. So do this question once again, sir, because this question gives you proper clarity about when both are not satisfied, when both are satisfied, when only amalgamation satisfied and 72A is not satisfied. So do this question today for sure. Section 72A, section 79. Carry forward of loss and unabsorbed depreciation. In the case of succession. 79. Restriction on carry forward of loss. When there is change in shareholding. Sir, this where we discuss section 79. Section 79, if you remember, we have discussed this in assessment of companies. We solved a problem also there. The first PGBP question is on this only. If you have did the PGBP question, the first question links with this point. 4 shareholders will be there. So that point related. Assessment of companies chapter will get this point. This is normal. So what we says like here, this talks about allowability. This talks about restriction. Here what? Loss can be carried forward for 8 assessment years from the first year. Which loss reported? Unabsorbed depreciation, sir. Is there any time limit or restriction for unabsorbed depreciation? Any number of years. But here restriction is what? When change in shareholding is more than 50%, because there they says like what? At least 51% should remain. Here what we are saying like more than change in shareholding is greater than or equal to 50%. Sir, when 50% changes also, then the balance will be only, unchanged will be only 50. But to satisfy the condition, how much should be their minimum? 51%. Okay, when change in shareholders is greater than or equal to 50%, then business loss cannot be set off. Business loss cannot be set off. However, it not applies to unabsorbed depreciation. However, it not applies to unabsorbed depreciation. However, it not applies to unabsorbed depreciation. So you got the clarity. So under 72A covers both unabsorbed depreciation and losses. So if 72A conditions are not met, both loss also cannot be carried forward, depreciation also cannot be carried forward. When 79 conditions attract, only loss cannot be carry forward, unabsorbed depreciation can be carry forward even though change in shareholding is more than 50%. So what I want to communicate is like in 72A, if conditions are not satisfied, not just loss, even unabsorbed depreciation also can't be carry forwarded and eligible for set off. First, 17.2a talks about allowability of set off. 79 does not talks about allowability of set off. It restricts the allowability of set off because there is a change in shareholding. But that restriction not applicable only to business loss, not applicable to unabsorbed depreciation. It's okay. So we have solved question number 2 also, sir. So we'll solve quickly question number 3 also, then we'll go to next questions. Sir, I asked you to redo once again question number 3. Any of you tried? Tried? Tried, Amoli? No. Pravalika, you tried question number 2? Clear? Okay. So look at question number 3, sir, now. Is it related to anything like demerger? No, right? Amalgamation. Okay, I think we can see. Sir, here we should be clear about this one also, sir. Like here, business loss can be carry forwarded, we said, right? If you see here, accumulated business loss other than what? Non-speculative. I mean, speculative losses cannot be carry forwarded. So be clear about that also. We can carry forward the losses other than, carry forward business losses other than speculative. What is speculative loss? Speculation business means what? That comes as a business, huh? Trading of shares. He is into trading shares, options, futures, now high risk involved, so that comes under speculative. Both are same only, you will say. Huh? Question number 3. Solve quickly, everyone. Moon Limited engaged in the textile business, got amalgamated with Sun Limited. Moon amalgamated with Sun. Also engaged in similar businesses on 1st April 2024, duly complying with the provisions of 728. Moon Limited has always been filing its ITRs within the due date specified under section 139, subsection 1. The following items remain unabsorbed in the hands of Moon as on the above date. Business loss for assessment year 2021. Speculative loss. So speculative loss, can it be carry forwarded? No. Unabsorbed depreciation. Yes. Loss from warehousing business. Sir, if you remember one thing, sir. Specified business loss, yes, here it is covered. But the provision is like specified business loss can be set off only with specified businesses. Is he carrying specified business? No, see. Loss from warehousing business eligible under 35. Business discontinued. For the previous year, Sun Limited earned a profit of how much? 24,10,000 after providing for current depreciation but before considering the unabsorbed items. With respect to machinery transferred from Moon Limited, WDV is 120 lakhs. Sun Limited adopted a book value of 100 lakhs on 1st April 2025 and depreciation provided 15% on this value. The block of assets is eligible at 15%. Required to compute the total income of Sun Limited. Sir, business income is how much? 24,10,000. First, depreciation they have been reversing. Why depreciation is reversing? Which depreciation? Sir, here if you see, Sun Limited adopted a book value of what? 100 lakhs on 1st April 2025 and provided depreciation on 15% of value. Sir, on what value they need to depreciate? WDV value. But on what value they have been depreciating? 100 lakhs. So 100 lakhs is wrong. Okay, they cannot take the book value, they have to take what? Written down value only if amalgamation conditions are satisfied and section 72 is being satisfied. So now what? That's why whatever the depreciation charge that has been added back, 15 lakhs. And what is the actual depreciation to be provided? 120 into 15%, 18 lakhs, that is provided. So what is the actual correct profit and loss? 21,10,000. Understood, sir? Now, out of all these losses, which can be set off? This 12,60 and unabsorbed depreciation. Sir, see, loss for assessment year 2021. How long it can be set off? 21, 22, 22, 23. 25, 26, 26, 27. So we are in which year? 1, 2, 3, 4, 5, 6th year only. So it can be set off. 12,60. Sir, to set off complete unabsorbed depreciation, profit is not enough to set off complete. So that's why it was set off only to the extent of 8,50,000. So the total income became what? Nil. Okay. So balance unabsorbed depreciation 4,73,000 can be carried forward indefinitely. Speculation losses are not eligible for set off. Specified business loss can be set off only with specified business income. Since the business discontinued, not eligible for set off. Any number of years. So then we are moving on to demerger. Okay, here other accumulated business loss, the meaning here is non-speculative you can carry forward. That is what, okay, non-speculative. So here only non-speculative I am mentioning. Okay, non-speculative means what? The normal business losses and all you can do. Nothing but what? Other than speculative. Discussing about demerger, sir. You know, classic amoeba exam. Amoeba, you know, in school. You drawn the only diagram which we know perfectly. But for that also they given a shape. In textbook there will be a shape, right? It's okay. So if you remember there, not only just the amoeba diagram, if you know that amoeba concept there, the reproduction system in amoeba is like how? The same thing will split into two. Then again it splits into two. So like that it will grow. It's okay. So from the same one, it will split into two. That's called demerger. Okay. The existing company itself will split into two or more. Then that's called as what? Demerging company. It will not merge into something else. The only continuing company will split into two or more. So Reliance Limited, let's say, is the parent company. It is handling two businesses, telecom business and oil and gas business. So from telecom business, so now, sir, why they have to split first? So why they have to split now? Sir, for a company there will be one set of board of directors. Now they should be having knowledge in both the businesses, right? So now sometimes it's not, they cannot take efficiently the decision making, because let's say the board has 15 members. Some 6-7 members will be about telecom business and 6-7 members will be about oil and gas. So if the decision has to be taken related to telecom thing, the other directors are completely irrelevant, but they'll be sitting in the board. It's okay, their decision, their views, nothing are relevant to them, because they are related to what? They have expertise in oil and gas, but the decision has to be taken related to telecom. So because of this, the decision making will become slow, or they cannot take effective decision making. If they split, then in the telecom related board, all the people will be related to telecom related experts only. The decision making will be much more efficient. Same way for oil and gas also. That's why when company is into multiple businesses or multiple industries, to give extra care or to be more efficient in that particular operations, they may split into different companies. So Reliance Limited has a telecom. So telecom is continued with the parent company only as what? Reliance Limited. Okay, Reliance Limited has even an oil and gas. So that they are doing it what? Reliance Industries Limited. Reliance Industries Limited. Sir, if you see Reliance these days, I mean, what I observed is like, instead of they going with Reliance brand, they are mostly promoting Jio brand. So okay, with Jio only they are doing most of their businesses. So Jio started as a telecom, but then they are promoting the Jio brand to other things. Why? Why you think? No, sir. Reliance brand has positives as well as negatives also. There are two brothers own Reliance brand. Some Reliance companies are owned by Mukesh Ambani, some companies are owned by Anil Ambani. But most of the times we cannot, so the normal common investor these days may not know the backstory which happened 15 years back. So they think like what? Reliance means all the Reliances belongs to Mukesh Ambani only. But still Anil Ambani's Reliances are also being traded. So okay, whenever a fraud, so these days also, last 2-3 years also, some misreporting, some fraud things are being coming in the Reliance. Okay, but Reliance owned by whom? Anil Ambani, not in Mukesh Ambani Reliances. So in Anil Ambani Reliances when they come, then it is affecting the whole Reliance brand value, even including Mukesh Ambani's also. That's why, so they thought, not now, maybe even in future also, it may be acting as a threat for them. So, I mean, sir, it's not like I didn't read somewhere. I observed something, so based on that I'm saying, so it may be wrong also. But I observed like most of the places they are promoting Jio brand than that of Reliance brand. Parent company transfers a unit or division. So what happens, sir? Parent company, they are continuing with the same brand. I mean, telecom business lies with the parent company only, Reliance Limited. Whereas the oil and gas alone has been transferred to another company called what? Reliance Industries Limited. So now one company became two. The parent continuing and a resulting came. What is the parent company? Reliance Limited as it is. Resulting was formed as Reliance Industries Limited. So like this, demerger happens. But in demerger, from the parent company, certain assets will be transferred to whom? Assets and liabilities will be transferred to Reliance Industries Limited. So all these oil and gas segment related assets and liabilities will be transferred to Reliance Industries. They have two industries. When oil and gas is formed as a separate company, all the assets related to oil and gas segment will be transferred to whom? Reliance Industries Limited. So when parent company transfers a unit or division to resulting company, the question is it a transfer? Will there be capital gains? Okay, so now there are conditions for demerger. What are the conditions? All the properties and liabilities of an undertaking has to be transferred to resulting company. All the assets and liabilities, so oil and gas segment is being transferred, right? So now all the assets and liabilities related to oil and gas segment has to be transferred. Second one, such a transfer should be at book values. If any revaluations are there, what we have to do? Ignore. Then resulting company shall issue shares to the shareholders of parent company. Sir, I am a shareholder of Reliance Limited, sir. Okay. You are a shareholder of what? Reliance Limited. So you are owner of parent company. But if some resulting company is formed and if they say like you are not owner to them, is it possible, sir? Can we say? Simple example, sir. You own a cow. To the cow afterwards a calf came. So you are owner of cow and even the calf also, right? The same thing here also. Reliance Limited is a parent company and it has a resulting company also. It's a parent company, it has a resulting company also. Now if you are a shareholder of Reliance Limited, you will even become the shareholder of the resulting company also, right? So that's why resulting company shall issue shares to the shareholders of parent company because they are only the owners of even the resulting company. Sir, what if they were paid money? you are a shareholder of parent company, to forego the share in resulting company, you have been paid money. Okay, that can be done. Okay, but how much they are saying? See, 3/4 of shareholders in value, I mean 75% or more shareholders in value in parent company shall become shareholders of resulting company. Same as like amalgamation. At least 75% of value of shareholders shall become shareholders even in the resulting company. And the transfer of undertaking is on what basis? Going concern basis. Okay, so what are the demerger 5 conditions? All the assets and liabilities of such unit or division has to be transferred. Such a transfer should be at book values. Resulting company shall issue shares to the shareholders of parent company. At least 75% should be continuing, and it should be on a going concern basis. Transfer is on a going concern basis. These are the conditions for demerger. When parent company transfers a capital asset with resulting company, is it transfer? Is it capital gain? No. When it is not a transfer, when no capital gains. Here, above 5 demerger conditions has to be satisfied, and resulting company should be an Indian company. Then it is not a transfer, no capital gains will attract. What are the five conditions to be satisfied? Next one, what sir? Resulting company should be an Indian company. What are all the 5 conditions? All the assets and liabilities of that particular unit has to be transferred. Book values. Third one. For the parent company shareholders, shares should be issued in resulting company. How many shareholders should be minimum continuing? Value of shares, sir. More than or equal to 75% or 3/4. Then it is on going concern basis. If all the 5 conditions are satisfied and resulting company is an Indian company, then demerger conditions are satisfied. Then demerger is not a transfer. No capital gains will attract. Sir, but I purchased in Reliance Limited for 100 rupees per share. Okay. Now I got, after demerger, I have 1 share or 2 shares, sir. 2 shares. One is still continuing in the Reliance Limited parent, and I got additionally even in the resulting company also a share. Now, how do we apportionate our cost of acquisition here? Because for 100 rupees, originally you got 1 share only, but now the 1 share became 2 shares. So now the cost of acquisition has to be apportioned between the parent company share and the resulting company share also, right? So how do we apportionate is the question now. For shareholder. Sir, parent company, see, before going into that, for parent company, if conditions are satisfied, not a transfer, no capital gains. For resulting company, what should be the cost of acquisition? Cost of acquisition to previous owner. Period of holding of previous owner plus period of holding of new owner. Cost of acquisition, depreciable assets equals to WDV to previous owner, same as like amalgamation. So let me write down here. Add that one. Same as like amalgamation. I mean, even in demerger case also, predecessor, successor concept will come. The depreciation has to be apportioned between predecessor and successor in the ratio of number of days used. Okay, the same concept as it is applicable even for demerger also. Sir, for all the succession cases, that depreciation concept applicable. For predecessor and successor. That's why we didn't use the words there amalgamating company and amalgamated company. We use the word there predecessor and successor. So it applies for amalgamation and it even applies for demerger also. If you remember 35DD expenses, that also for Indian company, any expense incurred related to amalgamation or demerger not claimed elsewhere, it can be taken as installments. In how many installments? 5 installments. So that applicable even for demerger also. Now, sir, I have 2,000 shares in Reliance Limited. Now Reliance Limited demerged into Reliance and Oil and Gas. Now I got allotted 2,000 shares in Reliance Industries Limited also. 2,000 shares in Reliance and 2,000 shares in Reliance Industries also. Now what is the cost of acquisition for the new 2,000 shares and what is the period of holding? Because they were newly allotted. For them, what is the period of holding? For the parent company shares, what is the period of holding? So you know period of holding means what? How long we are holding the shares is called as period of holding. Okay. See. Shareholder on demerger. Any split of shares. Sir, because my 1 share is also becoming 2. If the company is becoming 2, my 1 share also becoming 2 shares. So any split of shares consequent to demerger is not a transfer. Capital gains will not attract. Conditions are what? Demerger conditions has to be satisfied and resulting company is an Indian company. But we need to see cost of acquisition. See cost of acquisition. See, first you should take the original cost of acquisition. Sir, originally I purchased, let's say, Reliance share for 100. Take that cost of acquisition into net book value of assets transferred in demerger. How many assets are given to resulting company? How much value of assets are given to demerger company? Sir, net book value, sir. That means what? Assets minus liabilities is the net book value divided by total net worth of the company before demerger. Net worth of the company before demerger. Sir, what is net worth? Net worth we can compute 2 ways. Assets minus outside liabilities or equity plus reserves. Equity preference, share capital plus reserves is also called as what? Net worth or assets minus outside liabilities. So if you take assets minus liabilities, before demerger we are taking. Okay, out of this, let's say my total net worth before demerger is 500 lakhs. Out of them, 200 lakhs are given to resulting company. So what ratio we need to apportionate the cost of acquisition? Cost of acquisition into 200 divided by 500. That will be the cost of acquisition of resulting company. Understood, sir? See, 100 is the original share purchase price. Here, the assets given to resulting company are worth 200, whereas the net worth is 500. So 100 into 200 by 500. 40 rupees is the resulting company share of cost of acquisition. Then what is parent companies? If resulting is 40, what is parent? 60 only, right? How do we got 60? Original cost of acquisition minus resulting, if you do, we'll get 60. That only wrote. Cost of original shares minus cost of resulting company, then we'll get parent company's cost of acquisition. So why it is important? In question they may say parent company shares only sold. Resulting company shares are as it is. So then we need what? Cost of acquisition of parent company. Or he may say resulting parent company shares are as it is only he sold. Resulting company shares. Then we need cost of acquisition of resulting company. And period of holding, sir, starts from original date of acquisition only. I mean, I purchased the first share 10 years back. Then even in the resulting company also, the cost of the period of holding has to be taken as 10 years only. It's not from the forming of the new company. From the original date you purchase, from the date the period of holding has to be continued. Then 72A. Sir, here, right, other than speculate. Sir, what we are saying, the losses of parent company can be carried forward by resulting company also. How long? 8 years fresh. Same amendment applies even here also. Not fresh 8 years. From the first year the loss has been reported. From their account, 8 assessment years. Still, 1-2 years are there. Then that 1-2 years you can carry forward. Understand, sir? Unabsorbed depreciation, no limit at all. Any number of years. If it happened on or after 1st April 2025, before there is another 8 years loss can be carry forwarded. Sir, see, if there is any loss or unabsorbed depreciation not specific to any undertaking, there is loss, but you cannot find out whether that loss is related to oil and gas segment or telecom segment. If you are following our example, then what? Split them both in the proportion of assets transferred. Assets transferred are nothing but how many are held by resulting, how many are held by taken by resulting. In that ratio, it has to be transferred. Okay, carry forward and set off loss. 8 years from the first year loss has been reported, and unabsorbed depreciation any number of years. Even this common loss which was shared between two, that also can be carried forwarded for 8 years only, not fresh 8 years. 8 years from the year in which the loss has been first reported. So throughout the chapter, sir, the loss can be carried forwarded in all the succession cases. Before amendment, in all the cases, you can carry forwarded for fresh 8 years. Now the amendment makes like what? In every case, it's not fresh 8 years. It's 8 years only from the year in which loss has been first reported. Same again, sir, just like as demerger of, amalgamation of foreign companies, here demerger of foreign companies. So parent company demerges with resulting company, no transfer, no capital gains. Sir, first one foreign company demerges and forms another foreign company. What's the problem to us? Because in the demerger, assets being transferred are Indian shares or a share in foreign company which derives its value from an Indian share. Okay, but still it is not a transfer, sir. When 75% only here, there 25% only. Here, instead of 75%, actually it is given as 3/4. How you know? It's okay. Demerger of foreign company, parent company demerged with resulting company. The capital asset transferred is share of Indian company or share of foreign company only, but which derives its value directly or indirectly from an Indian company. That is not a transfer, no capital gains. When in that country where this demerger happened and resulting company is formed, there it is not taxable. Second one, at least 75% of the shareholders of parent company shall continue to be shareholders in resulting company also in terms of value services. Then we can go to questions, sir. I think, yes. So read question number 4, sir. Okay, so let me go into the question. Sir, Donna purchases 600 equity shares on 1st April 2025 at 150. On 31st December 2025, it is demerged. In the scheme of demerger, division Y was transferred to Y. On the date, balance sheet of X Private Limited is as follows. 6,000 equity shares, 6 lakhs. General reserve, 4 lakhs. So these anyhow will not consider now because assets minus liabilities. Loan, outside liability. Loan, outside, creditors also outside liability. Assets, land, plant, investment, stock, debtors, cash and bank, 14 lakhs. So total assets is how much? 14 lakhs. Then Y is in consideration of the demerger issued equity shares of 100 each to the shareholders on proportionate basis. You are required to compute the number of shares received by Donna and cost thereof. Cost of acquisition of shares after demerger. So first we need to find out what is the net value of assets transferred to X. Okay, so how division X are transferred, division Y, sorry. So for division Y, if you do this total of assets, how much? 2,50,000 plus 1, 3,50,000, 5,80,000, then 1,20,000. If you add total is how much? 7 lakhs. This is the total of assets. From there we need to subtract what? Liabilities. But liabilities, sir, this is general, okay, this is no general, okay, this is specific liability, these two specific we need to subtract. Minus how much? 75 plus 40 means 1,15,000. Now in this specific liability 2 lakhs also we need to subtract. But 2 lakhs, what basis? Sir, here we don't have any reasonable basis. We'll take what? So assets basis only. Total assets given to Y are 7 lakhs, whereas the total assets are how much? 14. So 1:2 ratio. So 1 lakh belongs to Y. So what is the net value of assets transferred? 4,85,000. So the net worth of the company is 4,85,000. So how many shares will be issued? Each share value how much, sir? 100. They're going to issue each share at 100. So the share value will be equivalent of net worth. Okay, so 4,80,000, 85,000 divided by 100 means 4,850 shares will be allotted in Y Private Limited. But we don't want how many shares are there in Y Private Limited. We want how many shares are held by Donna. Okay, first. Sir, what is the share capital of this company first, before demerger? 6 lakhs. Okay, how many shares? 6,000. Okay, out of 6,000 shares, how many Donna has? That means what is the percentage? 10%. So if he has 10% in his parent, then resulting also he'll get 10%. So 4,850 into 10%, how much? So Donna has how many shares? 485 shares. So Donna has 485 shares. We want only, they asked only in Y Private Limited, not in both. In XY, 600 as is there. In Donna, extra how many came? 485 shares came. Okay. Now cost of acquisition. Sir, originally they purchased for how much? 600 into 150, 90,000. 90,000. So now this 90,000 is related to both 600 of XY and 485 of Donna. So we need to segregate. So how do we segregate, sir? So okay, first 90,000 we need to take into net value of assets transferred. What is the net value of assets transferred? 4,85,000 divided by 10 lakhs. Why 10 lakhs, sir? This is the net worth. 6 plus 4. 6 plus 4. Or else you can do 14 minus this 4. Anyway, it is like 10 only. So out of total 10 lakh net worth, 4,85,000 transferred. What is the new resulting company's related cost of acquisition? 43,650. This is for what? Cost of acquisition to Donna for Y Private Limited. What is the cost of acquisition to XY? 90 minus 43,650. How much? 46,350. Okay. Now Donna sold how many shares? 200 of XY for 125, 100 of Y. Sir, this 43,650 is for how many shares? 485 shares. This 46,350 is for how many shares? 600 shares. So we need to take proportionately for 200 shares and 100 shares and then calculate the capital gain. See, sale consideration 200 into 125, 25, 100 into 110, 11. So minus cost of acquisition 46,350 into 200 by 600 and 43,650 into 100 by 485. If you subtract cost of acquisition, the short term capital gains are 9,550 and 2,000. Understood, sir, everybody? Okay, so how do we compute general capital gain format, you tell? Okay, here this cost of acquisition 43,650 is for how many shares? 43,650 is related to whom? Y. How many shares? But they sold 485 shares of Y. How many sold? So for 100 shares, what is the cost of acquisition? If for 485 shares it is 43,650, for 100 how much? 9,000. Okay, 100 shares sold for each how much? What is the sale value? 100 into 110 is the total sale consideration. What is the sale consideration? 100 into 110 is how much? 1 lakh. 11,000. So 11,000. Now it's clear. How many shares they sold of Y Limited? 100. 100 into 110. 11,000 is the sale consideration. Now can we subtract 43,650? We cannot subtract 43,650 because 43,650 for 485 shares. We want only 100. 100 shares already you calculated how much? 9,000. So 11,000 minus 9,000. 2,000 is the short term capital gain. Sir, why short term? Because the demerger happened recently. Okay. And even in XY also he purchased only in 1st April 2025. Period of holding is not even more than 12 months also. Okay, so it's not what? Long term, it is short term. Same way for XY. Sir, XY how many shares sold? 200. Each at 125. What is the sale consideration? 200 into 25,000. Okay. Sir, here 46,350 is for how many shares? 600. We want for how many shares only? 200. So for 600, 46,350. For 200 how much? 46,350 into 200 by 600. 15,450. From 25,000 if you subtract 15,450 you'll get 9,550, you'll get here 2,000. Okay, now read question number 5. Sir, solved. Sir, Parikshit Limited Kolkata is a domestic company with 2 divisions, textile and automobile. The board of directors of the company to hive off textile division by way of demerger. The net book value of the assets of textile division before demerger was how much? 50 crores. And the total book value of the company was 150 crores. The scheme of demerger was approved with, so total, how many are given? 50. How much is the total book value of assets of the company? 150. The scheme was approved with allotment of 5 for every 10 fully paid up shares in the quota for each equity share held in Parikshit. The demerger was made in April. Borman is one of the shareholder of Parikshit Limited with 2,000 equity shares acquired in the financial year 18-19 for 8,40,000. He sold all the shares received from quota in May for 30 lakhs. CII number nowhere relevant, sir, because no indexation now. Is the transaction of demerger of textile division by Parikshit Limited attract any consequence in its hand? Sir, first. So look at the conditions. Transfer of undertaking under a scheme of demerger by Indian company to resulting is not a transfer. Therefore, transaction is tax neutral. Okay, because assuming all the demerger conditions has been satisfied. Then second one, what is the second question? How much is the capital gain in the hands of Burman on exchange of shares of Parikshit with quota? I mean, he's getting 2 shares right now. That also not a transfer, no capital gains will attract, assuming all the demerger conditions has been satisfied. Third one, compute capital gain on transfer of shares of quota. So how much is his original cost of acquisition? 8,40,000. Okay, 8,40,000. So now into what is the new value of assets he got? The textile division book value of assets is 50, whereas total is how much? 150. So total is how much? 8,40,000 into 50 by 150. 2,80,000 is the cost of acquisition for what? Quota Limited shares. Why? Because textile division has been transferred. The next book value of textile division is how much? 50. The total book value of assets is how much? 150. So how do we compute cost of acquisition of resulting company share? Original cost of acquisition into net book value of assets of resulting company divided by total book value of the assets before demerger. Then you will get how much? 2,80,000 is the cost of acquisition. But for what value he sold all of them? 30 lakhs. So 30 lakhs minus 2,80,000 if you do, it comes to how much? 27,20,000 is what? Long-term capital gain. Sir, why long-term capital gain? Recently only in a demerger happened. Period of holding starts from the day original share has been acquired. Original shares were acquired in which year? 1819. So it's a long-term capital gain. Okay. Then, does the sale of shares by Bumrah have any implication in the demerger undertaken by Parikshit? Okay, sale of shares of resulting company by the shareholder of the demerger company will not have any tax implications in the hands of both demerger and resulting company. Sir, tarvata vaad shares ammeste ana problem. There is no such restriction. There is no such restriction like what? That he has to, the resulting company shareholder has to continue for 2 years, 3 years like that. There is no lock-in period. That's why there is no problem even if he sells afterwards the shares also. Okay. When the problem will come? To carry forward the losses and to set off the losses, at least 75% should be continuing, which where we discussed under 72A. So there may be a problem will come. But just because he sold the shares, nothing will happen. Okay. Sir, question number 6. Amalgamation related depreciation. Question number 7. The same question we solved in PGBP. So, okay. So from question number 8, we need to solve now, sir. Slump sale. 8, 9, 10 are related to slump sale. 11th is slump sale versus demerger. 12, 13, 14, 15, 16, 17. Okay, 17 is also a demerger, sir. Sir, compute question number 17, sir. December 25 exam question on demerger. Sir, solved? Easy or tough? Easy only, na? Okay, but last exam, na, that's why now it will be easy. Tal Private Limited, Kanpur is an Indian company engaged in the manufacture of leather bags and synthetic bags. 2 units. Unit A for leather bags, Unit B for synthetic bags. The management of the company to decide, demerge and sell Unit A to another Indian company by name Salt. The book value of assets minus liability was how much? 50. Whereas the book value of Tal, the book value of assets minus liabilities of Unit A is how much? 20. So what is the ratio, sir? 20 by 50. Because total 50, out of them the assets being transferred is 20. It was decided in the scheme of demerger that for every equity share, 5 equity shares of Salt will be issued. Sunil A resident, sir, actually the previous question kind of only, just they change the names and the numbers. Sunil A resident individual has how many shares, sir? 15,000. He has acquired all of them for how much? 150. So what is his total cost of acquisition? 22.5 lakhs. Total cost of acquisition. Okay. He received 75,000 of Salt. He sold all the shares. Now, sir, what is the cost of acquisition of Salt? 22.5 into 20 by 50. How much? How much? 9 lakhs is for Salt. If 9 lakhs is Salt, then Tal is how much? 22.5 minus 9. 13? 13.5 lakhs. But this 9 lakhs is for how many shares? 75,000 shares. And this 13.5 lakhs is for how many shares? 15,000 shares. Now, he sold all the shares of Salt. All the shares means how much, sir? 75,000 into 20. For what value he has sold? 15 lakhs. Minus if you subtract 9 lakhs cost of acquisition, what is the capital gain taxable? So it is the December 2025 exam question. So now, a student who skipped business restructuring and NR taxation might be doing something tricky there and losing this easy marks. So we cannot know which question is going to be easy and which question is going to be tough. We as a faculty can tell you from which chapter the question will come. It's okay, that's what we can do. So from there, if you take choice again and go to exam, na, so 2 questions out of the 5 you read only, 2-3 questions if they become tough and the rest of the 2 which you left became easy, na, then your attempt becomes complicated, sir. That's why read. Slum sale. When an undertaking, division, branch or unit as a whole transferred. So, okay, lump sumly as a lot they sold, not just particularly few assets or one or two assets. A unit as a whole, all the assets in the unit, all the liabilities has been sold, okay, including debtors, creditors, everything, for a lump sum consideration, without assigning individual value for each asset and liability. So, okay, so తెలుగులో అయితే గంపగొత్తుగా మొత్తం కలిపి ఒకేసారి లాట్గా సేల్ చేయడం. So without value being assigned to individual assets and liabilities. So they may have plant and machinery, furniture, land, building. For all of them, individual values will not be given. All together 20 crores, 30 crores, like that, as a lump sum consideration has been fixed. And then without assigning value to individual assets, wholly transferred, then it is called as what? Slum sale. Period of holding. In case of slum sale, date of commencement of such undertaking to date of transfer. When such unit is commenced, from there to date of transfer, we need to count. That will be considered as the period of holding. Then long-term capital gain or short-term capital gain. If the unit is held for more than 36 months, long-term, otherwise short-term. Held for more than 36 months, then long-term, otherwise short-term. Tax rate. Long-term capital gain is like 12.5%, which is covered under what? 112. Not 112, covered under 112. Short-term capital gain normal rates covered under 111. Section 112, section 111. Then cost of acquisition. What is cost of acquisition? Is nothing but net worth of undertaking. So which is nothing but cost of improvement, assets minus. Sir, cost of acquisition. Sir, we got sale consideration here. To calculate capital gains, sale consideration is there. Any transfer related expenses you'll subtract, you'll get net sale consideration. From there we should subtract cost of acquisition. Here, cost of acquisition, improvement altogether one only. What to take that as cost of acquisition? Because individual assets are not being sold, they were sold as a lot. And even liabilities also transferred. So we cannot just take the asset values. So we need to take what as cost of acquisition. The cost of acquisition is nothing but net worth. Net worth is what? Assets minus liabilities. Liabilities has to be taken at what values? Book values. Whatever is there in the book, that value has to be taken. Assets. Depreciable assets means we'll take written down value. Self-generated goodwill and all will take it as like nil. Even the book value, some value is there, but self-generated goodwill will take nil. Depreciable assets, what we have to take? WDV as per which act? IT Act. 35AD. So what is 35AD? Specified businesses, 100% capital expenditure is allowed as deduction. For them, the cost will be nil. That's why actual cost will be taken as what? Nil. Any other assets? Sir, any other assets, na? If it is like land, book value, shares, investments, book value, debtors, book value, stock, book value, cash, book value. So assets minus outside liabilities. Liabilities has to be taken as book value, assets. Depreciable assets take WDV, self-generated goodwill, nil. 35AD asset, nil. And others we have to take it as what? Book values. Ignore revaluation. If any revalued figures are there, such revaluation has to ignore. Without revaluation values only we have to take. This is for what? Cost of acquisition. Okay. But now, sir, actually, sale consideration in case of some slum sale under Rule 11 UAE. Sir, sometimes the consideration, in some questions they'll select consideration is paid in money itself. Then this Rule 11 UAE will not apply. If consideration is paid in money plus non-monetary, I mean something given in money and something else given also, but not in money form, then the consideration what we have to take shall be determined as per Rule 11 UAE. The consideration will be higher of these two. Higher of these two. Okay, what is higher, sir? Sir, this is only keys are here. Otherwise, slum sale is easy only. Because of this Rule 11 UAE only, it's become little complicated. See, higher of fair market value of consideration received. Fair market value of what? Consideration received. Money paid plus non-monetary thing if any given. Let's say immovable property given. What we should take? Stamp duty value. Movable property given. We should take what? Fair market value as per the valuation rules prescribed. Any other asset? Open market value. So any other asset we have to take what? Open market value. Okay. So we need to decide fair market value of undertaking or fair market value of consideration, whichever is higher. What is fair market value of consideration? Money paid, take it. Non-monetary, build some immovable property given. We should take what? Stamp duty value. Movable assets given. Movable assets, na, there could be shares and all also. We'll take what? Fair market value. Any other assets, na? Open market value. So both are like almost same only. Fair market value or open market value, both are like same only. So nothing but except for immovable property, rest all will take what? Market values. For immovable property, we'll take stamp duty value. Money paid, then monetary value only. That's the fair market value of consideration received under 11 UAE. Okay. But we cannot straight away take this as consideration. We need to compare it with what? Fair market value of undertaking. So fair market value of undertaking or fair market value of consideration, whichever is higher. What is fair market value of undertaking? Assets minus liabilities. Sir, what liabilities? All the liabilities to be subtracted except this. Except this means what? Equity share capital, dividend set aside, reserves and surplus, provision for tax, unascertained liabilities, contingent liabilities. Okay, excluding this, nothing but, sir, outside liabilities only they are talking. But even in outside liabilities also, if they are contingent and unascertained, don't subtract. And if they are like provision for tax, okay, sir, equity share capital only, dividend, reserves and surplus, again, reserves only, provision for tax. So what extra they are saying, sir? Liabilities means all the liabilities except share capital and reserves and surplus, that is there. And then again we should subtract what, sir? We should not exclude, I mean we should not subtract what? Unascertained liabilities and contingent liabilities also, and even provision for tax. So these things if you exclude, what are the other liabilities? We can subtract creditors, bank loans, debentures, okay, all those kind of outside liabilities we can subtract. So now assets value. What assets value we should take? Jewelry and artistic work, take what? Fair market value. Shares and securities take fair market value. Immobile property, stamp duty value. Others book value. Sir, book value as per accounts, not as per IT. As per books of accounts, not as per IT. Sir, depreciable assets, did they mention anything? Here if you see, jewelry, what value has to be taken? Fair market value. Shares, fair market value. Immobile property, stamp duty value. Depreciable assets are also covered under where? Others. So others means what value we have to take? Book value. I mean nothing but written down value as per IT Act, books of accounts. Books of accounts. But for cost of acquisition, if you see, we'll take what? WDV as per IT Act. For cost of acquisition also we'll do assets and minus liabilities. For fair market value of undertaking transfer also we are doing what? Assets minus liabilities. But their assets values are different. Here assets values are different. Comparison. Their assets value for cost of acquisition, what is said? Depreciable assets take WDV. Subgenerated goodwill, nil. 3580 assets, nil. Others take book values. But here assets means what? Jewelry and all, book, fair market value. Shares and securities, fair market value. Then immobile property, stamp duty value. But for cost of acquisition, immobile property will take book values only. But here cost of acquisition for immobile property will take stamp duty value. For cost of acquisition, jewelry will take book value. Here market value. Shares and securities there, book value. Here market value. Are able to understand? Because here we are finding out fair market value of the undertaking transfer, not the book values. See, here we want to find out the real worth of the undertaking, the sale price. That's right. Okay. What assets means here? Jewelry, we should take what? Fair market value. Shares and securities, fair market value. Immobile property, stamp duty value. Others take book value, including depreciable assets also. So depreciable assets, book values. Now book values as per what? Accounts or tax? Accounts. So that is as per books of accounts. Okay. SSC shall furnish a CA report by the date of audit, indicate the computation of net worth and certifying it. Okay, we'll go to a question, sir, then you'll understand betterly. Question number 10 we'll solve, sir. 9 is also related to slum sale only, but first we'll solve 10 and we'll go to the other one. 10 is a more comprehensive question which even involves 11 UAE also, rule. Mundra Private Limited has sold all its assets and liabilities as slum sale on 31st March 2026. To Sonam Private Limited for a lump sum consideration. Mundra received the following considerations. What is the consideration received? Money. So first we need to find out what revenue they said, right? So that's why we need to take what? Fair market for consideration only. Fair market value of consideration we need to find out, and fair market value of undertaking also we need to find out. Understand? Whichever is higher. So fair market value of consideration is easy to do. Money paid. Take what? That money amount. How much? 600 lakhs. Immobile property will take what? Okay, 800 lakhs. How much is the house given? Immobile property also given. Stamp duty value. Immobile property, we should take what? Stamp duty value. How much? 300 lakhs. Then, any other will take what, sir? Fair market value or market value. So, bitcoins will take what? Value 60 lakhs. For shares will take what? Value they only given 140. So, what is the fair market value of consideration given? 1100 plus 200, total 1300 lakhs. 1300 lakhs. Paka? Done. Then, fair market value of undertaking. Fair market value of what? Undertaking. So here fair market value of consideration is how much? 800 plus 300 plus 60 plus 140, total how much? 1300 lakhs. Fair market value of undertaking is what? Assets minus liabilities. Sorry, in liabilities we'll target first. Liabilities, what we should not take? Equity share capital we should not take. Reserves not there. Then we should not take what? Provision for tax. Is there provision for tax? Nothing is there. Unascertained liabilities, ascertained liabilities, nothing is there. So except equity, rest all can be subtracted only. Okay. Then asset side will come. Sir, first we are talking about consideration only, not going to cost of acquisition. Asset side. Sir, asset side, if you see, plant and machinery, what value we have to take? WDV. Okay, nothing but book value we have to take. Okay, sir, this is as per what? As per income tax 400. But we are calculating cost of acquisition or sale consideration. First we are calculating sale consideration. For sale consideration, we should take book value only, not the tax written down value. Don't get confused, sir. We need to do net worth 2 times. That's why you may get confused. But for cost of acquisition also assets minus liabilities we are doing. For sale consideration also we are doing assets minus liabilities. But there assets minus liabilities is different. Here assets minus liabilities is different. So under 11 UA, assets means what values we have to take. Go first jewelry, market value, shares and securities, market value, immobile property, stamp duty value, others, book value as per accounting records. So that's why 500. Land revalue 2400, sir. But land we want what? Stamp duty value only. So we'll take it as how much? 800. Sir, see here. Stamp duty value is 800. Then unlisted shares, sir, 160. But we'll take what? Fair market value. How much? 240. Sundry debtors, book value 600. Cash and bank balance, book 4. Loans and advances 300. Closing stock 500. Okay. So what is the total of assets, sir? 29 minus outside liabilities. If you see 50,000, 160. Total how much? 1,210. Correct only, right? So if you subtract, what is the fair market value of undertaking? 1734 is the fair market value of undertaking. Whereas 1300 is what? Fair market value of consideration. Whichever is higher has to be taken as sale consideration. Everybody clear, sir? Here assets minus liabilities we have to do. Assets, what values we have to take? Plant and machinery, book value as per books of accounts only 500. Land, stamp duty value, so we don't took 2400, we took what? 800. Unlisted shares, fair market value 240. All the other debtor, cash, loans, advances, stock, we need to take what? Book values. Total of assets is 2944. Liabilities except share capital 1210. So what is the fair market value of undertaking? 1734. Fair market value of consideration is how much? 1300. Whichever is higher. So what is the sale consideration, sir? 1734. They didn't give any transfer related expenses also. Now we need to find out what? Cost of acquisition. Cost of acquisition is again what? Assets minus liabilities only. So liability side common only, sir. How much? 1210, because the same outside liabilities only. Okay, then coming to the assets, sir. I'll do here with another color pen, sir. Okay, sir, plant and machinery 500, but as per IT WDV how much? 400. So we should take how much? 400 only. As per IT we need to take now 400. Land we should take neither revalued amount, neither stamp duty value. We should take what? Book value. We should take book value. So it will be how much? 200. Sir, 4 only, sir, under cost of acquisition. What are those for? First one, depreciable assets. Take written down value as per IT Act. Then self-generated goodwill, nil. Then next one, 3580 assets, nil. Others all, book value only. So this is 200, this is 160, this is 600, this is 4, 300, 500. So total how much? 2164. 2164, correct only, sir. Sir, any doubt you are having here? Sir, you need to get the cost of acquisition only clear. For the purchase of cost of acquisition, we need to subtract what? Assets minus liabilities. Assets means what? Depreciable assets, written down value. Self-generated assets, nil. 3580 assets, nil. Rest all, book values only, minus liabilities. But under 11 UA, we need to do again what? Fair market value of undertaking. There also you'll do assets minus liabilities. Assets means what there? First one, sir, jewelry, fair market value. Then next one, shares and securities, fair market value. Immobile property, stamp duty value. Others, book value. Others, book value. I mean, depreciable asset also we should take book value as per what? Accounting. So now 2164 minus 1210, if you do, what is the cost of acquisition, sir? 954. So from 1734 you subtract 954. What is the capital gain? 780 is the capital gain. Long term or short term? When they started the unit, sir? Sir, definitely long term capital gain only. How can I say? Because land purchased in March. Related to this undertaking, land purchased in March 2007. That means minimum it is there from where? March 2017. So it is what? Long term capital gain only, which is how much? 780. Correct only, yeah? Yeah, 780. On that you see tax rate, sir. Income tax at 12.5%, 97.5 plus surcharge. Sir, surcharge 7%. Why? 780 lakhs means 7.8 crores. 7.8 crores. And it is a company, private limited company. So that's why 7%. Assuming this is the only income. And this, okay. So 6.85 total 104.325 plus 4%. Total tax liability is 108.498. Okay. Clear, sir, this question? Then we'll go to question number 9. So question number 9, read it, sir, and try to understand. Tiger Private Limited is engaged in manufacturing of textile garments and automobile parts. It has been incurring losses in manufacturing of automobile parts. The management of the company wants to disinvest automobile parts manufacture for a lump sum consideration of 500 lakhs. Net worth has been computed as 340. So I mean this net worth is what? Cost of acquisition. This is what? Sale consideration. The automobile was in existence for the past 10 years. So the resulting capital gain is what? Long term. The management has identified a potential buyer, Lion. There are two options. One is divesting slump sale and the next one is demerger. Sorry, if it is demerger and instead of paying consideration money, if they give shareholding and all the assets and liabilities are, what are the demerger 5 conditions, sir? All the assets and liabilities of the undertaking has to be transferred. Has to be transferred at what? Book values. Third one what? For for the parent company, the shares has to be issued in the resulting company. At least 75% shareholder shall be continuing, okay, as a going concern. If the demerger conditions are satisfied and if it is made as a demerger and the resulting company, if it is an Indian company, so this Lion Limited, if it is an Indian company, then there won't be any taxability on demerger. So they can escape from taxability. If they go for slump sale route, what is the taxability? 500 lakhs is the sale consideration minus 340 is what? Cost of acquisition. How much is the long term capital gain? 160. So 160 into 12.5% plus surcharge plus cess has to be paid as tax. Slump sale means transfer of one or more undertaking without individual value being assigned. Any profit arising from slump sale which is held for more than 36 months was taxable as what? Long term capital gain, liable to 12.5 plus cess plus 4. So total taxability is how much, sir? Okay, 22.256% effectively. Correct only, yeah? No, sir. This would be wrong. The tax once checks are correct or not. 160 lakhs into first 12.5% means how much? Rate wrong. This effective rate percentage wrong. These rates are correct only. Effective rate percentage is wrong. I think it was like added all the 4. Then also wrong only, right? 12.5 plus 7, 19.5, 23 point. Answer correct only, then fine. So this effective rate, first this sentence itself is not needed for us. Okay, why to do effective rate? On 160 lakhs, first levy tax 12.5. And then on that levy, what? Surcharge at a rate of 7%, cess at a rate of 4%. So the tax will be how much? 22 lakh 25,600. In the first route, we need to pay how much? Slum sale route, 22 lakh 25,600. If at all demerger and all the conditions are satisfied, no tax at all. So it is advisable to prefer what? Demerger than that of sale of automobile division. Then question number 11, sir. 11. Sir, X Limited has how many units? 2 units. What are those two? A, B. Engaged in operating a warehouse for storage of computer peripherals and mobile spares, respectively. Since when? 2017. Y Limited takes over Unit B of X Limited by way of slum sale for how much, sir? 350 lakhs. For that, the transfer related expenses are how much? 10 lakhs. So what is the net sale consideration? 340 lakhs is the net sale consideration here. Balance sheet of X Limited. Unit A, fixed assets, debtors, inventory. Unit B, fixed assets, debtors, inventory. Paid up share capital, general reserve, revaluation reserve, bank loan, creditors. Other information. Fixed units of Unit B include a land purchased for 50 lakhs and revalued to 160. Its stamp duty value is only 150. Fixed assets of Unit B includes a plant and machinery acquired from Unit A for 30 lakhs. Okay, now what is the profit on transfers from? What is the profit on transfers from Unit A to Unit B? So there is only one transfer, right, from Unit A to Unit B. Fixed assets of Unit B includes a plant and machinery acquired from Unit A for 30 lakhs. And that also they didn't say which year. So first point, actually we cannot do it clearly, sir, because there is no clarity regarding in the question. Why? Because fixed assets of Unit B includes a plant and machinery acquired from Unit A for what price? 30. Okay, that is the only information available in the question. And they are asking what is the profit on transfer from Unit A to Unit B. So maybe, so since only this particular plant and machinery is transferred from Unit A to Unit B, on that what they are asking what is the profit? What is the profit on transfer na WDV of plant? That also how can we take it as plant of WDV of plant? So this point, sir, first forget about this. Then come to the normal capital gain computation, sir. What is the normal capital gain computation, sir? First we have sale consideration. What is the sale consideration? 340. To apply rule 11 UAE, they didn't even market values and all. So directly we have to take whatever is the money, that only. To apply rule 11 UA, there is no information available. So sale consideration 340. Minus we want what? Cost of acquisition. What is cost of acquisition? Assets minus liabilities. What are the liabilities we need to take, sir? Reserves to paid up share capital not required. Liability side. Bank loan 70%. So 115 into 70%. How much, sir? 280 into 45%. 1. Right. This. What is the total of liabilities? 206.5. Then asset side. Fixed assets is how much, sir? 280 here. But they given like what? Fixed assets of Unit B includes land purchase 50 and revalued to 160. Stamp duty value is 150. Sir, in books, usually fixed assets will show after revaluation, revalued figures only we might be showing. In this 280, if 160 lakhs is fixed assets, balance 120 lakhs is what? Other fixed assets. Here fixed assets land. 160 lakhs is related to what? Land. Sir, how can I say 160 lakhs only related to land? In books, usually will not show if revaluation is done as per accounting books. If revaluation is done, then the asset value will show at what value? Revalued figures. Since we not at stamp duty values, will show at what? Usually in accounting, revalued figures. So 280, 160 lakhs is the revalued figure of land. The other 120 lakhs is what? Other fixed assets. Other fixed assets. Now take, sir, here 160 lakhs is the land revalued price. We'll take revalued figure of book value. Book value. So we'll take only land price how much? Sir, let me show you here. To find out the assets cost. Fixed assets we are starting with. Fixed assets total is how much? 280. But in 280, the book value of land is only 50. Revalued value is how much? 160. So, but in this 280, we have to consider like not book value. Which value is included? Revalued amount is included. So, 280, land is 160. The other 120 is what? Other fixed assets. So, land value I am taking only 50. Why not 160? Revaluations has to be ignored. Land 50. Others how much? 120. Plus debtors how much, sir? 175. Debtors, book value. Inventory, we need to take what? Book value, 100. So total of assets is how much, sir? 445 lakhs. How much they got? 445 only. But what did it means? First they took land value 50. Instead of taking 120, they took 30 and 90 separately. Why? If you see here, fixed assets of Unit B even includes a plant and machinery from Unit A for how much? 30 lakhs. So the 30 lakhs also has been taken separately. Then balance will be how much? 90. But what we did? We did like together 120. So 50, 120, debtors, book value 175, inventory 100. So total of assets is how much? 445. Minus total of liabilities is how much? 206.5. So what is the net worth? Net worth is how much, sir? 445 minus 206.5. 238.5 lakhs is the net worth. Sir, how do we got net worth here? Assets minus liabilities. Total assets are again unit be only transferred. Okay, please be careful, sir. Debtors nothing to be done, book value take. Inventory nothing to be done, book value. Fixed assets were given 280, but in this 280 only land also included, plant and machinery also included. So plant and machinery 30, subtract. How much is there still? 250. Out of 250 revalued figure of land is how much? 160, subtract. Other assets is how much? 90. So other assets 90, plant and machinery 30. Land is at 160, but we'll take 160. Yeah? No, we'll take only book value 50. So the total of assets is 445 minus outside liabilities 206.5. 206.5, then the net worth is how much? 238.5 lakhs. If you see here, sale consideration is there. How much? 340. How 340, sir? 350 lakhs minus related expense how much? 10 lakhs. If you subtract 340. 340 minus this 238.5. How much? 101.5 lakhs. If it is under demerger, then there is no tax itself. So which is better always? Demerger is only better. Okay. Then. So we are almost towards the end of the chapter, sir. Okay, so we'll discuss, since we have 10 minutes, the theory part we'll discuss, sums and all we can do tomorrow. So tomorrow, some 40 minutes if it takes also, then we can start with NR taxation. Section 47(14), Section 47, subsection 13. Conversion of sole proprietorship concern into a company, conversion of partnership firm into a company. Sir, amalgamation done, demerger done. Now, sole proprietorship to company, firm to company. Then the third one is what? Company to LLP. So company to LLP we'll discuss at last. So now what? Like sole proprietorship to company or firm to company, succession is being happen. Conversion of sole proprietorship concern to company, conversion of partnership firm to company. When a sole proprietorship is converted to company, in the process, the sole proprietor assets will become assets of what? Company. The capital assets transferred is not a transfer. Capital gains will not attract when satisfaction of conditions. Here also, firm converted into company. Now what happens? Firm assets will be transferred to company. Then such capital asset transfer is also not a transfer. Capital gains will not attract. But on satisfaction of these conditions, what are those? All the assets and liabilities has to be transferred. First one is what? All the assets. Sir, this is one point common in all the conditions. All the assets and liabilities has to be transferred. Second one, consideration is only by way of shares in successor company. This is also common. Amalgamation also consideration should be through shares. Demerger also consideration should be through shares. Here also consideration should be through what? Shares in the successor company. Third one, proprietor or all the partners together shall have more than or equal to 50% voting power in the resulting company. All the partners shall have greater than or equal to 50% of voting power in the newly formed company also. Sir, there what they said? The old shareholders shall continue for 75%, at least 75% of the shareholders shall be continuing in the new company. But here in conversion what? Sole proprietorship converted into company. Now the sole proprietor should have in company at least 50% share capital. Now firm converted into company. Now all the partners together should have 50% share capital or voting power in the company. Understand? Okay, all them shall have more than or equal to 50% voting power. And they should maintain, there is a lock-in period also. For demerger, there is no lock-in period, sir. Like through demerger, if you get a new share in the resulting company, there is no lock-in period like how long you have to keep those shares. But here there is a lock-in period also. When you convert sole proprietorship to company or firm to company, he remains to be shareholder in the company also. For how long? Maintain the same voting power for 5 years from succession. Sir, certain shares can be sold, but it should not in any case drop below 50%. If it drops below 15%, then it is a violation of conditions. What are the conditions here? All the assets and liabilities has to be transferred. Second one, sir, consideration should be given in like shares in the successor company. Third one, proprietors are all the partners. If it is sole proprietorship, proprietor, firm, all the partners together should hold more than or equal to 50% in the successor company. Then fourth one, they should not, their shareholding shall not fall below 50% for the period of 5 years even after succession also. Then fifth one, sir, this is only to firm. All the partners should become shareholders in the company in same proportion to their capital accounts in the firm, not in the proportion of profit sharing ratio, in the proportion of their capital accounts. Sir, capital ratio, profit sharing ratio might be different, but they should become shareholders in the company as in which ratio? Capital ratios only. Okay, 1:1:1. Okay, so together in company, in successor company, they got 60%. Now ABCR partners, before succession, they used to have 1:1:1 ratio. Now in the company, all the three together got how much percentage? 60. Now each should have how much? 20, 20, 20, assuming this is capital contribution ratio, not profit sharing ratio. Okay, 20, 20, 20. Let's say. It is like 2:1:1. Then capital contribution ratios. Now out of 60, how much should be there, sir, for them? For A, 30% shareholding should be there in the company. B, 15%. C also 15%. So like that, the same capital contribution share only should be their share capital ratio also among them if you compare. Not as a whole company if you compare. Among them if you compare, it should be in the same capital contribution ratios only. Then withdrawal of exemption. When any conditions are violated, then the gains from transfer of capital asset which are previously exempted will be taxed in the hands of successor in the year of violation. So total how many conditions are there, sir? Firm na 5, individual na 4 only. What are those 5, sir? Common 4 we'll discuss first. All the assets and liabilities has to be transferred. Consideration only through shares. Third one, this proprietor or partners together should have 50% shareholding in the successor company. Fourth one, they should maintain the same shareholding for a period of 5 years. And the last one for firm only, sir. Whatever are their capital contribution ratios in the firm before succession, the same ratio should be there in for their shareholding also in the successor company. If any of these conditions initially satisfied, they claimed exemption. But later on, for 5 years they have to be the right. Later on violated, then what? The exemption given will be withdrawn, considered as income and taxed in the year of violation. Sir, what 47 3B? What it is? This also, see, conversion of private limited company into LLP or unlisted public company into LLP. See what? Company has been converted into LLP. Capital asset transferred. It is also not a transfer, no capital gain. But again, conditions has to be satisfied. But here how many, sir? 7 conditions has to be satisfied. What is happening here? Company to LLP. Listed or public limited companies. Yes, listed company alone cannot be converted. If converted also, these gains will not, this exemption will not come. Either unlisted public company or even private limited company converted into LLP, this exemption is available. First one, all the assets and liabilities has to be transferred. Common one. Second one, all the shareholders of the company shall become partners. All the shareholders of the company shall become partners. Okay, and their partners ratio should be what? And their profit sharing ratio shall be the same as their shareholding proportion. Sir, 5 shareholders are there. A, B, C, D, E. Each has 20% in the company. Now in LLP also they should have what? 1:2, 1:2, 1:2, 1:1 ratio. It is nothing but 20, 20, 20, 20, 20 only. Their voting power also. Consideration is only by way of share in LLP. No money has to be paid. Only the share in LLP. Fourth one, aggregate of all shareholders together should have profit sharing in ratio in LLP should be for minimum of how much? 50%. Sir, even in sole proprietorship to company, firm to company also this restriction is there. In successor entity, they should have minimum how much? 50%. When the company converted into LLP also, all the shareholders together, the share in company should be how much? Minimum of, all the shareholders of company together in LLP should have a consolidated shareholding, share of how much? 50%, and that should be continued for a minimum period of how much? 5 years. So these 4 are like common only, sir. They are also there. They are now what? Firm to company also these conditions are there. What? All assets has to be transferred. Consideration should be only through share in the successor. Third one, partners. Profit, the shareholders should get in their shareholding ratio only the profit sharing ratio in the LLP. Then the fourth one is here what? All the shareholders together get at least 50% share in the LLP. And it should be continued for a minimum period of how many years? 5 years. Then the company which wants to convert into LLP, its turnover should be within 60 lakhs in all the 3 years. If its turnover is more than 60 lakhs, then it cannot convert. Even if it converts also, exemption is not available. The turnover of the company in all the 3 years should be within how much? 60 lakhs. Then the assets, book value of assets of the company should be within 5 crores in all the 3 years before conversion. Then no amount can be paid to any partner from accumulated profit. Sir, company will have accumulated profit under where? Reserves and surplus. Okay, now once company converted into LLP, that becomes LLPs. From that money, any amount should not be paid to partner until the 3 years from date of conversion. So, sorry, accumulated profit, nothing but it is reserves. If from there, if it is given as dividend, as a company dividend is taxable. Now what they are doing to avoid the tax, they are converting into firm and distributing it to shareholders. But if you see, when firm distributes profit to shareholders, they can claim exemption. Sir. When company gives it as dividend to shareholders, it is taxable. But firm gives it, the firm shares the profit to partners, it is exempted. So what they are doing, company has accumulated all the dividend, all the profits. Now instead of giving it as dividend, they'll convert into firm and immediately declare it as immediately give it to the partners. So that's why in that way they can they can escape the tax liability. So to prevent that, what they are saying, like once you convert into LLP, there's a lock-in period for 3 years. That reserves, that accumulated profits you cannot touch, you cannot use by way of paying it to partners until the expiry of how many years? 3 years. What are all the 7 conditions, sir? All assets and liabilities. Consideration should be only through share in LLP. Third one, like the shareholders should get the partnership share also in the same as their shareholding ratio. Altogether, all the shareholders should have at least 50% shares even in the LLP also, and it should be maintained for a period of 5 years. The turnover of the company in all the 3 years should be within 60 lakhs in all the 3 preceding years. Then the net book value of assets also should be within 5 crores. Then the next one is what, sir? The last one, no amount can be paid to any partner from accumulated profit in the company account for 3 years from date of conversion. Then 72A, sir, simple one, we already discussed only. We know all this. What? Business loss can be carried forwarded for what? 8 years. Fresh 8 years are like from the assessment year in which loss first reported, whereas unabsorbed depreciation indefinitely. Sir, here also business loss other than other than speculative. Okay, sir, to get this set of benefit, carry forward benefit, what? All the above conditions only has to be satisfied. No extra conditions. The previous conditions only. If they are satisfied, fine. If any of them are violated, then the loss which was made already set off will be again considered as income in the year of violation. In the year of violation. Sir, when there is a succession of business other than death. Okay, in any way, sir. As a going concern, you are selling sole proprietorship, you are selling your business to someone else. So predecessor business transferred to successor other than by way of death. Then income up to date of succession is taxable to predecessor. Income after succession is taxable to successor. That is normal thing only, sir. Up to date of succession, up to date of amalgamation, whatever income is there, taxable to predecessor. After amalgamation, successor. Okay. So predecessor, successor. The income up to succession is taxable to predecessor. From succession is taxable to successor. Where predecessor cannot be found. He sold business and left the country. Predecessor can't be found. Then entire income is taxable in the hands of successor. Okay. So with this we have completed the provision, sir. Then we discussed about what? Conversion of a sole proprietorship concern into company or conversion of a partnership firm into company. Sole proprietorship into company or firm into company. Sir, in this conversion, sole proprietorship to company, certain assets will be transferred. When firm is converting into company, also the firm assets will be transferred to company. Whether such a transfer amounts to transfer under capital gains? No, it is not a transfer. No capital gain will arise, provided certain conditions has to be satisfied. What are those? All the assets and liabilities of predecessor shall become assets and liabilities of successor. Consideration shall be only by way of shares in the successor company. No money shall be paid. Only shares shall be given in the successor company. Third one, if it is sole proprietorship to company, this sole proprietorship should get at least 50% shareholding in the company. If it is firm to company, all the partners in the firm together shall get a minimum 50% shareholding in the company. And those shareholding shall be continued for minimum of how many years, sir? 5 years. Then for the partnership alone, sir, the next condition, all the partners shall become shareholders in the company. Fine. But their shareholding pattern also should be equal to their capital contribution ratio in the firm. To their capital account ratio in the firm, not to the profit sharing ratio in the firm. In the firm, what is their capital account ratio? With the same ratio only they should have. Continuing even in the company also. If any of the conditions are violated, then the gains from transfer of capital gains previously exempted will be taxed in the hands of successor in the year of violation. Then we discussed even conversion of private limited company into or unlisted public company into LLP. What are the conditions? That is also, in that process also, if any assets transferred, that is also not a transfer. But certain conditions has to be satisfied. What? All the assets and liabilities has to be transferred. All the shareholders shall become partners and their profit sharing ratio in the LLP shall be same as to that of their shareholding proportion. Consideration is only the share in LLP. Aggregate of, first all the assets and liabilities has to be transferred. All the shareholders shall become partners. Okay, and their how their profit sharing ratio should be there as per their shareholding pattern. Let's say each having 10%, then profit sharing ratio also should be same 10%, 10% like that only it should be there. Consideration they should get is not in money. They should get only share in LLP, nothing else. Next, all these shareholders together should get minimum 50% power or 50% profit share in the LLP. And that should be continued for how many years, sir? 5 years. The turnover of the company in any of the last 3 years should be within 60 lakhs. Not even in a single year also it should be more than 60 lakhs. Then their total assets in books of accounts, book value of assets, which should be how much, sir? Within 5 crores for the last 3 years. In any of the 3 years, it shouldn't be more than 5 crores. Last one, no amount can be paid to any partner out of the accumulated profits of the company on conversion to firm for a period of 3 years from date of conversion. Again, set off and carry forward of losses are same. Other than speculative, they can be carry forward and set off by successor. How many years? 8 years from the day in which the loss has been first reported. Unabsorbed depreciation can be carry forwarded. How many years, sir? Unlimited. No restriction at all. But however, if the conditions are not satisfied, those conditions, then whatever is the loss set off or unabsorbed depreciation set off will be claimed as again income in the year of violation and it is taxable. So now come to the workbook, sir. So read the question, sir. Question number 12, page number 8.15. What happened? ABC converted itself into a company as on 31st December 2025. As on the date of balance sheet of the firm is as under: machinery 1 lakh, investment 50, stock 70, Tata 60, bank 20. Creditors A, B, C capitals. Following values were agreed upon on conversion: machinery 1 lakh 20, investment 2 lakh 50, stock 90, Tata 60. The firm fulfilled all the conditions and partners' accounts are settled by way of issue of equity shares in the capital ratio. Sir, then what happens? It is not a transfer, no capital gains will arise. However, on 1st December 2026, all partners transfer their share. Sir, if all partners transfer their share, already firm converted into company. At the time of transfer, no problem, condition satisfied, no capital gains. But later on, the conditions, what are the conditions, sir? Like what is the condition here? All the partners together should hold how much percentage minimum? 50% in the company. And they should continue to hold it for how many years? 5 years. But since here they didn't hold it for 5 years, there is a violation of condition. So if there is a violation, what happens? Whatever the gains exempted will be again taxable in the hands of whom? company, because now the firm is no more there. So it will be taxable in the hands of whom? Company. So see, as per section 47A3, where any of the conditions laid down are not complied, the gain exempted shall be charged to tax in the hands of successor company in the previous year in which the requirements are violated. One of the condition is that partner of the old firm cannot transfer till how many years? 5 years. In the given case, all partners hold shares, hence earlier exempted gain will be revoked. It is taxable. So first we need to calculate what will be the gains. Sir, what is the fair market value of conversion? The following values are agreed. So these are treated as what? Sale considerations. For machinery, what value, sir? 1,20,000. Okay, see, for machinery 1,20,000. WDV is how much? 1 lakh. So what is the machinery related capital gain? 20,000. Then investments related, what is the investment value? 2,50,000. What are the investment book value? 50. 2,50,000 minus 50. Long term capital gain here is how much? 2 lakh. Sir, why we are not calculating for stock and debtors? Stock is not a capital asset. Debtor is not a capital asset. Since these two are only capital assets, for these two only capital gains will arise. For machine 1,20,000 depreciable asset. For depreciable asset, what is the cost of acquisition, sir? For machinery, you need to know, you need to go to 50A. So there we'll discuss about in capital gains chapter, it will be there, sir. For depreciable assets, what will be the cost of acquisition? Return on value. 1,20,000 minus 1,20,000 is the capital gain. For investments, 2,50,000 is the sale consideration. What is their cost of acquisition? 50. You subtract 2 lakhs. Sir, they were acquired in 2004. That's why it is what? Long-term capital gain. Sir, for machinery, depreciable assets, always the resulting capital gain is short-term capital gain. That's why here long-term, here short-term. Okay. Profit on transfer of stock by firm. Sir, here stock value is how much? 70. But they are taken for how much? 90. Here also profit is there how much? 20. But this 20 is not taxable as per capital gains. This is taxable as for what? PGBP, business income. Okay. Profit on transfer of stock, 20,000 being is taxable as business income of the. Yes, business. Sir, again, one more thing. This violation of conditions, the amount will be again taxable in the hands of. Here, this point is also important, sir. Here we discuss certain conditions. On satisfaction of those conditions, capital gains is exempted. Business income is not exempted. So, in the year of transfer itself, when stock is transferred 70,000 worth to 90,000, then the 20,000 gain they got is taxable in the year of conversion only. Okay, because the exemption is available on succession is only with related to capital gains. We didn't discuss about the exemption related to business income. So here they have a business related gain also because of succession, 20,000. That 20,000 is taxable under the PGBP head only in the year of succession itself. That also to whom? Predecessor only, because the gain is to predecessor. But for machinery and investments, capital gain section given an exemption stating like it is not a transfer, no capital gains will be attracted. But since they didn't satisfy the conditions, they violated the conditions, the capital gain exempted is again being taxed. Okay, so this 2 lakhs long term, 20,000 short term. This 20,000 is taxable for which year? In the year in which succession is happened. But here, sir, what happened actually? Succession is different here. Sir, this long term capital gain 2 lakhs and this 20,000 is for which year, sir? 1st December 2026 this has happened. So that means previous year 26-27. So assessment year 27-28. Okay, computation. Okay, keep a line here also, sir. The capital gain, long term capital gain and short term capital gain are taxable to company. In assessment year 27-28, not in assessment year 26-27. Why? Because look at the question, sir. When they violated the conditions? 1st December 2026. Since they violated in 1st December 26, which previous year? 26-27. That means for which assessment year? 27-28. Whereas this business income is taxable in 26-27 only. Because in the year of succession only that is taxable. Whereas this capital gain is taxable when? Subsequently in the year of violation. Violation happened in the year 27-28. So here capital gain is for 27-28. This is for 26-27 only. So look at the answer, sir, once again, if you have any doubts. When capital assets are transferred, what? Not a transfer. Capital gains not applicable when the conditions satisfied. Whereas for business assets, if any gain arises, taxable under head PGBP to predecessor in the year of succession. In the year of succession. Whereas here, subsequently conditions violated. Subsequently conditions violated. What happens? Taxable to, okay, capital gain exempted will become in which year? In the year of violation. In the year of violation. In whose hands? In hands of successor. in hands of successor. Arihant Motors Noida is a partnership firm having how many partners, sir? 3 partners. X, Y, Z. Their ratio is how much? Profit sharing ratio? 3:2:1. It was taken over by Anand Limited. All the assets and liabilities taken over. The capital assets, capital accounts are in which ratio? 10:8:6. So 10:8:6. In other way, 5:4:3. Anand has only 2 shareholders, namely A and B, having equity capital. Sir, in the new company, okay, already they have how many shareholders? A and B, capital of 10 lakhs each. Okay, so already the company is having how much capital? 20 lakhs. Now the company further allocated shares worth 10, 8 and 6 lakhs to XYZ. So how much shares has been added? 10, 8 plus 16, total how much? 24 lakhs added. So what is the total share capital of the company? 44 lakhs. Sir, this new shareholders X, Y and Z together, how much they got the shareholding in Anand Private Limited? Sir, out of 44 lakhs, they had how much? 24. So 24 by 44 lakhs into 100 means how much? 50? 54.5. Minimum how much should be there? 50. So that condition is being satisfied, no problem. Analyze the above situation in the light of the condition specified under section 47.3. Transaction not recorded as transfer. Here condition satisfying only, sir. It is not a transfer. No capital gain will arise. Second one. Suppose shareholder X sells his entire shareholding to Y for 12 lakhs on 1st January. What will be the tax implication in the hands of X and Anand Private Limited? Sir, see. So look at this point. The condition D says what? Sir, here what is the aggregate of shareholding in the company of the partners of the erstwhile firm is not less than 50% of total voting power in the company, and their shareholding continues to be for a period of how much? 5 years. Now look at the interpretation. The aggregate of shareholding of the company in the partners is not less than 50% of the company, and their shareholding continues to be as such for a period of 5 years from date of succession. Now what happened? X sold his shares to Y. Now what happens? Therefore, if X sells the entire shareholding to Y, then still remaining partners Y and Z together hold what? More than 50%. Sir, if X sells that to A or B, then it is a problem. To the same partners only, old partners only, they said, nah. So all the old partners together now, even X sells also still holds more than 50%. So not a problem. Okay. But when it might be a problem, when X sells to someone outsider other than Y and Z, then their shareholding cumulatively drops below 50%. Then it is a violation of condition. So holding not less than 50% in the company and no capital gain arises in the hands of Anand Private Limited. The next one, sir, what is the third one? Where there is any change in your answer, if company allotted 3,000 debentures of 100 each to the 3 partners in the profit sharing ratio besides the equity. Yes, their shares only should be allotted, not debentures. If debentures allotted, then capital gains will be applicable, sir. It is taxable only at the time of conversion itself. How much is the short-term capital gain that will arise, sir? Anything mentioned here? Issues equity shares along with debentures, sir. Will there be any change in your answer if the company allotted 3,009% debentures to the 3 partners in the profit sharing ratio besides the equity share started earlier? I mean, they'll get equity as well as debentures also. Now see what they are saying. Short-term capital gain of 2 lakhs which arises in the hands of... Okay, sir. This is still the second point related only. We discussed about company perspective. For company wise, what? Successor still 50% is holding, no problem. But for X, for what is the share value, he is having 10. But he sold for how much? 12. So for him 2 lakhs capital gain will come. For shareholder, because 10 lakhs worth of shares he is selling for 12 lakhs. For him capital gains will come. But for company, no capital gains will arise. Why no capital gain will arise? Because still, even with the sale of X shares also, the remaining partners continues to hold together more than 50%. So it's not a problem. But for shareholder, sir, originally he has allocated shares worth how much? 10 lakhs. But now he is selling for how much? 12 lakhs. So he has a gain of 2 lakhs. That is taxable only. Sir, this 2 lakhs is not because of succession being taxed. Succession time exempted only. His firm 10 lakhs capital is there. That became share in company. At the time of conversion, nothing is taxed. Subsequently, after conversion, he is selling his 10 lakhs worth of shares to 12 lakhs. So he is having a gain of 2 lakhs. That 2 lakhs is taxable. Now the last point, sir. This is the third point. If the company issues debentures along with equity shares, the above condition gets violated. What condition? C condition. The partners of the firm do not receive any consideration other than share, directly or indirectly, other than by way of allotment of shares in the company. Okay, and that also all the 3 partners received only equity in this case also. But here what happened? They got even debentures. Hence the firm will not get exemption. Capital gain arising from such transfer will be taxable because they got other than shares also. Okay, so this is question number 13. So now go through question number 14, sir. Question number 14. Balance sheet of Handu and Handu Private Limited. Land, building, machinery, investments, current assets, equity share reserves. Okay. Company converts itself into what? LLP. All assets are transferred to LLP. Okay. Total number of shareholders in the company 4. Each has 25%. Fine. On 28th February, the LLP has transferred land to Animesh for a consideration of how much? 63 lakhs. What is the land value? Acquired for 10 lakhs. Who is Animesh? Anywhere mentioned as shareholder or something? Nothing. For a consideration of 63 lakhs. Sir, first they'll calculate capital gain, sir, but see, they'll say like entire capital gains is exempted. Violate అయిందా ఇక్కడ? ట్యాక్స్ ఎలా పోతుంది అసలు? కంపెనీకైనా అదే లాంగ్ టర్మ్ క్యాపిటల్ గెయిన్ ట్యాక్స్ రేట్, ఫర్మ్కైనా అదే లాంగ్ టర్మ్ క్యాపిటల్ గెయిన్ ట్యాక్స్ రేట్ కదా. కంపెనీ నుంచి ఫర్మ్కి వచ్చినప్పుడు ట్యాక్స్ లాస్ ఏమైంది? Here also exempt only the given shareholder. Okay, so to both they computed, but ultimately they are saying what? Exempted only. To the company also, no violation is there. To company also it is exempted. To shareholders also it is exempted only. But ultimately what they are saying, like only on sale of land. Sale of land is for how much? 63. Sir, when there is a succession happened, what is the cost of acquisition to new owner? Cost of acquisition of previous owner. The 10 lakhs only subtracted. This 53 lakhs is only taxable. Rest for shareholders and for the company what they did, they have calculated gain. And again, ultimately they are writing it as what? Capital gain is exempted only. See, first, the land 10 lakhs taken over at what value, sir? 50. Where it is given, all the assets and liabilities are transferred. It was also agreed that they will be taken at market value. Okay, land 50, cost of acquisition 10, gain 40 will come. If the conditions are not satisfied, building 30. What is the written down value of building, sir? 13 lakhs. If you subtract, you will get 17 lakhs short-term capital gain. Machinery, what is the value? 6 lakhs. Machinery market value is how much? 10 lakhs. Written down value if you subtract 6, 4 lakhs short-term capital gain. Investment acquired on 18th August 2008, market value 12 lakhs, whereas cost is 4 lakhs if you subtract, here 8 lakhs. All these gains, if the conditions are not satisfied, they might have been taxed. If the conversion conditions are not satisfied. But here what happened? Entire capital gain is exempt if such conversion fulfills all the condition. However, if such conditions are not fulfilled at the conversion, then the entire capital gain would be taxable in the hands of company, because here company to LLP. Further, if later on such conditions are violated, then the capital gain will be taxed in the hands of LLP in the year of such violation. So they calculated and kept like that. Okay, so it is exempted only. But later on, if any conditions are violated, all these gains are again taxable to whom? Successor. Okay, then to shareholders also. So what are the conditions in terms of shareholder? Shareholders shall continue to hold at least minimum 50% altogether their profit share in the LLP. Then second one, what? No amount from accumulated results. Accumulated profits. How much is the accumulated profit, sir? 30 lakhs. From this 30 lakhs, no amount shall be given back to partners on conversion for a period of 3 years from date of conversion. That also didn't happen. So even for partners or shareholders also, no taxability. Capital gain is exempted only. See, first they'll calculate. If at all taxable, how much is taxable in the hands of shareholder? Sir, shareholder, what is the total net worth of the company? Land 50 lakhs, building market value 30 lakhs, machinery 10 lakhs, investment 12 lakhs, and there is a current asset also. Realizable value how much, sir? 7 lakhs. 7 lakhs. Okay, so total worth of assets is how much? 1 crore 9 lakhs. Sir, all the assets of company belongs to whom? Shareholders only, right? So the total value of assets is how much? 1 crore 9 lakhs. 4 shareholders, each has 25%. So how much is their share? 27 lakh 25,000. And out of this 27 lakh 25,000, there is already equivalent of reserves. Okay, so to the extent of reserves, if anything is being distributed, that has to be treated as what? Deemed dividend. Out of the accumulated profits from company, if anything is being distributed or to be distributed, even at the time of liquidation, such amount has to be treated as deemed dividend. So ante company profits nunchi, from company's accumulated profits, if anything is going back to shareholder, at whatever the time, either at the time of liquidation or at the time of buyback or at the time of normally as dividend also, to the extent of accumulated reserves, we need to treat it as what? Dividend, deemed dividend only. Sir, why has to be treated as dividend? Because dividend tax rate is different, capital gain tax rate is different. So here, it has to be received as dividend only to the extent of out of, sir, the total gain they have is 1 crore 9 lakhs. But out of 1 crore 9 lakhs, 30 lakhs is accumulated profit only. So that 30 lakhs you treat separately, balance you have to treat separately. Here, already, by taking at this values itself, already they have a profit of how much? 30 lakhs. So that means that 30 lakhs is already earned profit. So that has to be treated as like what? Dividend only. Now, what extra profit, how extra profit we got now? The extra profit we got now is because land is now taken at market value. Buildings, machines, all these are taken at, sir, what happening when you are selling a company? When you are selling a company, you will be disposing at what values? Market values. So the difference between book values and market values is only the extra amount. 30 lakhs is reserves and surplus related, already earned profit. Even the company is going concern also, still they are having already 30 lakhs worth of profit earned. Now if the company is selling all the assets, they got extra how much? This 30 minus 1 crore 9, they got extra 79 lakhs now gain because of selling the assets at a rate of market value. Okay, now out of the total gain 1 crore, out of the total money 1 crore 9 lakhs, what they are seeing, sir, to be received by each shareholder, how much? 27 lakh 25,000. But they'll get share of dividend also, which was already earned. How much? 30 lakhs into 25, 7 lakh 50. So from 27 lakh 25,000, if you subtract 7 lakh 50, how much is for shares? 19 lakh 75,000. Full value of consideration is how much? 19 lakh 75,000. From their indexed cost of acquisition, how much? There is no indexation, sir, but cost of acquisition. What is their share capital? 10 lakhs. Each share capital will be how much? 2 lakh 50. If you subtract the 2 lakh 50, long-term capital gain will be 7 lakh 50,000 only. The other 7 lakh 50, if taxable, that would be taxable as what? Deemed dividend. Whereas this 7 lakh 50 is taxable as long-term capital gain. Sir, here no capital gain or dividend taxability will attract. Why? Because this is treated as a succession. When it covered under the terms of succession, what we'll assume, like there is no change also we'll assume. If there is no change happened, here it is not even taxable. Even dividend is also not taxable in this case. But if at all conditions are violated, then what happens? Then this dividend 7 lakh 50,000 taxable and this long-term capital gain 7 lakh 50,000 also taxable. So when a company, if the conditions are not violated, then how it has to be treated? Company going for liquidation. Here conditions are satisfied, then what we are treating is like company converted into LLP. If conditions are not satisfied, then first we have to treat it as what? Company liquidating. Then again a new LLP is being formed. When company is being liquidated, out of accumulated profits, how much ever is the profit being distributed, such to the extent of accumulated profits distribution, we need to treat it as deemed dividend. To be treated as deemed dividend on account of liquidation. To the extent of accumulated profits, if anything is being distributed, that extent, it has to be treated as what? Deemed dividend. So total their distribution for each shareholder is how much, sir? 27 lakh 25,000 is distributed for each shareholder. Sir, here it is 17 lakh 50, sir. Correct it, not 7 lakh 50. It is how much? It's wrong. The answer is 19 lakh 75 minus 2 lakh 50, how much, sir? 17 lakh 25,000. Correct it. 17 lakh 25,000. For each shareholder, how much money is being received here? Total value of assets is 1 crore 9 lakhs. Out of 1 crore 9 lakhs, each shareholder will get how much, sir? How much it is? 27 lakh 25,000. Sir, out of the 27 lakh 25,000, 2 lakh 50,000 is capital only, which cannot be taxed. Cost of acquisition. Okay. Balance benefit, how much he is having? 24 lakh 75,000. Out of this 24 lakh 75,000, what is the amount he is receiving to the extent of dividend? I mean from accumulated reserves. 30 lakhs into 25%, how much? 7 lakh 50,000. To the extent of 7 lakh 50,000, we treat it as what? Deemed dividend. So okay, the balance amount, how much? 24 lakh 75 minus 7 lakh 50. So this only has to be treated as what? Long-term capital gain. So each shareholder will get this much money. 27 lakh 25. But 2 lakh 50 is investment only. Cost of acquisition, that is not taxable. Balance gain he got how much? Sir, originally he kept in company 2 lakh 50. Now he is getting how much? 27 lakh 20. Overall gain he made. It may be dividend or whatever the name you call. First his gain is 24 lakh 75,000. But what they are saying, out of this 24 lakh 75,000, to the extent of accumulated profits, we need to consider it as what? Deemed dividend. The balance we need to treat it as what? Long-term capital gain. When this is taxable? If the conversion conditions are not satisfied. But here they are saying like conditions has been satisfied, hence nothing is taxable. If conditions are violated, then this amount has to be taxed. Sir, okay, let us come back to this question. Sir, in this question actually, what happens? Patel & Co. Private Limited is having 4 individual shareholders. Arun, Bimal, Chirag, Dhaval. It was decided to convert the company into an LLP by Patel LLP. Okay. Company has brought forward depreciation of 5 lakhs and business loss of 10 lakhs. Shareholder does not want to continue in the business and wants to transfer. Sir, what are their shareholdings, sir? 25 only, right? You are the tax counsel of the company. Explain briefly the conditions to be satisfied by the company to have relief from capital gain on conversion into LLP. Also state the timing to exit shareholder. Sir, actually, here they wrote general conditions, sir. They didn't give we missed the conclusion here. What are the general conditions when a company converts into LLP? Okay, so all those points which we wrote, like all the assets has to be transferred. All the shareholders shall become partners, and their profit sharing ratio in LLP shall be same as their shareholding pattern. Consideration is the only thing in the share in LLP. Aggregate of all shareholders profit sharing ratio in LLP should be greater than or equal to 50% and should maintain it for 5 years from date of conversion. Company to turnover sales should be within 60 lakhs in all the 3 years. Value of company assets in books of accounts is within 5 crores in the 3 years of conversion. No amount can be paid to any partner out of accumulated profits. All those conditions only they have written here. 2, 3, 4, 5, 6, 7. In the company has brought forward loss or unabsorbed depreciation. If all these conditions are satisfied, then brought forward loss and unabsorbed depreciation also can be taken as the loss and depreciation of successor, which can be carried forward for 8 assessment years, starting from the year in which the first loss was recorded. Okay. Now the point is what? That means done. The point is here. State how timing of exit of shareholder of Bimal to be made from LLP so that it does not lose the benefit of set off of unabsorbed depreciation and brought forward of business loss. So previously we solved one more question, sir. Where? Which question? Like question number. If you look at question number 13, what happened? Firm to company. In this, X sells his entire shareholding to whom? Y. Entire shareholding to Y. So when it is sold by X to Y also, their shareholding still remains to be how much? 50% only. So nothing is impacting the company, the resulting company. Only to the shareholder, 2 lakhs capital gain is taxable. Okay, sir. But that is the case where firm to company. Here, now the current question is about what? Company to firm or company to LLP. Okay, we'll go back and see the conditions also. All the assets and liabilities has to be transferred. Consideration is only by way of shares in the company. Proprietor and all the partners together shall have more than or equal to 50% voting power. Maintain the same voting power for 5 years from succession. Sir, extra point if you compare here and here, all the shareholders shall become partners and the profit sharing LLP shall be same as their shareholding proportion. Sir, now here the problem is what in question number 15. Sir, once Bimal is there at the time of succession, then he should continues to be there like that only. Otherwise here what happens? See this condition. All the shareholders shall become partners and their profit sharing ratio in LLP shall be the same as their shareholding proportion. But if succeedingly, okay, if afterwards, immediate conversion afterwards, if one of the partners sells his share, their profit sharing ratio is not that of the same within the company. So this point gets disturbed. So what has to be done? If at all the Bimal wants to exit, before conversion only if he exits, there will be only 3 partners. All those 3 partners will become shareholders also and they will be continuing like that only. There won't be any violation of second point. Okay. But if he become if he become partner of LLP and then again he tries to exit, then what happens? There all the shareholders will become partners only. But the point is what? Their profit sharing ratio is not continuing in the same way as that of previously. So that's a disturbance of second point. It would be considered as what? Violation of point 2. So that's why what has to be done? If at all Bimal wants to exit, when he has to exit? He has to exit before conversion only. Okay. That conclusion is missing in the answer, sir. Here in the conclusion that is missing, but I downloaded the suggested answer also. This is the suggested answer. See, in case Bimal does not want to become a partner in LLP, he must cease to be shareholder in the company. He can transfer his shares to some other shareholders before conversion into LLP. So the unabsorbed depreciation and business loss on the date of conversion would remain intact and could be set off by the successor LLP. Otherwise it will become a violation and the successor company cannot set off. Okay. There are no other extra conditions, sir. You may think like maybe there are some other extra conditions. There are no extra conditions. For that only I did till now. I went to 72A subsection 6 also and says there. There clearly said like if the 47 subsection 8B. So these conditions are called, see 47 8B here also. 13B. So these conditions which we have written, right? These are only 47 subsection 13B. If these conditions are being satisfied, then the loss can be carry forwarded, no option. Okay. So if cannot be carry forwarded, the only violation that can be made is this point only. Okay. So what happens? If Bimal exists first itself, then all the shareholders will become partners and they continue like that only. There won't be any problem to the firm also. Okay. If firm after becoming a partner in the firm, if he exists, then it becomes a violation of second condition. The firm has to pay tax and even losses also cannot be set off. Okay. So if he wants to exit, before itself he has to exit. So this is about what? Question number 15. Sir, 16, you already know, sir. I need not to do it once again. It is nothing but about apportionment of depreciation between predecessor and successor. In what ratio? Number of days used. Okay. So with this we solved each and every question from the business restructuring, sir. Sir, again, from business restructuring, understand, sir, how the exam is going means transfer pricing, everybody on India, I mean, wherever they are, if they are doing CMA final, everybody targeting transfer pricing. Out of 3 questions, 1 question from transfer pricing. Out of DTA, 2 questions, 1 question from DTA. They are always trying to make it something new. They're always trying to make it something new. So if you only focus on transfer pricing and you think like 25 marks, I'll get 20 there only, then it will not happen. Because always they are trying to do 1 question new from transfer pricing. Okay, and one question new from DTA, because every time you've been planning. Basics also, tax planning, they are easy, sir. But the problem is like you may not recall those minute points at the exam time. Majority miss 1 or 2 points. Okay, so the point is like business restructuring, if you see, they are not going beyond the scope. Business restructuring, okay, and even when we go to appeals also, these chapters, they are not going beyond the scope. Okay, so what I'm going to say is like you don't leave these chapters as choice once again. Okay, read these chapters and also go to exam. Depending on the exam, the complicatedness, you can take, let's say, transfer pricing, all the questions came easy only. Then you give first priority to transfer pricing only. Okay, sir, I think like mostly if I'm going to write the paper now, I'll do first question number 6 to 7, DTA transfer pricing. Then I'll go to question number 3, tax planning related. Then I'll go for question number 4 is about this. Then 5 is about advanced tax, ICDS and appeals and all. The fourth question I'll take is advanced tax and appeals. Fifth question, it depends, like PGBP I may go or I may come to business restructuring and NR taxation. So the problem here is like NR taxation, has many students will get confused because of NR taxation. Because of NR taxation, they may even trying to end up with choices like business restructuring. But you put effort extra, like now we are going to start anyhow NR taxation only. They are asking, once you learn those chapters, they are asking on the basic level only. In these chapters, they are not going into advanced level, because see, simple paper setters, sir, I know if I know your mindset, then I can frame paper accordingly. I know you all prepare transfer pricing, then I'll target complicatedness in transfer pricing only. I know you will not focus much on NR taxation, so I'll ask easy question there. Even though it's an easy question, you are not going to attempt there. Every time since you are practicing transfer pricing only, now the complicated question only you're gonna do, because sir, these days institute examiners also might see YouTube, right? Don't they be only, YouTube is only available for you and the students only, not for the students only, right? Everybody will see. Majority of the, not only just me, all the faculties who are teaching DT will say more or less, maybe 10-15% there will be a difference in strategy. Rest all, every strategy will remain almost same. So because everybody will frame a strategy based on past trend only. So 10-15% difference only. Rest all will remain same. So the paper setter also might have some understanding about all the exam strategies being circulated, right? So what he'll do, he knows that okay, everyone they are saying like transfer pricing. So what they'll do, they'll be trying to something new in transfer pricing. NR taxation, he know that it is complicated only. So they are not doing something new questions also. The basic repetitive questions only, name changes, number changes only they are doing. Understand? So all the chapters which you are discussed in fast track, don't take any chapter as choice. Discuss all, read all the chapters and go to exam only. So okay, then you'll have the choice in exam hall to take, depending on which question it is tough. Who knows? Transfer pricing question only, we may have to take choice if such question is so complicated. Okay, you don't prepare your mindset like transfer pricing, I'll do all the questions, or DTA, I'll do all the questions. Who knows? Okay, so don't fix your mindset accordingly and go to the exam. Yes, you can do good, you can get good marks from transfer pricing only, but who knows? Okay, majority are last attempt what happened, they are with this fixed mindset. Transfer pricing questions only tough. So they say like obviously what, this question they don't even read. Question number 4, they are not even trying to read also. This question anyhow, they are first itself leaving it as choice. Okay, some people even 5 also they are leaving choice. That appeals, assessment, successes, or that concept also they are leaving choice. When 4, 5, last attempt 4, 5 only are the questions which could you attempt, where you can get good marks. 4, 5, 3, 3, 4, 5. It's okay. But you are targeting on what? 6, 7. Okay, so ultimately anything can happen, sir. Don't do those select to CMA final syllabus. How the institute framed is not complete syllabus. CA final syllabus, now the point is from basic to last, every provision is included. So as a faculty, they have to teach everything. So it could be asked from anything. But our final CMA final institute book is like, they didn't even include PGBP. They didn't even include capital gains. Set off carry forward, they didn't include it. So the basic interlevel chapters and all, they never included. Straight away, they'll start with assessment of companies. Now when we are discussing the other chapters, we are discussing with a limited scope. Okay, we are not discussing all the chapters full-fledgedly, which were not in our curriculum, in the institute study material. We are discussing only to the extent which were needed for us. So the point is, a question may be known to us only, but still, they may ask 1 or 2 points which were not even known to us, maybe interlevel basic, we didn't focus the year at done final level. Okay, easy question only, but the 2 points you may not get in the exam. So if you take choice in tax exams, there will always be a scope of new amendment or new way of bringing a provision. So you cannot go with 5 questions only studying and going to exam. Okay, you need to prepare at least, so I'm discussing all the 7 questions related content. Minimum 6 questions related you need to prepare and go to exam, at least 1 question choice will have. Okay na, మీరే ముందు చాయిస్ వదిలేసుకొని వెళ్తా, అక్కడికి వెళ్ళిన తర్వాత ఫస్ట్ మనం చేసే క్వశ్చన్స్ కూడా పర్ఫెక్ట్ కదా కూడా మీకు తెలియదు ఎగ్జామ్లో. ఓన్లీ ఇఫ్ యూ కుడ్ రైట్ ఫర్ 100 marks, MCQs say take like 20 marks MCQs, then there is another 70 marks. 70 marks if you get averagely, assuming half marks for each question also, you'll get only 35 plus 20, 55 only, because otherwise you don't know which question, you think you are correct, but only at the time of suggested answer only you can know what institute has taken the assumption. So avanni manaku teliyadu. See many times we are solving in question or in classroom also, 10 people will get 10 different answers. The same thing will happen even in the exam also, and you think you are correct only because you think like the provision wise what you did is correct only, and you don't have any doubt also. Okay, so మనం కరెక్టే అనుకుంటూ వెళ్తుంటాం. సో ఏది రాంగ్ అవుతుందో ఏది మిస్ అవుతుందో తెలియదు కాబట్టి ఫస్ట్ 100 మార్క్స్కి అటెంప్ట్ చేస్తే అప్పుడు ఛాన్సెస్ బెటర్ అవుతాయి. 100 మార్క్స్ రాయాలనంటే యూ నీడ్ టు ఫస్ట్ ప్రిపేర్ దీస్ చాప్టర్స్ ఫర్ షూర్ సార్. ఓకే సార్, బోత్ గ్రూప్స్ వాట్ టు డూ. non-resident taxation. Sir, minimum 1 7 marks question and 1 MCQ is there from this chapter. But in June 2025, yes, in June 2025, there is 1 7 marks question and 3 MCQs. 3 MCQs from this chapter, then it became 7 plus 6, 13 marks. 1 7 at least you can take choice. 3 MCQs you don't have the option to take choice. So NR taxation was an important chapter. So out of this, actually, if you have studied interlevel properly, these two segments are from interlevel only. Like here, like the chapter can be categorized into 5 parts. Non-resident individual taxation, non-resident individuals only. Then for general, not specific to individual, in general to non-resident tax rates and TDS rates together. Presumptive schemes. For non-resident, separate presumptive schemes are there, sir. In PGBP, we have discussed only presumptive schemes like 44, AD, ADA, AE. But for non-resident, there is series under 44B. So that we didn't discuss. We're going to discuss those presumptive schemes here. There's a new presumptive scheme also has been introduced. So there's an amendment there. Residential status, nothing new. Interlevel only. Then scope of total income. Scope of total income, na 3 rules will be there. Income received in India or deemed to be received in India. Income accrued in India or deemed to be accrued in India. Income received and accrued both outside India. For resident, how they are taxable. Resident, ROR, how they are taxable. RNOR, how they are taxable. NR, how they are taxable. We'll remember little bit from interlevel. Okay. So actually these two segments are from interlevel related only. Okay. So if I start these two first, by the time we complete these two only, you get bored with residential status. I mean this chapter. So that's why we are not starting with these two. Okay, I'm assuming you know basic residential status conditions. Even if you don't know also, no problem, because question they'll not ask us to calculate resident or non-resident. He'll straight away say like he is non-resident only. So straight away we can go with this thing. Okay, so mostly from the first 3 segments only 99% of the cases the question is coming. Okay, and then I can give you one thing, sir. If we are clear and if we can solve all the questions. Okay, sure. If we can solve all the questions from NR taxation chapter, again, I can reasonably give you assurance that within these questions only, the exam question also will come. They may change names and numbers, but the provision wise, they may not develop much more something. They cannot develop much more. So mostly, sir, in this also, from the past 3 attempts, the question is from non-resident individual taxation only. From past 3 attempts, even in the last attempt also in revision series, I said, okay, they're asking question only from individual taxation. At least to go refer individual taxation and go to exam. Then in the December 2025 also, they asked from individual taxation only. Then this is about overall. All the non-residents will be covered. Presumptive schemes, residential status, scope of total income, and if any some miscellaneous points are there, this. Okay. So 99% chance from these 3 only. Out of that 99, 70% will be from individual taxation only. For non-residents, special tax rates are applicable. Okay. For non-residents, special tax rates are applicable. Chapter 12A. For non-resident, special tax rates applicable, sir. Sir, see. Non-resident tax rates are mentioned under 2 chapters. So again, these chapters are not our syllabus chapters. Income Tax Act. Okay, Chapter 6A, deductions. The Chapter 6A also not our chapter. Income Tax Act wise chapters. Here the same way, Chapter 12A. Chapter 12 is for non-residents. 12A is for non-resident individuals. 12 mandatory. I mean, if you are covered under Chapter 12, you don't have option like I'll follow normal rates only. I don't follow Chapter 12. That is mandatory. But for 12A, so 12A is for whom, sir? Non-resident individuals. If they feel like this Chapter 12A is beneficial, then they can follow. If they feel like this is not beneficial, normal rates only better, they can come to normal rates also. So Chapter 12A is purely optional, not compulsory. Okay. Here under Chapter 12, we have sections like 115A, AC, AD, ADA. 115A, AC, AD, ADA. Sir, most of the questions, like this part, if you read, this relevant part, if you read, then I can assure you, sir, most of the cases, 90% the question will be from this area only. Okay. 115A, 115AC, AD, ADA. Here 115C2, 115I. But this attempt, since there is a new presumptive scheme introduced, so presumptive scheme also we will add. Then mostly the questions we gonna cover, I mean, mostly you can answer the NR taxation question. Okay, na? Presumptive taxation is easy only, sir. Just like as how we did in PGBP only, here also presumptive schemes, they'll tell certain conditions, they'll tell how the presumptive income to be calculated. That is easy only. This part only mostly will get confused. Okay. For non-residents, mandatory 115A, 115AC, AD, ADA. Section numbers you need to remember, no other option here. 115A, AC, AD, ADA. 4 sections. Here 115C2, 115I. Okay. So now we are first starting with this Chapter 12A. Okay. Because it is from non-resident individual perspective. Non-resident individual. This non-resident individual, sir, he might have some incomes which are covered under Chapter 12A. He might have some other incomes also which are covered under Chapter 12. So for these incomes, for certain incomes, he'll opt Chapter 12A and the tax rates. For some incomes which were not covered by 12A, then Chapter 12A, he'll come to Chapter 12. So altogether, mostly the question is asking from individual perspective only, non-resident individual. He'll have certain incomes which are covered under Chapter 12A and which some are covered under Chapter 12. We need to decide those incomes, taxability, tax rates, and you need to calculate the tax. That's what the expectation here. Okay. First, person of Indian origin. Who is called person of Indian origin? Parents, grandparents are Indian citizens. any one of them are like Indian citizens, then he's called as what? He or she called as what? Person of Indian origin. Okay. See, Sundar Pichai. Okay, he's born in, you know Sundar Pichai? You don't know? Who? Satyanadalla? Okay. Okay. Non-resident and Indian citizen. Okay, he is born in India. So he is an Indian citizen only. He may be non-resident now. Not maybe, he is non-resident only now because he usually resides where? US. Okay, but since he is born in India, he is called what? Citizen of India, settled outside India, so he is just a non-resident. His son, born also outside India only, so what happens? That he is non-resident, parents also born, parents alone born in India, he is citizen of USA, not citizen of India, but he is called as what? Person of Indian origin. He is called person of Indian origin. Okay, now, non-resident individual taxation, we are first talking about what? Chapter 12A, which is optional, So whether you are revising every day or not, but for this chapter alone, that day itself, don't even postpone also to next day. Whatever we discuss, that day itself you try to remember, sir, because so many, these conditions, provisions, small conditions and provisions, we need to remember much, memorize much, need to revise so many number of times, then only you can remember. Only when we go to questions, you can at least will not get confused. Otherwise, they'll use 7-8 points, sir, like incomes. You will not be connecting easily which section, which related income and all. Only if you revise every day. Okay, it's not like multiple days also, 2 or 3 days only. Maximum tomorrow, day after tomorrow. If not, another one session. Okay, so these 2-3 days, if you revise every day, spend 1 hour for NR taxation only. Memorize, try to memorize now only. Okay. SSC can follow non-resident individual taxation, chapter 12A. It is like what? Optional. SSC can follow normal tax rates or special tax rates under chapter 12A also. First, when this 12A applicable or for what incomes this 12A is applicable. Non-resident individual, SSC. Individual means he is a non-resident plus Indian citizen or person of Indian origin. For whom this section is eligible, this chapter is eligible, sir? Non-resident individual. Non-resident individual means what? Non-resident plus Indian citizen or non-resident plus person of Indian origin. Non-resident foreign national, not applicable. Sir, to David Warner, this is applicable. To David Warner, this provision applicable. Who is David Warner? Australian cricketer. Okay. Non-resident or not? Non-resident. But non-resident individual also. But is he Indian citizen or person of Indian origin? No. So it's not applicable. Okay. See, recently I'm seeing SRH Instagram posts also. Okay. Every time they'll make the foreigners also as like Indians only, like Kane Mama, Warner Bhai. Then recently this is like Lingampet, Livingstone. Livingstone is from SRH. They are giving names like local names. They are giving for those people, right? So we are owning them. Just because we own them, they are not Indian citizens or persons of Indian origin. So this chapter 12A is applicable to non-resident individual, but that individual should be Indian citizen or person of Indian origin. Donald Trump also non-resident individual, but for him chapter 12A is not applicable. Okay, so this non-resident individual have two incomes, two types: Indian income, foreign income. What we call as foreign income: accrued outside India, received also outside India, no connection with India at all. Accrued outside India, received outside India. Then foreign income, such foreign incomes are not taxable in India. Why? Basic residential status will not allow us to tax this. For a non-resident to tax an income in India, either it should be received in India or accrued or deemed to be accrued in India. But since this income accrued outside India, received also outside India, that is called as what? Foreign income. Such foreign incomes are not taxable in India. Okay, he may say like, let's say he given like Sundar Pichai, he got 5 lakhs dividend from Google listed in US. He is a non-resident individual. Google share listed where, sir? NASDAQ, US. So share in US, accrued in US only. So received where? US only. So that is a foreign income not taxable in India. But same Sachinadalla, he invested even in Infosys also. Sorry, Sundar Pichai invested in Infosys. But Infosys is where? India. So since it is in India, the income will be considered as accrued in India. So then it will be called as what? Indian income. Understand, sir? Same way again. Non-resident has a house property in foreign country only. There only he got rent. So where it is accrued? Outside India, received also outside India. Since he is non-resident, it is not taxable to him. Okay, that's why we are taking as what? They are foreign incomes. Those are not taxable in India. Now, Indian incomes. Sir, this chapter will not talk about each and every Indian income. Only certain Indian incomes has been discussed. What? Indian income arising from these assets. First we are talking about assets. Then we'll talk about what income from those assets. First one, shares of Indian company. It could be public company, private limited company. Debentures of Indian public company. Deposits of Indian public company. Debentures are different, deposits are different. Securities of central government or any other asset notified by central government. And these assets should be purchased in foreign exchange. By using foreign exchange, this asset should be purchased. Then these are called as what? Foreign exchange assets. These 5 are called as what? Foreign exchange assets. What are those? Shares in Indian company. Public or private? both public or private. Debentures only in Indian public company, deposits only in Indian public company, securities of central government or any other assets notified by central government should be purchased in what? Convertible foreign exchange. Then they are called as foreign exchange assets. Now from these foreign exchange assets, if any investment income is arising, investment income. What is called investment income, sir? If it is share, dividend will come. If it is debenture or bond, you will get interest. So such interest or dividend income is taxable at what rate? 20%. If it is long-term capital gain, then the tax rate is 12.5%. If it is any other income, sir, what else will come from this, sir? All these are like shares, securities only. From them, either interest, dividend come covered. Long-term capital gain. Other than long-term capital gain, what else will be there? Short-term only will be there. So any other income, which is nothing but short-term capital gain, they are taxed at what? Normal rates only. Okay. So now first tell me, what are called foreign exchange assets here? Shares of Indian private or public company. Next. Debentures of Indian public company. Then deposits of Indian public company. Fourth. Securities of central government. Fifth one. Any other asset notified by central government purchased in foreign exchange. Then they are called as what? Foreign exchange assets. Now from these, three kind of incomes could be there. Mostly three only. Investment income, nothing but interest or dividend. Long-term capital gain. The third one is like short-term only, mostly. Okay. The other income, but we are referring it as. The interest dividend has special rate, 20%. Long-term capital gain has special rate, 12.5%. Other income has normal rates only. So other income, no benefit. Chapter 12A is there or not there also no benefit, because normally also it is taxable at normal rates. Long-term capital gain also, if you see now, no big benefit. Currently long-term capital gains are taxable at what rate, sir? 12.5% only. These are also 12.5. Previously long-term capital gains used to be taxed at 20% or 15%. That time there used to be a benefit. Now currently long-term capital gain wise also no big benefit, because normally also 12.5, here also 12.5. But there is a benefit with respect to investment income. Otherwise investment incomes are normally taxable at slab rates. So it could be even 30% also. But now because of this, they are eligible to tax only at what rates, sir? 20% only. So three incomes. These incomes should be arising from where? Foreign exchange asset. To whom? Non-resident. Non-resident individual being an Indian citizen or person of Indian origin. If he has foreign income, Indian income which is covered here arising from foreign exchange assets. Foreign exchange assets, you might have paid foreign currency and purchased these shares or these assets. Okay, what are those? Shares of Indian public private limited company, debentures of Indian public company, deposits of Indian public company, securities of central government or any other assets notified by central government. Okay, investment income means interest or dividend taxable at what rate? 20%. Long-term capital gain taxable at 12.5%. Any other income taxable at normal rates. Okay, now for the special rate incomes, no expense or deduction is allowed. Chapter 6A deductions are also not allowed from this. Here on this long-term capital gain, see, related to transfer-related expenses under capital gains can be adjusted. Like to sell those shares, commission incurred, brokerage incurred. That kind of transfer-related expenses can be adjusted. But what is not available? Indexation not available. Chapter 6A deductions not available. Here we said like 48 proviso 1. What is 48 proviso 1? For certain foreign non-resident with respect to specific assets, the capital gains has to be computed in foreign currency only. Then the resulting gain only has to be converted into Indian currency. Proviso 1 says nothing but simple. Computation of capital gains has to be made in foreign currency only, not in Indian currency. The resulting gain or loss again reconvert into Indian rupees. That is called proviso 1. That proviso 1 is applicable here also. Related expenses, transfer related expenses can be claimed, but indexation not available. Chapter 6 deductions are not available. Understand, sir? From these two special rate incomes, long-term capital gain, you can at least claim transfer related expenses. But under no other section, you can claim any other deduction, or chapter 6 deductions also not available. For interest and dividend, anything related to PGBP, IFOS, no expense can be allowed as deduction. Chapter 6 deductions also not allowed. Clear, sir? Clear? No. I didn't understand. First 1,25,000 you are asking. Wait, I'll tell that one. Okay. Then Pravilika NRI took a loan and purchased Indian company shares. Okay. Suited for her. Huh? She's in Punjab, but not Indian Punjab, Pakistan Punjab. So the only thing which is not matching is like the top black color. That you might have heard white. How na? Pravilika NRI took a loan and purchased Indian company shares. She received dividend 5 lakhs. Interest paid on loan 2 lakhs. Dividend, okay, sir. Now what? Usually, and she took a loan and purchased what? Indian company shares. She got dividend 5 lakhs. But to earn the dividend, she already took a loan. For that loan, she has to pay interest, right? If you remember, sir, there is a deduction we already discussed 3 times. But never you are able to recall that provision at the time when it is needed. When there is a dividend income, we can claim only one expense as deduction. Which expense? From dividend, we can claim one expense as deduction. What is that one? Interest. How much we can claim it as deduction? Actual interest or 20% of the dividend received, whichever is lower, that can be claimed as deduction. So here, she received how much dividend? 5 lakhs. Incurred how much expense? 2 lakhs. As per IFOS section 57, interest allowed as deduction is actual interest or 20% of dividend, whichever is lower. But since she is a non-resident individual, opting to chapter 12A, okay, chapter 12 or 13? Chapter 12A, okay, she cannot claim any expense or deduction under IFOS or PGBP. So this expense is also not allowable. Her dividend gross 5 lakhs is taxable at what rate? 20%, which equals to 1 lakh. Her dividend, how much is taxable, sir? Gross rate. Okay. If he didn't opt at chapter 12A, then she might have availed here expense. How much? 2 lakhs or 5 lakhs into 20% now 1 lakh. So 4 lakhs only might be taxable if she didn't opted chapter 12A. But since she opted 12A, 5 lakhs into 20%, 1 lakh is taxable. Okay. So now your point. Okay. So my understanding, sir, in some questions, but again, morning also, I did again research on this point only. The point is like, there is no clarity anywhere whether excess of 1,25,000 is taxable or total amount is taxable. While explaining like regular class, I thought of this long-term capital gain on foreign exchange asset. If it is a listed equity share in India, then tax rate 12.5% in excess of 1.25 lakhs. But that also nowhere it is clear. Okay, nowhere it is mentioned clearly like that. I vaguely remember that there is a sum. Okay, I didn't remember. Okay, in which one sum institute has exempted first 1,25,000. Okay, by analyzing all that, the only thing I can clarify is here foreign exchange asset. Foreign exchange asset, they said like what? Shares of Indian company. It could be even private limited also, public limited also, public listed company also. Okay, if it is a listed company which is covered under 112A, then only you can claim 1,25,000 exemption also. Otherwise, just because it is foreign exchange asset, we cannot claim 1,25,000 exemption. Foreign exchange asset plus it should be what? Listed equity share. Then you can claim first 1,25,000 as exemption. Balance only taxable. If it is not listed equity share, like it may be shares of private limited company, shares of unlisted public company, or it may be a debenture. Okay, on all of them capital gain may arise. That capital gain is flat at 12.5% only. No first 1,25,000 exemption. First 1,25,000 exemption only available. In which case? Listed company foreign exchange asset. Then covers here. And that also, sir, I'm already again mentioning this one. This point subject to correction because there is nowhere I could find an exact provision. My understanding, I clearly wrote even in the notes also you'll be seeing. My understanding is this way. Like if at all such foreign exchange asset is listed equity share in India, then the tax rate we should take 12.5%. In excess of 1.25 lakhs has to be taxed. Okay, if it is a listed equity share. Okay, there are counter arguments also can be made like what? Since this is a separate chapter, this is a separate chapter, chapter 12A. Once he is a non-resident and he takes for this separate chapter, then the 112A benefit and all we cannot merge here. So gross 1,20,000, I mean you don't need to subtract that 1,25,000 and gross amount can be taxed. That view is also there. Okay, so this could be what? The alternate view is like, sir, I'm only differing at one particular point like what? If it is a listed equity share. The counter version can be what? Even though it is listed equity share also, since it is under chapter 12A, that for that also there will not be 1,25,000 exemption. That view also possible, but I don't have any clear-cut provision or explanation to do or to take a stand on that. That's why this also can be done, that also can be done. No clarity over here. Okay, so if any faculty or if anywhere if you have seen and some other view if you have also, we will, I mean we can respect that view also. That can also be possible. There is no clarity from department side or from CBDT side. If at all we get any clarification or maybe clarification also, I couldn't find it anywhere. Okay, so if you could find a clarification or if it is there, then it could be said like what? This also gross amount taxable at 12.5. No, first 1,25,000 exemption is there. Okay, but I believe like, so why I am taking this now, sir? Mostly we should be on which side? Department side or client side? Actually, institute also. Here, our institute prepares book mostly considering department side only. But we learning the tax, we will not be usually on department side. If we are on department side, no client will come for us. So mostly we'll be doing provisions or doing calculations in favor of SSC. Since there is nothing there conclusively, we can take this view. Then 115G, what? Non-resident individual is not required to file return of income. This non-resident individual is there now, who is having foreign exchange asset. On that he is having investment income, long-term capital gain and all. That person need not to file return when his total income consists only investment income and long-term capital gain. Only two incomes. What are those two? Investment income, long-term capital gain. And on them TDS also deducted. And on them TDS also deducted. Sir, which section? That will again go to those TDS sections also. If TDS is deducted on them, then return need not to be filed. Here I don't have any other income, only two incomes. What are those two? Investment income, long-term capital gain. TDS deducted, then need not to file return of income. Then, sir, when he purchased the asset, he is non-resident only. At the time of purchase, SSC non-resident individual. Afterwards, he became resident. Now, long-term capital gain, investment incomes, how they have to be taxed? Can he continues to be under Chapter 12A or he has to exit from Chapter 12A? That's the question. Simple, sir. Pravalika, when she invested, she is non-resident. Now, resident only. But on these assets, she continues to get investment income. On sale, she'll get long-term capital gain. So how they has to be taxed? Even after becoming resident, investment income continues to be taxed at what rate? Special rates only. But for that, SSC has to file a declaration what? Even though I became resident, I still wants to continue to tax those incomes at special rates only. Okay? But for long-term capital gain, special rate not applies. See this example. Year 1 non-resident, year 2 non-resident, but year 3 became resident. Investment income, sir, even though became non-resident, it continues to be taxed at what? Special rate only. But long-term capital gain, year 1 special rate, year 2 special rate. But year 3, sir, only investment income special rate. For normal incomes, for long-term capital gain, no special rate is applicable. But the problem is, even normal rate also same rate only. What is the rate, sir? Long-term capital gain, 12.5% only. Okay. Then exemption on long-term capital gain. So this non-resident individual even gets an exemption on long-term capital gain. What is that? He has sold foreign exchange asset, transferred, and the net sale consideration he gets from the sale of asset should be used to acquire another foreign exchange asset. He sold foreign exchange asset and should buy what? Another foreign exchange asset, or he should buy a savings certificate within how many days? 6 months from date of transfer. This is something similar to 54 EC. 54 EC. There also, if any immovable property is transferred, the resulting capital gains has to be invested in RECL bonds, NHA bonds within 6 months from date of transfer. Here what? He sold foreign exchange asset. Then again, where he has to invest? Another foreign exchange asset within how many days? 6 months from date of transfer. Then the long-term capital gain is exempted proportionate to investment. How much? Long-term capital gain into cost of asset divided by net sale consideration. So not the whole amount invested is exempted. Proportionate to the net sale consideration. Let's say, sir, he got net sale consideration 100 lakhs, but he invested only 15 lakhs. Then how much exemption? 1 by 2. 50 by 100 into capital gain, let's say 20 lakhs. How much? 10 lakhs is only exempted. The capital gain is proportionate to the amount of investment he made from net sale consideration. Lock-in period. What is lock-in period? Here, he purchased a new foreign exchange asset that couldn't be sold for another 3 years. If violated, what happens? The long-term capital gain previously exempted shall be taxed as long-term capital gain in the year of violation. Shall be taxed in the year of violation. So, okay, all this we'll discuss tomorrow, sir. Now, whatever we have completed now, once again we'll revise. We are discussing for whom? Chapter 12. Applicables to whom? Being Indian citizen, person of Indian origin. Foreign income, if any, is there. What is called foreign income? Accrued, received both outside India, not taxable. Then he has income from foreign exchange assets. What are called foreign exchange assets? Shares of private and public limited company, debentures public only, deposits public only, securities of central government or any other assets of central government. Okay. Those assets, from those assets, he might have investment income, taxable. No expense, no deduction can be claimed, gross amount into 20%. Long-term capital gain, 12.5%. Now, 12.5, only transfer related expenses can be claimed. Indexation not available, no other deduction can be claimed. But one point to be remembered, Proviso 1 of 48 is applicable. What is Proviso 1 of 48? Gains has to be computed in foreign currency only, then reconvert them into Indian currency. Okay. Now, 1,25,000 exemption under. About first 1,25,000. If at all it is a listed equity share, not being foreign exchange asset is enough. It should be again what? Listed equity share. Then first 1,25,000 can be claimed as exemption while calculating tax. Rest. Any other foreign exchange asset, gross amount into 12.5%. Any other asset, normal rates only. Then, does this person has to file written off income? Mostly no only, sir. If he has only investment income, long-term capital gain income, and on the TDS has been deducted, then he need not to file written off income. Then next one, sir, originally non-resident, but later on he converted into resident. Then investment income continues to be taxed at what? Special rates only if he files a declaration. Whereas long-term capital gain, since he already became resident, normal rate only, but normal rate also same rate, 12.5% only. Then exemption, he is eligible for an exemption under 115F. What is the exemption available? He transferred foreign exchange asset and should acquire another foreign exchange asset using net sale consideration or saving certificate. Any foreign exchange asset or saving certificate he should buy using net sale consideration. Then he'll get exemption. How much is the exemption he'll get? Long-term capital gain into cost of new asset divided by net sale consideration. So nothing but in proportionate to the investment he made, he'll get capital gain exemption. This asset he purchased has a lock-in period of 3 years. Within 3 years he sells that. Then the capital gain which is exempted previously again gets taxed in the year of violation. Okay. Now we are going into Proviso 1 to section 48. What is Proviso 1 says? Like, it's 48 is actually related to computation of capital gains. Proviso 1 is about what? While computing capital gains in case of non-resident. In case of non-resident. Sir, they didn't, they are not specific. Proviso 1 to 48 is not specific to non-resident individual. It is to whom? Non-resident. So he could be non-resident individual, other than non-resident individual also. Proviso 1. Okay. And asset transferred need not to be a foreign exchange asset. It should be what? Share, debenture of Indian company. But these two can be even foreign exchange assets also. Share of Indian public company or private company, debenture of Indian public company. So these two can be foreign exchange assets, okay, if they are acquired by non-resident. Then the capital gain shall be computed in what? Foreign currency and then convert into Indian currency. But what exchange rates? Those are given under Rule 115A. Those are given under Rule 115A. So once again, sir, Proviso 1 to section 48. What does it say? For non-resident, capital gains has to be computed in foreign currency only. Does for every asset it has to be computed in foreign currency? No. Only for shares and debentures of Indian company. So they said like only Indian company. So it could be public or private. Shares of or debentures of Indian company has to be computed in foreign, capital gains has to be computed in foreign currency only. Okay. And then by using what rates? As per Rule 115A. What are the rates? 115 talks about conversion rates. Cost of acquisition. Sir, again, capital gains. What is the format, sir? First we'll take what? Sale consideration. From there, transfer related expenditure. Then we'll get net sale consideration. From there, cost of acquisition. We'll get capital gain or loss. So first, sale consideration has to be transferred using the average of TTBR, telegraphic transfer buying rate or selling rate as on the date of transfer. On the date of transfer, you'll have buying rate, selling rate, right? So take average of those two and with that convert that sale consideration. Sir, why sale consideration has to be considered? Sir, they may give the amounts in Indian values only. But still we need to calculate in which currencies? Foreign currency only. So Even, let's say they said like 40 lakhs is the sale consideration. That 40 lakhs again you should convert into what? Foreign currency. So what rate you will take? TTBR, TTSR average as on the date of transfer. As on the date of transfer. So from there you subtract transfer related expenses also. They also incurred in Indian currency. What do you have to do again? Convert them into foreign currency using what? Average of TTBR and TTSR as on the date of transfer. You got net sale consideration. Now we need to subtract what? Cost of acquisition. So again cost of acquisition also average of TTBR and TTSR, but as on the date of acquisition. Date of acquisition. Understand, sir? Then capital gain will come. The resulting capital gain has to be reconverted into Indian currency by using only the TTBR, not average. TTBR as on the date of transfer. As on the date of transfer. So this is what? Section 48, Proviso 1. So what is Proviso 2 also there, sir? Proviso 2 is about indexation. But indexation largely is not applicable, not largely, it is not even applicable only in resident individual case or HUF case when he is selling an immovable property as an option that is available. As an option, that also at the point of tax calculation. It's not a new amendment, it was there even in the last year also as it is. Okay, so now what is rule 115 here, sir? Tell me clearly. Sale consideration by using what we have to consideration? Gross sale consideration. Average of TTBR and, okay, as on which date? As on date of transfer. Then transfer related expenditure. Again, average of TTBR and TTSR as on the date of. Then what we have to subtract? What is transfer related expense means? So we need to subtract what? Cost of acquisition means what? Average of TTBR and TTSR as on which date? Date of acquisition. So acquisition date we need to take. Then what will arrive? Capital gain. So the capital gain what we have to do? We have to convert into Indian currency using what rate? TTBR as on which day? Transfer. As on the date of transfer. Okay. So for whom Proviso 1 of section 48 applicable? Non-resident individual, any non-resident? Let's go and see once again. While computing capital gains in case of what? Non-resident. Asset transfer being share debenture of Indian company. Capital gain shall be computed in foreign currency and then converted into Indian currency as per method given in rule 115A. Done, sir, this one. So, okay, so look at this question, sir. In workbook, I think first question it is. Question number 1 or 2 now? 1 only, right? Okay. See whether these dates are corrected in the material or not. Like it is given as 18th August 2025 or 4 only. 2025, 16th September 2025, 13th September 2025, previous year 25, 26. Then year August 25, September 25, September 25. Okay. So now look at the question. Anthony is a non-resident Indian. Acquired 1,000 shares in A Limited for rupees 20,000 by utilizing Singapore dollars on 18th August 2025. On 16th September, Anthony sold such shares for 45,000 and utilized the proceeds in acquisition of 500 shares of B Limited after paying expenditure on transfer 5,000. Compute capital gain. Sir, he is a non-resident Indian. So eligible for what? Chapter 12A or not? 12A or not? What asset he has acquired? Shares of Indian company. Through what? Foreign exchange. So it is a foreign exchange asset only. So such foreign exchange asset is transferred. So transferred. When he purchased it, sir? On 16th September 2025, Anthony sold. On 16th September 2025, Anthony sold them. Sir, here if you see, sir, there is an exemption also. But this exemption is available to what? Long-term capital gain. But whether he has held for a long-term, August purchased, in September sold. So it is what? Short-term capital gain only, exemption not available. Okay. But we need to compute his capital gains using what? Proviso 1 of section 48. So first we need to take what? Gross sale consideration. What is the gross sale consideration, sir? 45,000. What is the date of transfer? 16th September 2025. On 16th September 2025, what is the average rate? 47. So 45,000 into 47 divided by 47. 45,000 is what? Indian currency. We want, okay, sir, this is like what? For $1 of Singapore currency, we'll get 47 rupees. That means what we have to do here? We need to divide by 47. So how much? Are you able to understand, sir? It's not indirect code. It's a direct code only, like $1 equals to 47. So how much, sir, it is? 950.45 Singapore dollars. Then from there, we should subtract what? Transfer related expenditure. How much, sir? 5,000. Transfer related expenditure also, how much we need to take as the average of TTBR and TDS, sir? Same on the date of transfer. Na? So 5,000 divided by 47 equals to 1038. So subtract how much? 851.06 dollars. $851.067. Okay, done. Then what is the net sale consideration we have? Okay, we got. From there we have to subtract what? Cost of acquisition. What is the cost of acquisition? 20,000. So 20,000 we should divide by what? Average of TTBR, TDSR only as on the date of acquisition. Acquisition made on which day? 18th August 2025. That day what is the average rate? 45.5. So subtract that. Okay, what is the how many dollars? 5 dollars. Subtract that. What is the capital gain? Short term capital gain. 411.05 5 0.5. So we need to convert again into Indian currency using what rate? Transfer rate TTBR. So on transfer rate what is the TTBR? 46. 18,929. So okay, round it off to 30. Understood, sir, this question? So now first segment we have completed, sir. Second segment is only tough. I mean tough na, like too many sections, same interest coming from different funds and all they'll be giving. So I'll be going slowly and we'll revise more number of times possible. Okay, then you're gonna understand this. Okay. The third segment is like presumptive taxation. That's going to be again easy only. The second segment only, we have TDS sections and the non-resident related special rate incomes or taxability related sections. Sir, if you know this, then the TDS will be easy only, because let's say if there are like some 4 incomes covered under 115A, for those respective incomes where TDS has to be deducted, we'll be covering here. And 115AB, some 2 incomes covered. Those 2 incomes related TDS sections will be here. Okay, so there are total 5 sections are here. These 5 sections corresponding TDS sections only, these ones. Understand? Okay, so what are those 5 sections we are having? 115A, AB, AC, AD. And again BBA, you already know it's easy only. Non-resident sportsmen. Okay, this fourth one is like easy only, sir. You can easily remember, because even in inter-level also somehow this section will be remembered. But whereas this 4 sections only, we need to now spend or focus much. 115A, AB, AC, AD. A, AB, AC, AD. This 4. Okay, so these are for non-resident. They are not specific about individual or anything. Okay, so in the provision they may say like in each section they may say like this is applicable only for these people, like that. These kind of non-residents only. So for that only we need to apply. See, 115A is applicable to non-resident or even a foreign company. Sir, non-resident, why they are against saying foreign company? Foreign companies, sometimes they could be resident also. A foreign company can become resident. But even though it is a resident, still covered by 115A. Okay, that's why foreign company has been said separately. For foreign companies, we'll decide resident or non-resident based on place of effective management. Okay, place of effective management, na, in simple nothing but where the key management is there, where the decisions has been taken is called as place of effective management. So even though it's a foreign company, its effective management could be from India. Okay, then in such case, it could be called as resident for that year. For that year, it could be called as resident. So foreign company doesn't mean always non-resident. They could be residents also. Even though foreign company becomes resident, still it is covered under what? 115A. So if they simply said non-resident, then it covers only foreign company if it is non-resident. Why they are specifically giving foreign company here? Because foreign company sometimes could be non-resident, sometimes it could be even resident. In both the cases, it is covered under 115A. So foreign company and any other non-resident receives what incomes? Interest, dividend, or income from UTI. UTI means Unit Trust of India. Nothing but mutual funds related. Income from UTI or mutual funds. Or if they are receiving any royalty or fee for technical service. Sir, first, who have to receive? Sir, who is SSC, eligible SSC under 115A? So we are dealing from, sir, in this section perspective, our SSC is like whom? Non-resident or foreign company. He may get income from different sources. Okay, but ultimately SSC is whom? Non-resident or a foreign company. Okay, so he is having, first we are starting with what? He is having royalty or fee for technical service income. Royalty or fee for technical service income. Okay, it is received from government or from an Indian concern. It is received from whom? Government or from an Indian concern. Indian concern, it could be an Indian company, it could be an Indian firm, anything. So from an Indian concern royalty receiving, or from government he is receiving royalty, or fee for technical service also. From government or from an Indian concern he is receiving in pursuance of an agreement with the government. Then such royalty or FTS is taxable at what rate? 20%. Okay, for this no specific TDS section. Okay, sir, what we thought like for these incomes, these are corresponding TDS sections, right? But for royalty, fee for technical service related, there is no specific TDS section. If there is no specific TDS section, then all of them are covered by 195. Section 195 is a TDS section, which is a general section for non-residents. Okay, if your income is not, if a non-resident income is not specifically covered under any of these sections like 194E, LB, LC, LDA, 196A, 196B, CD, these are for non-residents only. If not covered specifically under any other section, then it is covered by 195. Okay, so what income you are referring? Royalty, fee for technical service. Received by whom? Non-resident or foreign company. Paid by government or an Indian concern, that also in pursuance of an agreement through government, then the tax rate is how much? 20%. There is no corresponding TDS section, so it comes under what? 195. What does 195 says? Like deduct TDS as per the applicable rate. Rates in force. So that means nothing but they'll simply deduct TDS at what rate? 20% only if TDS applicable also. Okay. Now here one more point, sir. This particular royalty fee for technical service is even linked with 44DA. Okay, there is a section called 44DA. If it is covered under 44DA, then 115A is not applicable. I mean, here it is not applicable. This 20% special rate is not applicable if it is covered by 44DA. So we'll go to 44DA and come back. After 3 or 4 pages, you'll find 44DA. Section 44DA. 241. Page number 241. Sir, 44DA. Sir, we already know what is called P, where we discussed. DTA chapter we have discussed. Permanent establishment means. Okay, so now, permanent establishment means what, sir? If you just store stock there, it's not P. If you just put your stock and just keep it for display, not a permanent establishment. When it comes as a PE, if it is like an office, if it is like a factory, if it is like a warehouse, or if it is like a project site, okay, or a mining site, then it comes as what? Permanent establishment. So from there, you should not, if you are not selling anything, you are not delivering anything, then it's not a PE. You just put your goods there, store there, you keep them for display, or you'll sort the goods, arrange goods, or you purchase from that place. You just act, that place just act as a licensing office. Licensing office not to talk with the different people only, it was there. Okay, but it was not there to deliver the goods, not to sell the goods, not to sell any service, then it is not called as what? PE. So when it is called as a PE, usually from office, we'll enter into contracts to sell or to deliver. From factory, from warehouse, from godown, from mining site, from an oil site, from a project site, from all these places, usually you'll do the manufacturing process, extraction process, selling and all you'll do. Okay, if it is a place where just storing is happening, displaying is happening, that is not a PE. So you understood, right, what is called PE? So non-resident or foreign company carrying business through PE in India. Sir, non-resident or foreign company has a PE in India, okay, or has a profession, has carrying out a profession through fixed place in India. Sir, fee for technical service will come to professionals only. If an engineer team came, designing team, they provide what? Technical service. So they are professionals. So that's why when any profession is carried out through fixed place of business in India or business carried out through PE in India, and for that business or for that profession they carried, they are getting what? Receiving consideration as like royalty or fee for technical service, and this royalty FTS is connected to this PE only. Sir, foreign company has units outside India also. Unit in India. The unit in India we call as what? PE. So if any royalty they are earning, such royalty should be connected to this Indian PE. Or the service fee for technical service they are getting is connected to this Indian office or Indian fixed place of business. Then that also receiving from whom? Government of India or Indian concern. Then what they are saying means compute such income as per the normal provisions of PGBP. That means this royalty FTS you will take it as your sales. All the relevant expenses, what you can do, you can claim as expenses, then you will get the resulting or the normal profit. So we'll do normally, sir. You are having your P&L, have credit side what? Royalty, fee for technical service. And your debit side, you'll have so many expenses, rental expense, depreciation, interest expense, all those expenses as per PGBP, how they are allowed, like that you can do. Only restriction is about what? Expense not exclusively related to that PE or fixed place cannot be taken. Sir, P&L debit side, if any expense is there, such expense should be related to what? That PE or that fixed place of business. All those expenses are allowed. Not related, then they are not allowed. Then payments to head office. If they are making any payments to head office and other offices, they are not allowed to be claimed as expenses other than if they are reimbursements. Sir, actually for this PE, advertisement expenditure is incurred, sir, 5 lakhs. But this PE didn't pay 5 lakhs. Paid by whom? HO. That's why that 5 lakhs has been reimbursed. So that 5 lakhs can be claimed as expense. What kind of expenses? Sir, HO may be managing all the PEs and all. So HO may allocate its share of expense to PEs. That expenses can't be claimed as deduction by PE. So okay, PE, what expenses can claim as deduction is specifically or exclusively related to PE or fixed place of business, and the payments to head office and other offices cannot be claimed as deduction unless they are related to PE only, incurred by HO or other offices. This PE is being reimbursing, except those things, rest all the other expenses are not allowed. So then SSE cannot. If 44DA is applicable, he cannot go to Sir, then what? Sir, for foreign company, what is the tax rate, sir? 35%. So here we'll calculate normal income and apply what? 35% if it is a foreign company. Normal non-resident, 30% will apply. Okay. So if these conditions are satisfied, it comes under what? 44DA. If these conditions are not satisfied, then it will come under 115A. Then 115A, which rate is applicable? Special rate is applicable. Special rate is applicable. So here, if 44DA applies, books of accounts has to be maintained and audit also is mandatory. Audit also mandatory irrespective of turnovers. Understand, sir? So once again, so understand. First, royalty fee for technical service is receiving from whom? Government or an Indian concern. What we have to check? Whether it is connected to PE of non-resident or foreign company or fixed place of non-resident or foreign company. If it is related to PEs, then it is covered by what? 44DA. If 44DA applies, then what not applicable? 115A. Let's say if it is not related to PE, then 44DA will not apply. Which will apply? 115A will apply. If 115A will apply, what is the tax rate? 20% flat rate. If 44DA applies, how do we have to compute income? Normal for Indian entities, how we will compute income? Like whatever this royalty fee for technical service income is there, that will take as like their sales. Then they have the relevant expenses can be claimed as deduction. Then we'll get the taxable income. That taxable income tax at the applicable rate. If it is foreign company, 30%, non-resident 30%. Like that you will be doing. Understand, sir? Simple thing. Clear? So royalty fee for technical service received by whom? Non-resident or foreign company. Paid by whom? Government or Indian concern in pursuance of an agreement. So what is the first point to be checked? Related to PE or fixed place of business of this NR or foreign company or not? Yes, 44DA. No, 115A. Yes, PE is there. Yes, 44DA. No, 115A. 115A, now what is the tax rate? 20%. 44DA has to be computed. We will not take the gross royalty or fee for technical service received as income. We'll take them as sales. Okay, it's like a sale amount. So the relevant expenses can be claimed as deduction. Which cannot be claimed as deduction? Expenses not related to PE or fixed place of business or amounts paid to HO or other officers. But amounts paid to HO also can be claimed as deduction if they are related to this PE only and you are paying to HO as a reimbursement only, then that can be claimed as deduction. Okay. If 44DA applies, audit applicable, books of accounts also has to be maintained. Sir, everybody clear about royalty and FTS? Where tax rate? Normal rates only. Normal. For non-resident, what are the normal tax rates? Individual. What are the normal? Slab rates only, right? So normal rates only. See, when we discussed about the slab rates, we didn't specify about resident or non-resident, then they are applicable to both. Foreign company, 35%. Non-resident firm, 30% only. Okay. Non-resident HUF, slab rates. Okay. So now we came back to 115A. Sir, why for non-residents special rates has to be given? So for them they are taxing at lesser rates, right? Comparatively, if you see special rates. Then why non-residents only being encouraged? Why not us? They'll bring foreign exchange. Okay. More than that, they'll bring investment. So okay, why they are not encouraging Indians? Na? They will do. Okay. That's why long-term capital gains on these investments are taxed at concessional rates only, like 12.5% up to 1,25,000 exemption. Why those are given? Those are also given to encourage residents to come and invest in the businesses only. But compared to, sir, we residents, if you want to invest in a company, we don't have choice. Obviously, we have to invest where? In India only. But non-residents, they have choice. They can invest in their own country, so they have to sacrifice, sir, their money. Let's say US citizen is there. If he invests in US only, it is like completely safe. Okay. But if he invests in India or any foreign country, it has risk. Because we don't know when Donald Trump will take a fight with country. Okay, he can take up a fight with any country. So his money is under risk. Because when war happens, now that country, see, US now they can believe because it's a stabilized economy. But other countries, they cannot believe the same way. But they are taking that risk and have to come and invest. So why they have to come and invest only in India? They can go to China. They can go to Vietnam and invest. They can go and invest even in Pakistan also. Why only in India? So simple thing, sir. So we are giving a little chocolate for them. Okay, come here. We'll give you some incentives also. You don't worry. You go to China now, you need to pay this much tax rate. So don't go to China. Come to India and come here only and invest. So you are having this tax rate benefit only. That's why to attract them. Not just for foreign currency only. Yes, foreign results also will increase. Even the money to be invested in India also will increase through FDIs. Okay, so through FDIs only, at least our growth has took the acceleration. Our growth rate has taken acceleration only because of the FDI being allowed. So ante kadandi. ఇప్పుడు ఓన్లీ ఇండియాలో ఉన్న మనీతోనే బిజినెస్ చేయాలనుకుంటే నీతో 2 lakhs ఉన్నాయి, 2 lakhs తోనే చేయగలవు. 2 lakhs తో నువ్వు 20% గ్రోత్ అయినా ఇయర్కి ఎంత వస్తాయి? 40,000 వస్తాయి. లేదు నీ బిజినెస్ మోడల్ కరెక్ట్ది అనుకున్నప్పుడు, లెట్స్ సే ఇఫ్ యువర్ బిజినెస్ you have 2 lakhs and you invested in India with the 2 lakhs only, even though growth rate is 20%, you will get how much? Only 40,000. But let's say if the business model is correct and if you can pool 20 lakhs, okay, by pooling 20 lakhs, maybe the growth rate may come down. Okay, may come down to 10%, but still, if you put 20 lakhs, how much extra income is being generated? 2 lakhs extra income is being generated, so our overall GDP will increase. It's okay, overall GDP will increase. Understand, sir? So government wants more money to be invested in Indian markets, Indian companies. So the Indian companies will do more business. Their companies will grow. Only when companies grow, employment will be created, economy will grow. So there is a chain reaction with everything linked here. So that's why foreign currency or foreign investments are being encouraged into India. Okay. Now, even India also, within India also, government wants specifically into certain more funds, into certain funds much more. So there may be much more better tax rates or concessional tax rates. So where they want to encourage more, where Indian governments are more desperate, the foreign investors should come. There they'll put or they'll give much more lesser tax rates. Okay. First, interest on infrastructure debt funds. Which funds are? Infrastructure debt funds. That means these debt funds will be investing in what? Infrastructure related companies, the companies which are into building infrastructures. So in that infrastructure debt fund, when this non-resident or foreign company invests and he is getting interest, such interest is taxable at what rate? 5%. 5%. Interest from infrastructure debt fund to non-resident or foreign company taxable at what rate, sir? 5%. Done. Then interest or dividend received by a non-resident unit holder. Unit holder means what? He could be non-resident, but he is having units. He is having units in a business trust. Units in a business trust. So what is business trust? Look at here. A unit holder will invest money in business trust. Then business trust, what it will do? It will invest that in multiple SPVs. SPVs are called as what? Special purpose vehicles. So I already explained this concept twice already. Initially in first classes also explained. Then in assessment of companies chapter also we have explained this one. Okay, now third time. A unit holders are like the small investors, like shareholders in a company. But instead of investing in a company, they invest in where? Business trust. Now business trust has pool of money. That money, trust will not directly do business. Trust is just a middleman kind of. Okay, it just acts as a medium. So now this trust will float different companies. So okay, for every company, a specific business will be allocated. Let's say a road has been laid. A national highway for 500 kilometers has been laid through a specific SPV. Now that road operation, road maintenance, and from that the toll collection revenue, everything will be taken care by one particular SPV. Second one, they constructed a real estate project. Like a commercial project has been constructed and that project has been given on rent. Now this second SPV will be getting what? Rental incomes. Third one, they may have constructed a express highway or a flyover or a bridge kind of. There again they will be getting the access fee or toll fee kind of. That was allocated to another SPV. So why SPVs? For a specific job, this company will be specifically doing only for that purpose. So like the trust, it look after multiple SPVs. But one SPV is for a specific job. Understand, sir? So now SPVs will be earning interest income, toll fee, rental incomes, all those incomes. Now SPVs will be giving it as dividend or interest to whom? Trust. Trust again will give it to whom? Unit holders. Okay. Now this unit holder is non-resident. Now this unit holder is what? Non-resident. So a non-resident invested in Indian business trust. Interest dividend received by a non-resident unit holder from business trust, which received from when? SPV. Sir, how business trust will get income? It receives from SPV. Now business trust again pays it to whom? Unit holders, being non-resident. Then what is the tax rate? Interest at a rate of 5%. If at all the amount given to this unit holders is like interest element, then the tax rate is how much? 5%. If it is like dividend kind of, then the tax rate is 10%. Understand, sir? SSE is whom? Non-resident. Being a unit holder in business trust. Now business trust is giving him what? Interest. Tax rate how much? 5%. Dividend. Tax rate how much? 10%. Okay, na, sir? Interest on infrastructure debt fund. What is the tax rate? Then interest received from business trust. 5%. Dividend received from business trust, 10%. Sir, already two interest came. One interest is from what? Infrastructure debt fund. Second interest is from business trust. Both the tax rates is like 5% only. Now, third one we are going. Third one, sir, see. Interest on foreign currency loan. I mean, the loan is given in which currency? Foreign currency. And now the interest is paid by whom? Indian company or business trust. Sir, here also business trust is there. Here also business trust is there. Here what? Here to business trust it was given as a loan. Here to business trust it was investment through units. So interest on foreign currency loan either paid by Indian company or by a business trust, including the interest payable on rupee denominated bonds or long-term bonds. Okay, those bonds, rupee denominated bonds, they will invest in foreign currency only, but they will be traded in rupee values only, or their values will be reflecting in rupees only. So they are called as rupee denominated bonds or any other long-term bonds. So once again, sir, what is the third one, sir? Interest received on what? Foreign currency loans given. That interest is paid by whom? Indian company or business trust. And even include the interest received on rupee denominated bonds and even long-term bonds. What is the tax rate? If they are listed in IFSC. What is IFSC? International Financial Service Center. We have only one. That is also there in Ahmedabad. So there, if this kind of, this business trust. Okay. Sir, listed on nothing, but if that unit which is paying is in IFSC, then the tax rate, sir, they want more investments or more money to be coming first into IFSCs. So if that unit is in IFSC and such IFSC unit is paying interest, or such IFSC related unit is paying interest, then what is the tax rate? 9% only. If other than IFSC related unit is paying, then what is the tax rate? 20%. 20%. So now third interest also came. First interest is from infrastructure debt fund, 5%. Second interest is from what? Business trust. That also it came it from SPV, 5%. Now third interest, sir. What is the third interest? Interest payable on foreign exchange loan, either by business trust or by a Indian company. What is the tax rate? Listed in IFSC, 9%. Not listed in IFSC, 20%. So 4 rates came as of now. 4 rates. And here there is a note 1 also. We didn't discuss note 1. Sir, note 2 is nothing but here one more point is also there. That if I cannot cover here, so that's why I wrote note 2. So come to note 2. Any other incomes under 115A. 115A. 3 points they said clearly. The fourth one they are referring as what? Other income. Received by whom? Non-resident or foreign company. It may be dividend or income from UTI or mutual fund. If it is a dividend kind of from IFSC, tax rate 10%. Other than IFSC, tax rate 20%. Sir, it's a unit or a company in IFSC. You invested in that company and that company is giving you what? Non-resident dividend. If it is an IFSC, what is the dividend rate? What is the tax rate? 10%. Other than IFSC, 20%. If any other income from UTI or mutual funds, then the tax rate is also 20%. Okay, sir? So 2 minutes time. Go through all those points. Again, I will revise. Note 1, I'll tell afterwards, sir. So don't think of note 1. Rest of the points under 115A. So don't read them plainly. So think like how many interest points are there? Who is paying? Who is receiving? What is the tax rate? How many dividend points are there? Who is receiving? Who is paying? What is the tax rate? Okay, interest done, dividend done. Then others. What are the others are there? From whom it is receiving? And then what is the tax rate? So like that, try to make a connections and read. It's okay. It's okay, sir. 115A. First one is about what? Interest from infrastructure debt fund, taxable at 5%. Then interest from business trust, interest from business trust, like you have invested in units and then you are getting interest kind of. Then what is the tax rate? 5%. Again, interest from business trust or an Indian company by way of giving a foreign exchange loan. So then the tax rate is how much? Listed 9%, unlisted 20%. So total 4 are there, interest related. Okay, sir. Now we'll go with what? Dividend from units of business trust. Okay, then what is the tax rate, sir? 10%. Dividend from units of business trust, 10%. Then in others, sir, there is one more thing called dividend. Again, listed in IFSC, 10%, not listed, 20%. And what else we are having now? Other income. What is the other income, sir? Income from UTI or mutual fund. That is also taxable at a rate of 20%. So here, majorly it is 20%. On certain cases, it was not even 20. So what is not even 20? Infrastructure debt fund, 5%. Interest on investment in business trust, and you are getting interest, 5% only. Then interest on foreign exchange loan, if listed in IFSC, 9%. Okay. Then dividend, if received from IFSC, then also what? 10% there. Otherwise, the rest all are okay. Dividend received from business trust, then also here what? 10%. Okay. So now, sir, you could see here clearly the list. Section 115A, non-resident. This note 1 we'll see. Note 1, sir. For exam relevance, this is very much less now. Why? Because, sir, here what we said, like this third point, if you see, interest on foreign currency loan. Listed in IFSC, what is the rate? 9%. Not listed, 20. But these rates, if they were before 30th June 2023, then in IFSC it is only 4%. If not listed, it is only 5%. But now how much it became? This not listed became 20%. This listed in IFSC became 9%. Understand, sir? Interest on foreign exchange loans. From whom? Business trust or Indian company. If it is listed in IFSC, current rates are what? 9%, 20%. But if such loan is given before 30th June 2023, loan given before 30th June 2023, sir, loan might be given 2023 before, and now still interest may be paying. That's why we have to discuss this point even now. Otherwise, now we might have completely ignored this point. If loan is given before 30th June 2023, and still on that loan interest is being paid, the interest rate is how much? From IFSC now 4 only, not 9. Okay, other than IFSC, 5% only, not 20. So interest here only 4 rates it became. Listed in IFSC 9, not listed 20. But before 30th June loan is given, listed in IFSC 4, not listed 5%. Understand? Okay, now you come to here, sir, the table. Infrastructure debt fund. Okay, this one, sir. Foreign currency loan interest from government or Indian concern. Directly a foreign currency loan given to whom? Indian government or Indian concern. Then the tax rate is what? 20%. Sir, here also interest on foreign currency loan only. Paid by a Indian company. Sir, if it is company, then not listed means again what? 20%. If it is listed in IFSC, 9%. Okay. So here any other concern means what? It could be a partnership firm, anything, or it could be paid by government. Then what is the interest rate? Tax rate, not interest rate, tax rate, 20%. So now here you'll understand, sir, the total list of interest. Interest paid by infrastructure debt fund. What is the tax rate? 5%. Interest paid by business trust through which it received from SPV. What is the tax rate? 5%. Interest paid by Indian company or business trust on foreign currency loan, long-term bonds, rupee denominated bonds. Listed in IFSC 9, not listed in IFSC 20. But before 30th June, 4% and 5%. Sir, able to understand this one, sir? Listed in IFSC, what is the rate? 9. Not listed, 20. But before 30th June, they are like 4 and 5%. That also taken. Then fourth one, interest being paid by a government or Indian concern in foreign currency loan. What is the tax rate? 20%. So total interest related 4 points are there. Debt fund paying. Then business trust paying on investment. Third one, on foreign exchange loan, business trust or Indian company paying. Fourth one is what? Indian concern or government is paying. Okay, first one, infrastructure debt fund related, 5%. Second one, if it is paid by business trust on investment, 5%. Paid by business trust or Indian company when the loan is taken in foreign exchange, listed in IFSC 9, not listed 20, but before amendment 4%, 5%. Then interest paid by any Indian concern or government, what is the tax rate? 20%. Done, interest part done. Now dividend. When dividend is being paid by, sir, dividend covered under 2 places. One is here and the next one is under other points. Dividend. So dividend paid by business trust. How much, sir? 10%. Okay, if dividend is paid by Indian company, any other Indian company, not business trust, then listed in IFSC 10%, not listed in IFSC 20%. Then what else is there? Other income. Other income is from where? Income from UTI or mutual fund. Then what is the tax rate? 20%. Then royalty fee for technical services paid by government or an Indian concern in pursuance of an agreement. What is the tax rate? 20%. Okay, here we wrote even the corresponding TDS sections applicable also. Okay, the corresponding TDS section will not say anything new, sir. The same income they'll mention and the same tax rate they'll say as TDS rate. The same tax rate they'll say as TDS rate. So let's say we'll go one by one now. Infrastructure debt fund related. What is the applicable TDS section? 194 LB. We'll go to 194 LB. See here. What is 194 LB? Any person paying interest on infrastructure debt fund. Any person paying interest on infrastructure debt fund. 115A, right? What is the tax rate? 5%. Paying to whom? Non-resident or foreign company. But remember, sir, TDS, what they are saying, like, not just 5% plus applicable surcharge and cess also. The TDS is like 5% plus applicable surcharge and cess. Sir, even in special rates also. We just said the tax rate. Surcharge and cess is anyhow common only. But here, for non-residents, sir, when you are deducting TDS, for residents usually will deduct that rate only. But for non-residents, that rate plus applicable surcharge plus applicable cess all together we will be deducting as TDS. So any person paying interest on infrastructure debt fund to non-resident foreign company, then the TDS is at what rate? 5% plus surcharge plus cess. When it has to be deducted? At the time of payment or credit. Credit means entry. In books, when you pass the entry, payable entry, that is called credit. Credit entry. Credit means payable entry in books or the actual payment out of these two, whichever is earlier, then the TDS has to be deducted. So infrastructure debt fund related clear. 5% interest rate, 5%, tax rate 5%, TDS rate also 5%. Okay, then what is the next one, sir? Business trust, paying interest. What is the corresponding TDS section for it? 194 LBA. See, sir, 194 LBA. Business trust, paying interest which is received from SPV and even dividend. So it covers not only just interest, even dividend also it covers. And it is paying to whom? Resident as well as non-resident. Sir, 115A covers only non-resident, but 194 LBA covers about both non-resident TDS and even resident also related TDS. Sir, first 115A rates will recall again once again. Business trust is paying interest which is received from SPV. What is the tax rate? 5. Dividend 10%. Same TDS rate. See, to non-resident interest 5%, to non-resident dividend 10%. Residents, irrespective of interest or dividend, it is 10% only. To residents, it is like how much? 10% only is the TDS to be deducted. Okay, sir, here only 10% NFA or 5% NFA for non-resident plus surcharge plus cess is common only at the time of payment or credit, whichever is earlier. Sir, clear this one? Okay. LBA done. Then third one is what? Indian company or business trust paying interest on what? Foreign exchange loan. To whom? A non-resident or a foreign company. Covered under which sections? 194 LC and LD. Why now? Here only, not only foreign currency loan, even long-term bonds and rupee denominated bonds also has been covered. LC. Where an Indian company or business trust paying interest to non-resident or foreign company related to foreign company loans, foreign currency loans, long-term bonds, rupee denominated bonds. Listed in IFSC before how much? 4. After 9. Not listed in IFSC before 5. Now 20. That only is there. 5%. Okay. Not listed, sir. It is not covered currently under 194 LBA. LC. It is covered under 195, but the rate, TDS rate remains same only. Okay. So tax rates, if you remember, the same will be the TDS rate also. The same will be the TDS rate also. Understand, sir? And then TDS, they are not mixing in questions. TDS, if they ask as an MCQ only. To solve a 7 marks question, if you remember 115 properly, it's enough. TDS, they are not being involved in the 115. Even if they involve also, simple only. Whatever is the tax rate, that only might the TDS has been deducted. So what they do, sir, maximum, from business trust interest received, net of TDS. That's what they'll say. If TDS provision has to be involved. Net of TDS, now, if interest is received from business trust on investment, what is that rate? 5%. What TDS they might have deducted? 5% plus surcharge cess together they might have deducted as TDS. So that you gross up, you will get the interest grossing amount. Okay, but that much complex points also they are not asking. They are asking plain points. You just need to figure out which income it is, what is the tax rate. Whether it fits under 115 chapter 12 or else some other sections like 115, AB, AC, those sections are. So you just identify an income, which section it is, what is the tax rate. If you can identify, then the sum is almost done. Then, sir, dividend related also. 194 LBA already covered. Here 195. So what is 195 also we'll see. What is section 195? TDS on other sums payable to non-resident. I mean in general. If those sums are not covered specifically under any other section, then this general section comes into picture 195. So if any amount which is chargeable to tax to non-resident is being paid except salary, then TDS has to be deducted at a rate in force during the financial year. In that financial year, whatever is the rate force, I mean whatever the tax rate applicable to that income, that rate TDS has to be deducted at the time of payment or credit, whichever is earlier. Okay. If at all the non-resident wants to get the TDS to be deducted at a lower rate, what is the difference between 115A third point and fourth point? Sir, you tell what is the difference between this third point and fourth point? Here Indian company or business trust has to pay. Here government has to pay or any other Indian concern. Concern means it could be firm, AOP, BOI, HUF, all those individual, all those will come under Indian concerns. Here Indian company. So what is 195, sir? Again on any other them. So 195. TDS on any other sum payable to non-resident. Person, any sum chargeable to tax except salary, TDS has to be deducted at the rate in force. Whatever the rate, na? If the rate is like 10%, deduct 10%. It does not say a specific rate because it is a general section. Whatever the rate applicable, that rate you deduct it as TDS. Okay, sir, if this is a common point, sir, in TDS. If the deductee wants to get the TDS to be deducted at a lower rate, then he has to apply to the AO. AO verifies and gives a certificate. That certificate you give to the person who has to deduct TDS. Then he'll be deducting at a lower rate. He'll be deducting at a lower rate. The recipient applies to AO in Form 13 and gets a certificate authorizing the payer to deduct tax at a lower rate or no TDS. Sir, understood 115A? So 115A has royalty fee for technical service. Okay? Receiving by whom? Received by foreign company or non-resident? Paid by Indian concern or government? As per the agreement entered with, as per the agreement in connection or in terms with the government. We need to check PE, India. I mean that royalty fee for technical service is related to PE in India or fixed place of business in India. Related to that only. 44DA. Then how to calculate income? Normal PGPP income, how do we calculate? Same way calculate. All the expenses allowed only except which were not related to that PE and fixed place or head office payments. If they are like reimbursements, kind of fine. Others not allowed. Okay. What is the tax rate? General rates only. There is no specific rate given. Normally for non-resident, what are the tax rates applicable? Like slab rates, firm 30%, company 35%. That rate only applicable. Sir, if no PE, no fixed place of business, then 115A, which is like what is the tax rate? 20%. Then we came to other investment incomes like interest. Interest on infrastructure debt fund, 5%. Interest paid to non-resident unit holders by whom? Business trust with respect to investments made. So what is the tax rate? 5%. However, if it is dividend, 10%. Then third one, interest received by non-resident foreign company from an Indian company or business trust. The loan given is in foreign exchange loan. It could be a long-term bond or even it could be a rupee denominated bond. Then the interest rate is listed in IFSC 9%, otherwise 20%. But loan given before 30th June 2023, listed in IFSC 4%, others 5%. And the fourth one, interest on foreign currency loan only paid by government or any other Indian concern, tax rate 20%. Now one more thing is there, sir. Fifth one, others. Other is what? Any dividend paid by an Indian company to non-resident or non-resident foreign company. Tax rate, sir. IFSC 10%, other than IFSC 20%. The last one, income on UTI or mutual funds. The tax rate is 20%. So this is totally about 115A tax rates. The corresponding sections are different, TDS sections. 194LB, 194LC, 194LBA, like the different sections came, but the tax rate remains same. Now look at the other procedural points under 115A, sir. So here, from these special rate incomes, if they are like interest, dividend, others, or if they are like royalty fee for technical service, you cannot claim any expense under head PGPP from 28 to 40C. Either on interest, dividend also you cannot claim anything as expense, and on royalty fee for technical service also no expense is allowed. The gross amount only taxable. That's what. Then under IFOS also nothing expense can be allowed. Sir, sometimes these incomes might be taxable in PGPP, sometimes this income may be taxable under IFOS, depending on the SSE, okay, whether it is active income or passive income. Active income, mostly it comes under PGPP. Sir, active na fee for technical services, actively providing services, so it's an active income taxable under PGPP. Passive, he just given a loan, his business is something different, then it is passive income taxable under our IFOS. But for these incomes, no expense can be allowed, either under PGPP or even under IFOS. Then, Chapter 60 deductions. For interest, dividend and others, Chapter 60 deduction, only one deduction is allowed, sir, which is called what? 80LA. So go back and read what is 80LA. Banks which are there in offshore units, okay, if they are like in IFSC, then their profits are 100% of their profits are eligible for deduction. Okay, so a non-resident or a foreign company can have an offshore unit in India. In which zone? IFSC zone, because it's like a SEZ. So there, such unit if is getting this kind of incomes, then they can claim still what? 80LA deduction. So let me show you 80LA once again. Deductions in respect of incomes of offshore banking units and IFSC. So offshore banking unit means what? It's a foreign company branch, foreign bank related branch operating in IFSC zone or in that notified Indian zones. For them, what is the benefits? 100% of their incomes are eligible for, profits are eligible for deduction. Okay, so now what they are saying, this foreign company, sir, foreign company is what? Foreign company might have a PE in India. Foreign company, even though resident, it still can claim which benefit? 115A benefit. So it's a foreign bank only. It has a branch located in IFSC. Now the IFSC income, that foreign bank related IFSC income is eligible for what? 100% deduction. So they can claim, even though they can claim special rate, and even they can claim what? 80LA deduction also. But basic exemption limits benefits are not available. They are taxable at what? These special rates only. Okay. Then expenses under royalty for fee for technical service. On royalty fee for technical service, PGPP expense, IFOS expense can't be claimed. Basic exemption limit benefit is not available. But Chapter 68 deductions can be claimed. Any Chapter 68 deduction can be claimed from what? Royalty and fee for technical service related income extent. But if it is like interest, dividend and others, except 80LA, no other deduction can be claimed from those incomes. Then return not required. When return is not required, see, non-resident foreign company has the only incomes referred under 115A. And on all those incomes, TDS has been deducted. If since TDS has been deducted under respective sections, then they need not to file return. So only those incomes should be there. You should not have any other income. Those incomes only there which are taxable in India, and corresponding TDS sections applicable, TDS has been deducted, then he is not required to file return. It's okay. So to continue in NR taxation. So the next one is about 115 AB. 115 AB is about what? Income of offshore fund. Offshore fund. So offshore fund means in simple nothing but it's a mutual fund which is there outside India. Okay, in US also there may be mutual funds. In Dubai also there may be mutual funds. So those funds we call them as like what? Offshore fund. They are getting income from mutual funds from India. So nothing but in simple. A US mutual fund invested in India, that also again in a mutual fund. Okay, now this Indian mutual fund will be paying income to this US mutual fund. Okay, that's what we've been talking here. Income of offshore fund. Income of offshore fund. In simple, it's a mutual fund which is there outside India. And they are paying income of offshore fund. They are getting incomes from what? Sorry, offshore fund is getting income from where? UTI or mutual fund. See, offshore fund, nothing but overseas financial organization. In simple, you could remember it as like what? A foreign mutual fund. Receives income from units in India. Receives long-term capital gain on selling those units in India. It's okay. A US mutual fund invested in Indian mutual fund. Now what US mutual fund will get? From the Indian mutual fund, it may get investment income like income of offshore fund from UTI mutual fund in India. Offshore fund means what? Overseas financial organization. It receives income from units being interest or dividend taxable at what rate? 10%. Okay. Long-term capital gain on selling those units, 12.5%. But these units should be purchased in what? Foreign currency. So a US mutual fund invested in Indian mutual fund. Now this Indian mutual fund gives what? Dividend or interest. Okay. But this US mutual fund should have been invested in what currency? Foreign currency. And on selling of this Indian mutual fund units, there may be even long-term capital gain also. Sir, okay. Offshore fund means what? A foreign country mutual fund. Income of offshore fund from UTI or mutual fund in India. So income from units, the tax rate is what? 10%. Long-term capital gain, what is the tax rate? 12.5. Any other income? Any other income now, what else will be there? So short-term capital gain. That is taxable at what? Normal rates only. So simple section. A offshore fund invested in Indian mutual funds or UTI. It is getting what income? Investment income, being interest or dividend or long-term capital gain on sale of those units. Interest dividend, 10%. Long-term capital gain on sale of those units, 12.5. Okay. Then any other incomes are including short-term capital gain, taxable at what rate? Normal rates. Okay. Here, indexation not applicable. Sir, 48 proviso 2, not proviso 1. Proviso 2 is about what? Indexation. So indexation not applicable. Currently indexation is not there also. Deductions under PGBP or IFOS, any expenses are not allowed as allowable. And no chapter 60 deductions also allowable. But see sir, if there are other incomes, on other incomes you can claim deductions. On other incomes you can claim expenses also deduction. But these two only special rate side. So with respect to special rate incomes only restrictions. With respect to these two special rate incomes, indexation anyhow not there. Deductions like any business relevant expenditures incurred to earn these incomes can't be claimed as deduction. No chapter 60 deductions also can be claimed. Okay. So offshore fund receiving what? Interest dividend 10%, long-term capital gain 12.5%. Now the corresponding TDS section is 196B. What does it say? Any person paying to NR income referred on 115AB, income refund nothing but what? Income or dividend on investment in Indian mutual funds or UTA, the tax rate is how much? 10%. Whereas long-term capital gain on transfer of such units to an offshore fund, the tax rate is how much? 12.5. Plus surcharge plus cess, together it has to be deducted as TDS when at the time of payment or credit, whichever is earlier. Then we are moving on to 115AC. Okay, we completed what? 115AB. Yes, we are moving on to 115AC. Income from bonds, GDRs purchased in foreign currency. What are called GDRs? Global Depository Receipts. It means, GDR means, at least who completed SFM? It's okay. So it is globally traded only, that I'll agree. Sir, it is something like, sir, does Indian share can be traded in NASDAQ? Where is NASDAQ located? US Stock Exchange. NASDAQ is US Stock Exchange. Does Tata Motor share or Reliance share can be traded in USA? Can be traded in USA? You cannot trade them. Does Google share trade in India? In India. Can we buy Google share in India? In BSE, NSE, you cannot buy Google share, you cannot buy Meta share because those were where? Listed in US Stock Exchange. Same way, Reliance Limited share, Tata Motors, Infosys, these shares are listed where? India. But you are in US. You wanted to buy Tata Motors share. Can you buy? You cannot buy. Being there in US, you cannot buy. Because those shares are not freely tradable there. Then how to do? And how to do na? To make sure that the foreign non-residents also to invest in India, they'll create GDRs. GDR is an instrument which has the backing of Indian share. So it's nothing but GDR is also like an Indian share. But with the GDR, you will not have voting right. Understand, sir? So let's say, sir, I'll keep 100 shares in a depository. So for this 100 shares, I'll not give it to anyone. I'll just keep there. For this 100 shares, I'll generate GDRs. So these GDRs are tradable across the world. Global depository receipts. So, sir, understand the word global. So they are tradable globally. Depository. Those corresponding shares were deposited with the depository. That's why these receipts has been came. So this receipt is nothing but an equivalent of equity share. This global depository receipt. The only difference is like it can be traded anywhere. Okay, in Dubai stock exchanges, in global Nasdaq, everywhere it can be traded. But with that, you cannot have voting right. Because that's not a share, it's a depository receipt. But still it is equivalent of an Indian share only. Then they are called as what? Global depository receipts. Only for America. So not globally. Only to trade in America if you generate anything, then they are American depository receipts. Okay, so that is what? Global depository receipts. So income from bonds, GDRs purchased in foreign currency. You purchase these GDRs or bonds in what? Foreign currency. So even though non-resident purchase GDR, ultimately the money comes to whom? Indian company, right? So they need not to invest directly in Indian company. They buy GDRs also. Still the money is floating into Indian company. So that's why interest on these bonds or GDRs, which is purchased in what? Foreign currency. So non-resident is earning any interest on bonds purchased in foreign currency of an Indian company. Bonds of which company, sir? Indian company notified by government. On that interest rate, on that interest tax rate is how much? 10%. Then dividend on GDRs. Sir, why dividend will come? Because they are like shares. So just like on a share, dividend come. On GDR also, dividend will come. So only thing missing is what? Voting rights. Dividend on GDRs purchased in foreign currency. On them, the tax rate is what? 10%. So in simple, investment income 10%. Whereas that bonds or GDRs has been sold, long-term capital gain arrest, taxable at what rate? 12.5. So you are a non-resident. You invested in what? Bonds, GDRs of Indian company. Okay. What incomes you'll get? Investment income, capital gain, long-term. Investment income, either interest or dividend, taxable at 10%. Long-term capital gain, taxable at 12.5. So now again, what is 115 AB? AB, the previous one. Sir, going forward, you'll get confused if you section by section. It is easy only, but you should have all the sections together because a specific point you should identify which section it is. So 115 AB is about what? Offshore fund, getting income from Indian mutual fund or UTA. Then investment income taxable at 10%, long-term capital gain 12.5. Other incomes normal rates only. Now here what? 115 AC, non-resident, not specific about which non-resident. Non-resident, getting income from where? Bonds or GDRs of an Indian company. Investment income 10%, long-term capital gain 12.5%. If it is like infrastructure debt fund, 5%, right? Royalty fee for technical service, 20%. Okay, from a business trust, investment income being interest, dividend. Okay. So on these GDRs, sir, why bonds? Sir, usually, okay, on these GDRs, indexation not available. No PGBP IFOS deductions available. Chapter 6A deductions not available. Only interest dividend income on bonds GDRs. Okay, he has only interest or dividend income on bonds GDRs. TDS deducted under 194C. Return not required to be filed. Okay, during the course of amalgamation, sir, actually you purchased bonds GDRs of A Limited. Now A Limited merged into B Limited. Okay, now you are holding technically the bond GDR of A Limited, but that was no more. You got what? B Limited. Still you can continue to get the special rate benefit only because that was succeeded. The successor will absorb the predecessor, right? So even though you hold the new share or the new GDR, still the old special rates only be continuing. During the course of amalgamation, bonds GDRs held by one entity transferred to the new entity. For the new entity also, even if you held in new entity also, concessional rates are available. Clear, sir? 115 AC. Then 11. So then TDS 196C. Any person paying interest dividend TDS 10%, long-term capital gain 12.5%. When it has to be deducted, payment or credit, whichever is earlier. Then 115 AD, income received by foreign institutional investors or specified funds. Received by whom, sir? Foreign institutional investors or specified funds. They get interest or dividend. They get what? Interest or dividend. Income covered under section 194 LD. Sir, who are these foreign institutional investors? Who are called foreign institutional investors? See, foreign institutional investors means these are large foreign institutions. Qualified foreign institutions, these are foreign individuals. Okay, like they may be a foreign bank. It may be a foreign insurance company. Okay, largely they'll invest into Indian markets. They are foreign institutional because those are institutions. Bank is an institution. Insurance company is an institution. So large foreign institutions are called FIS. QFI, he is an individual only, but he do little bit bigger trading. He'll buy in much more. So normal is he'll do in volumes. He's a normal individual kind of only, investor only, but he can do in a big amounts. Then he's called as qualified foreign individuals and small institutions. Okay, investment scale of FII is like large, QFI is like usually smaller. Okay. So now what is the section here? This foreign institutional investor is getting income. From where? Interest dividend. From income covered under 194 LD. So again we need to go back and see what is 194 LD. See, this is 194 LD. What is 194 LD? Go back, sir, 2 pages back, you'll have 194 LD. This is like MGR. Any person paying interest to whom? Foreign institutional investor or qualified foreign institution. What interest? Interest on municipal debt securities, government securities, rupee denominated bonds of Indian company. MGR na, M means municipal debt securities, G means government securities, R means rupee denominated bonds. On these three, if any interest is paid, and these were issued before 1st July. I mean, till 30th June 2023 only these were issued. On them, that interest, the TDS rate is what? 5%. Sir, currently what? Currently this section doesn't cover. Then it fit under 195. Okay, it goes under 195. There is no special rate available to them currently if these are purchased. But before 30th June 2023, they are covered under 194 LD. Which instruments are? MGR, R for rupee denominated bonds, G for government securities, M for municipal debt securities. On them, if any interest is being received by a non-resident, which non-resident? FIIs, foreign institutional investors, or QFIs, qualified foreign institutional investors, then the tax rate would be 5%. Done, sir. So you're getting interest dividend from where? Income covered under 194 LD. Then the tax rate is what? 5%. One second, sir. Okay. Sorry, here this part is not about FII. Add this word, sir. FII receives. Specified fund receives. Sir, here what? Interest dividend on. Sir, FIS, QFIS getting interest dividend. If they are from MGR, 5%. FIS getting other interest or dividend, 10%. There are specified fund getting other interest or dividend, 20%. Sorry, FIS getting 20%, others getting. Simple. Okay, let me break it much more clearly and tell you. From MGR, MGR means what? Municipal debt securities, government securities, rupee denominated bonds. That also, which time, sir? Before 1st July 23. On this, what is being paid? Interest. Interest on what? FIS or to QFIs, qualified foreign institutional investors. On this interest, what is the tax rate? 5%. Others paying interest. Others paying interest to FII. Others paying interest to FII. Then the interest rate is what? 20%. Other na, any other bond, any other loan. Okay, on that interest is being paid to specified fund. What is specified fund na? So nowhere, I also didn't dig in that deep and identify like which specified fund. So interest rate is like how much here? 10%. Understand, sir? So here the specified fund is not paying. So this is like, actually I might have written this section much more betterly like this. Why? Because all the previous sections what I did, like who is paying I have written here. But these two are not like paying. These two, okay, when the interest is received by a foreign institutional investor, specified fund. When it is received from foreign investor, that also what? Other interest and dividend. Interest and dividend from MGR, 5% only, whoever receives. Other interest and dividend received by FII, what is the tax rate? 10%, sorry, 20%. Other interest received by specified fund, taxable at what rate? 10%. If there is any long-term capital gain, taxable at what rate? 12.5%. Same common condition, sir. PGBP, expense reductions, not allowed. Chapter 6A, not allowed. Indexation, not allowed. But return filing, sir, this QF foreign institutional investors has to file return even though TDS is deducted. Rest all till now, if TDS is deducted under respective sections, they are not required to file returns. But this person has to file return even though TDS has been deducted. So now 196D. Any person paying income with respect to securities other than those covered under 194 LD. What are 194 LD? MGR, municipal debt securities, government securities, rupee denominated bonds. To FII or specified fund. When it is paid to FII, TDS rate is how much? 20% plus surcharge plus cess. Paid to FII, sorry, specified fund, TDS rate is 10% plus surcharge plus cess. Okay. TDS on income in respect of units to non-resident. Any person, okay, he could be a recipient of income, he could be non-resident individual or non-resident HUF, paying income from units. Okay, first, sir, this is the provision. Let me tell you. Any person paying income to whom? Foreign company or non-corporate non-resident. Foreign company or non-corporate non-resident. So that means he could be non-resident individual, non-resident HUF also. Paying income from units of mutual fund or UTI, then the TDS rate is what? 20% or DTA rate, whichever is lower. But this any person is paying to whom? NRI, non-resident individual or non-resident HUF, and they were acquired using funds from NRE account. NRE account is nothing but non-resident external account. So their foreign earnings, they are depositing in an Indian bank. So what is called NRE account means? SBI, usually if you have an SBI account, your money will be reflecting in which currency? Indian currency. But you have an SBI NRE account, then your Indian money, okay, you might have deposited Indian money also, but it will reflect in what currency? Foreign currency only. Then that is called as non-resident external account. So you have purchased these units using what? NRE account or using convertible foreign exchange remittance, then TDS is not applicable. Nothing but, sir, to encourage NRIs and non-resident HUFs. If a non-resident individuals and HUF will invest in Indian mutual funds or UTA, then for them no TDS applicable. But if they are invested by, some others has been invested, like who? Like foreign company or like AOPs, BOS, those has been invested, then for them the tax rate is how much? 20% or DTA rate, whichever is lower. Okay. So till now, whatever we have discussed, you should have clarity. So now, first, 115A, who has been covered? 115A, who is covered? Non-resident foreign company. 115AB, who is covered? Offshore fund. 115AC, who is covered? Foreign institutional investors or qualified financial investors. Okay, for not qualified, specified funds. Foreign institutional investors are like specified funds. Then 115AD, the previous one. They are not specific about which non-residents are. If you see 115AD. 115AD is said like what? Okay, received by FI. Okay, AD is this. Then AC what I wrote. Okay. It's just bonds and GDRs by any non-resident, right? Okay. Bonds and GDRs by non-resident. AD is about what? Foreign institutional investors or by specified funds. This is clear, sir? Who is the non-resident under each section? 115, it should be what? Non-resident or foreign company. AB, it should be offshore fund. AC, bonds, GDRs purchased by non-resident. AD, foreign institutional investors or specified funds. A, we have reasonable clarity. AB, offshore fund. Where it have invested? In Indian mutual funds. From there it has what? Investment income or long-term capital gain. Investment income 10%, long-term capital gain 12.5%. Again on this bonds and GDRs also, investment income 10%, long-term capital gain 12.5%. Then on this FII and specified funds, they might have MGR 5%. Then other incomes, like related by FII na 20%. If it is related by specified fund na 10%. Long-term capital gain 12.5%. You got clarity right now? Okay. So look at this, sir. Again, the summary of 115, this page, the summary of total 115 A, AB, AC, AD, B. Quickly, sir. Go through this A, AB, AC, AD. Find out if you have any. First 5 points clear, right? Interest related points clear, right? Infrastructure debt fund 5%. Business trust received interest from special purpose vehicle 5%. 5% done. Then third one, sir. Interest from foreign company loans by Indian concern or business trust or interest on rupee denominated bonds. Listed in IFSC, not listed. 9, 20. Before 4, 5. This is also done. Then the fourth one, interest on foreign currency loan only paid by government or any other Indian concern, 20%. Interest part done. Dividend from business trust received, 10%. Other dividend listed in IFSC, 10. Not listed, 20. Income from UTI or mutual fund, 20. Royalty fee for technical service if not covered under 44DA, 20. So this is the summary of what? 115A. Then 115AB. SSC is being what? Offshore fund. Okay, this offshore fund receives income from units, 10%. Income long-term capital gain, 12.5%. 115AC. SSC, any non-resident, he receives interest on bonds or dividend on bonds and GDS, 10%. Long-term capital gain, 12.5. 115AD, FIIs or specified funds. Investment on MGR, 5%. Interest dividend received to FII, 20%. Interest dividend to specified fund, 10%. Long-term capital gain, 12.5%. Clear, sir? If this summary you have, you can do questions. This summary, if you have in your mind, then we can solve the questions from the mostly the last 3 attempts exam questions are based on this summary only. Along with chapter 12A. What is chapter 12A? Non-resident individual. Okay, he's having income from foreign exchange assets. Then investment income, like interest, dividend, taxable at what? 20%. Long-term capital gain, 12.5%. And he is eligible for 115F exemption also. Sold a foreign exchange asset and purchased another foreign exchange asset or saving certificate and 10 subsection 4D. Then within 6 months from date of transfer, capital gains proportionate to the investment made out of net sale consideration is exempted. Right? So this part, if you have clarity. And then one small section we're going to discuss now, 115 BBD. You are ready to do problems. See, 115 BBA. Non-resident sportsman or entertainer. Non-resident sportsman or entertainer is getting incomes. Here 115 BBA covers non-resident sportsman or non-resident entertainer or even a non-resident sports association. 3 people covered. Non-resident sportsman, non-resident entertainer, non-resident sports association. So now for non-resident sportsman, he may get income for participation in a sport. Okay, the foreign cricketers coming to India to participate in IPL. For that participation in game, they'll get money. advertisement also. So they'll be acting in various advertisements also. Like for that also they'll get money. Contribution to articles. Articles, na, sir, like they'll be telling their life story. They'll be telling their struggles and also. Certain magazines will be printing their stories and all. For that they have to pay money to that sportsman. Okay, these days they became free, but previously, na, for giving or sharing or giving those articles also, the journals and all those people used to pay. So contribution to articles, or this third one is for entertainer. For participation or for performance in a event. Sir, a show has been organized in India. In that, the BTS troupe came and participated. For participating in India, they'll get fees, right? That fee we are covering here. Okay, non-resident sportsman, non-resident entertainer. Now, non-resident sports association. Sir, the recent World Cup organized where? India, right? Pakistan. Huh? The recent World Cup organized where? In India. Sir, now, does all those money will go to BCCA only? Huh? It has to be. There will be a sharing agreement, sir. Organizing country will get some amount. ICC will get some amount. Now, ICC is a non-resident sports association or resident sports association? Just because Indian is ICC president, it will not become resident. ICC is like International Cricket Council, right? So it's a non-resident only. Let's say there is a bilateral series between India and Australia. Sir, now, why Australia has to agree to play in India? Always they may select play only in Australia, right? Why na? Sir, in India only the revenues will be high. Because more people will come and see the matches. And in that revenue, certain share will be taken by BCCA and certain share will be given to Australian Cricket Board also. That's why they'll come. Okay, so for the matches organized in India, even the non-resident sports association, it may be ICC or any other country cricket board also will get shares. That share income, amount guaranteed for sport or play in India. They guarantee this much amount will pay if you come and play in India. So that amount they're gonna get. Okay, so sportsmen will get what? For participation in game, for acting in a commercial or contributing to any articles in a journal. And then entertainer for participation in a event. There are sports association. For entering into this agreement to play game in India, they'll get a share of match fees and all. So now, what is the tax rate on all this, sir? 20%. No expense allowed. Chapter 6 deductions not allowed. Return not required to be filed if TDS is deducted. Okay, what is the applicable TDS section? 194E. Any person making a payment with respect to incomes covered under 115 BBA. Any person making a payment with respect to incomes covered under 115 BBA to a non-resident sportsman, entertainer or sports association. Sir, any person making payment with respect to what? Incomes covered under 115 BBA. It could be sportsman, entertainer, sports association. Okay, then what is the tax rate? 20% of surcharge, 20% tax plus surcharge plus cess. Payment or credit, whichever is earlier. Okay. So now in the chart, if you see, even this also has been included. 115 BBA, SSC, non-resident sportsman, entertainer, association, then the tax rate is 20%. So with this, the second segment also we have completed. So okay, then third one, sir, we have presumptive taxation schemes. Presumptive taxation schemes. How many presumptive taxation schemes? This was added by Finance Act 2025. How many are there? 44B, BB, BBA, BBB, BBC. B, BB, BBA, BBB, BBC, BBD. I know, sir, how to remember all these section numbers. Okay, in our schooling, they have taught us one thing so well. 2 1s are 2, 2 3s are 4, like every day we need to tell, right? So that's what. Okay, in 4th class, like because I couldn't learn 12th table, 13th table, 14th table. So in our school there used to be a rule like after lunch, 1:30 the lunch break completes. And then 1:45 the next session starts. So like this 15 minutes they have kept like that only because the 45 minutes schedule can't be adjusted accordingly. So that 15 minutes is like a leisure kind of every class in the school standardly. So this 15 minutes what we have to do now, by 1:30 we should be in classroom. 12:30 to 1:30 is the lunch break. 1:30 we should be in classroom. But they start at only 1:45. So this 15 minutes, everyone in a row. It's okay, like this fellow has to tell 7th table. Again next one 8th, 9th, 10th not there again. Next one 11, 12, 13, 14 like this till 14. These tables has to come and so this used to happen like continuously every day. So for me, I don't. Okay, if some tables like 9, fine, 11 is also fine, but other tables and all, no, we don't get. So okay, we used to like change places. Okay, where if I sit, I'll get 7, but others also same like me only. So they are also not adjusting. So if we don't change, there will be a class leader, mostly girls only. Okay, they'll do what? They'll again write the names. Okay, so this was, that time maybe teacher also may not be there. So this later only. Okay, teacher also fine, later only more than teacher. Okay, so they used to think of what, okay, this person didn't settle and all, they have to give list. Okay, then once the teacher comes now, like we need to. So this thing. So every day it's like a torture for us. So then we 4 friends decided to go away from the school. Okay, so like recently, like I'm in 4th class. So I mean like I am 9 or 10. So that time, so we went to some Pushkaralu. I vaguely remember. There we seen like Pushkaralu, you know, right? Okay, there what happened? Like they are selling these pearls, these and all. So we at that age we thought like diamonds will be there in reverse. So okay, what we thought means we'll go away from school, 4 people. We'll go to Vijayawada. So there Krishna River is there. There we can find diamonds. We'll sell diamonds and we'll not reach. We can survive. So okay, we had a plan. We executed. I mean, we made a plan for 2 days. 3rd day we went. We started like going also. Okay, from Noosveed in 9th class we almost went to 10 kilometers. We almost went, like skipping the school, we went like 10 kilometers. In lunch break we did. So lunch break 12:30 to 1:30, so that time. So we went. So okay, by 3 o'clock the school is under complete. So no class is going on, all the teachers are in like tension and all. Okay, what happened means like, so our backbench guy has listened to all our plan. Okay, so we came to know that he already listened to the plan. So that's why so that time our pocket money used to be like 1 rupee. So okay, we all have like each 1 rupee. We gave 4 rupees commission not to tell to anyone. And then we went, but that fellow, okay, he said to like the teachers like 3 o'clock because they are also afraid on that. So okay, then, and out of these 4, sir, like for me, I'll be taking carriage only. So one other guy also will be taking carriage only, but the other 2, their house is near to school only. They'll go to house, they'll eat, and again they'll come back to the school. So those people didn't went actually. So because of those 2 students, actually this total issue came out. So okay, then actually we went like some 7-8 kilometers. So okay, now that water tank is not there, we are like standing, we are like water tank. We wanted to do adventure, to go and climb the water tank and all. So when we are about to climb the water tank, then the people came chasing us. So okay, so what is the problem there? The problem is like, so they didn't give us like time or they didn't explain, so they only pressurized us on by hearting tables. But for me, somehow, that day only, so like almost like, so when they are taking me like that's why the scooter came for us to chase. Okay, like 4 kids only, like we are like on scooter backside 3 of us. And if you remember like for scooters those days, like there will be a front seat also. Small front seat will be there. So one student was there, like I mean, he's a relative or someone only came. So he's like on front, we back, sitting 3, we don't even talking anything. We are just looking at our faces only. So by the time I go to school, my daddy bike is already there. Oh, he also know na. So okay, like ours is like a missionary school where sisters will be there. Okay, like principal kind of sister will be there. So usually we'll more afraid of like when we take to sister room now, we'll feel like so much. But then we were taken to that sister room. Okay, so we were made comfortable. We are sitting there. Then she's talking with each and every parents individually and all. Okay, that is the only thing I had favorable opinion on sister. Okay, why? Because she said like don't tell anything. I mean, don't say anything. Those are kids only. They don't know anything like that. But still I know. Okay, nobody can save me today. But actually I got saved that day. By the time we go home, so already the relatives are coming to my home. So okay, my grandmother, grandfather, so they're just about to step into my house. So before them, they cannot hit to trash, all those they cannot do me. So that's why I got saved. So okay, but 2 students can't, I mean the other 2 friends can't even come to school for next 3 days. After 4th day they came to school also, they can show. So okay, sir. So now all these section numbers, we don't have any choice. What we have to do? Memorizing by hearting only, no other thing. Okay, for the exam purpose. So afterwards, nobody will remember this. We have Google, we have ChatGPT, we have big books available with us. Okay, we'll be referring them because there is no urgency. Like within 2 hours only you have to do that. In exam, you have time limit, time constraint. You don't have any other access and all. But let's say if you have a non-resident client come also, you just have an overview. So because you're studying, you'll have a overview. That time nobody will remember. Okay, so just because he is CSMA, he'll not remember all these things. You go and ask any CSMA, and they'll say like what you are talking only. So now we are moving on to presumptive schemes, sir. Simple only. Like in 20 minutes we can complete this presumptive schemes and we can solve the questions. So this 44 BBD is added by Finance Act 2025, sir. BBC is added by Finance Act 2024, but that also they didn't ask any question. BBC, BBD, BB, BBA, BBB, BBC, BBD. Okay, now see first. SSC non-resident. Of course, these presumptive schemes are for whom? Non-resident only. So we can discuss these 3 simultaneously, sir, because all the 3 will complete one, then come to other 2, but these 3 looks similar. First 44B. SSC is into business of operating ships other than cruise ships. So you know cruise ships. What are cruise ships? What is the purpose of cruise ships? Cruise ships are meant for transportation. And then for what? Cruise ships are meant for transportation. Then what? Then what are called cruise ships? Sir, cruise ships are for amusement, entertainment. Okay? Like what? So the cruise ship, sir, it has so many fun activities involved in that particular ship. You will be going like a vacation kind of from one location to another. Let's say there are like many crews available, like from Vizag to Andaman, a crew will go. Okay, or Vizag to Chennai also there are like cruise ships which are going. So okay, so like the voyage takes like for 5 days to 7 days and all. So all this period, once you go into cruise, you'll have a free buffet there. You'll have the entertainment activities going on different floors of the ship. Okay, you experience the ship voyage and all. So those are called cruise ships. The normal ships are like meant for transportation. Okay, so here business of operating ships other than cruise ships. Okay, deemed profit, sir, from these ships you are into the business of operating ships. What is your deemed profit? Your deemed profit will be 7.5% of what? That we have to calculate. Okay, of what? We need to check whether amount received in India. Okay, if the goods are shipped from port in India, the goods, it may be goods, passengers, livestock, mail, any of this. If they are shipped from port in India, wherever it is received, take that and multiply it with 7.5%. If the passengers onboarded in India, Indian port, goods onboarded in Indian port, or the livestock or mail, if they are loaded in from an Indian port, then that income, that particular freight received in India or outside India, you should take that income, multiply it with 7.5%. If they are shipped from port outside India, then you will consider them only when they are received in India. Understand, sir? Where they were shipped, from where the shipping has been started for these goods, passengers, livestock and mail. From India, from Indian port only. So now the freight, wherever it is received, consider that freight. If they are shipped from outside India, then consider that freight only when it is received in India. So now you got a total of freight to be considered on that 7.5%. Sir, which one we are ignoring? Shipped from outside India and the freight also received outside India, such freight we are ignoring. So in simple, sir, if it is received in India, take it outrightly. Even though received outside India, we'll take only in one case. When if the goods are shipped from India, then even though received outside India, we'll take those freights and on that we'll multiply 7.5%. That is called the deemed profit. Understand, sir? What is the business here? 44B. Operating ships, including cruiser, excluding cruiser? Excluding cruise. Okay, what is the presumptive profit to be taken? 7.5% on the freight. But which freight? Can we take the total freight? No. We need to check for that where the goods, passengers, livestock or mail has been shipped. If they are shipped from port in India, then the freight wherever it is received, consider. If they are shipped from a port outside India, then consider only when the freight is received in India. On that multiply 7.5%. Done. 44 BBC. Business of operation of cruise ships. Cruise ships are, sir, the cruise ships definition is given by Finance Act 2025 only. Okay, cruise ships are for what? Leisure, to spend your leisure time or for recreational purpose, like amusement parks, entertainment event kind of it is like. Okay, this is like for an amusement, for an entertainment, to recreation. Cruise ships, these are not meant for transportation. These are not meant for transportation. So now see, sir, deemed profit. So deemed profit, how much we have to take? Deemed profit is how much? 20% on what? Sir, these cruise ships, origin also will be in India, destination also will be in India. See, their voyage touch 2 seaports in India. So you will not be going to a foreign country. You will be going from Chennai port to Andaman Nicobar Islands. Both are in India, na? Andaman outside India. Na? India only, right? Both are in India. Chennai to Vizag, India. Okay. Then Mumbai to somewhere like Cochin. So Cochin has, okay, somewhere like in Kerala, someplace. Okay. So that voyage within India comes under what? Cruise ships. If it is going to some other country, like let's say from Mumbai to Dubai you are going as a voyage, then that doesn't cover under this particular cruise ship, sir. So cruise means here what? The voyage touches at least 2 seaports in India. Okay. And the ship capacity should be greater than or equal to 200 passengers, and it should be more than or equal to 75 meters in length. Okay. This was defined recently. Voyage means what? It should touch minimum 2 seaports in India. The ship capacity should be more than or equal to 200 passengers. Length should be more than or equal to 75 meters. So then it comes under a cruise ship. So from that cruise ship, sir, here you need not to check where they were boarded and all. They will be boarded from where? India only. So whatever is the freight they received, on that multiply it with 20%. On that multiply it with what? 20%. Sir, why 20? Here only 7.5. Sir, cruise ships charge more. Normal ship for voyage, normal ship for transportation of goods. So they'll charge less only. Normally only they'll charge. But these cruise ships are meant for entertainment and recreational activities, no? So they'll be charging more. So since they'll charge more, their margin also will be high. That's why they are taking deemed profit as how much? 20%. Understand, sir? Now again, aircrafts. 44 BBA is about what? Business of operating aircrafts. BBA is about what? Business of operating aircrafts. So here the deemed profit is 5%. The deemed profit is how much? 5%. So what we need to check? Amount received in India or outside India? Same thing, sir. Again, if they are shipped from port in India, wherever they are received, you should multiply it with 5%. If they are shipped from port outside India, then only when they are received in India take. So aircraft and ship which are meant for normal transportation, what we'll check? From where they have been shipped. If they shipped from India, wherever the freight is received, take. If they are shipped from outside India, take that freight only when it is received in India. For aircraft, what is the deemed profit percentage? 5. For ships, 7.5. For cruise ships, the total receipts into 20% is the deemed profit. So here, sir, under presumptive scheme, sir, if you remember 44 AD, 44 ADA, 44 AE, they'll say, tell the deemed profit or minimum profits to be declared. 44 AD, 8% of the turnover, if it is other than through specified mode. Through specified modes, 6% of the turnover. 44 ADA, 50% of their gross receipts. And 44 AE, depending on the truck, normal vehicle, 7,500 per month. Heavy goods vehicle. What is called heavy goods vehicle? When its gross unladen weight is more than or equal to 12 tons, then that is called heavy good vehicle. For heavy good vehicle, you need to take per ton 1,000 rupees per month. Okay. But can a SSE show less than 6%? His turnover is like 1.5 crores only, sir. He's like eligible for presumptive scheme. But he is declaring profit of like 4% only, not even 6%. Can he show? Yes, he can show. But in that case, for him audit applicable, books of accounts has to be maintained. If he cannot show the minimum profits to be declared under presumptive scheme, then audit applicable. But for these 3 sections, even though you wanted to get your books audited, audit is fine for you, but you wanted to declare lesser profits, that option is not available. You should minimum show how much? 7.5, 5 or this 20%. There is no option to declare lower profits. And then you have other business also. In other business, you have losses. Whether such other business related loss can be set off with this business? Yes. With this income, set off and brought forward of losses or unabsorbed depreciation is allowed. Now, next one, sir. Next two sections we are going into 44BB, BBB. What is 44BB? SSE non-resident providing services or supplying plant and machinery for hire. What is doing? He is providing services or supplying plant and machinery on hire. For what? For exploration of minerals, oils, gas, etc. Then the deemed profit is how much? 10% of the amount received in India or outside India, where the extraction is in India. Where the extraction is outside India. Sir, their shipment we checked. Here, extraction. Whether the oil and gas or minerals extraction is in India or outside India. In India, what we have to take? Whether the amount received in India or outside India, we should take. If the extraction is outside India, you should take only the amounts received in India. On that, you have to apply how much? 10%. What is the business, sir? SSC should have been doing what? He is providing services or providing plant and machinery on hire or rent to a person who is engaged into extraction of minerals, oils, etc. Then this non-resident deemed income is how much, sir? 10%. Then 44BBB, 44BBB is what? SSC engaged into the business of construction or erection of a plant and machinery with respect to turnkey projects. Turnkey projects, now these are certain prestigious projects, first thing. Second one, the contract is given to SSC like he only has to do end to end. Okay, you should make sure it ready. Turnkey means you just go with the key and you just turn on, everything is ready. Okay, so it should be in that ready to use mode. Till that place or till that point, it's the responsibility of the contractor only. Those are called as turnkey contracts. So construction, erection of a plant and machinery with respect to turnkey projects approved by central government. So this SC non-resident is engaged in what? Construction, erection of plant and machinery with respect to turnkey projects. So let's say, sir, if you see in Amravati, in like AP capital. So CBN will say like many times like Singapore people will come, they'll construct these towers and all. Let's say if they have been allocated something, then they'll come under here. So okay, that non-resident company coming here, they are constructing or erecting and they are turnkey projects only, they'll like they only have to take care of everything until it gets ready. So then for those non-residents, what is the deemed profit, sir? 10%. Either the amount paid in India or outside India. Why? Because ultimately the execution of project is in India, na? That's why wherever the amount received, you will take 10%. But here in previous case, mining can be done even outside India or in India also. If mining is done in India, wherever it is received into 10%. Mining done outside India, only when it is received in India, on that multiply with 10%. Understand, sir? Okay. Then option to declare lower profits than mentioned in 44BB, 44BBB. Here available. They are not available. Sir, there means which three sections, sir? 44B, BBA, BBC. Under this, okay, BBA, BBC only, right? 44B, BBA, BBC. For those three sections, declaring lower profits is not available. You should minimum declare those amounts as profit. But here in these two businesses, under 44BB and BBB, SSC can show lesser profit than 10% also. It is allowed only. But since he is showing lesser profit than 10%, he has to get his books of accounts audited and obviously books has to be maintained. Okay. If here one more, sir, one more point which is opposite to that of B, BBC, BBA. There, set off of losses with this presumptive incomes is also possible. But here, if SSC opts for 44BB, BBB for that previous year, set off of brought forward losses or unabsorbed depreciation is not available. If SSC opts for 44BB, BBB for the previous year, set off of brought forward loss or unabsorbed depreciation is not available. Whereas here, allowed. That means available. Understood, sir? So now tell me section wise, 44B is for what? Ships, including cruiser, other than cruiser. What is the deemed profit? 7.5%. On what we have to take? Freight only. Can we take the total freights given in the question? We need to check where the goods are shipped, goods, passengers, livestock has been shipped. In India. Then where are the freight received? Take it. From outside India. Only when it is received in India, take. Okay, then for cruise ships, 44BBC. Wherever it is received, you will take 20%. Simple only, sir. But they defined what is called cruise ship. Cruise ship minimum capacity should be what? 200 passengers. Minimum length 75 meters. And then it should touch minimum 2 ports in India. It is meant for like amusement, entertainment, recreational activities for that. Operating ships. What is the deemed profit? 44 BBA. 5%. Okay, 5%. Again on the freight only. But what freight we need to take? Shipped from India, outside India. Shipped from India. Wherever received, take that freight. Shipped from outside India. Only received in India, take that into 5%. Done. Here, is there an option to declare lower profits? No. There is no option to declare lower profits. Second thing, losses can be set off with even this presumptive income also. Now we came to 44BB, 44BBB. 44BB is like what? Non-resident is providing services or hiring a plant and machinery with respect to extraction of minerals and oils. Now, what amount? What is the deemed profit? 10% of what? Of the receipts. What receipts we have to take? Extraction in India, outside India. Extraction in India. Where are the amount is received, that into 10%. Extraction outside India, only when the amount is received in India into 10%. Clear? Then 44B. So what is that one, sir? Construction, erection of a plant and machineries with respect to turnkey projects approved by central government. Deemed profit is how much? 10%. Amount paid or payable, India or outside India. Here, is there an option to declare lesser profits than this minimum? Yes. But if you do that, books has to be maintained, audit also mandatory. And here, losses set off is not possible. So this income straight away taxable like that only. The last ones are here, which is introduced recently, 44BBD, added by Finance Act 2025. Assessee non-resident, engaged in the business of providing services or technology. So SSC business is what? He provides technology or services for setting up an electronic manufacturing facility. I mean, a mobile manufacturing unit has to be started. For that required technology or services is going to provided by non-resident or any other electronic manufacturing company. Or else, in connection with, already there might be a company, but to that, in connection with producing the mobiles there, manufacturing electronic goods, articles, things in India. For a new facility or for an existing facility also, in connection with producing, manufacturing electronic goods, articles, things in India. To whom these are providing? To a resident company, which is into manufacturing of electronic goods, articles, things in India, or to a resident company, any other which satisfies prescribed conditions. So what is the service, sir, here? Service and technology has to be provided. For what? To a person who is engaged in manufacturing, setting up a new electronic manufacturing facility, or in connection with producing, manufacturing of electronic goods, articles, things in India. Recipient should be, sir, recipient business is this. He's starting a manufacturing facility electronic, or he's already into that, he is producing or manufacturing electronic goods, articles, things in India. He should be a resident manufacturing company of electronic goods, articles, things in India, or to any other resident company also if satisfies prescribed conditions. What is the deemed profit, sir? 25% of amount paid or payable for such services or technology. Amount paid or payable for such services or technology. So this is the 25, sir. BBB 10%, here 25%, aircrafts 5%, cruise ships 20%, then normal ships 7.5%. Okay. Here option to declare lower profits not available. Set off of brought forward losses also not available. Both the two are not available. Brought forward losses also can't be set off with this presumptive incomes, and then you cannot even declare lower profits. Minimum you should show how much? That non-resident 25% of amount paid or payable for such services or technology. Sir, this is not tax rate. 7.5%. These are not tax rates. We are deemed profit. We are calculating, not deemed tax. Understand? So see, these are the presumptive sections. Go through this chart quickly, sir. Lower profits declaring option is available only for oil exploration related and that construction projects which are like turnkey related. Okay. Set off is possible for ships, cruise ships, aircrafts. So 115A, 115A, BAC, AD, BBA, all these also done. So this one small section, sir. This also will complete and go to questions. Section 44C. Deduction of head office expenditure in case of non-resident. So non-resident having a PE in India, now his income is taxable in India. So now they might be claiming what head office expenditure also as an expense, because head office will incur expenditure which is related to all the branches. Now they also will be getting a share of head office expenditure. Now can it be claimed as deduction or not? Head office expenditure in case of non-resident is allowed only to an extent of 5% of adjusted total income or actual head office expenditure attributable to Indian business, whichever is lower. 5% of adjusted total income or actual head office expenditure attributable to this Indian business, whichever is lower. So what is adjusted total income? First, head office expenses means the head office might have paid rent, rates, taxes outside India, salaries, wages for the employees working in head office, traveling expenses of employees managing the office. The key people has to come to this office and has to go. So these are the typical head office expenses. What? Rent, rates, taxes, salaries and wages of the employees who are working in head office, traveling expenses of those employees who are managing for the office. So these are head office expenses. But we want what? Adjusted total income, because we want to apply 5% on adjusted total income. Means total income before giving effect to head office expenditure. So you want total income before charging head office expenditure, unabsorbed depreciation, unabsorbed family planning expenditure, brought forward losses, chapter 60 deduction. So nothing but calculate current year profit. Current year profit, you can charge current year depreciation. Calculate current year profit after charging current year depreciation, but before charging, sir, unabsorbed depreciation, family planning, brought forward loss, chapter 60 will do like afterwards only, right? So we want current year profit without giving effect to head office expenditure. Okay, remember even this way. We want total income before giving effect to head office expenditure, unabsorbed depreciation, unabsorbed family planning, brought forward losses, and even chapter 6A deductions. So that is called as what? Adjusted total income. On that we'll apply 5%. Then we'll be getting what? The deduction available with respect to head office expenditure. If they are claiming more than that, disallowed. More than this amount, it is what? Disallowed. Sir, 44C, it is also related to what? PGBP only. So this is also like a disallowance only. What they are saying, like head office expenditure, they will not allow how much ever is incurred. They will allow only to an extent of how much? 5% of adjusted total income or actual share related to Indian business, whichever is lower. Okay, question number 7 only. Come to problems or no. The net results of the business carried on by the branch of a foreign company in India for the year ended 31st March 2026 was a loss of 30 lakhs after debiting the head office expense of 60 lakhs. Sir, after charging 60 lakhs, it is 30 lakhs loss. So what do you do for 30 lakhs loss? Add back 60 lakhs. Then what is the profit? 30 lakhs. This is only adjusted total income. So into 5% you do how much? 1.5 lakhs. So that 1.5 lakhs is what? Allowed. Okay, now what you have to do from the adjusted total income 30, subtract the allowable head office expenditure. Now the new total income is how much? 28 lakh 50,000. It's okay. Look at question number 18, sir. Question number 18. Question number 18. Allowed or not allowed expenses? You also have the same doubt, huh? If presumptive scheme, then why we are doing? We are taking only 5%. Why the rest 95% we are leaving? Assuming the rest all is what? Expenditure only. That's the basic point of presumptive scheme, right? You are directly calculating deemed profit. No other expense is allowed. The only where if any expense is allowed is under 44 AE. That also partners related interest remuneration paid is allowed. That is the only expense allowed under the whole presumptive schemes, either resident related or non-resident related. Nowhere else under presumptive scheme we can claim expense as deduction. Z, a non-resident, operates an aircraft between Dubai and Delhi. He received the following amounts during the previous year in the course of Delhi. Passengers from Delhi, so consider. Goods from Delhi, consider. Passengers from Dubai, but received in India, consider. Yes or no, sir? Then 0.5 crores in Dubai for carriage of goods from Delhi. So that means all the 4 has to be considered. What is the total of 4? 4.5. 5 total is how much? 7.5 crores into 5%. How much is the deemed profit? 37 lakh 50,000. Question number 19. So it's an exam question, sir. See, Paul Limited is a foreign company engaged in India in the activity of what? Civil construction at various locations in West Bengal in connection with turnkey power projects approved by central government. So okay, so turnkey projects. Which section, sir? 44 B, B, B. Okay. Also, it is engaged in provision of consultancy also. So it is not only into one, it has a second thing also called what? Consultancy. So how many businesses are there? It has 2 businesses are there. One is like this turnkey power project approved by central government. The second one is like providing. It also engaged in providing consultancy service. Okay. Sir, for this consultancy service, is there any presumptive scheme? 44 BB is for what? Construction, erection of plant and machineries with respect to a turnkey power projects or turnkey contracts notified by central government. For that only 44 BB. For this consultancy service, 44 BB is not there. So through a branch office located at Chennai, there is no administrative nexus between branch office Chennai and civil construction. Okay. Now, it furnishes the following information. What is the gross amount received in India from civil construction projects in India? 60. What is the gross amount received outside India from civil construction projects in India? Sir, the project is in India only. So whether it is received in India or outside India, we should take. So total how much? 90 lakhs. Sir, here there are expenses given. Can we subtract expenses? No expense is subtracted. So 90 lakhs into 10%. What is the deemed profit? 9 lakhs. Now, they are talking about something else. Amount received in India for their consultancy service. So this is a separate business. For this separate business, there is no presumptive scheme. Since there is no presumptive scheme, we'll calculate normally. How much is the income? 2 lakhs. What is the relevant expense? 70. So 2 lakhs minus 70. What is this income? 1 lakh 30,000 is from consultancy. From that construction of that turnkey power project is like 9 lakhs. The total is how much? 10 lakh 30,000. 10 lakh 30,000. Understood, sir? Then question number 20. Question number 20. Sorry, calculated. How much? Sir, these are like what flights? Which section? 44 B, 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 A. What is the 5%? Okay, he has what? 150 lakhs total for carriage of passengers and cargo. Out of this 150, 90 was received in dollars for the passenger fare booked from New York to Mumbai. That means if this 90 lakhs are okay received in dollars, but they didn't clearly said like whether it is received in India or outside India. So we'll take 2 assumptions. 60 lakhs for sure received where? India. So 60 lakhs into 5%. How much? 3 lakhs. The balance 90 lakhs, if it is received in India only now, we'll take how much? Sir, why we are taking only India? Because the fare booked from where? New York to Mumbai. So they are shipping from where? New York, outside India. So only when it is received, we have to consider. So 90 lakhs into 5%. 4.5 lakhs. So this 4.5 lakhs will take only when they are received in India. 3 lakhs. If paid in India, 4 lakh 50. If paid outside India, will not consider anything. ఎందుకు తీసుకుంటాం? అవును 150 తీసుకుంటాం, బట్ దే ఆర్ క్యాలిక్యులేటింగ్ 60 lakhs separately, 90 lakhs separately. There are no two separate fares given, right? The only thing is like given like New York to Mumbai. Collects charges of 150 for carriage of passengers and cargo, out of which 90 was from New York to Mumbai. Total 150 only, right? So out of that 90 is from New York to Mumbai. The balance 60 is from where? Mumbai to New York. Understand? Okay. So 150 is the total. From there 90 they are saying like what? New York to Mumbai. But they didn't say like where this 90 is received. But the other 60 is then from what? Mumbai to New York. That's why here 60 Mumbai to New York. The other 90 is for what? New York to Mumbai. But this 90 will not taxable always. Only if it is received in India, taxable. Otherwise not taxable. Question number 21. Question number 21, sir. What? Non-resident having a branch office in India submits the following information. What is his total income? 30 lakhs. This is after deductions or net total income. So what we should do? Add back deductions because we want adjusted total income. Why? Head office related this one. Brought forward loss adjusted. Add back what? 1 lakh. Sir, house property loss we need to add back. Because there what has been mentioned? Unabsorbed depreciation, unabsorbed family planning expenditure, brought forward loss, chapter 6A deductions, head office expenditure. Only those 5 we need to add back. There house properties loss is not there, so ignore. Unabsorbed depreciation, add back 1,50,000. And head office expenditure reimbursed how much? 3 lakhs. If you add back all this, what is the adjusted total income? 33, 34.5, 37 lakh, 50,000 into 5%. 1,87,500 is what the head office expenditure allowed. So now we need to calculate the revised net total income. Okay, so again what? From net total income 30 lakhs, simply you just add back this 3 lakhs minus 1,87,500, you will get the revised net total income. 31,12,500. 31,12,500. Sir, why this one alone? Sir, they already calculated net total income, sir. We don't have problem with giving deductions. Normally, only for the purpose of head office expenditure only we have did that. Normally, how much is the calculation of net total income will allow deductions, will allow business loss, will allow house property loss, unabsorbed depreciation. But this head office expenditure 3 lakhs is not allowed. So what you are doing? 3 lakhs add back and subtract the allowable 1,87,500. Then your revised net total income is how much? 31,12,500. Got it? Any doubt? Sir, question number 22. Again, you can solve quickly. So all these, sir, there is nothing right. Just if you know the provision, you can calculate them quickly. Question number 22. Which section will applicable? 115 BBA. Okay. Ian Morgan, a foreign national and cricketer, came to India as a member of England cricket team on 31st March 2026. He received 6 lakhs for participation of matches in India. 6 lakhs for participation of games. Taxable or not? Yes. What is the tax rate? 20% plus surcharge plus cess extra. Okay. He also received 2 lakhs for advertisement. That also taxable. Then he contributed articles in a journal for which he received 50,000. That also taxable. When he stayed in India, he also won a prize of 10,000 from lottery. Sir, that is taxable separately. Under 115 BBA, which incomes are covered? Participation in a game, advertisement, or contribution to magazine. So this 8,15,000 is taxable at what rate? 20%. He also won a lottery. Sir, lottery is what? Separate income. So lottery is taxable at what rate? 30%. That is separate 3,000. Okay, 8,15,000 into 20% is the tax rate. Here, 10 lakhs in 10,000 into 30%. He has no other income and he has opted out from 115 BAC also. Okay, sir, he can't even claim on this lottery income basic exemption limit because that is also a special income only. These are also special incomes only. Compute tax liability. What is the tax liability, sir? 8,15,000 into 20%. 8,15,000 into 20%. How much? 3 lakh. 1,00,000 plus this 30,000. Total how much? 1,93,000. No surcharge will come, sir. Why? Because the total income is within 50 lakhs only, even though he is an individual. Okay, sorry, this is 3,000. 1,66,000. So on 1,60,000, 6,000 surcharge not there. So we'll apply what? Cess. Cess at a rate of how much? 4%. How much? Total after cess 1,72,000. Are these incomes liable to deduction of TDS? Okay, correct only. 1,72,640. Correct only. The next question is what? Are these incomes subjected to TDS? Yes, sir. This 6 lakhs, 2 lakhs, 15,000. These are subject to TDS under what? 194E. Okay, so they are subject to TDS under 194E at a rate of 20%. Ian Morgan is a non-resident. The amount of TDS to be deducted is like 20% and with a cess of 4%. Then, is he liable to file return of his income? Sir, yes, sir. Actually, no. But he has only these incomes. But he has having extra what? Lottery income also. That's why. So see, provides that if the total income of non-resident only referred income in that section and TDS has been deducted, it shall not be necessary for him to file return. However, in this case, Morgan has lottery as well. Therefore, he cannot avail the benefit of exemption of filing the return. So he has to file the return. Then last one. What would have been his tax liability? He had been a match referee instead of a cricketer. For match referee, it is not there. Player or entertainer, or for a sports association. Those three only covered under 115 BBA. So this, if he's a match referee, all these are not available. Okay, then what is the tax liability, sir? Normally only we need to calculate tax. What are these total income, sir? Then normal na 6 lakhs, 2 lakhs, 15,000, 8 lakh 15,000. If he's a match referee, we need to give slab rates. Slab rates. He is under 115 BAC now, opted out of 115 BAC now, opted out of 115 BAC. So we need to provide what? Slab rates. First 2 lakh 50,000, nil. 2 lakh 50 to 5 lakhs, 12,500. On the balance 3 lakh 15,000 into 20%. Lottery income 10,000 into 30% only 3,000. So if you do such a way, 3,000 is special income, 12,500 and 63. Total it is like 78,500 plus 3140 and tax liability is 81,640. Clear, sir? Question number 27. Okay, so now come to question number 1. We already calculated, sir. 1 is done. Now we are going on to question number 2. So let me read. Smart, a non-resident, has computed his tax liability as under. Income from business A, he is having how much, sir? 2,80,000. He is having long-term capital gain how much? 10,000. He set off brought forward business loss with a long-term capital gain. Is this step correct? Why? Reason. Anybody in the class, sir? This step, he has a long-term capital gain. With that, he has adjusted a brought forward business loss. Is this step correct? Students in live also, tell this. You don't remember any set of carry forward. Normal, not related to business or something. Whatever you remember from set of carry forward, you tell. Carry forward leave. Set off related. Sir, first we have to do intra-head set off, intra-head set off. Intra. Okay, see these are some basic points we discussed in first chapters only, but we are coming to the end now, so we'll forget the basic points and all. First we do intra-head set off. Okay, and here it is a brought forward loss. Brought forward losses are not eligible for inter-head set offs. They are eligible only for intra. Okay, where we said for house property loss, we have discussed it so many times in DTAA and even in DTA chapter also. We have discussed that so many times. Brought forward house property loss is eligible for set off with only house property income, not with other heads. Same way business loss also, once it is brought forwarded, it is eligible for set off only within the business side. You cannot set off. So then why this fellow setting off with long-term capital gain? What is his motto? He can set off with business now. Why is setting off with long-term capital gain here? Find out that at least. Okay, he is wrong, but at least why he is doing that wrong? Business income has slab rates. Yes or no, sir? If he has opted for 115 BSE, default regime, total business income can be availed as what? 2,80,000. But long-term capital gain, you cannot adjust there. And he is a non-resident, so unexhausted basic exemption limit concept is also not applicable. So long-term capital gain has to be taxed at flat. So that's why what he is doing, he is adjusting the brought forward business loss with long-term capital gain so that his tax liability will become 0. But is he correct? He cannot do that, sir. Okay. So total income tax liability, what you have to do? Profit from business 2,80,000, adjust 10,000. So total how much? 2,70,000. Okay. Then long term capital gain 10. Income from other sources 30. Gross total income is how much, sir? 3,10,000. Sir, here they didn't mention. Okay. Computation in old regime. So old regime now what we have to do, sir? Total income is how much? 3,10,000. Out of this long term capital gain separately taxable. Leave that. So balance how much is there, sir? 3 lakhs. On 3 lakhs, 2,50,000 basic exemption limit. 50,000 into 5%. It is how much? 2,500. Then on long term capital gain 10,000. What is the tax rate? 12.5. 1,250. Okay, so plus cess if you add 150, total 3,900. Now you may come and say like, sir, total income within 5 lakhs only now, why can't we claim rebate? So on this 2,500 we can claim rebate, na? Because he is a non-resident. Rebate is available only to resident individual. Question number 3. Do it quickly. 3. It's also an exam question. Sir, he is what? Non-resident. Individual being an Indian citizen. So what applicable? Chapter 12A. So what he has? 10,000 equity shares of PQR Limited, a listed Indian company. He sold all the shares for how much? 770. Out of sale process, Dravid bought 11,000 equity shares of another listed Indian company for 500 per share. So first we need to calculate what? Capital gains. First calculate capital gains. Sir, how many shares? What is his sale consideration, sir? He sold the 10,000 share each for how much? 770. So 10,000 into 770, we need to convert it into what? Foreign currency. So okay, as on the date of transfer. Okay, sir, these dates has to be changed, sir. 2025. Here 13th July 2025. 12th June 2025. This is also make it as like 13th June 2025. Sir, on 12th June 2025, what is the average of TDBR and TDSR? 77. So 10,000 into 770 divided by 77. How much is the sale consideration? 1 From there, we need to subtract what? Transfer related expenses not given. So straight away, we'll be subtracting what? Cost of acquisition. Cost of acquisition straight away they given like $5 per share. So how much? 10,000 into 5. How much, sir? 50,000. So what is their long-term capital gain? 50,000. Okay, keep it. So now long-term capital gain 50,000 is there. Now we need to reconvert into Indian rupees. No, okay, we'll do that. But before that, sir, he already made an investment during Dravid sold all the shares 750. Out of the sale proceeds, Dravid bought 11,550 for 500 per share. Sir, what is the sale proceeds actually? 10,000 into 770 means how much? 77 lakhs. So did he invest a total 77 lakhs or not? We have to check. How much he invested? 11,550 into 500. How much? 57.75. 57.75 lakhs is what he has invested. Okay, so is it clear? Now we'll convert this long-term capital gain again into Indian currency. What rate we have to take, sir? TTBR rate as on the date of transfer. What is the date of transfer? 12th June. On that BR rate is how much? 76. So 50,000 into 76, how much? 38 lakhs is long-term capital gain. Now he is eligible for an exemption also. What is the exemption under Chapter 12, sir? If he invest, transferred foreign exchange asset and should acquire another foreign exchange, another asset. Sir, see, he purchased another listed equity share, so it is eligible for what? Exemption only. How much he has invested? 57.75 lakhs he invested. Out of how much money, sir? Out of 77 lakhs into capital gain 38 lakhs, you will get the exemption amount. Proportionate to that of investment made is only exempted. So how much is the exemption? 57.75 divided by 77 into 38 lakhs. 28 lakh 50. Okay, is what? Exemption under 115F. Okay, now there is another point also given. He has subscribed to REC bonds. Sir, when he has invested here, date I didn't check. 12th June 2025 sold. When invested? 13th July. So within 6 months only. So eligible for exemption. Whereas he subscribed for REC bonds 10 lakhs 15th September. Sir, REC bonds now this is related to 54 EC section. Capital gains 54 EC. But capital gains 54 EC exemption will come only when the asset transferred is immovable property. Here the capital asset transferred is what? Here, what is the capital asset transferred, sir? SSC sold what? Shares. He sold shares. He didn't transfer immovable property. So he is not eligible for this 54 EC exemption. So no 54 EC exemption available. So what is how much is the exemption, sir? 38 lakh minus 21 lakh. 50,000 if you subtract, how much? 9 lakh 50,000 is his taxable capital gain. Okay, this is like what? Which exam questions are June 2024? Okay, June 2025 exam question also will do and take break, sir. Jahir, an Indian citizen, resident of Germany. Sir, again, which chapter? Which provisions? Jahir, Indian citizen, resident of Germany. So chapter 12 will comes into picture or not? Yes, because non-resident, but again, Indian citizen. Has following information to you relating this. He has a long-term capital gain 5,67,000 on transfer of foreign exchange asset. So what is the tax rate on this 5,67,000, sir? 12.5%. Okay. Then interest from notified government bonds. Sir, notified government bonds, na, it's like any other interest. 115A, that other interest is there, like interest paid on foreign exchange loans paid by government or any other Indian concern. That we can take, sir, here 46,000, this one, 115A. How much is the interest rate? Tax rate. Sorry, not 5% is there. Notified, so go to 115A. Infrastructure debt fund 5%. If it is from business trust, 5%. Oh, here it is what? Go back and check and tell. You need not to be sure. 115A, it comes under the fourth point. How much? 20%. No expense. Allowed or not allowed? Expense not allowed. Dividend from shares in Indian company. Dividend from shares in Indian companies, na, like again, it comes under investment income, sir, under what? This 115, chapter 12A only. So chapter 12A, how much is this one, sir? Sir, okay, sorry, you need not to go to 115A also. This interest from notified government bonds also will come under what? Foreign exchange assets. Okay, there if you take under 115E, also it is what rate? 20%. Expense is not allowed. Then dividend from shares in Indian companies. Foreign exchange asset only again. What is the dividend tax rate, sir? 115E, 20%. No expense allowed. Long-term capital gain 12.5%. Then tax deducted at source. How much, sir? Long-term capital gain, interest and dividend. What is the total TDS deducted? 1,20,000. Investment in shares of Indian companies. Sir, he made a long-term capital gain. He has long-term capital gain. And again, he has invested in what? Indian shares. Sir, this is purely related to chapter 12A only. No other section also got involved. Again, once again, see, he has a long-term capital gain. How much is the long-term capital gain? 5,67,000. But on long-term capital gain, there is an exemption available. What is the exemption? He has to invest in another foreign exchange asset. He's saying like what? Investment in shares of Indian companies and investment made on what? 31st March. Sir, these Indian company shares are eligible for being called as foreign exchange asset. So 31st March. When the transfer happened? 12th August. So 12th August to 31st March. Is it within 6 months? September, October, November, December, Jan, Feb, March. So it's not within 6 months. So this exemption is not available. So what is we having? 5,67,000 into 12.5 percentage. This 46,000 into 20 percentage, and this dividend 80,000 into 20 percentage. See, 5,67,000, 46,000, 80. So total is how much? 6,93,000. Okay. Now on 5,67,000, if you apply 12.5, 70,875. Interest and dividend 20 percentage, 25,200. Total tax is how much? 96,075. Plus add cess of 4%. Total tax payable is 99,920. But TDS deducted how much? 1,20,000. So excess TDS got deducted. So how much he'll get as refund? 20,080. He'll get it as refund. So okay, this is pure which section? Chapter 12A related question only. He is having investment income like interest and dividend. He is having long-term capital gain. Only 3 incomes. So June 2025 paper, sir. Again, you could see it's a easy question. So okay, before so I have added here December 25 question or not. Okay, sir. Quickly, this also we'll see. I mean, just to make sure the questions are being easy only. Aditya, a non-resident Indian. Again, what, sir? Chapter 12A only. Chapter 12A. So this is what December 2025 attempt question. He is an employee of Global Limited UK and settled in UK. He received salary. How much, sir? 12,000 pounds, which was credited in his bank account in UK. Sir, where he is there? UK, right? Where he received salary? Where he is working? So income accrued outside India, received outside India. So is it taxable in India? No, it's a foreign income, not taxable in India. So this one 12,000 pounds nowhere connected to us. Then he had acquired certain shares and debentures in Indian company by remitting foreign currency. So these are what? Foreign exchange assets only in the year 24-25. He is earning a dividend income of 1,50,000, interest income 4 lakhs. Sir, this 1.5 and 4 lakhs are taxable at what rate? Sir, under chapter 12A, go back and see again. What is like? Irrespective of it is interest or dividend, it is taxable at what rate? 20% only. Investment income is taxable at what rate? 20%. Then, apart from the above, he purchased shares 4 lakhs of X Limited, Pune by remitting foreign currency on 10th June and sold them on 30th June for how much? 5,25,000. Sir, when he purchased for 4 lakhs and sold for how much? 5,25,000. So how much is the capital gain he is having? 1,25,000. And then he invested the entire sale consideration in another Indian company by when? 15th February. Sir, did he invested within 6 months? July, August, September, October, November, December. 6 months done. But he invested in when? February. So the exemption is not available. So what is the long-term capital gain? 1,25,000. Taxable at what rate? 12.5%. Okay, you may ask like first 1,25,000 I'll claim exemption, but they didn't mention anywhere that they are listed equity shares. You cannot assume them as listed equity shares unless they clearly specify. So what is the tax, sir? 5.5 lakhs. 1,25,000 capital gain. House property is also there, sir, for him. From where he is having house property income? He has a let out property in Mumbai. Sir, property in Mumbai. So where it is taxable? India. So fetching a monthly rent of 20,000. Sir, this is not special income. Investment income, long-term capital gain only special rate. So this is what normal monthly rent. How much he is getting? 20,000 into 12. How much? 2,40,000. But we need to provide what? Standard deduction 30%. How much? 72,000. Then if you subtract how much? 1 lakh. 1,68,000. So long-term capital gain 1,25,000. House property 1,68,000. Now he is having investment income 5,50,000. House property 1,68,000. Long-term capital gain 1,28,000. So gross total income is how much? 8,43,000. But this 5,50,000 is taxable at what rate, sir? 20%, which equals to how much? How much, sir? 1,10,000. Then long-term capital gain how much? 12.5% on 1,25,000. How much? 15,625. So total tax is how much, sir? House property included or not included? 5,50,000. Okay. House property is not taxable at special rates, sir. House property income is taxable at what? Normal rates. Normal rates now, what is the slab benefit? Up to, sir, did they mention anywhere like old regime? Okay, yes, ignore the provisions of 115 BAC. So we'll take what? Up to 2.5 lakhs is the slab rate benefit. So up to 1,68,000 if you claim. Okay, slab rate benefit. Then the tax on other income is what? Nil. So total income is how much? 1,25,625 plus cess 5,225. Total liability is how much? 1,30,650. But chapter 12 mandatory or optional? Optional. So you compute without taking special rates, taking slab rates even on interest and dividend also. Actually here they given only chapter 12 answer. But if you remember, sir, exact answer to be done, chapter 12 is not mandatory, it is optional. So if it is optional, you can compute the tax normally also. Normally means what? Total income remains common, 8,50,000. Out of this 8,50,000, long-term capital gain, if ignore chapter 12 also, it is what? Special rate only. How much is long-term capital gain, sir? 1,25,000 into 12.5%. How much? 15,625. Then other incomes. Other now it could be dividend, all are like slab rates eligible only, right? So what is the other income totally? 1.5 lakhs plus 4 lakhs plus 1,68,000, 1.68 lakhs. So what is the total, sir, here? 7,25,000, right? No. Sorry, here it is 8,43. So total income is 8,43. From there, if you subtract 1,25,000, how much? 6 lakh? 7 lakh? How much? 18,000. Sir, on 7,18,000, give slab rates. Up to 2.5, nil. 2.5 to 5 lakhs, 5%. Above 5 lakhs to 10 lakhs, 20%. How much? 58,000. 3, 4. What is the total tax? This 15,000 also add. How much? 70? 70? 960? Okay, 970 I'll take. Okay, sorry, 969 only I'll take, no issues. Then plus cessation rate of 4%. How much? Where? We need to calculate together, right, cess? So on 7,18,000, separately calculate and tell the tax without cess. 50? 100. So now add total and tell. 71,725 plus cessation rate of 4%. 2869. So what is the total liability? 74,594. Okay, rounded off to 590. Sir, which option is better, sir? Normal regime is better. So you can ignore chapter 12A and can follow the normal option also. So you need not to stick under the normal only. Okay, I didn't check the suggested answer, sir, actually, because by the time I prepare this, suggested answer not there. But actually it has to be done in like both. Chapter 12A also you have to do, because chapter 12A is optional. So you can do as per chapter 12A, you are getting how much as tax liability? 1,30,650. If you avoid chapter 12A, you are getting 74,590. Which is better? Skipping chapter 12A is only better. Okay, so we'll check the suggested answers also, sir. So, okay, so as per suggested answer, also same answer, but they didn't did as per the normal thing. Okay, sir, you could see. So NR taxation, the questions like December 25 question we have seen, June 25 question we have seen, and before that we have seen even June 24 question, and the December 24 question is related to a presumptive scheme related question. So last 4 attempts questions already we have solved. So all those are like no complexities involved, sir, just basic NR tax provisions. Okay, so it is like, just because you didn't learn previously NR taxation, you might have felt tough, but understand, questions are very easy if you could recall the provisions. Okay, and see, question number 3, chapter 12A. I mean, June 24 they asked from chapter 12A. June 2025 they asked from chapter 12A. December 25 also they asked from chapter 12A. So high focus is on chapter 12A. So, okay, look at question number 5, sir, quickly. Question number 5. They didn't even ask us to calculate tax. They asked us to only compute total income. If at all they are taxable, sir, here the point missing is like interest from government securities, but this is in foreign exchange asset, we don't know. And interest from deposits in Indian companies, but we don't know like it is in foreign exchange or not. And then Crone, they just simply said like non-resident. They didn't mention it as like non-resident, individual or anything. So actually to decide tax rates, the question is not clear. The question should have much more information to go and decide the tax rates. So it's a vaguely framed question, sir, where they didn't give in proper details and all. But if you have seen the exam questions are like more specific, we can able to identify. So don't worry about if any question you can find also. So in exam questions, mostly they're taking care and providing all the required details which were useful for us to find out the tax rates and all. Okay, so here, sir, interest on government securities. First, it is an Indian income only, taxable in India. Okay, then dividend on shares from foreign company received abroad. Sir, it is Indian income. Huh? Dividend on shares where they are located, foreign country, received where? Outside India. He is a non-resident. So non-resident income accrued outside India, received outside India. Taxable or not taxable? Not taxable. Interest from deposits in India. Since deposits are in India, it is accrued in India, taxable in India. Horse race in India, taxable. He has donated a sum of 10,000 to Municipal Corporation of Delhi for promotion of family planning. Sir, promotion of family planning is eligible for deduction under 80G. Under 80G, we have 4 categories, category 1, category 2, category 3, category 4. So promotion of family planning will come under category 3. 100% of adjusted gross total income is eligible for a deduction. Sir, here we have incomes like what? 3 incomes are there. What? Okay. Then he has paid 2,000 by check to New India for mediclaim for himself, and he also spent 16,000 on medical treatment for his minor son, which is physically handicapped. Sir, it comes under 80DD, but 80DD is available only for resident individuals. Here he is a non-resident, so this point is not applicable. But for medical insurance premium, 2,000 can be claimed as a deduction. Okay. So now, what is the adjusted gross total income, sir? First gross total income, 21, 30 plus 20. So total how much? 71,000 is the total income. And then he is eligible for what? 2,000 80D medical insurance. Now we want what, sir? Adjusted gross total income equals to 71,000 minus 2,000. All the other deductions except 80G. So how much it came? 69,000. So multiply with this 69,000 into 100%. How much is the, gross total income into 10% is the qualifying limit. How much, sir, that is? 6,900. Okay. But the contribution made to municipal corporation is how much? 10,000. But the qualifying limit is only 6,900. So the deduction is limited to only 6,900 only to the extent of qualifying limit. If you add these two and claim the deduction, then the total income is 62,100. Okay. So to decide tax rates, question is not clear actually. Okay. Under chapter 12A, what we are having? Investment income, long-term capital gain income, other income. So here he is having long-term capital gain. As per the current applicable rates, it is taxable at 12.5%. Sir, December 2025 exam, now we need to check whether the transfer is before 23rd July or not. So when did they mention the date of transfer? Yes. In the previous exam, it is like 30th June 2024. That means before 23rd July 2024. Sir, in last year exam, if you remember, before 23rd July, it is like 10%. After 23rd July, it is like 12.5. For that reason, in the suggested answer, you could see 10%. But now, the amended rate is only applicable 12.5. So we are correct with doing 12.5% only. In December 25 answer, na previous year 24, 25. For us now, previous year 25, 26. So that year, before 23rd July, one tax rate. After 23rd July, another tax rate is there. So before 23rd July, it is 10%. Here the sale is made on when? 30th June. In last year, it is like 30th June 2024. Before 23rd July. That's why they have taken the tax rate as 10%. So now, when we are doing now, the tax rate 12.5% is only correct. You got the answer? You understood now? So there's nothing like specific assets and all there. So the basic cap. Okay. So come back and see which questions are question number 6. You read the question, are you able to understand? Sir, first, McFun is a non-resident and German citizen is employed in a German company. Chapter 12 applicable. Chapter 12. Yes or no? So don't put question mark face. It's a simple sentence. Read it and tell either yes or no. No. Why no? Because he is not an Indian citizen or person of Indian origin. So chapter 12 not applicable. The German company has a PE in India. Accordingly, the income of PE is chargeable to tax in India. Sir, first they talk about employee. Now they are talking about what? Employer. Okay. To tax in India. Okay. McFun. Sir, see, the German company has a PE in India. I mean, it has a branch office or factory located in India. Now, McFun has visited in India during the financial year 2026 and stayed here for how many days? 83 days. His salary for that period is how much? 23 lakhs. So now tell this 23 lakhs, Indian income, not Indian income. Indian income only because he has worked in India only. So it is accrued in India. So this 23 lakhs is what? Indian income. Then McFun had 1500 shares of Brunda Banex Private Limited, an Indian company, since 29th November 2017, which he acquired for how much? 12 per share. Okay, for how much, sir, he acquired? 1500 each at 12 he has acquired. For acquiring the shares, he remitted $50,000 to India. He sold the shares in the current year 45. So he is a non-resident. He sold Indian shares. Okay, sir, even though he is not under chapter 12A, but still for him proviso 1 of 48 is applicable. Why? Proviso 1 of 48 says what? When SSE is a non-resident and he sells Indian company shares or Indian debentures, then the capital gains has to be computed in foreign currency only. So for him, the capital gains has to be computed what? In foreign currency. Then McFun also held 2,000 equity shares of DT, a German company. Sir, which company, sir? German company, which acquired for 145. During the year, he sold all those for 615 to Ben, another non-resident. Sir, is it taxable in India? Where he held shares? He is first word, he is a German citizen. In a German company, he purchased shares and sold shares. So the capital gains accrued where? Germany. Okay, it's a foreign income, nowhere taxable in India. So this point not connected to us. Okay, so 2 points only relevant for us as of now. One is salary, the second one is capital gain related to Indian shares. But that Indian shares we need to compute in what? Foreign currency. Then his asset details game not relevant for us. Total value of assets, immovable property is held in India. All this is like what? Irrelevant only. Then dividend from DT received in India. Sir, dividend, even though it's a German company, it is received in India. So this 1,15,000 is taxable in India. Okay. So for us what? 23 lakhs taxable salary. Okay. Since the salary is taxable, standard deduction is also available up to an extent of 50 or 75 depending on the regime. Then capital gain applicable. Capital gain has to be computed in what? Proviso 1 of 48 is applicable, so we need to convert it into foreign currency and calculate. Then the third point, Germany company shares sold in Germany, there only money got, so it is not even Indian income. But dividend received on that shares in India. Since received in India, it is taxable in India. Okay, so now 23 lakhs from the standard deduction 50, 22 lakh 50. Then capital gains, they computed in foreign currency only, sir. We know, so I am not doing it once again. And then dividend 1 lakh 15. What is the total income, sir? 24 lakh 11,730. Simple question only again. Then question number 7. Okay, we need to change the year 2025. So total income of a non-resident Indian includes investment income, long-term income, other income. What will be the tax payable under Chapter 12? Sir, investment income, what is the tax rate? 20. Long-term capital gain, 12.5%. Other income, slab rates. So 50,000 into 10%, 10,000. 25,000 into 12.5%. How much? 3,125. 3,15,000, sir. Which they didn't mention optional or default. So default, if you take it, is like nil. So total it is 13,125 plus S4, total 13,650. Sir, now try to solve December 23 question, sir. Here the answer is wrong. Everybody, in handwritten the answer will be correct. We have solved it even in the handwritten. Okay, this handwritten there. So here in the workbook the answer is wrong. It was not updated. So okay, try to solve this exam question also. So here also, sir, Wesley also, they are asking to compute as per chapter 12 only. So last 5 items, 4 times they asked only from chapter 12. Sir, interest on deposits with limited companies in India. Investment income, tax rate what rate, sir? Interest income, 20%. Then short-term capital gain, sir, normal rate, other income, normal slab rates. Long-term capital gain from transfer of foreign exchange asset, when it is sold? 1st June. Okay, the long-term capital gain is computed. Expenditure is in connection with the transfer 17,000. If you remember, sir, expenditure in related to transfer can be subtracted. So 17,000 if you subtract it is how much? 6,50,000 is the net sale consideration. Then investment in shares of public company he made. Sir, again, he made an investment. Public company, so it is another foreign exchange asset only. When 22nd November 2025. What is the time, sir? June, July, August, September, October, November. Within 6 months only he has made the investment. How much he has made investment? 2 lakh 10. Okay, so what is the exemption available, sir? 2.1 lakh divided by 6.5 lakhs. Why 6.5 lakhs? Proportionate to the net sale consideration. 2.1 divided by 6.5 lakhs. Okay, actually, sir, here capital gain itself, exemption itself can't be calculated. Question itself is a mistake. Why? We need net sale consideration. Okay, but what they given is see. Long-term capital gain from transfer of foreign exchange asset. Sold. Okay, they given capital gain directly as 6,67,000 and transfer related expenses as 17. What they should have given here? Net sale, gross sale consideration separately, capital gain separately. Okay, so even the suggested answer also will be wrong, sir, because here the question itself is wrong and the answer also they'll compute wrongly only. Like what they'll do now, they'll take this total 2,10,000 as exemption in answer. In December 23 suggested answer. Okay, so how do they do now? They'll subtract transfer related expenses 17,000. I'll show you that one also suggested answer. It will become 6,50,000 and straight away they'll give 2,10,000 as exemption. Let me show you the suggested answer, sir, once. Sir, they given the answer, see, how much is the total income? 11,10,000. How we will get 11,10,000? By doing this stupid calculation only, we'll get 11,10,000. See, interest on deposits 2,10,000. That is like what? 20%. Okay, that is correct only, no problem. Short-term capital gain, normal rates, that is also no problem. But long-term capital gain is how much? 6,67,000. Sir, gain means after adjustment of expenses only, right? Gross sale consideration, from there transfer related expenses, from there if you subtract cost of acquisition, then we'll get how much? Long-term capital gain, 6,67,000. So usually when they refer it as long-term capital gain, this 6,67,000 is what? After adjustments only, right? Okay. And then they give an investment amount. Here, without giving net sale consideration, you cannot even calculate the exemption amount. Why? Because the exemption amount is in proportionate to the net sale consideration that has been invested. So it's a poorly framed, not poorly, utterly wrongly framed question because we can't calculate the exemption. For this, so what they thought? Expenditure incurred 17,000 subtracted, and then how much ever is the investment made, that was given as exemption. Okay, sir, but actually whether like that exemption is given no. When the 100% of net sale consideration is invested, then total capital gain is exempted. Otherwise, it is exempted proportionate to the amount of investment made. But here this 2,10,000, so it is straight away given. By doing that only, we'll get how much? The gross total income as 11,10,000. Okay, ila chestene 11,10,000 ostadi. But this is what wrong. So then what is correct? Okay, we cannot do correctly also, sir, because the question itself has certain mistakes. So let me show you how I did it in handwritten. See, you can see in the handwritten also, sir. I wrote page number also, tell me, sir. Sir, everybody with workbooks, you can just link with the handwritten page number. So could you just tell me the page number for this, sir? Mr. Wesley, you'll find the question. 256. It's okay, sir. If you didn't receive handwritten also, just in the applicator write it like refer handwritten page number 256. Interest on deposit, how much, sir? 2,10,000 general rate. Okay. Not specified as foreign exchange, but this also. Okay, then long-term capital gain for exchange of foreign exchange is 6,50,000, from there 2,10,000. We did, but mistake in framing question. Exemption is proportionate to investment made from net sale consideration, but here net sale consideration is not given. So we took what? 11,10,000 and we have calculated as 1,52,880. Sir, here what I did now, interest on deposits with limited companies in India also, since it is not mentioned in foreign exchange, we don't know whether it is a foreign exchange asset or not also. If it is a foreign exchange asset only, then investment income tax bill at what rate? 20%. So that information is also not there. So since it is not there, I am taking it as what? General. You can take other assumption also. Assuming it as forex, you will take it as what? 20% also. Okay, so overly this 23 December 23 question itself is a wrongly framed question. Okay, if you wanted to, if you spend time on this question, you will unnecessarily forget your basic provisions and all, you will be thinking of it. One simple thing I can say is like, you leave that question also, no problem. Or else come to the handwritten and look at this answer, then you'll get. Okay, I wrote once again, exemption 2,10,000 is wrong, but since net sale consideration is not available, it was taken as 2,10,000. Okay, so with that mistake question only, somehow we made an answer convincing to us. But still I cannot accept that this answer is truly correct. Okay, because the question itself is wrong. Sir, question number 15, if you see, John Smith football player, you can do it easily. Which section? Single section only, sir. For games, participation in game, sport, or in advertisement, or contribution to articles and all, then 20% is taxable. If it is a sports association, their share of income, share of match fees, taxable, 20%. Then entertainer, for performing in an event, whatever the amount you'll get, that is taxable at a rate of 20%. Rest all normal rates only. Okay, this question number 15 you can do on your own. Question number 16 we already solved only, sir. I mean, the same kind of only, sir. Okay, sir, we'll see question number 16. See, non-resident foreign company has a PE in India in respect of which royalty 101 lakh was, and sir, see, non-resident foreign company has a PE in India and they had royalty. So royalty covered where? 115A. But if it is connected to PE, then 115A is not applicable. We'll go to what? 44DA. What is 44DA says? Like, compute normally only. So what is the income they had? 101 lakhs is their income. And then they have expenditure of how much? 12,37,600. They don't have anything. So from 1 crore 1 lakh, 12,37,600 subtract. What is their income? 88,62,400, which is taxable at normal rates. Sir, it is what? It's a non-resident foreign company. For foreign company, what is the tax rate? 35%. So they applied 35%. This is the tax. Okay. But again, extra what has to be done, sir? Cess has been added. Surcharge will not come. Why? For foreign companies, when the total income exceeds 1 crore only, surcharge will come. But here how much? 88 lakhs only. So no surcharge. Tax plus cess together they calculated. 104%. Okay, so here 35 first tax plus on that cess also added. It's a direct step. Tax plus cess. So 16 done. 15 you can do. Okay, 14 tells her. Compute the income tax in the following cases. Royalty 10 lakhs received by a foreign company. 10 lakhs received by a foreign company from an Indian concern in pursuance of the agreement approved by the central government. Sir, is there anything mentioned about PE? So if PE is not there, then covered under what? 115A. 115A now what is the tax rate? 20% plus cess anyhow. Okay, see. 20% of 10 lakhs, 2 lakhs plus cess 4%, 8,000. Total is how much? 2 lakh, 8,000. Done. Then 10 lakh long-term capital gain received by a overseas financial organization. 115AB. Overseas financial organization. Long-term capital gain taxable at what rate? 12.5%. So 10 lakhs into 12.5, 1,25,000 plus cess at a rate of 4%. Total 1,30,000. Here total 2,08,000. Okay. So question-wise, it's just identifying the section and tax rate only, sir. Question-wise, leave that December 23 question. Rest all the questions. If you know the provision and tax rate, easily. Okay, it doesn't even take much time also for us to calculate. Okay. So we are going with residential status and scope of total income. Residential status of individual. First, so like we have to determine residential status for individual, HUF, AOP, BOI, AJP, local authority, company. For all of them, we need to find out residential status here. But individual, since we learnt already in inter-level, so quite easy only. So we can discuss a little quicker also. For individual, any one of the basic conditions has to be satisfied. There will be two basic conditions. Any one of them. See, first for individual, there is like ROR, RNOR, NR. The first level will decide like resident or non-resident. If he is a resident, again we'll classify him as like ordinary resident, but not ordinary resident. Okay. So see, we need to check what basic conditions. Out of two basic conditions, if any one basic condition satisfied, then resident, otherwise non-resident. Then if he is a resident, again we need to check additional conditions. They are also two. Both the additional conditions satisfied, ROR. Both of them are not satisfied or any one of them not satisfied. Then resident but not ordinary resident. Now what are those basic conditions? His total period of stay in India in relevant previous year should be more than or equal to 182 days. Total period of stay in India in relevant previous year should be more than or equal to 182 days. Or stay in relevant previous year is more than or equal to 60 days. But stay in 4 preceding previous years together should be more than or equal to 365 days. First basic condition, just in the previous year 182 days. Whereas basic condition 2, in previous year 60 plus 4 preceding previous years together 365. Okay. If any one of these two, 182 or 60 plus 365, out of these two, any one basic condition has been satisfied, then such person, such individual is called as what? Resident. Otherwise, non-resident. Okay. Here certain. Sir, this 182 days, 60 days or 365, whatever we are checking, that period need not to be continuous. I mean, you need not to stay continuously 182 days. You can go, I mean, you can go abroad, come back, go abroad, come back. So in a period of intervals also, it could be 182, 60 or 365, whatever the period is needed. Okay, so it need not to be continuous. If he is staying in territorial waters, his stay in territorial waters also has to be counted as stay in India only. Then date of arrival into India, date of departure from India, both will be considered as stay in India only. Date of arrival, date of departure, both will be considered as stay in India. Understand, sir? What are the 3 note points I said? Stay need not to be continuous. Stay in territorial waters also has to be counted as stay in India. Third one, date of arrival and date of departure both has to be considered as stay in India. Now, there is an exception for this, sir. Exceptions what? Sir, usually to decide resident and non-resident, we need to check basic conditions too. Any one of them satisfies also is called as resident. So now exception 1, if you see, he is an Indian citizen leaving India during relevant previous year. Why he is leaving India? For the purpose of employment outside India. For the purpose of employment outside India. So like employment means any occupation. It need not to be only job. It could be for profession outside India or business outside India or employment outside India. He is leaving India. Okay. Or else he is going as a crew member of foreign going vessel. That vessel is going on a foreign voyage. Okay. So he is a crew member in that ship. So for these 2 kind of people, who are those 2, sir? Indian citizen leaving India for the purpose of employment outside India, or Indian citizen who is working as a crew member of foreign outgoing vessel. So these people will be considered as resident only when they satisfy first basic condition. Sir, why they have been given as exception? Sir, to become resident, second case is only, or second condition is only more easy to attract rather than that of first one. Sir, being resident is better only. No, being resident is not better. Non-resident only better. Why? Because non-resident, only incomes accrued or received in India are taxable. Whereas for resident, global incomes, even though he has income outside India also will become taxable. So there also it will tax, in India also it will tax, again double taxation, DTA, all that has to be done. If first itself he was categorized as non-resident, then in India, if they were not received or accrued, they are escaped from taxability. So for these people, being non-resident only better. Since first condition attracts easy, what they are saying like, since the second condition attracts easy, what they are saying like, for these 2 people, second condition need not to be checked. Only if first condition satisfies, they are called as what? Residents. Okay, it is actually favorable to those people. Okay, because they will not become residents easily. Only if the majority of the year, if they are in India, then only they will become residents. Okay, so it is in favor of the normal citizens or SSCs only. Okay, what is the exception, sir? Indian citizen leaving India for what? Employment outside India or as a crew member of a foreign outgoing vessel. Then for that persons, we need not to check 2 basic conditions. Only first condition alone has to be checked. What is the first basic condition? More than or equal to 182 days in relevant previous year. Then exception 2. He is an Indian citizen or person of Indian origin. Who is called person of Indian origin? When his parents or grandparents belongs to India, even though he born citizen of some other country, he is called as what? Person of Indian origin. Indian citizen or person of Indian origin came to India for a visit. So he doesn't came to India to stay here. Okay, he has relatives here, so he came to India. So you know Sunita Williams? So who is she? Astronaut. Okay, she is a person of Indian origin. Okay, her parents are Indians. Okay, she is a person of Indian origin. See, her parents moved to US, but still, she might have relatives in India only because the brothers of parents, his grandfather, her grandfather, grandmother, so all those will be in India only. So they make all, and they may have properties in India also. So usually, even though they are Indian citizens, being non-residents or person of Indian origin, still they may have relatives, family, properties in India. So they may be coming to India for a visit. Okay, so the exception to applicable to Indian citizens or person of Indian origins, they are not coming to India to stay here. They are coming to India for a visit. Okay, they may stay here for 1 month, 2 months, then again they'll go back. For such people, only if basic condition 1 satisfied, resident or modified B2. Okay, B2 is actually what? What is basic condition 2, sir? Actually, 60 days in the relevant previous year, more than or equal to 365 days in the relevant 4 previous years, the actual B2. But for these people, modified B2 is applicable. What is modified B2? See, sir, when we'll come to modified B2 also. First preference is like for them also you should check only basic condition 1. If basic condition 1 satisfied, then obviously they are what? Residents. If basic condition fails, basic condition 1 failed, then we'll check modified B2. We'll check modified B2 only in certain cases. What are those? When the total income from other than foreign source, it is nothing but what? Indian source. The total income from other than foreign source. So other than foreign source, it will become what? Other than foreign source. Then it will become what? Indian source. Should be how much? More than or equal to 15 lakhs. Okay. So the modified B2 will come when you check the basic condition 1. That not applies. And such person's total income is more than or equal to 15 lakhs in relevant previous year. That also other than foreign source income. Then for him modified B2 is applicable. What is modified B2? In the current relevant previous year, instead of 60, we'll be checking what? 120. So more than or equal to 120 in the relevant previous year. More than or equal to 365 in the 4 preceding previous years. Understand, sir? When modified B2 is applicable? To which kind of individual modified B2 is applicable? Indian citizen or person of Indian origin who came to India for a visit. Okay, for him also actually B1 has to be checked. B1 fails. and his total income from foreign source is more than 15 lakhs during the relevant or equal to 15 lakhs during the relevant previous year, then modified B2 applicable. What is modified B2? More than or equal to 120 days in the relevant previous year, more than or equal to 365 days in the 4 preceding previous years. Okay, but one point, sir, if any Indian citizen or person of Indian origin, he becomes resident because of modified B2. Because of modified B2, he became resident. Then, whether additional conditions satisfied or not, he'll always be RNOR only, not ROR. What is RNOR? Resident, but not ordinary resident. So, if any individual becomes resident because of modified B2, he will be straight away said as like what? RNOR only, irrespective of additional conditions. But irrespective of additional conditions is what? RNOR. Understood, sir? What are the two basic conditions? B1, more than or equal to 182 days in relevant previous year. B2, more than or equal to 60 days in relevant previous year, and more than or equal to 365 days in 4 preceding previous years. Let's say previous year 25-26. Then that is the relevant previous year. What are called 4 preceding previous years? 24, you will not count 25-26 there. 24-25, 23-24, 22-23, 21-22. Those are the 4 preceding previous years. Done. Done, sir, this part clear. Okay. Then stay can be in intervals, sir. Like he'll come for 10 days, he'll go back and again come for 10 days. Yes, stay need not to be continuous. He constructed his house in territorial waters on the sea. Can he live there? Still he'll be continuous as living in India only. So stay in territorial waters also, stay in India. So okay, then third one. Date of arrival, date of departure. Both has to be considered as stay in India. What is first exception? First exception. Indian citizen leaving India for employment outside India, or crew member is an Indian citizen being a crew member of foreign going vessel. Then what applicables for them? Only B1 has to be checked. B2 ignore. Then exception 2 applies to Indian citizen or person of Indian origin. Indian citizen or person of Indian origin who came to India for a visit. For them B1 checked. B1 satisfies, no problem. B1 failed. Then we need to check further whether his total income from other than foreign sources is more than or equal to 15 lakhs. Then modified B2 applicable. What is modified B2? Greater than or equal to 120 days in the previous year, more than or equal to 365 days in the 4 preceding previous years. Because of modified B2, even though he becomes resident, he'll be resident but not ordinary resident only. Now additional conditions. What are additional conditions? So now we have decided he is resident or non-resident. Let's say individual is resident. Then additional conditions. First one. Out of the last 10 preceding previous years, he should be resident for 2 years. That means resident for 2 years means out of last 10 preceding previous years, he should satisfy basic conditions for at least 2 years. Okay, so let's say sir, previous year is 25-26. What are 10 preceding previous years? 24-25, 23-24, 23-23, or 22-23, 21-22, 20? Okay. Okay. For all these years, you need to do what? Basic conditions has to be checked in all these years, at least for 2 years. If he satisfies, then additional condition 1 is. Sir, both the basic conditions need not to be satisfied. Any one of the basic conditions satisfies for any of the 2. Let's say 15, 16, 16, 17, 17, 18 satisfied. Then additional condition 1 is satisfied all. Then he should be present in India, stay in India for more than or equal to 730 days in 7 preceding previous years. So what are 7 means till when? From here to here till 1819. These are the 7 years. In all these years together, his stay in India should be how much? 730 days minimum. Okay, so in these 10 years, at least he should be resident for 2 years. And in this 7 years, his stay in India should be 730 days minimum. If both these 2 conditions are satisfied, then such individual is ROR. Otherwise, RNOR. Understand, sir? Resident for 2 years out of 10 preceding previous years. Present in India for more than or equal to 730 days in 7 preceding previous years. If both the additional conditions are satisfied, then SSE is ROR. Otherwise, RNOR. Then deemed resident. Deemed resident. So this person, sir, irrespective of basic conditions, he'll become resident. That's why it's called as what? Deemed resident. So usually we'll check at least one of the basic condition to call him as resident. Or at least modified B2 we are checking. But this one, nowhere connected to basic conditions. But still he can be called as what? Resident. Then he's called as what? Deemed resident. What are the case? He is an Indian citizen. He has income from other than foreign sources more than 15 lakhs. None of the basic conditions satisfied. If satisfies not, there only he is resident. And not liable to pay tax in any other country. Okay, that means what? This fellow is having income and not paying tax in any country. So India wants to tax him because he's an Indian citizen. That's why what they're saying, like, since he is Indian citizen, his other than foreign source income is more than 15 lakhs, not paying tax in any other country, he's called as resident of India. But additional conditions and all not required, sir, is always RNOR only, resident but not ordinary resident only. So who is called deemed resident, sir? Individual being an Indian citizen, income other than from foreign source is more than or equal to 50 lakhs, didn't satisfy any of the basic conditions, not liable to pay tax in any other country, then he is called as deemed resident. But always RNOR, not ROR. Then we are moving on to residential status of HUF. HUF. What is called HUF, sir? Hindu undivided family. Who is the head of HUF? Who can be Karta? Any member of the family can become Karta now. You know something called co-parsoner is there? Co-parsoners. Vaguely. Remembering little. Maybe you remember. Co-parsoners means the person or individuals born within the same family. Usually wife will come from other family, whereas his children are born within the family, so they are called as co-parsoner. Only co-parsoner can become Karta of Hindu undivided family. Understand, sir? Only. It's okay, sir. It's not about gender. A daughter can become Karta. Okay, but the thing is like they should have born in the family. Okay, not when they brought from some other family. Okay, so then they'll become what? Co-parsoner. Co-parsoner only can become Karta. Any member cannot become Karta. Only co-parsoner can become Karta. Okay. So what is co-parsoner having? Sir, every member will have equal right in the property. But co-parsoners only can demand partition. Just members cannot demand partition. Co-parsoner can demand partition. Okay. A 3 years child, so even though since he is born within the family, he'll become co-parsoner. He has the right to demand partition. But let's say wife is there in the family, she cannot ask for partition. Okay. If she wanted to ask, she can at least convince her children to ask for partition. Then the partition will move. Okay. So HUF has Hindu undivided family, Karta. Okay. So again, this one, sir, why here additional conditions has been kept? Just with basic conditions, we can decide like resident or non-resident, right? Sir, additional conditions kept means accidentally you might become resident sometimes. Like you came to India, but lockdown came. So okay, you are stuck in India only. So okay, you came as a tourist only to India, but lockdown came, you stuck here, no flights and all to travel also. So you stayed here for more than 180 days. Then you accidentally became resident. You genuinely not a resident, but accidentally your stay is more than 182 days. Or else like you came here, some accident happened, you fell sick, so you are only hospitalized, you cannot go now. So because of these kind of reasons, you accidentally became resident. That's why for you also, so these accidental residents shouldn't be taxed for global incomes because they are not genuinely residents. Accidentally they became residents. That's why they introduced a concept called as ordinary. Ordinary, in general they are residents, accidentally residents. So in general, how do we can test? That's why we are checking not the current year alone. Past 7 years we are checking, past 10 years we are checking. Okay, in the two conditions also following, he's not someone became accidentally resident, he is ordinarily also resident. That's why ROR and RNOR concept has been introduced. ROR means what? Resident and ordinary resident. RNOR means resident but not ordinary resident. Now HUF. HUF, sir, control and management wholly or partly in India. Sir, the wrong notion is like Karta will have control and management. Nowhere in HUF said like the control lies with Karta only. Karta is a representative. He's a head of the family. Okay, he may go to his house, his wife may kick him. Like anything. So okay, we don't know all that. He don't have any decision making, nothing. Okay, whatever his wife cooks, that only he has to eat. Whatever she says at home, that only he has to say outside. But he's head of the family, Karta. So but no, control and management. So control and management is different. Okay, being Karta is different. So Karta is like what? Sir, let's say you watch movie like Venkatesh movie, Adavaru Madlu Kartala Verle. Watch movie, there joint family will be there. They'll go for saree shopping. Okay, when they go for shopping now, like the whole family will go, 20, 25 people will go in one single car like that, right? So now, if income tax people wants to give a notice to HUF, all the family, these 40 members need not to come to income tax office and they're sitting in front of commissioner. Okay, in between one small kid coming and asking like, where is washroom, restroom? So that and all not required. That's why, for convenience purpose, the whole family need not to come. Let he alone come. That's why they appointed Karta. It doesn't mean Karta alone take the decisions. Let's say there are 4 brothers in a family. So all the 4 brothers will talk and then only decide. Okay, for representation, who will go? Karta will go. Or they cannot sign. Let's say in written signing has to be done. The whole family need not to sign. Just like as these people signed yesterday. Okay, so it's not like taking like collecting signs, 1 lakh signatures. Sometimes these political parties and all will keep collecting 1 lakh signatures, collecting 1 crore signatures and all. So that many signatures not needed, right? So only for representation capacity, Karta. We cannot conclude like the control and management lies with Karta only. Okay, so control and management wholly or partly in India. How? Let's say 4 brothers jointly, they are like HUF. Now 2 brothers are in US, 2 brothers are in India running the business. Now these 2 brothers who are running the business in India, doesn't have whole control because they need to inform day to day like to whom the other two brothers also who are in US. Okay, so now what happens? Wholly the control is not in India. Partly it is in India, partly outside India. But what here it says, control and management need not to be wholly in India. Even though it is partly in India, it is called as what? HUF. I mean, it is called as what? Resident. Let's say, sir, a family is running, a family business is there, HUF, but husband is staying in Dubai. Wife runs the family. This wife actually will not ask any decision making, nothing. Okay, nothing was said to husband. She will only do whatever she will based on the situations. But Karta is situated where? Outside India. Sir, on record, okay, at least even though she takes everything, on face, she cannot tell, right? I will only do everything. He is just for rubber stamp only. She cannot tell all that, right? So, what they may project like, we both together decide. So, then also, control partly in India, partly outside India. HUF is called as what? Resident. Now, we need to check what to decide whether HUF is ordinary resident or but not ordinary resident. We need to check the residential status of Karta. Karta individual residential status. Karta as an individual is ROR. HUF also ROR. If Karta is RNOR or NR, HUF also RNOR. Okay. So to become HUF ROR, control management should be partly or wholly in India. Plus Karta of such HUF, individual capacity, he also should be ROR. Then HUF will become ROR. Otherwise RNOR, HUF. Okay, no, sir. Okay. Now residential status of firm, AOP, BOI, AJP, local authority. For all this, we need to check control and management whether wholly or partly in India. Yes, in India. Resident. Otherwise, non-resident. Sir, for firm, AOP, BOI, AJP, LA, there is no ordinary resident and all. Okay, because, okay, there is no concept of ordinary resident and but not ordinary resident. They have only straight away resident and non-resident. Only for individual and HUF only we have ROR, RNOR and NR category. Right? Understood? Clear? Right? So now residential status of company, it is important. So all that what we have discussed is not important for the purpose of exams at final. But this company related will be important. So then company related. I mean, if at all here there is a chance of asking question, they can ask from this company related. Company, Indian company, foreign company. What is called Indian company? You only have to tell, you only studying Companies Act. I am not studying. Incorporated as per Indian Companies Act 2013 or 1956 or any other as well Companies Act. Then it is called what? Indian company. If it is an Indian company, always resident. Foreign company means what? Incorporated outside India. Okay, as per the Foreign Companies Act, not as per the Indian Companies Act. So they are called as what? Foreign company. So for Indian company, no problem. If it is Indian company resident, what is there to discuss? Nothing else. But for foreign company only, it is important. For foreign company, we need to check poem. Poem means not the normal poetry, poems and all. Okay, poem means place of effective management. Place of effective management. Okay, in HUF wife I said na, who exercise the control power and all, like that here. In company also we need to check poem, place of effective management. So substance over form we are checking. Okay, substance wise the company may be outside India, but form, it's okay, so like, sorry, substance, form, okay, it is formed outside India only, but substance is in India only because the company is controlled in India, everything, the meetings, everything is organized in India only, na? Then poem will be in India. So to check substance or form, we are checking what? Poem. Okay, poem means what? Place of effective management. If poem is in India, resident. Poem outside India, non-resident. So the question is about how do we know poem in India, outside India? Okay, poem. Poem determination applicable only when the turnover is more than or equal to 50 crores. For companies whose poem is within 50 crores, sorry, for companies whose turnover is within 50 crores, we need not to check poem at all. That means what? They are foreign company, will think them as like non-resident only. So we'll check only when their poem, we'll check a foreign company poem when the foreign company turnover is more than 50 crores. Sir, small company, small foreign company, why to do this much? Okay, that's why they're leaving. Let us take it as like non-resident only. But it's not a small company because its turnover is what? More than 50 crores. Then we need to check what? Poem. Sir, this is already asked as an MCQ, this point. Okay, an MCQ is framed testing this point only, whether poem applicable or not. Poem applicable when? When the turnover of such company, foreign company is more than or equal to 50 crores. Otherwise, we will not check poem. If you now don't check poem, then straight away it is what? Non-resident only. Okay, so now what is poem? Sir, not just poem here. Okay, how poem will be considered as outside India? Okay, the definition says like poem outside India if these two conditions are satisfied. If poem outside India, it is resident or non-resident? Non-resident. Okay, what is that? When active business outside India and majority board meetings outside India, both has to be satisfied to say that poem is outside India. Active business, India na outside India na? Outside India. Active business, the company's active business is outside India. Majority board meetings are also outside India. Then we can say like what? The poem is outside India. When poem is outside India, non-resident. Let's say sir, in a year 4 board meetings are held. 3 in India, 1 only outside India. Majority in India na outside India na? Majority not outside India, so obviously poem test fail. Poem is in India, it will become what? Resident. Okay, 4 meetings, only 1 meeting held in India, 3 held outside India. Majority board meetings outside India only. But straight away you cannot say poem outside India. You need to check even active business also. Sir, out of these two, even one fails also poem inside India. Poem in India. So when poem is in India, it will become what? Resident. Understand, sir? Both has to be satisfied to decide poem outside India. When poem outside India only, it is called as what? Non-resident. Understand, sir? So both satisfies only poem outside India, non-resident. If one condition only satisfied, still it become what? Resident only. Poem within India, it become resident. Okay? If both satisfied, obviously poem India, it will become resident. So, okay? What are those two? Majority board meetings. That is easy only, sir. By reading the point itself, we can say. Important one is like what? Active business outside India or not. Sir, business they can say. Why they are saying active business? So the incomes can be classified as like passive incomes, active incomes. Now tell, for a normal business or for us also, what could be passive incomes? What could be active incomes? Or tell the list of passive incomes which you think. Active incomes means what generally? So tell active or passive, whichever you remember, tell examples for both active and passive. From business, what you do is called active income only. Then what is passive? Interest, dividend, then. I didn't understand. That is active only, right? Profit on sale of capital assets. Sir, active income means you should actively work on it. If you are getting salary, you are actively engaged in it. If you are getting business income, you are actively engaged in it. But for interest, what you will do daily? You given money, you invested there, it accrues passively. You can do some other work also, right? So passive. You invest in a company, you get dividend. Do you need to again every day going and all, right? No. Okay, maximum it is what? The company will run on its own. It has a set of board of directors, everything is there. It will run on its own. You'll just get dividend. So passive income. So here what? Active business should be outside India to make sure that poem is outside India. When we can say active business is outside India, if all the 4 conditions are satisfied, then only active business outside India. Sir, understand? First 2 conditions has to be satisfied to become poem. Sir, this is favorable to Indian income tax. Any one fails, you'll become resident. All the 4 conditions satisfied, then active business outside India. Even though active business outside India, again you should check what majority board meetings are outside India or not. If both satisfies, then poem outside India. If poem outside India, then only non-resident. At any place it fails, it will become what? Poem India, it become resident. Okay, all the 4 conditions has to be satisfied, then active business is outside India. First one, out of the total income, passive income should be less than or equal to 50%. Okay, out of the total income, passive income should be within how much, sir? 50%. What are called passive incomes? Royalty, dividend, capital gains, rent, house property rent, interest, except for banks and financial institutions. Sir, banks, financial institutions, interest is active income. For people like us, interest is passive income. Okay, Mauli is like running money for interest, like 5 rupees interest, 10 rupees interest. Okay, every day he'll go evening. So, okay, you see in like sometimes in near grocery stores, the small vendors and all. Okay, evening time, these people will be coming like with a card. With 2 bags, they'll be coming. Every day they'll be collecting interest or their principal amount. You know them? Seen? It's okay. So their interest rates are like 2x. Okay, like what? You watch Dubai's, you know. There Krishna Bhagwan will be there. Okay, his character. Morning he'll give 1,000 rupees. Afternoon, morning he'll not give 1,000. From 1,000 he'll already cut interest. 800 he'll give. Then by evening he'll collect 1,000. It's okay, very legal. Okay, what? Dharmavadi. Okay, so such kind of business Mauli is doing. So even though he is actively engaged, but since it is not a finance business, he cannot show it legally. That's why what? Passive income only. Rent, passive income. Capital gain, passive income. Dividend, passive income. Royalty also, passive income. Then extra, any income from transactions where both sale and purchase are also to associate enterprises. Any income from transaction, not just purchase to associate enterprise or not just sale to associate enterprise. Both purchase and sale are also with associate enterprises only. So where you got customer? Sir, you buy goods from your mother, sell to your father. Okay, your mother cooks their breakfast, idli. Okay, you'll put it in the plate. So okay, so until sell it to your father, plate 30 rupees. Then what happened? From associate enterprise, you took plate idli and then you sold it to your father again, associate enterprise. So where you did actual business there? Within the group only, right? So that's why they will not consider it as what? Active income. It is what? Passive income. Understand? So passive income should be means what? Royalty, interest, dividend, rent, capital gains. Then income from both buying, income from purchase or sale, when both buying and selling is with associate enterprise only. Okay, such from these sources the passive income is there. Such a passive income should be how much? More than 50 or within 50? Less than or equal to 50, within 50. Okay, if it is 51%, then the test fails. If this test fails, poem outside India also fails. When poem outside India fails, then the company will become resident. The next one, out of their total assets, only less than 50% of the assets should be in India. Less than 50% of the assets should be in India. Second one. Third one, out of their total number of employees, less than 50% only should be in India. Out of their total employees, less than 50% only should be in India. Fourth one, out of their total payroll expense, less than 50% only should be in India. Sir, what people are doing now? So first this condition kept, sir. Then what people are doing means, this foreign companies doing means to escape, sir. Because you know, in India, employees will be hired more. They will not have much assets here. They may not have income directly from India more, but what happens now? They have more employees because many of these small tasks, since here employment labor is cheaper, they'll hire more people here. Instead of doing it in a foreign country, they are doing it here. Okay, so employees count is kept. Now, since employees count is checked, what they are doing now? They are not bringing into the payroll of the companies. I mean, you'll work for Accenture, but you are not under the Accenture employees list. Okay, a third party consultant will come. Okay, a third payroll companies will be there. That company will be hiring you, but you will be working for Accenture only. Or else, some other company, let's say BCCA is working like a manpower supply company. Now you will be under the payroll of BCCA, but actually you will be working for whom? Accenture, Cognizant, or to any of those multinational software companies you will be working, but you are not under the employee list of those companies. Why? To make sure that they will not have more than 50% of employees. Headcount they will make sir here. Okay, so to avoid that they having more than 50% of employees in India, or more than 50 or equal to 50% of employees in India, sir, if this condition, if there is no this hiring them under the different name, then most of the companies like Accenture, companies like Cognizant, all of them, even though they are foreign companies, their poem will be in India, they'll become what? Residents only. Okay, that's why they will not keep all the employees on their payroll name. What they'll do? They'll create some more companies, okay, or else they'll tie up with some other companies. So the employee will be under the, so when you're working, you'll say like what? Your company name and all will be the same thing only. But, sir, okay, will be the same thing only. But you do actually work for what? The original company like Cognizant. So TCS, anyhow, Indian company only, not required. Accenture, then Salesforce. It's okay. So all these are like companies. Then if all the, okay, then the fourth condition is what? So they'll not check headcount. They'll check only salary expense, the payroll expense. If payroll expense is within 50% from India, fine. If it is more than 50%, then this ABOI test fails, then ABOI fails, place of effective management fails, POEM fails, then POEM fails. He is like what? Resident in India. The company is like resident in India. What are the four conditions, sir? Passive income should be less than or equal to 50%. What is called passive income? Interest, royalty, dividend, capital gains income, rental income, those. Then both income from transactions of purchase and selling, where both buying and selling is with associate enterprises. Assets related. Less than 50% should only in India. Employees. Less than 50% of total only in India. Payroll expenditure also. Less than 50% is only in India. Okay. Now, this question, sir, this is a CA final question. We don't have question on this actually, so borrowed from CA final. I think it is there even in our material also. I've added it, I think. Let us check once. So it is not there, sir. It was not added. So check only in the handwritten only. It's there, huh? Not there, right? This question. Single limited. Not there, na? It's okay. Read this question here. Singtel Limited is a company incorporated in Singapore, and 55% of its shares are held by Godavari Private Limited, an Indian company. Sir, but Singtel is incorporated where? Foreign company, Indian company? Foreign company. Singtel had its presence in India also. The details are like what? Fixed assets at depreciated values for tax purposes. How much? In India, 120, Singapore, 80. Intangible assets, India, 50, Singapore, 200. Other assets, India 40, Singapore 120. Then income from operations. So for assets wise, sir, we don't set like only depreciable assets anywhere. Total assets. Total assets includes what? It includes fixed assets, intangible assets, other assets also. So what is the total of other assets, sir? What is the total of all this? 120 plus 80 plus 50 plus 200 plus 40 plus 120. $410. Here only 400 is there, right? 200, 320, 80, 400. This is only 400. 610. 400 plus 210 total 610. Okay. So total 610 is there assets. How many are there in India? In India, how much is there? How many? 210 divided by 610 into 100. How much? Within 50% only, na? Total assets point checked within 50%. Then income from trading operations 25, 50. The above figure includes income from transactions where purchases are from associate enterprises, sales to unrelated. Is it to be counted as passive? Read the first point and tell whether it is passive. Why? Navneet, why is it active or passive income? The second point related. Active only. Bhavya. Active or passive? Passive. Active. Why passive? Or why active? associate enterprise తో అయింది కదా అని చెప్పి. Okay, go back to the page and check the condition once again. Why? To call it as passive, both buying and selling also to associate only. Here what happened? Only purchase from associate, sales to unrelated person. That's why it is not a passive. Then income from transactions. Second point, sir, tell her, active or passive? Active only, right? Why? Income from transactions where sales are to associate and purchase are from. So again what? Active. Third point. Why passive? Both purchase and sales are to associate enterprise. So this 5 and 10 is passive. Sir, this 5, 10, if you see what they said, in this 25 and 50, already these are included. So we need not to add anything. Okay, so already 25, 50. Then interest and dividend and investments. Passive only. Okay, so now what we need to do, these are the income. So tell me, sir, what is this person's total income here? Total income is how much? Because we need to find out payroll by total, right, to check the percentage. What is the total income? So I'm not asking active or passive also. I'm asking total income. 110. How much? Navneet, how much is the total income? 20. So I'm asking total income of Shintel Limited. 20. $110. Paka. Subhashri got 40,856. Okay, 40 and 56. Sorry. 40 and 56. So, okay, her total is like 40 and 56, 96. 110. Navneet, what is your answer? It's simple only, there is no problem to them. They're just asking, they give in the table, what is the total income? How much? 110. 110. Okay, now, Moli, how much? Okay, explain why 110. Okay, 25. Trading operations, 25. These 3 points already included, so need not to touch. Okay, then. Interest and dividend, 20. Same way, here 45, here 65. So 45 plus 65 is how much? 110. Total income. Okay, now tell what is their passive income. Now tell what is their passive income. Passive income is how much? Everyone, if 110 is total income, what is passive income? $50. How? This 5, this 10. Passive. Interest 20, 15 here. So total is how much? 50. So what do you have to do? 50 by 110 into 100. Within 50 only, no problem. So first condition satisfied, second condition also satisfied, active business. Then third one, number of employees, total how many? How many are in India? 70 by 160 into 100. 43. Again, third condition also satisfied. Fourth one, payroll expense. Total expense how much? 20. How many are in India? How much is in India? 8. 8 divided by 20. So all the four active business, all the four conditions has been satisfied. So active business India na, outside India na? If all the four conditions are satisfied, active business outside India. If active business outside India, we can straight away say like poem outside India na. Some other condition also has to be checked. What? Majority of board meetings also should be outside India. How many board meetings total? 8 board meetings, 3 in India, 5 in Singapore. Where the majority held? Singapore. So active business outside India, majority board meetings also outside India. So poem outside India. Foreign company poem outside India. So it is what? Non-resident. So we check like condition wise here. Condition 1, like income wise satisfied. Condition 2, assets satisfied. Condition 3, employees satisfied. Condition 4, payroll satisfied. Active business also outside India, majority board meetings also outside India. Then what? Poem outside India. Hence Singtel is a non-resident for the previous year. 25, 26 assessment year, na 26, 27. So this question we already solved yesterday. This one also we solved already yesterday. Now we are coming to scope of total income. For residents, global income is taxable. For residents, global income is taxable. But for non-residents, for Donald Trump, will be taxed in India? That will go afterwards. Okay, so generally, resident, non-resident. For Donald Trump, will it be taxed in India? If we start taxing, then the warships will not go to Iran. They'll take turn and come. Okay. He'll do all the things and then last he'll say, prank. So, resident, what happens, sir? Global income. So, Mowgli is a resident. He might have income in Russia, he might have income in Pakistan, Larry. He might have income in Bangladesh. So, wherever he is having income, all that is taxable in India. Okay. But non-resident will be taxed in India only when he has income received in India or accrued in India. In general rules, sir. We'll go detailedly also, in general. So, Indian income is only taxable. When can we call it as Indian income? What is received in India or accrued in India? Okay. So, these are basic points in inter-level, sir, those points. ROR, RNOR, NR. First one. Income accrued in India or deemed to be accrued in India. Sir, what is called accrued or deemed to be accrued? Nothing but source in India. Here, accrual or deemed to be accrual, nothing but for such income, source is in India. Then it is called as what? Accrued or deemed to be accrued in India. So, let's say, sir, David Warner invested in Reliance Limited. David Warner, resident or non-resident? Non-resident. He invested in Reliance. He usually lives in Australia. He is getting dividend from Reliance Limited. Where the income is accruing, he received in Dubai, in Australia only. He is also non-resident only. But the source of income is where? India. Because it is a share of Indian company, the source is in India, it is considered as what? Deemed to be accrued in India. Okay, na, sir? Donald Trump has a house in India. That house is given on rent to Mowgli. Okay, now Mowgli is paying rent to Donald Trump. So where Donald Trump is there? USA. He is getting rent outside India, but for that rental income source is where? India. So that is what deemed to be accrued in India. Okay, so where the income is accrued or deemed to be accrued in India, irrespective of his residential status, it is taxable in India. Second one, forget about where it is accrued. If it is received in India, then also it is taxable for all the three. Where if it is received in India. Third one, sir, income accrued and received both outside India only. Accrued also outside India, received also outside India. But it is from a business which is controlled from India. Sir, in UK, London, you have a business. But such business is controlled from India only. Then ROR anyhow taxable. Why global income taxable? Non-resident not taxable. But if you are RNOR, even though business outside India, accrued outside India, received outside India, but if it is controlled from India, it is taxable in India. Same profession. Okay, you have started a law firm in UK. You have a law firm in UK, but, or a CMA firm in UK, but it was set up in India. You have registration in India, but you went for an assignment in UK. You did all the work in UK. Your fees also paid in UK, but your profession is registered where? India. Okay, your firm is located where? Your professional firm and all is in India. So for a particular audit, you went to UK. There only the audit consignment, everything is made. I mean, the audit is done, everything done. The fees also paid there only. But still, your profession is set up where? India. So then for ROR it is taxable. Even for RNOR also it is taxable. But for NR it is not taxable. The last one, sir. Accrued also outside India, received also outside India, no this business link or professional link also. Then it is taxable only to ROR, not taxable to RNOR and non-resident. Okay. Then if any past untaxed incomes are brought to India, they are not taxable in current previous year. Past untaxed incomes brought to India, they are not taxable in current previous year. Fine. Then next one is about deemed to be accrued in India, deemed to be received in India. So what is called deemed to be received in India? You didn't receive money actually, but still the money is being used for your benefit only. Then that is called as deemed to be received in India. Sir, employer contributing to PF account of employee. Did he give the money directly to employee? Employer contributing to the PF account of employee. Did he give money directly to employee? No. But for whose benefit? That means that is also income to employee. Na? He cannot say like I didn't receive. Na. Even though he didn't receive, it is for his benefit only. It is considered as what? Income deemed to be received. Income deemed to be received. Okay. Now, same way we are thinking of what? Income deemed to be accrued in India. So this first and seventh point we'll discuss last. First this 2, 3, 4, 5, 6 will complete because these are like easy only. First 2, 3, 4, 5, 6 will complete quickly. Income deemed to be accrued in India. What? Income from any property, asset or source of income in India. I already said example. Donald Trump has a house in India. From that house he is getting rent. Since the property is in India, source in India only. Or else he has became partner with Mowgli and they both started a business here. Okay. Now again, he is giving Donald Trump's share of profit also. Okay. When Trump receives his share of profit from India, okay, where the actual source is located, India. That is also what deemed to be accrued in India. Then income from transfer of capital asset in India. We said that house na for rent, that house sold. Okay, that house is sold to whom? He sold it to Putin. Putin is from where? Russia. Okay, so one non-resident sold to another non-resident, but there is capital gains. Okay, whether the capital gains taxable or not? Taxable only, sir. Why? Because ultimately the capital asset is located where? In India. Okay, because the capital asset is in India, it is taxable in India, deemed to be accrued in India. Next, salary earned for services rendered in India. Salary earned for services rendered in India. So, what is his name? Bharadwaj, sorry. Okay. Salary earned for services rendered outside India. Okay, so Vaishnavi worked in India. So like, she's a government employee, she worked in India. After retirement, she went and settled in US. Okay, with her kids, she settled in US. But still she is getting the pension income from Indian government. Okay, okay, so still she is getting what? Pension income. Sir, pension income currently she is receiving in USA. I mean, the pension. But whether for residing in US she is getting pension? No, for the past services she did in India, she is getting pension now. But still that pension is taxable in India because it is deemed to be accrued in India. Next, fifth one, sir. Bharadwaj, like Durandar, he went as a spy. Okay, like Durandar, he went as a spy. Now, for him, if salary has to be paid, who will pay? Indian government. Where he is working? Outside India only, right? Okay, for monthly expenditure, let's say he is receiving money also there only. Received outside India, accrued outside India, but still, since he is working for Indian government, it is taxable in India only, deemed to be accrued in India. Okay, na Bharadwaj? Okay, even if you go like Durandar, you do so many things, but still income tax will not leave you. Salary payable by government to Indian citizen for services rendered outside India. Then, dividend paid by Indian company outside India. So, because it is ultimately Indian company, the share is in India, so it is considered as what? Deemed to be accrued in India. Here share is there, here property is there, from that property capital gain is there. Salary paid outside India, but for the service rendered in India, salary payable by government of India. Sir, not only this spies and all, there will be in every country, Indian embassies will be there. So, there will be Indian ambassadors working there. For them, they are working where? Outside India, receives where? Outside India, but still paid by government of India now, so they are considered as what? Deemed to be accrued in India. Okay. Now, income accrued by way of business connection in India. So we need to check whether business connection has been established or not. If business connection is established, then through such connection, whatever the income earned, that is considered as what? Deemed to be accrued in India. Understand, sir? If through business connection, or if business, first we need to check business connection established or not. Yes, established. So then from that connection, any income earned, that will be considered as accrued from where? In India only. So if it is accrued in India, it is taxable. Okay. See, what is business connection? Can be established when a person is acting on behalf of non-resident. For that non-resident, here one person is acting on behalf of him. Okay. Non-resident is outside India, and the person acting on behalf of such a non-resident is a resident. Something like he is acting as a agent. So for a non-resident, a resident is acting as an agent. Okay. What resident will do? He habitually concludes the contract. This resident in India only finalizes the contract. Concludes means nothing but finalizing the contract. What this non-resident has to do, everything will be finalizing by whom? This resident only. Then habitually plays principal. Okay, he will directly not finalize, but he will place the principal role in finalizing the contract. I mean, he can influence the other non-resident whether to materialize that contract or not. He can only decide. Then business connection established. Even though he cannot finalize, he plays principal role in finalizing the contract. Okay, third one, he will not decide the contract, but he maintains the stock and delivers on behalf of non-resident. This agent will maintain stock of non-resident and delivers if anyone comes. So Tesla wants to sell cars in India. Okay, now it has tied up with a person in India where what happens? The cars will be, okay, now to whom the Tesla car has to be sold, decided by this person only, this resident only. Then what? Business connection established. Second one, that this resident person cannot decide, but at least he can convince the non-resident saying like, no, this person is a good guy, for him we can sell and all. So like that if he can convince, then playing principal role. Third one, he will not decide to whom to sell and all. That is the role of Tesla only. But this person has stock of Tesla cars. Then someone comes now, then he will deliver the Tesla car. So then also he is like what? Habitually maintains. What is called habitually? Regularly they have to do, not like occasionally 1 or 2 transactions. Regularly they do that like that. Okay, maintain stock and delivers on behalf of non-resident. Then habitually secures orders wholly or mainly. Habitually secures, not like occasionally, sir. Every day habitually they'll secure orders wholly or mainly. Okay, if this happens, then that is called as what? Business connection. Further, business connection can be established in this case also, sir. Mr. A is a non-resident. He controls Mr. B, or Mr. B controls Mr. A. Now what? A is non-resident. For him, Mr. L is acting as an agent. Okay. Between these two also business. Okay. Sir, actually, between A and L there is business connection. But A controls B or B controls A. Nothing but this is holding company, this is subsidiary company. If you have business connection with holding, then they can say like what? Even business connection is established with subsidiary. If a person is having business connection with subsidiary, then we can say like even with holding also business connection is established. మీరు హోల్డింగ్తో బిజినెస్ కనెక్షన్ ఉంది అని ఎస్టాబ్లిష్ చేస్తే సబ్సిడరీతో కూడా ఆటోమేటిక్గా బిజినెస్ కనెక్షన్ ఉన్నట్టే. ఆర్ ఎల్స్ విత్ సబ్సిడరీ వీ కెన్ ప్రూవ్ దట్ దర్ ఇస్ బిజినెస్ కనెక్షన్, దెన్ ఈవెన్ విత్ holding also we can prove that there is business connection. In simple, when business connection is established with one company in a group, then business connection will be established with the whole group. Understand? Then business connection can be established through significant economic presence. Sir, Meta is there. Meta, is it operating in India or not? Meta has business in India or not? You know Meta company? What? Instagram, WhatsApp, Facebook, all this belongs to whom? Meta. Okay, so now we are using them or not? They're earning revenues from here or not? But did they need to be physically present in India? Did they need to conclude any contracts here? Did they require any agent here? Did they have to, someone should be there to play a principal role here? No. Did anyone has to maintain stock for them? No. Did anyone secure orders for them? No. So nothing is there. So they themselves bring orders for others. They need not to get orders. So now if that is the case, Meta, US company, earning so much of revenue from India also, but still it will become what? Non-resident, and this income doesn't have any physical connection here, so it may escape from taxability. That's why what they said. They said like business connection can be established even through significant economic presence also. What is significant economic presence? Significant economic presence means transaction related to goods, services or property carried out by a non-resident with any person in India, including provision of download of data or software like Netflix, all this. Okay, transaction related to goods, service or property carried out by a non-resident with any provision in India. So we have the option like what? Provision of download of data or software. So they are having business connection. We can say like when their total payments are like more than 2 crores from India in previous year, then we can say like they are having business connection in India. Netflix kind of. Then transactions where systematic and continuous soliciting of business activities will happen. Sir, Instagram will not solicit once in a while. Always you'll be getting ads or promotions only. YouTube, you'll be consistently getting the ads only. Okay? So transactions where systematic and consisting soliciting of business activities are engaging in interaction with users in India, like what? Insta, YouTube. When the total number of users are like greater than 3 lakhs. From India, the users should be more than 3 lakhs. Then that app, we can say like having significant economic presence in India, so there is a business connection. Or like Netflix kind of apps. Okay, when they can generate more than 2 crores revenue in India, then also we can say like what? They are having significant economic presence, they are having business connection in India. Then, in case of non-resident, following not to be treated as business connection. What? Purchase of goods in India for export. Purchase of goods in India for export. So, okay, you just buy goods in India and export them. That is not business connection. You buy goods and export. When it is business connection, when procures orders from here, when delivers goods from here. Okay, sir, these 2 points you can link with PE concept also. What is PE? If it maintains stock, not a PE. If it arranges the stock, not a PE. But it delivers the goods, it's a PE. Okay, so the same way sir here, and their PE also, if it purchases goods, it is not a PE. Same here, if it purchases goods in India for export, it is not business connection. Collection of news and views. Sir, Navneet is a BBC reporter. Whatever happens here, that will be BBC, you know, right? British Broadcasting Network. Okay, so across the globe, it has presence, right? So he's a reporter of BBC. Okay, so he covers the news here, news views covers here, and then give it to the BBC where it will be telecasting across the globe. So now what happens? Is it whether such news reporter connection can be called as business connection? No. Collection of news and business in India from a transaction in India is not what? Business connection. Then in case of business where all the operations are not carried out in India, there is a business, sir, but part of the work is done in India. Then we cannot say like since part of the work is done in India, total business is related to India, business connection is there and all, you cannot argue. Only to that part, to that extent where business is done in India, that part only we can say like what? Business connection is in India. Then a Hollywood movie came to India and shooted for some 10 days. Just because it is shooted for 10 days, we cannot say like the film is having a business connection, that film income is considered as deemed to be accrued in India. Okay, sir? So what? That shooting of cinematographic films is not a business connection. The last one, activities confined to display of diamonds. Here an exhibition is kept. So the foreign exhibitors came and they just exhibited their diamonds. Okay, because of that exhibition, they got some orders. We cannot say like it is business connection. Okay, these 5 points are not business connection. What? You buy goods here and export, not a business connection. You collect news or news will be transmitted here, not a business connection. Third one, business, a part work is done in India. Then to that part only business connection, not to the whole business. Fourth one, film shooted for a few days in India. We cannot say like the business connection is in India for that film. Sir, if there is business connection, we can say like it is deemed to be accrued in India. If it is deemed to be accrued in India, it is taxable to everyone. Then activities confined to display of rough diamonds in India. Okay, when there is a display of rough diamonds in India, then that is also called as what? Called as, it is also not called as business connection. Then gift. A non-resident or a foreign company or a resident but not ordinary resident. If he receives any gift from resident, non-resident getting a gift from where? Resident. Resident given money without consideration to non-resident, foreign company, resident but not ordinary resident, and the aggregate of amount is more than 50,000, then such gift is deemed to be accrued in India for non-resident, foreign company, resident but not ordinary resident. You are in foreign country only, but you got gift from where? India, resident of India, then that will be considered as what? Deemed to be accrued in India only, and that gift is taxable in India. The last one, sir, important. We completed the chapter, sir. The last point, this one. Interest, royalty, fee for technical service. Interest, sir, simple. If it is paid, interest, sir, understand this point very clearly. Any of these three, interest, royalty, fee for technical service, paying to non-resident. I mean, non-resident receiving interest, royalty, fee for technical service. Our point is what? Whether for non-resident, this interest, royalty, FTS has to be considered as deemed to be accrued in India or not. If deemed to be accrued in India, they are taxable. If the amount is being paid by Government of India paying interest, royalty, fee for technical service to a non-resident, then all those amounts will be considered as accrued in India only. They are taxable in India for non-resident. Understand, sir? US has given loan to India. On that, Indian government is paying interest. Now that interest is considered as where accrued? In India only. Understand, sir? If it is paid by Government of India, interest, royalty, fee for technical service, if it is paid by Government of India, it is considered as what? Deemed to be accrued in India. So Government of India done. If it is interest, royalty, fee for technical service, recipient, non-resident, always it is what? Deemed to be accrued in India. Resident paying. Sir, I am paying interest, royalty, fee for technical service to a non-resident. Then when it is deemed to be accrued when used for other than business outside India. So this other strike off, other than strike off, then the meaning will come correctly. You took loan from non-resident, but that money, if you use for anything in India, to non-resident taxable. You took copyright, you took some trademark, used in India, then the royalty you will pay is taxable to non-resident. You took any service, and the service is going to be used in India only, then the amount you pay to the non-resident is taxable in India. But when it is not taxable, you took loan money, but that loan money you are not using in India. You are using for something in outside India, then it is not considered as deemed to be accrued in India. Sir, I understand, sir. I am resident only, na? Agree? You had doubt that I am resident or non-resident? Navneet, I am resident only, na? Paka? Okay, I am resident. Let's say I took loan from Putin. No Putin? Putin dalida niku? Okay. Trump. Okay, so I took loan from Trump. Okay, so now I have to pay to Trump what? Interest. So I am paying interest. Now the point, whether to Trump that interest is taxable in India or not is the question. Who has given the loan? Me, being resident. Who has taken the loan? Me, being resident. Who given the loan? Non-resident Trump. Now, non-resident Trump will get interest income, whether that interest is taxable in India or not. Okay. When that is taxable to Trump, depending on where I use that money. If I use that money in India only, then the interest will be considered as accrued in India only to Trump. So to Trump, that interest is taxable. But this loan money I used in Dubai. I took loan from whom? Trump. I am resident only. But that loan money I didn't use in India. I used where? In Dubai. Since I used in Dubai, it is not considered as deemed to be accrued in India to Trump. Why? Because ultimately where that money, sir, interest you will get because of loan, royalty you will get because of that underlying trademark copyright, you will get fee for technical service because of the underlying service. So that underlying loan, underlying service, underlying the trademark, where I am using, you need to check. If I used in India, then the consideration paid to non-resident is taxable in India. If I didn't use them in India, I used in Dubai, Australia, somewhere, then it is not taxable to non-resident. Understand, sir, everybody? But if it is paid by Government of India, you need not to check all this. Wherever Government of India used, since it is paid by Government of India to non-resident, it is deemed to be accrued. Sir, we understand, sir? First point, what? Paid by whom? Government of India. Wherever government has used, no problem. It is taxable to the non-resident. Paid by resident, like me or you. If we are paying, what happens? Only when we use that underlying loan money in India, or underlying copyrights in India, or underlying service in India, taxable to non-resident. If you use outside India, then not taxable to non-resident. Third point, sir. This time, Trump given loan to Kim. You know Kim? Navneet. Kim, you know? Oh, North Korea. Okay. Trump given loan to Kim. Both are what? Non-residents only. So why it is relevant? Because that loan money they used in India. Both are non-residents only. But the underlying loan money used in India, or the underlying copyright used in India, or the underlying service used in India, then paid by non-resident, received by non-resident. But still that is taxable in India. Understand, sir? Okay. Correct on that? Other than business outside India. Okay, correct only. Okay. Then the last one, sir. Conversion of an Indian branch of foreign company into subsidiary Indian company. First they started here as a branch. Foreign company started a branch here. But then instead of keeping it as a branch, they thought like create it as a separate company, Indian company, which acts as like a subsidiary of foreign company. Are you able to understand, sir? Coca-Cola came here. First they have kept their branch. Through branch they are operating. But then they thought branch legally and compliances wise it's tough for them. So what they thought? They created a company called Coca-Cola India Private Limited. So in this, who has shareholding? The holding company Coca-Cola will have. Coca-Cola Global will have shareholding. So foreign company engaged in, but here sorry sir, here they covered only banking businesses only, not for others. Okay, foreign company engaged in banking business. What are banking businesses? HSBC, Dutch Bank. We have discussed one day. Foreign banks, we searched also. HSBC. Okay, then other than outside India. Other than outside India, nothing but what? India only, right? Other than outside India means nothing but India. So other than outside India. So it has to be written like this only. So okay, it's like that section wording only. Okay, if I framed the act now, I might have written much more easily like what? Deemed to be excluded when used in India. But they said like what? Other than. Foreign company engaged in banking business through branch. Let's say JP Morgan has a branch in India. But now they thought of what? Instead of JP Morgan running as a branch here, they wanted to start like JP Morgan India Private Limited. Okay, so now what they did? They converted that branch into an Indian subsidiary as per scheme approved by RBI, conditions set by central government. Then the capital gains arising on such conversion is exempted. In workbook, sir, we have this one last question. See, examine reasons whether the following transactions attract income tax India in the hands of recipients under section 9. So this is related to business connection and that interest royalty point. See, a non-resident USA company which did not have PE in India entered into an agreement for electrical work in India. Separate payments were made towards drawings, designs which were described as engineering fee. The SSC contended that such business profit should be taxable in USA as there is no business connection within the section 9. Sir, when any fees is coming like engineering fee, this is nothing but fee for technical service. When fee for technical service is received by a non-resident company where the ultimate working is being carried out. Ultimate electrical work is being carried out there, India. So fee for technical non-resident receiving what? Fee for technical service. We need to check what? If it is paid by government of India, deemed to accrued in India. If it is paid by resident or non-resident, if it is used in India ultimately, then it is taxable in India. Where that work is used? India. So it is what? Deemed to be accrued in India. So it is taxable in India. A firm of solicitors in Delhi. Firm of solicitors in Delhi. I mean nothing but lawyers in Delhi. Engaged in barrister in UK for arguing a case before Supreme Court of India. Sir, these lawyers are from Delhi only, but their firm is where? UK. Now, for arguing a case before Supreme Court of India, a payment of 5,000 was made as per terms of professional engagement. Where they have to argue, sir? Supreme Court, na? So ultimately the work is being carried out there, India. So it is also what? Deemed to be accrued in India. All income accruing whether directly or indirectly through business connection in India here. There was a professional connection between the firm, Delhi and barrister. The expression business includes not only trade, it also includes profession. Therefore, the existence of professional amounts to business connection, it is, hence the amount 5,000 paid is taxable. Then, the amount paid by government of India for use of patent developed by X who is a non-resident. So government of India is paying what? Royalty to non-resident. When government of India paying royalty to non-resident, it is deemed to be accrued in India, taxable. Fourth one, Home Engineering, a non-resident foreign company entered into a collaboration agreement with an Indian company. With what it entered into collaboration, sir? Indian company. And was in receipt of interest on debentures for 20 lakhs issued by Indian company. Foreign company entered into collaboration. And it was receiving what? Interest issued by Indian company in consideration for providing know-how. Sir, first, it's not about interest. It's about what? Foreign company provided know-how. Know-how means what? How to do a product. For that, instead of paying consideration in money, they given what? Debentures. That debenture 20 lakhs is consideration only. Taxable amount only. So that 20 lakhs taxable or not is the question. Ardhamatundandi. Meer fees kattunda debentures icharu naku. Then what happens? That is also consideration. Same here to the non-resident, instead of paying 20 lakhs money, they given 20 lakhs worth debentures. But that is also what? Consideration only, taxable. But we need to check whether it is accrued in India or not. Where the ultimate know-how is used. Business in Pune. So that is nothing but what? Where any interest, royalty, fee for technical service paid by a resident, where that is used for any purpose other than business outside India, then it is taxable to non-resident. So that's why it is also taxable to non-resident. Okay. This one done, sir. Yesterday, I asked you to solve one question. Which question? Techno Limited, a German company, received 4.5 crores in previous year 25-26 as fee for technical services from Krishna. How much it received, sir? 4.5. Under an agreement approved by central government. Expenses incurred are like how much? 35 lakhs. Evaluate when it has a not have a PE, it has a PE. Sir, not having PE, then 115A. When has PE, 44 DA. Okay. When it is having not having a PE, so we'll take what? Gross amount 4.5 crores. No expense is allowed into 20%. Any other information is there? Expense. Okay, fee from technical services from Krishna, what 4.5 is that? Fee from technical services from other Indian companies under approved agreements. So total income is not 4.5, sir. 4.5 plus 2.8. Total how much? 7.3 crores. Tax is how much? 20%. 1 crore, 46 lakhs. This is done. This is what? When it is having a, not having a PE. When it has a PE, then what? We should calculate normally. What is the income again? 7.8 crores. From their expenses, 35, 30. Then expenses not wholly and exclusively for PE, not allowable. Amounts paid by PE to head office, not reimbursement of actual, then this is also not allowable. So only these two, 65 lakhs only allowable. 7.8 minus 65 lakhs. So 7.8 minus, sorry, 7.3 minus 65. The total income is how much? 6 crore, 65 lakhs. Taxable income is 6 crore, 65 lakhs. Sir, it is a company, sir. Techno Limited, foreign company. What is the tax rate? 35% plus surcharge at a rate of 2%, because for foreign company total income in excess of 1 crore 2%, excess of 10 crores 5%, 2%, then tax plus surcharge, then sir, you'll get the total tax liability. Okay, so we have discussed every model of question from NR taxation. NR is easy. The chances of asking questions like the last question, if you see from that interest, royalty, fee for technical service, business connection point, they can ask a question. Then from active business outside India, they can ask a question. That poem related, 2 areas. Chapter 12A we see anyhow frequently being asked. 115A, that special right series, presumptive series, 5 areas here. Residential status of individual and all they may not ask, but these 5 areas important, sir. Once you revise, then it will, 1 or 2 times only, it takes time, then it will be easy only. Once you learn these questions, they are not having much twists and all. So easily only you will get 7 out of 7. Okay, so business restructuring, NR taxation, these topics you don't skip. And my advice is like, whether you are doing single group or both groups, give every day 45 minutes for DT irrespective of your schedule. Okay, irrespective. Sir, I think like to clear CMA final, 3 subjects are key. DT, SFM, CFR. Or anything is there. Most 3 key subjects are like DT, SFM, CFR. If these 3, if you get 50s now, then mostly, in a exceptional case, but mostly your group will be clear. If in these 3 subjects you will not get less than 50 means, you'll get more than. If these 3 subjects only you are getting 60s now, then nobody can stop you also. Okay, so the point is these 3. So what I'm going to say is like, in DT, the problem is like, you read 4 days now, and after 1.5 months again, if you open DT, you'll not remember anything. So DT requires regular revision. You cannot come out of it. So okay, every day you should be revising something from the DT. So what you do, every day 45 minutes. You may keep like 3 days, 4 days for that also, and in a day, every day keep 45 minutes separately for DT. So that 45 minutes, 1 chapter you revise every day. Okay, so initially you may not cover even 1 chapter also, but give it like 2-3 days also. So okay, today let's say like this, that for particular time SFM is going on, but still 45 days, first you give the first 45 minutes in a day for DT only and revise. Okay, it may take 2 days, 3 days initially for every chapter to complete, but once one cycle is completed, then your time will get reduced. Okay, so you can effectively do more revisions. Okay, just because you are allocating 45 minutes a day, don't skip that giving 3 days or 4 days cumulative revision DT time also. That also should be there. Then what happens? Every day you are revising, you'll remember it, and with these cumulative revisions, you can form again connections also. Then you're gonna get good marks. Okay. So if you could manage time now, even SFM also do the same thing, CFR also. So every day, if you're going to study for 12 hours, 2 hours for this 3 revision only, 2 hours. Then the balance 10 hours you do with the other subject. So okay, so that's going to be the plan, which I think it's going to work. Advanced tax and interest. Sir, it's a simple chapter, sir. But basics wise, you should be correct. So once those basic points you will understand, then this chapter is going to be very easy. Advanced tax is nothing but tax for an assessment year related. For every, sir, usually we'll assess and pay tax in assessment year. But for an assessment year, if the tax is paid in the preceding financial year itself, sir, assessment year 26-27. For the assessment to be done in 26-27, tax is paid in which year? 25-26 only. Then we call it as what? Advanced tax. Nothing but in simple, in previous year itself, you pay the tax. Then that is called as advanced tax. Understand? But they didn't say like in the previous year itself when the tax is paid, it is called as advanced tax, like that they didn't say. With respect to where the tax is paid in the preceding financial year to assessment year, then such a tax paid is called as advanced tax. But preceding financial year to assessment year is nothing but called as previous year. So in the previous year itself, when you are earning income itself, when you are paying taxes, then that is called as advanced tax. So okay, advanced tax, TDS, all these concepts are like with an intention like pay as you earn. Instead of earning now and paying it in the subsequent years, the advanced tax or TDS whole objective is like pay as you earn. Since you are earning in the current year, pay tax also in the current year itself so that your burden will be reduced. Okay, how? Again, sir, self-assessment tax, which we pay in assessment year, you need to pay everything in as a lump sum. But because of advanced tax, instead of paying everything at once, you have the flexibility to pay it in installments also. So instead of mobilizing the total tax money at once, you can make it in installments. Okay, so that's why the concept of advanced tax has been introduced to make sure that an SSE is paying tax as he earns. So now section 208. SSE is required to pay advanced tax when the liability for advanced tax is more than or equal to 10,000. When your advanced tax liability is more than or equal to 10,000, then such person has to pay advanced tax. Okay. However, SSE shouldn't be a resident senior citizen and not having. SSE is not a resident senior citizen, sir. Why? There is an exception here, sir. What the exception says means, if SSE is a resident senior citizen and if he is not having PGBP income, then he is exempted from advanced tax provisions and all. When sir resident senior citizen and he doesn't have income under that PGBP, then even though his advanced tax liability is more than 10,000, for him advanced tax provisions are not applicable. So to whom advanced tax provisions are not applicable, sir? Resident senior citizen plus not having PGBP income. For rest all, the advanced tax provisions are applicable when the advanced tax liability is, sir, not tax liability. Advanced tax liability is more than 10,000. So how do we calculate advanced tax liability? First, based on estimation of income of the current financial year. So because you are still in the current year only. When you have to pay advanced tax in assessment year, previous year only. Previous year. Sir, in previous year, you don't know how much income you earn now itself. You can just make an estimate only. So based on your estimation of current income, you have to calculate tax. Then from that tax, if any relief is there, TDS already got deducted, TCS, MAT, AMTs are there, adjust. Then that final liability, estimated liability you will get, right? That's called advanced tax liability. If such estimated advanced tax liability is more than or equal to 10,000, then you have to pay advanced tax, or you have the requirement to pay advanced tax. Otherwise, you are exempted from advanced tax provisions. Okay. Once again, sir, applicability of advanced tax. When it applies, when the advanced tax liability is more than 10,000. However, if SSE is a resident senior citizen and he does not have PGBP income, okay, it applies when SSE is not a resident senior citizen. Here, this not has to be stricken off, right? So no, then the sentence itself will go wrong. SSE, sir, it has to be better presented in such a way, in this way only. Except SSE is resident. నువ్వు మాట్లాడుకుంటా తొందరగా. SSE is a resident senior citizen, not super senior citizen. And not having PGBP income. So this is correct framing, sir. You understood, right? For whom advanced tax provisions are not applicable. If he is a senior citizen, resident senior citizen, and he is not having PGBP income, then advanced tax provisions are not applicable. Sir, resident senior citizen only having PGBP income, then advanced tax provisions are applicable. Except, it is an exception. Exception means for him, advanced tax provisions are not applicable. Just because he is a senior citizen, he is not exempted from advanced tax. He should be senior citizen and shouldn't have PGBP income. Then he is exempted or he is excluded from advanced tax provisions. That's the correct way. So previously also I mean that only, but the sentence doesn't give the exact meaning. So this gives better meaning. SSE is required to pay advanced tax when his liability for advanced tax is more than or equal to 10,000. Exception. Exception means the above rule is not applicable to whom? If he is a senior citizen and he does not have any PGBP income. Okay. Then how to compute advanced tax liability? Advanced tax liabilities has to be calculated based on the estimation of current incomes. So currently you need to estimate how much incomes they're going to have. And on that estimation, you need to first find out tax liability. From that tax liability, if there is already any TDS there, TCS there, MAT credit is there, IMT credit is there, any relief is there, adjust all of them. After adjusting them, the liability will get right. That's called advanced tax liability. If such amount is more than or equal to 10,000, then we have the requirement to pay advanced tax. Okay. Sir, advanced tax need not to be paid in one go. It can be paid in 4 installments. What are those 4 installments? Sir, what are the months the quarter ends generally? In which months the quarter ends? June, July, June, September, December, March. June, September, December, March. June 15, September 15, December 15, March 15. These are the installment dates, not the quarter end date. Quarter end months, June, September, December, March. In this month, 15th, June 15, September 15, December 15, March 15. Right. Then how much of advance tax has to be paid? 15, 45, 75, 100 percentages. 15% of the advance tax, 15% of the liability, tax liability has to be paid by 15th June. 45% has to be paid by 15th September. 75% of the liability has to be paid by 15th December. 100% of the liability has to be paid by 15th March. If you can correlate again to present to scheme, there we said like if SSE opted for 44AD, 44AD applies to whom? Any resident individual, firm, HUF, sir. They shouldn't be carrying out commission business or GTA. For all of them, presumptive taxation is applicable. 44ADA is applicable for notified professionals. Who are notified professionals? Accounting, medical, legal, engineering, interior decoration, technical. Their turnover should be within 50 lakh. So for those people, we discussed that. If you remember, we discussed like a table, 44AD, ADA, AE. There we wrote like for 44 AE, 4 advance tax installments applicable. 44 AE. AE means what? SSE engaged in plying, hiring, leasing of goods transport vehicles. But for AD and ADA, 4 installments are not applicable. Only the 4th installment alone is applicable. That means they have to pay. If you have opted for 44 AD or ADA, you need not to pay 15% by 15th June, 45% by 15th September, 75% by 15th December, but you should pay 100% by 15th March if you have opted for presumptive scheme. Okay, only one installment, that also when 15th March of previous year one is applicable. Then, sir, this is the year starting date. First installment is what? 15th June, 15th March, 15th December, sorry, 15th June, 15th September, 15th December, 15th March. But still, 15th March to 31st March is also still preceding financial year to assessment year only, right? Now I paid tax within the 16 days. I mean March 20, March 22nd. Then is it not called as advance tax? That's my question. Assessment year 26-27. For assessment year 26-27, this is preceding financial year only, right? So I didn't pay it by 15th June, by 15th September, 15th December also not, 15th March also not. But I paid in the 16 days period. Still is it called as advance tax or not? Yes. Anything, again, go back to the first point. Any tax paid in the preceding financial year itself is called as what? Advance tax. Okay. So even if you pay in 15th March to 31st March, that part is also called as advance tax. But since you didn't pay it within these timelines, you may get interest. But the tax paid in the 16 days period also still be called as what? Advance tax only. But for non-fulfillment of these deadlines, you may get interest. But still, here within the 16 days, whatever the amount you paid also still called as what? Advance tax. Whether paid by due dates of installments or not, if it is paid in preceding financial year, it is called as what? Advance tax only. It is called as advance tax. Then section 219, what does it say? If any advance tax is paid, that can be taken as credit and could be adjusted on payment of self-assessed tax. Sir, you already paid advance tax in the year as 2 lakhs. Your self-assessed tax is 3 lakhs. It doesn't mean again you will pay another 3 lakhs, right? What you will do? While paying the 3 lakhs, you can adjust this advance tax 2 lakhs as credit and the balance 1 lakh only you'll pay. So section 219 says that one only. Whatever you paid as advance tax, that can be taken as credit and can be adjusted with self-assessed tax or the regular assessed tax. Okay. Now, sir, we are into interest. So interest, sir, 234A, 234B, 234C. Mostly from this chapter, if they ask question, that could be from 234A, 234B, 234C interest calculations. To do 234A, B, C interest calculations, first you should be sure about tax calculations. When you are good at tax calculations, then you will be learning like interest calculations. So now I'm expecting like what? You already know. You're experts in what? Tax calculations. We are now learning what to calculate 234A, B, C interest, because this interest has to be calculated on taxes only. Okay. So why 234A? Where the return is not filed by due date. What are the due dates? Go back, open returns first chapter and then at least tell. Okay. If you can recall, fine. If you couldn't recall, go back to the chapter. And then at least now revise once again and tell the due dates. First one. 31st July for whom? Others. So if anybody asks a question, first we'll tell others, specific others. First itself if you say others, now who are those others? For companies and for other SSEs to whom tax audit is applicable. What is the due date? 31st October of assessment year. Then for any person, transfer pricing provisions are applicable. 30th November of assessment year. Now you can say others. Okay. So now who can be under others? Individual and HF or AOP, BOI, AJP for whom tax audit is not applicable. They have to file the return by 31st July. Okay. So next again under 31st October, if to firm tax audit is applicable, then to the partner also, even though for partner individually no tax audit, but since for firm tax audit is applicable, for partner also the due date is what? 31st October of assessment year, right? If you couldn't file the return by those due dates, then you will have 234F late fee. 234F late fee will be there. Okay, that is anyhow common. Additionally, other than late fee, there will be even 234A interest also. 234A interest. Either you filed belatedly or not yet filed also. Okay, for non-filing or delay in filing. Asal file then also you'll get 234A interest. You filed, but what? Belatedly you filed. Then also you'll get 234A interest. Then 234B. For non-payment of advance tax. What is called advance tax, sir? The tax we pay in the preceding financial year itself with respect to an assessment year is called as what? Advance tax. So if any shortfall of advance tax you paid, for that you need to pay 234B interest. Then what is 234C? Sir, advance tax payment, there are certain installment dates. What are the installment dates? 15th June, 15th September, 15th December, 15th March. By these 4 due dates, you need to pay how much? By 15th June, 15%. By 15th September, 45%. By 15th December, 75%. And by 15th March, 100% you have to pay. But by 15th June, you paid only 8%. How much shortfall is there? 7%. By 15th September, you paid only 25%. 45 to be paid, 20% shortfall. So if there are such kind of shortfalls in meeting the installment timelines, then For that deferment, we'll get 234C interest. 234A is for non-filing or belated filing. 234B is for non-payment of or short payment of advance tax. 234C is for deferment of advance tax installments. Okay, now before going into the 234A, first, when we file a return, how the assessment goes. First, how do the process of we computing tax itself is called assessment. But usually SSE will do himself or with the help of consultant. So even if you take the help of consultant also, it will be counted as who did self-assessment. SSE only did. So SSE, since SSE didn't know, he took help. But still it comes under what? Self-assessment. So first thing is what? Self-assessment. Okay. What is self-assessment? You figuring out your tax liability itself is called as what? Self-assessment. So usually you file return with the self-assessment. You do self-assessment. I mean, on your own, you do calculation and find out your tax liability, and that tax you'll pay, file a return. So at the time of filing return of income, usually we do what? Self-assessment. Okay, once self-assessment is done, then there will be 143 subsection 1 processing. What is 143 subsection 1 processing? Every return filed by default will be taken by the system. Okay, and it get processed once again. What kind of processes? Sir, let me tell you. She's here only, huh? Okay. 143 subsection 1 processing. What is about 143 subsection 1 processing, sir? System itself will verify for certain errors or omissions which are clearly evident to the system itself. Let's say, sir, if it is a belated return, can the losses be carried forward? If it is a belated return, can the losses be carried forwarded? Which losses can be carried forwarded? House property loss, unabsorbed depreciation. But this SSE filed a belated return and carry forwarded business loss. Is it correct? Now, what system will do? Such kind of losses carry forward will be, okay, will not be allowed. Then certain deductions, if you remember deductions chapter, certain deductions are allowed only when the return is filed by the due date, like 80 I series, okay, JJAA, such kind of deductions. But this fellow didn't file return of income by the due date, but claimed such deductions. Then also it gets adjusted by whom? 143 subsection 1 processing. Okay, the system itself will check for these kind of errors. Okay, there is no background check needed. Face itself, you can say that there is some mistake or some error. Second thing. Third one, you claimed ATC deduction as 2 lakhs. Correct or incorrect? Okay, maximum how much we can collect? 1,50,000. Again, that processing also will be done by system only. Okay, then there is the incorrect information. Like at one place you given 1,20,000, same amount, it has to be shown at a different place also. There you given 1,50,000. So same item, but you reflected different values, right? So then that also a error. So such kind of errors will be identified in the 143 subsection 1 processing. No humans involved here. The system itself will directly process each and every return. And if there are differences, it compute as per the differences. Okay, so it will show us both what you computed and what system feels like is correct. With the suggested corrections it is saying, that will be sent to you as 143 subsection 1 intimation. Okay, so usually you have to respond to that within 30 days. Otherwise, that intimation will get final. You need to pay the balance tax also. So that is called as what? 143 subsection 1 processing. We call it as provisional assessment. Self-assessment means what, sir? What we do and file return of income is called as what? Self-assessment. Then through 143 subsection 1, the system do processing, right? That we can call it as provisional assessment. Okay, but not frequently used, sir. Provisional assessment wording and all. But 143 1 processing, which is done by system, we can call it as provisional because that is not final. Even after 143 subsection 1 processing also, again AO can take it for scrutiny. So in scrutiny, what they will do? Again, they will verify the correctness of your records, expenses, okay, incomes you have claimed, everything, correctness they'll verify. Okay, 143 subsection 3 scrutiny. Sir, but you are not cooperating for the assessment. Not cooperating, no, you are not giving any record which they are asking. Then they'll initiate 144, which is called best judgment assessment. Okay, so like that. So how many assessments are there, sir? First time, self-assessment, then provisional assessment, nothing but 143 subsection 1 processing, that is. Then scrutiny assessment, best judgment assessment. Then the stage wise, first stage self-assessment, second stage system level 143 1 processing, which we call it as provisional assessment. Third stage scrutiny assessment. In the place of scrutiny, there could be even best judgment also. 143 subsection 3, 144. Then even after these three also, there could be a fourth one called income escaping assessment. Income escaping assessment. So like this, there are 4 stages of assessment. Fine. The tax we paid through self-assessment, because usually the self-assessed tax is paid through what? At the time of filing return. So self-assessed tax we paid can be even called as returned tax. So okay, along with return, the taxes you paid, okay, is called as what? Returned tax. But whatever the tax that gets finalized in assessment is called as what? Assessed tax. What you have paid as per your computation is called as returned tax or self-assessed tax. What finally it's being determined in 143 subsection 1, 143 subsection 3 and all is called as what? Assessed tax. So ultimately we need to pay which tax? If you pay just a self-assessed tax, is it enough? Ultimately in the final assessment, in the last stage, whatever is finally fixed, that is what you have to pay, right? Okay, so forget about income escaping and all, sir. We'll think or we'll restrict ourselves for these 3 stages as of now. What is self-assessment? 1 stage, 143 subsection 1 processing is second thing. Third one is about scrutiny assessment. Scrutiny assessment. So what they are saying, like, ultimately, if you pay this tax, return tax, is it enough? Ultimately, we should have paid what? This assessed tax only. How much ever is finalized by the income tax officers or AO, that is the final tax obligation or liability of us. So ultimately, what do you have to pay? Assessed tax only. Okay, now see the note, sir. 234A and 234B interest has to be calculated on assessed tax, not on returned tax. Okay, you'll understand much more better, sir, once we go into the concepts and once we start solving the examples also. First one, before going further, rounding off. rounding off, sir, for the purpose of this interest calculation. Sir, there is 890. On 8, here 234A, B, C, all the places, the interest rate is 1% only. If it is 890, if you calculate 1%, how much is the interest? 80.9. So it is coming in paisas. The interest amount is coming in paisas. So they want at least it should be in rupees, not in paisas. That's why what they said, na, for the purpose of interest calculation, either under 234A, 234B, 234C, the total will take right. I mean, the total tax liability will take right to calculate interest. Such a tax liability has to be taken only in multiples of 100. If there are fractions, ignore. Let's say it is like 2,35,460. 2,35,460. That fractions, ignore. Don't round that off to next multiple of 100, sir. If it is in fractions, ignore. 2,35,460. How much we have to take? 2,35,400. 2,35,499. Still 400 only. Here it's not like rounding off kind of. Here it's like ignoring the fractions. See, 1,22,430. Still 400. 450. Still 400. 496. Still will take what? 1,22,400 only. Understand? Okay. So now we are moving on to 234A. Sir, live students are able to follow? Students attending live classes, are you able to follow? Okay, done. Sir, basic 4th class, I think they'll teach us interest formula. PTR by 100. Here also ultimately what you have to do? Interest only. So wherever we calculate interest, the basic formula remains same. Here also we want principal, time, rate. Okay, so rate is 1%. 234A interest. First 234A, when it will attract? For non-filing of return or delay in filing the return of income. What is the rate? 1% per month is the rate of interest. Part month also still will calculate 1% only. So rate of interest fine. 1% per month or part of the month. Okay, are done. Now we want what? Time. So for what period we need to calculate the interest? Sir, 234A attracts in two situations. What are those two situations? One is non-filing, the other one is belated filing. Okay, so in case of belated filing, the period is like always from date after the due date till the date of actually filing. So you should calculate only for this period. From which date to which date, sir? Date after due date to date of filing of return of income. Date after due date. Let's say, sir, individual, no tax audit. By when he has to file? Individual, no tax audit applicability. 31st July he has to file. But he filed on 4th November. 4th November means how many months, sir? August, September, October, 4th November. Part month also has to be counted as full month. So for 4 months, interest has to be calculated. From next day of due date till the date of actually filing, for this period only you should calculate interest. Sir, they may give different combinations. You should check, you should stick to these basic points only. Whether he filed a return either belatedly also or not. If he filed a belated return or not even filed a return. If he filed return at least belatedly or belated return if he has filed, then the interest has to be calculated from next day to the due date till date of actual filing of return. Okay, then return not yet filed. Return not yet filed. Not even belatedly also return not filed. Then how long you calculate, sir? Okay, from date after due date till date of completion of assessment under section 144. Sir, why 144 came? Sir, because you didn't file return. They cannot do 143 subsection 1 processing. How do they can do 143 when you file return? Only when you file return they can go for scrutiny. 143 subsection 3. Okay, if you don't do any of those, if you didn't file return, then 143 1 also cannot be done. 143 subsection 3 also cannot be done. Then they'll do assessment only based on best judgment. That's why here we took it as what? Date of completion of assessment under section 144. Sir, clear, sir, timings? What is the rate of interest first? 1%. Second one, sir, timing. For what period we need to calculate interest? From the next day of due date. In case of return filed at least delayedly. From the next day of due date till the date of actual filing of return. Second one, return not yet filed. Okay, not going to be filed also. Then in such case, next day of due date till date of completion of assessment. Obviously that assessment is under 144 only because ED is not cooperating. Best judgment assessment will only be initiated. So in our formula we got two things. Interest rate we got, time we got, what is required? Principal. Principal now here nothing but the tax liability, the pending tax liability. On that we need to calculate interest. First one. The interest has to be calculated on 143 subsection 1, 143 subsection 3 or 143, 144, nothing but tax on assessed income will take. Then from the tax on assessed income, if you have any TDS, TCS, MAT, AMT or DTAA credit. What is DTAA? Double taxation. If it is a foreign source income and on which outside India also tax paid and India also if you need to pay tax, then you'll get DTAA credit. So from tax on assessed income, you subtract TDS, TCS, MAT, AMT and DTAA credit also. And if any advance tax already paid. Advance tax. Sir, advance tax when you have paid, sir? Assessment year or preceding year only? So that advance tax if any paid, subtract. If any relief is given, that also subtract. So this amount is the shortfall. Okay, let's say, sir, if you filed a return by due date, then no interest at all, right? So if you didn't file return by the due date, then on this amount only we should calculate interest. Understand, sir? On what amount we should calculate interest? Not on the total tax liability, on the total assessed tax liability. From there you subtract if any TDS, TCS, advance tax, MAT, AMT credits are there, DTA credits are there, subtract. If any relief is given, subtract. Whatever is the tax yet to be paid. So that tax money only is the principal for calculation of interest. Okay, we'll take an example. Mr. Shiva, age how much, sir? 45. He's a resident and ordinary resident. His total income is how much? 16,45,000. His total income is 16,45,000. He filed return of income on when? 18th November 2026. But what is the due date? 31st July. So based on this information, we can find out for what period interest has to be calculated. For what period interest has to be calculated? From 1st August to 18th November. How many months? 4 months. So we can we have to calculate interest only for how many months? 4 months only. Then TDS given, advance tax given, and they're asking us to find out what? Calculate 234A interest. And it is under which regime? Default regime. So that means first we should do what? On 16,45,000, what is the tax? On 16,45,000, what is the tax? 1,29,000 plus cess. 1,29,000 tax will come. Plus cess 4% also you add. చిన్న వాయిస్ని అక్క చెప్పింది కదా యాక్సెప్ట్ చేసా. Mr. Shiva, tax liability on 16,45,000. Okay, slab rates if you do, what is the tax, sir? 1,29,000. On this cessity rate of 4%, total is how much? 1,34,160. But he already paid how much? TDS and advance tax. What we said, sir, above, if you see, tax. Sir, you said like tax on assessed income. Sir, for him, no assessment done. Okay, that's why first we calculated on what? His returned income only. Then TDS, TCS, MAT, AMT, if anything is there, subtract. Yes, he has 40,000. 40,000 to be what? Subtracted. What is subtracted? What is the shortfall? 94,160. So this is the 94,160 on which we need to calculate interest. How many months? What is the rate of interest? Okay, calculate until. So what we should have done here first? Can you take 94,160 straight away? Can you take 94,160 straight away? 100 you should take because fractions to be ignored. So you take what? 94,000 into 1% into 4 months. 3,764. So what you have to pay? 94,160 tax, balance tax, because already you paid here how much, sir? Already 40,000 is there, right, as TDS and advance tax. So you need not to pay 1,34,160 because already 40,000 paid as TDS and advance tax. So the tax to be paid is 94,160 plus advance interest is how much? 234, 3,764. So the total liability is how much? 97,924, ignoring B and C interest, 234B and C interest. Okay, clear, sir? At least a bit. Okay, now we are extending this example. Sir, here returned income is 16,45,000. At the time of filing return, you don't know that in assessment your income will increase. So you'll, sir, expect చేస్తారా మీరు? You are filing return when 18th November. That time you don't know that your case will be taken for assessment. In assessment, AO will increase your income. So as of now, at the time of filing return, you feel or you believe your income is how much? 16,45,000 only. Based on that, you have calculated 234A interest. But then what happened? It was taken for assessment. And then in assessment, the total income was finalized as how much? 22 lakhs. 22 lakhs. And the assessment is completed when 2nd March 2027. Assessment is completed when 2nd March 2027. Okay, sir, everybody carefully answer my questions. Ultimately, the interest under 234A has to be calculated based on returned income or assessed income? Assessed income. Okay, so now on 22 lakhs, tell me what is the tax liability? On 22 lakhs, tell me what is the tax liability? First tell tax, then add cess also. 2 lakh without cess, including cess 2,60,000. Correct only. ఏమ్మా ఏంటి మీరు చేయట్లేదంటే నిద్ర వస్తుంది. అదే కదా ఫస్ట్ చెప్పింది మనం. We started with that only, right? Advance tax provisions applicable to every SSE when his advance tax liability is more than or equal to 10,000. As first here, we are not even at advance tax now. We are talking about 234A. 234A is not even linked to advance tax. Hmm. Hmm. But he doesn't need to pay advance tax. Why? Because already total amount is deducted as TDS, right? So when the advance tax, okay, so what I understood is like in the first half of the class, you were not concentrated. See, how do we calculate advance tax here? Advance tax liability, tax on estimated current income. Your salary is, let's say, 20 lakhs. On that, calculate tax minus TDS, TCS, MAT, AMT. If he is a salaried employee, on the total 20 lakhs later, tax will be deducted as what? TDS. If you subtract, here it will become 0. Okay, so the liability is not more than 10,000. So for him, advance tax is not applicable because of this provision, because his estimated advance tax liability is not more than 10,000. Okay, మీరు అక్కడే స్టక్ అయిపోయారు. దాన్ని అక్కడే అడిగేసి ఉంటే ఈ పాటికి applicable only, but it covers under this restriction. So there is nowhere said like salaried employees are relieved from advance tax. They are also under advance tax. But why mostly we don't see salaried employees paying advance tax now? Because their total tax amount will be paid as TDS. Since it is paid as TDS, the total advance tax liability they are having is within 10,000. Mostly 0 only, because everything got deducted as TDS only, right? Okay, salaried employee has salary. He has some business income also. He has IFOS income also. Then only salary related got deducted as TDS. For other incomes, he don't have any TDS deduction. Then here the amount might be more than 10,000. For him, advance tax liability will come. Yes. Clear? Any other doubts you are having? You can do this question right now. లేదా ఇంకా అక్కడే ఆలోచిస్తుంటావా? Okay. So example 2. If the assessed income under 143 subsection 3 for Mr. Shiva is how much? 22 lakhs. On 22 lakhs, what is the tax? 2,60,000 including cess. Now he has to pay actually how much? 2,60,000 only. But this fellow previously paid how much? 1,34,160 only he paid. But actually he should pay how much? 2,20,000 only. Oh, sorry, 2,60,000. But on that advance tax and TDS is there how much? 40,000. So how much is that, sir? 2,20,000. Sir, actually even 234A interest also. 234A interest has to be calculated based on return income, assessed income. Assessed income, because assessed is the final liability, so the interest also has to be computed based on assessed or final liability only. But that means what we did at the time of return filing is wrong. Okay, but at that point of time that is only correct. But now because of the further information, because of assessment, 234A interest has to be again recalculated on what? Assessed income only. Sir, what we did previously is wrong. Okay, so what we'll do with the previous paid and all, I'll explain again. But now the correct procedure is what? You need to compute 234A interest only on assessed liability. Okay, that means what? On 2,60,000, there is already some TDS and advance tax paid how much? 40,000. How much balance is there? 2,20,000. On the 2,20,000, we need to calculate interest. Fine. Then what is the rate of interest? 1%. Now for how many months interest has to be calculated? Please tell. For how many months interest has to be calculated? Assessment completed on when? 2nd March. So now tell. How many months interest has to be calculated? 8 months. Okay? Part months also counted as full month. Right? Mac? 8 months only, na? It's okay. Then you are sleeping. Go back. Read. Return filed or non-filed? Not filed. Return filed. When return is filed, what is the time period we need to count? From the date after due date to the date of filing return of income. Who are you to write income tax? We have to interpret income tax and do whatever is there, right? So what is the time period? They said they are given 2 options. Return filed or not filed. We are under which situation now? Return filed. Now the interest has to be calculated from which period to which period, sir? From the next day of due date till the date of filing of return. So how many months is there? 4 months only. Just because we are computing tax on assessed income now, the period also will not get increased, because in the first case he has filed return. So when he has filed return, the time period has to be there from what? Next day of due date till the date of filing of return of income only. Okay, 4 months related only you need to calculate interest. Understood, sir? Okay. So 2,60,000 from there, advance tax TDS subtracted. 2,20,000 into 1% into 4 months. How much? 8,800. So total is how much? 2,28,800. Sir, if I pay again 2,28,800, na, at the time of return, I already paid certain taxes, right? How much I paid at the time of filing return? 94,160 I paid as self-assessed tax, and 3,764 I paid as 234A interest. Now you can adjust this. Okay, so nothing but, sir, what the mistake you can do is like, from this 2,20,000 only, you might straight away subtract the self-assessed tax paid, and then on the net amount you may calculate 234A interest. That is wrong. Okay, is forget that there is self-assessed tax and recompute again the 234A interest. Once you computed again the 234A interest, then subtract whatever the interest you already paid. See, now 2,28,800, right, total. From there, adjust self-assessed tax. How much? 94,160. And previously paid 234A interest is how much? 3,764. So total, how much you have to pay? 1,30,876 you have to pay. And the breakup of this, out of this 1,30,880, interest element which you are paying now is how much? 8,800 minus 3,764, which is adjusted. Extra 234A interest. Now how much you are paying? 5,036 consequent to assessment. So total 234A interest to be paid is how much? 8,800. But first itself you paid how much? 3,764. If you subtract now, after finalization of assessment, extra 234A interest you are paying is how much? 5,036. So what are the points to be learned? First, at the time of filing return, we'll compute 234A interest based on returned tax only. But afterwards, if there is assessment, then assessed tax is only the final one. On assessed tax only, we have to calculate 234A interest. Sir, we already did now. What we did is no more relevant. Okay, you have to do again on what? Final assessed tax only. Okay, final assessed tax. On that, you calculate 234A interest. But at the time of self-assessment, if you paid anything, that could be adjusted at last on determining the 234A interest on final assessed liability. From there, you subtract interest which is already paid at the time of self-assessment. Okay, so mostly you do 234A interest 2 times. Why? At the time of return filing, we calculate 234A interest with the return income. But once assessment stage, if the income got increased or income got enhanced, then again you recompute 234A interest based on assessed liability. Whatever you paid previously at the time of self-assessment, that could be adjusted when you are finalizing your assessed tax related liabilities. Okay, now then what is the next point, sir? Time period. Just because assessment is done after 9 months, after 1 year, the period for interest calculation will not differ based on assessment dates. It has to be decided in the beginning of the question itself. Okay, what is that? Whether return filed or not filed. If return is filed, at least belatedly, what is the time period we need to take? From the due date, next day of due date till the date of filing of return. If return is not at all filed, then next day from due date till the date of completion of assessment. What is the interest rate, sir? 1% per annum, 1% per month or part of the month also. Okay, now continuation example, sir. Assume Shiva didn't file return of income as per 144. Okay, didn't file return of income, and what is invoked? 144. Why? If you didn't file return of income, then they have to initiate best judgment assessment only. And the total income determined is again how much? 22 lakhs. Assessment completed on 2nd March 2027, whereas due date is what? 31st July, and same advance tax paid 25,000, TDS 15,000. Now what you have to do? There is no self-assessment in this case because first case you didn't even file return. So straight away you will calculate tax on what? Assessed income 22 lakhs. How much, sir? Tax is 12 lakh 50, cess 10,000, total 2 lakh 60,000. From there, adjust if any advance tax and TDS 40,000. So total balance is how much? 2 lakh 20,000. So now, for what period interest has to be calculated? Period. Count number of months. Count number of months until. Sir, August, September, October, November, December, Jan, Feb, March. 8 months. Okay. What is the interest rate? 1%. So 2 lakh 20,000 into 1% into 8 months you do, you'll get how much? 17,600 is the interest. Okay. So now, if you think like you have already understood 234A to an extent, then to test how much you understood, solve this question and come, sir, in advanced tax only. Just if you wanted, in case if you want to test whether you understood 234A properly or not. In advanced tax chapter, question number 4. Question number 4. It's okay. Spend some 20 minutes, 30 minutes time on that question. Try to understand how you have been calculated in different scenarios. Okay. Once you spend time here, then you'll register it much more. Okay. Then 234A interest. So to calculate interest, we need 3 things. What? Principal, time, rate. For 234A interest, what is the rate? 1% per month or part of the month. A part month also has to be counted as full month. So interest rate we have. Then timing. For what period we need to calculate interest? 2 situations are we have what? Return filed belatedly. So return filed in due date, by due date, then there is no 234A interest. So 2 situations are what? Return filed belatedly or no return has been filed. When return filed belatedly, then the time period we need to calculate interest is next day to due date, till the date of filing of return. Next day to due date until the date of filing of return. Then second one, sir, when the return is not yet filed. Then what? Next day of due date till the date of completion of assessment. Next day of due date till the date of completion of assessment. So these time periods will not change. So first itself you can fix by reading the question whether return filed or not filed. If return filed, then the interest we gonna calculate is only for which period? Next day to due date till the date of filing of return. If return is not filed, next day to due date till the date of completion of assessment. Understand? This is what? To time period. Now we need what? The amount on which interest has to be calculated. What is the amount? The tax liability. So return to tax liability we should take. Assess the tax liability will take. Assess the tax. But understand, sir, practically when you are filing return, you don't know the future assessment how it happens. So at the time of filing return belatedly, you will be calculating based on returned tax only. But ultimately, if in assessment the assessed tax is different, then again you should recompute based on assessed tax liability. Whatever you paid at the time of self-assessment can be adjusted. Okay. So see, tax surcharge plus cess on assessed income. From there, subtract if any TDS, TCS, MAT, AMT is there, advance tax is there, relief is there. So this shortfall is the amount on which interest has to be calculated. We solved certain examples also, sir, in the last class. And I asked you to do a question also. Here, due date of furnishing of return. So due date Then date of filing of return. So in first and second cases, return filed or not filed? First and second cases, sir. Filed. Okay, return filed. So we can lock the time period for which interest has to be calculated. In first case, what? Next day of due date to 4th December. Okay, I mean August, September, October, November, December. So in first case, interest has to be calculated only for 5 months. In second case, from next day of due date, November, December, only for 2 months. Whereas in this case, sir, return not filed. Then when the interest has to be calculated till the date of completion of the assessment. So next day of due date, August, September, October, November, December, January, February, 7 months. Okay, interest rate is constant everywhere, 1%, 1%, 1%. So two things we already got. Now we need what? The tax liability only. Okay, see here, sir. Income as per return they given 5 lakhs, 18 lakh 80. Assessed income also given. Sir, ultimately we need to pay interest on returned income or assessed income. So we should consider the first one or second one. So this only we need to consider because ultimately the interest has to be calculated on assessed income. Okay, from assessed income, if any advance tax is paid, subtract. If any TDS is there, subtract. Okay, now you have a question. Sir, tax paid along with return also has to be subtracted. Sir, you are calculating interest till which day? 4th December only, right? This 6,000 paid on which day? 4th December only. Sir, at the time of filing return only, right? This is paid. If you are calculating interest beyond the return date, then for the 6,000 you have to adjust. But you are calculating interest till which day to which day? 1st August to 4th December only. Okay, and this is paid on 4th December. So you need not to adjust it for calculation of interest. Sir, able to understand? So we are calculating interest for what period? 1st August to 4th December. How many months is there? 5 months. On 1st August, sir, what is the total tax liability we are having as per assessed tax? 119 lakh. Assessed income, sir, that's not tax liability. So compute the tax liability, sir, based on assessed income 19 lakh 10,000. On 19 lakh 10,000, what is the tax liability? Quickly. 1 lakh 89,000. Try. One lakh 89,000. So 1,89,280 is payable. Minus TDS. Sir, TDS might be paid by before 1st August itself, right? So we are adjusting. How much? 5,000. TDS 10,000. Advance tax also paid before this date only, right? How much? 5,000. So how much is there now? 1 lakh? 1,79,280. What is this now, Nith? 1,70,280. Yes. Okay. So now they given even tax paid along with return. The tax paid along with return is how much? 6,000, right? When it is paid along with return or it is filed when? 4th December. So that 6,000 is paid on this day here. Okay. So we need to we are calculating interest for this period only. On the day when we are ending the interest calculation, that day they paid. So it doesn't impact our interest calculation. So the 6,000 we need not to subtract. Sir, what if this 6,000 is paid in between? Then you need to calculate. You need to adjust it. For this period, you need to calculate on 1,74,280. And for this period, that 6,000 also subtract and calculate interest again separately. But here, okay, they paid it along with return. Paid along with return. So we need not to adjust it here for the purpose of 234A interest calculation. Everybody, is it clear for you? Okay. So how much here, sir? 1,74,280 into 5 months into 1%. 8,000? 7? Okay, sorry, first rounding off not done, sir. 1,74,200 into 5%. 7? This is 234A interest. Okay, here also 8,710 only should be there. Okay, 714 is not correct. 710 only it should be there. Even in last December 2025 exam also, they asked an MCQ on advanced tax, sir. In that MCQ, they didn't round it off and given the answer. Okay, but there is no answer for see, they given 8,714. That is only the answer available. If 8,710 and 714 both are available, then what will take? 710 is only the right answer. But since 8,710 is not there, then we'll go for what? 8,714 as the interest amount. Okay, so they asked, okay, in the options they didn't calculate it, but with rounding off, without rounding off only they gave it in the option. Sir, here they calculated, why again, sir, here calculated, sir. At the time of filing return, he don't know his liability is how much? 19 lakh 10,000. He'll know his liability as only how much? 18 lakh 80,000 only. So this is as per 140A. So 140A is nothing but called a self-assessment. So at the time of self-assessment, he computed this way. Whereas this is at the time of finalization of assessment. Okay, after finalization of assessment. Okay, sir, we'll calculate even at the time of filing return how much will be the interest also. Again, same interest period, sir. 1st August to what day? 4th December. How many months? 5 months. Sir, based on returned income. What is the returned income? 18,80,000. On 18,80,000, what is the tax liability? $1,82,000. 1,83,040, including cess. 1,83,040, including cess. Vaishnavi, calculated? Do. Minus TDS already paid, advance tax also already paid. So we should subtract what? TDS and advance tax. How much it is? 15,000. How much it will come? 1,68,040. Okay, there is nothing to be adjusted. 1,68,000 only we should take 40 rounding off into 5 months into 1%. How much? 8,400. This is at the time of return you will pay. But finally how much you should pay? 8,710. So what you will do here at the time of assessment? Instead of paying 8,710, already paid is how much? 8,400. So balance 310 will pay as 234A interest again. Sir, got it everybody this one? Okay. Then second case also similar only, sir. Okay, I'll do once again that one also. By when return has to be filed, sir? 31st October. But when it is filed? 28th December. Okay. Sir, what is the assessed tax liability? 5,50,000. Sir, it is a company. Did they mention the tax rate applicable to company? No. So we'll take it as what? 30%. Okay, 5 lakhs into 5,50,000 into 30%. How much? Plus cess. So total 1 lakh. Minus any TDS and advance tax. Yes. How much is there? 40,000 is there. Subtract that 40,000. 1,31,600 into how many months? How much? 26. This is what? On assessed liability. If on returned income we need to calculate. What is the returned income? 5 lakhs. 5 lakhs into 30%, 1,50,000 plus 4% cess. 1,56,000 minus again 40,000. 1,16,000 into 2 months into how much? 2,320. Yes, okay. So this is he'll pay at the time of filing return. But finally he has to pay how much? 2,632. So now again at the time of assessment he'll not pay 2,632. Already paid how much? 2,320. So 2,632 minus 2,320 if you adjust. Final 234 be interest, how much he'll pay? 312. Okay. Then last case. Data furnishing of return. Sir, in the last case, sir, did he file return of income? No. So from when it has to be computed, sir? From 1st August it has to be computed. Till what? Date of completion of assessment. When assessment is completed? 15th February. So 15th February now, how many months are there, sir, here? August, September, October, November, December, January, February, 7 months. Okay, sir, there is no returned income for him. Only assessed income. How much is the assessed income? 18 lakhs. Sir, 18 lakhs and he is an individual only. So again, what? Slab rates only. On 18 lakhs, what is the tax? 1,66,000, including cessa. 1,66,400. Any TDS and advance tax? Yes, 13,200. 1,53,200. So what is the interest now? 1,53,200 into 7 months into 1%. How much? 10,000. This has to be paid. Okay, there is no return related. Sir, understood how to calculate? Okay. Yes. See, assessed income is nothing but the income finalized in assessment. Assessed means not self-assessed. Either it could be 140 subsection 3, I mean like processing of return, or 143 subsection 3, scrutiny. Okay, assessment means not self-assessment here. Return income as per return is only self-assessment. Assessed means the department side did. Either it could be provisional assessment or the final assessment. There might be 2 things also. 143 subsection 1 processing might be given and 143 subsection 3 also might be given. Then you have to do 3 times. Why? At the time of return, first you will calculate based on return income. Then afterwards 143 1 processing done. Then by the time of 143 1 processing, that itself you will think as final. So again you recompute and the self-assessed you need to adjust. Then afterwards if it is again taken for scrutiny, again you have to recompute, taking it as the final assessed tax liability. Whatever you already paid has to be adjusted. Yes. Okay, why I took first assessed income, why can't I take returned income is your question. Yes, you have to do first return only. First మనం ప్రాక్టికల్ గా జరిగేది ఏంటి? అసెస్మెంట్ ముందు జరిగితే రిటర్న్ ముందు జరిగింది. రిటర్న్ ముందు జరిగితే ఫస్ట్ యూ షుడ్ డు రిటర్న్ ఓన్లీ. Yes, Subhash, it's a company. Then sir, we are moving on to 234B interest. Interest for non-payment or short payment of advance tax. When advance tax liability is applicable? When advance tax is applicable, when the advance tax liability is more than or equal to 10,000 and is not a senior citizen, not having PGBP income. If he is a senior citizen and not having PGBP income, then advance tax provisions are not applicable even though liability is more than 10,000. Okay. Liable to pay advance tax. Sir, here we are talking here applicability of 234B interest, not about applicability of advance tax. Advance tax applies when your liability is more than 10,000. Now the question is about 234B interest, whether 234B interest will come or not. 234B interest will come when you are liable to pay advance tax, and advance tax is paid by end of previous year is less than 90% of assessed tax, again not returned tax. Okay, if the amount you paid is more than 90% of assessed tax, the advance tax you paid is more than 90% of assessed tax, then 234B is not applicable. Let's say, sir, returned liability is 80,000, assessed liability is 1 lakh. Returned liability is 80,000, assessed liability is how much? 1 lakh. Okay, for him advance tax provisions are applicable. Sir, what he paid as advance tax is only 85,000. What he paid is only 85,000. Does advance 234B interest will be applicable or not? Applicable. Why? Because on assessed tax we need to check 90%, not on returned tax. Returned tax, if you compare now, he paid more than 100% already. Okay, but assessed tax, if you compare, he didn't pay even 90%. Then what is the shortfall? 15,000. What is the shortfall, sir? 15. So don't compare it with 90%. The shortfall has like up to 90% as the shortfall. Okay, how much is the assessed tax liability? 1 lakh. How much has to be paid? How much paid actually? 85 only. The total difference is how much? 15,000. That is the amount we need to take. Okay, see. Okay, sir, we'll go by order. Interest calculation, we need 3 things: P, amount, tax rate, time period. Okay, so applicability, it is liable to pay advance tax. First, if advance tax applicability is there. Second one, the advance tax you paid is less than 90% of assessed tax, then 234B interest is applicable. What let's say పట్టుకుని ఇంకా నిద్ర వస్తూనే ఉంటుంది. Let's say support ఉంటే. Rate of interest 1% per month or part month, same thing, 1% per month or part month. Now time period. So now you'll get much more better clarity because I given it in stepwise. Self assessment, how you do. When it went to 143.1 processing, how you do. When it was taken for final assessment, how you do. Sir, self assessment. But ultimately, which is final? Assessment 1 is only final. Okay, but self assessment first stage you do because you will not foresee the other things will happen. So first you will lock self assessment itself is the final one and pay. Then 143.1 processing is happened. Then you think that itself is final and do. And later on there is the ultimate scrutiny assessment also done. Then ultimately final one is that. See, when there is a self assessment, you have to calculate 234B interest from 1st April of following financial year, because advance tax means the tax paid in the preceding financial year. Preceding financial year ends by when? 31st March. So that's why from the next day, from 1st April of assessment year, the interest accrual starts under 234B. Then to the date of filing of return of income. In case of self assessment, the 234B has to be calculated from when to when, sir? 1st April of assessment year to the date of filing of return of income. Sir, then 143.1 processing. If it is 143.1 processing, then what? 1st April of following financial year to date of determination under 143 subsection 1. So when the 143.1 is finalized, then in case of 143 subsection 3, 144, 1st April of following financial year to the date of completion of assessment, you need to calculate interest. Self assessment case now you need to calculate only till self assessment. 143.1 processing now you need to calculate till when the 143.1 processing is made and the order is given. If it is final assessment now, when the final assessment order is given, till the date 234B interest has to be calculated. So 234A and 234B are different. 234A, the time period is fixed. Whether you go for 143.1 assessment, 143.4, 143 subsection 3 scrutiny assessment or not, if return is filed, the time period is locked. It will not change. But here, return filed, but still the interest period will be changing, sir. Okay, will be changing. Return filed or not, but the time period will be keep on changing based on which basis you are calculating the interest. At the time of self-assessment, 1st April to self-assessment. At the time of 143.1 processing means 1st April to the day when the processing is completed and determined. Then 143 subsection 3 scrutiny, 1st April to completion of scrutiny assessment. So now what is the, so now we got time period, we got rate. Now what we need? Shortfall. Again, tax on assessed income. From there subtract TDS, TCS, MAT, AMT, DTA credit. You need to subtract. Now this amount you have to check whether it is more than 90% of assessed tax or not. Okay, check advance tax paid is greater than 90% of the amount calculated above. So let's say here it is 3 lakhs. The TDS TCS amounts are some 50,000. So how much you got? 2,50,000. How much you got? 2,50,000. So now in this 2,50,000, in this 2,50,000, you check how much is the advance tax paid now. So let's say the advance tax paid in all the installments together is 2,20,000. 2,20,000. Sir, now this 2,20,000 has to be checked on 2,50,000, not on 3 lakhs. Assessed tax minus TDS, TCS, MAT, AMT, DTA credit, if any is there, subtract them, and on that net amount you need to check whether 90% is paid as advance tax or not. So 2,50,000. So 2.2 by 2.5 lakhs into 100. How much? 80. 8 only, sir. Less than 90%. Now on the shortfall, 234B interest has to be calculated. Check advance tax paid is greater than or equal to 90% of the amount calculated above. Yes, then there is no 234B. No, then 234B continues. Okay, now subtract advance tax paid. How much is the advance tax paid, sir? 2,20,000. Relief, nothing is there. So now what is the shortfall, sir? 30,000. On this 30,000, we need to calculate what? 234B interest. Okay, at the 234B, at self-assessment time, SSE calculates tax on returned incomes, check whether greater than or equal to 90% of tax is paid as advance tax. If not, on the shortfall, calculate 234B interest. At the assessment stage, it could be processing or it could be normal assessment. AO tax on assessed income, checks whether more than 90% is paid as advance tax. If not, on the shortfall, calculate 234B interest. But if any 234B is paid at the time of self-assessment, that has to be adjusted. That has to be adjusted. Okay, sir. So now we can go on solve questions on 234B. Question number 5, sir. Just try. Question number 5. Simple question only, sir. Basic questions on 234B. What is the total final assessed income, sir? The assessed income is 1 lakh original income plus 5,000. So total assessed income is how much? 1 lakh 5,000. Sir, they just asked to compute interest under 234B. So when they ask simply like this, you just straight away go with what? The final assessed related only. When they ask us sometimes to compute how much is paid at the time of return filing, how much is paid at the time of assessment, then you need to do separate workings. Otherwise, ultimately, we have to calculate based on what? Assessed tax only or assessed income only. How much is the assessed income? 1 lakh 5,000. What is the tax on it? Firm, sir, 30%. 1 lakh 5,000 into 30% plus 4% cess. Sir, from when the interest accrual will start here? So we are calculating for based on what? Assessment. When the assessment completed? So here 1st April 26, 29th March 27. So this is what? Assessment date. So how many months is there in between? 12 months. Okay. What is the assessed income? 1 lakh 5,000. On that, what is the tax amount, sir? 32,000 minus. Yes, advance tax and TDS. So okay, first we'll subtract what? TDS, sir. First we'll subtract what? TDS 1,000. How much is there? 31,760. We need to check whether 90% condition has been satisfied or not. What is the advance tax paid, sir? 20,000. So 20,000, 20,000 by 31,760. So it is less than 90% only. Advance tax 234B interest comes into picture. Now what we have to do from this subtract 20,000 advance tax also. How much? 11,760 is the shortfall. So 11,760 into, okay, rounding off. This has to be rounded off to 11,700 into 12 months into 1%. How much? 1,404. So now question number 6, sir. It's okay, so let me explain, sir. Sir, first there is something called order of adjustment of tax dues. In the question he said like what? Self-assessment tax paid is there. So what? How much is the self-assessment tax paid? Okay, let me show you. Sir, see, this is self-assessment related, sir. Self-assessment. SSE filing return of income by paying tax dues along with interest and fees priorly. Okay. Now, if there is a short payment at the time of self-assessment, the amount paid will be first adjusted to fees, then interest, then the balance will be considered as what? Tax. So here, look at the example, sir. 1,46,000 tax is there. Interest under 234A ABC is like some 8,300 is there. Then 234F is another 5,000 is there. So total you need to pay this total. but he paid self-assessment tax as 1,50,000. But now this 1,50,000 will be first adjusted to what? 5,000 fees, then to interest 8,300. Now the balance is how much? 1,36,700. So out of 1,46,000 will be considered as paid only how much? 1,36,700 only. The balance amount which is pending, self-assessed tax is only pending, not interest or fees is pending. Understand, sir? So when any self-assessed tax is paid, it has to be first adjusted with what? Any fees payable. Second with interest payable. Third with the balance tax. Okay, so now considering this. So here first interest has to be started at 1st April. Then till when it has to be calculated, sir? Assessment. Okay, when the assessment is made. In the previous question it is given, sir. 29th March 2027. Clear? Then in between he filed a return. When the return is filed, sir? This is assessment date. This is return filed date. When the return is filed? 30th June 2026. Yes or no? Sir, initially he'll calculate interest only this period, right? What is this period? 3 months. What is this period? 3 months. And this period is how much? 9 months. At the time of return, he'll pay originally for how much? 3 months. Okay. Now, on 1st April, based on returned income, what is his liability, sir? Returned income is how much, sir? 1 lakh. On 1 lakh, what is his tax liability? 31,200. Subtract TDS and advance tax. What is the shortfall? 10,200 is the shortfall based on return. Returned tax is how much? 10,200. Sir, agree everybody? Now, for this 3 months, first we should calculate what? 10,200. Sir, I'll write with the black color so that you'll have color clarity at least. If I do assessed na, then I'll use red color constantly. So 10,200 is the shortfall. On this, we need to calculate interest. 3 into 1%. How much? 306 is what? 234B interest. So total, how much he has to pay? 10,200. Sir, this 10,200 including cess, huh? Including cess only. So plus 306. Now total he has to pay how much? 10,506. But on the return filing day, he paid only how much, sir? 10,200. Okay, 10,200 only paid. So here what I am writing? Total with return, he has to pay how much? Has to pay 10,200 plus 306. But paid only how much? But paid only how much, sir? 10,200. So how do you adjust this 10,200 paid? First you need to adjust with interest. Okay, then first adjust with interest. So how much self-assessed tax is paid? So self-assessed tax paid equals to how much? 9,894 is only the self-assessed tax paid. Correct or not, sir? Self-assessed tax actually the paid is only 9,894 only. Okay, now. So here self-assessed tax paid is how much? 9,894. So by this date they paid how much? 9,894. Now we'll calculate again based on what? Assessed income. Sir, what is the assessed related tax? 32,760. From there again adjust TDS and advance tax. You'll get how much? 11,760. So rounded off to 11,700. Okay. Sir, this has to be calculated till when? 29th March, 12 months. But the total 11,700 is not outstanding for 12 months. After 3 months, you paid some amount from this 11,700. That's why we calculate for the first 3 months separately and for the balance 9 months separately. Are you able to understand, sir? In this 11,700 payable, they already paid 9,894 when? On 30th June. So how can you calculate for the total 12 months? Sir, the basic interest calculation question only, sir. There is nothing tax here. If you on first day of the year 1 lakh is there, sir. In the middle of the year 50,000 repaid. Now for the whole year you will calculate interest on 1 lakh. For the first 6 months you will calculate on 1 lakh. Balance 6 months you will calculate on 50,000. Same here also. On the year starting day, yes, 11,700 is pending. But in the middle they paid how much? 9,894. So for the first 3 months you have to calculate what? 11,700 into 3 months into 1%. How much? 351 has to be paid actually here. Okay. Then again here, sir, how much is pending? 11,700 minus. Sorry, not 11,700, I'll take full amount, 11,760 minus 9,894, subtract. 1,866, round it off to 1,800 into 9 months into 1%, how much? 162. So the total, okay, total 234B interest payable is how much now? Here 350, here 232, here 351, so total equals to how much? 351 plus 232, total how much, sir? Not 232, this is 162. So 351 plus 162 is how much? 513. But already paid how much? Now extra how much? 234B interest has to be paid? 40207. So this self-assessed tax 9894 adjusted na, the tax amount still pending how much? 1866 plus this interest 207 also has to be paid at the time of completion of assessment. This 1866 pending tax and this 207 pending 234B interest. See, this is 207 and here the pending tax liability. Here all 1866. Understood, sir? So simple only, sir, but you'll only make it get confused. It's simple interest calculation sums only. Okay, 4th class basics only. Okay, nothing great here. Okay, as far as I remember, 4th and 5th class only we'll get the formula PTR by 100. Okay, same here. So interest we need to calculate only for the, we'll not calculate for the throughout the year, right? For which year? First 3 months, 11,700 is outstanding. That's why we calculate interest on 11,700. But for the next 9 months, 11,700 is not outstanding. On that, 9,894 is already paid as self-assessed tax. What mistake we do generally? Here instead of 9894, we might adjust total 10,200. We might adjust what total 10,200 because in question they clearly said like self-assessed tax 10,200. But the point to be remembered is they didn't pay 234B interest there. 10,200 plus 306 if they paid, then it might be correct only. But they paid only total 10,200. So the 10,200 first will be adjusted to what? Interest. The balance only will be considered as self-assessed tax paid. So that means only 9894 has been paid. And after adjusting that, still 1866 is payable. On that 1866 again you calculate interest. So total 513. On that 306 already paid. So the balance payable is 207. Okay, everybody understood this one, sir? Okay. So now we are moving on to 234C. 234C, interest for deferment of advance tax installments. 234C is what? Interest for deferment of advance tax installments. Sir, what are the advance tax installments, sir? 15th June, 15th September, 15th December, 15th March. By 15th June, how much has to be paid? 15%. By 15th September, 45. By 15th December, 75%. By 15th March, 100%. What is the minimum? Okay, then for the first and second quarters or first and second installment, sir, they felt like it is too early in the year and sometimes there could be a chance of miscalculating their incomes. Okay. But third and fourth, third installment coming in 15th December. That means almost 9 months completed. So you can reasonably estimate your incomes properly only. But by 15th June and 15th September, it is still complicated. So there may be a chance of error with your estimation. That's why to give you that tolerance for error, they are saying like, yes, 15% is there. But even if you pay 12% also fine. 15% is there. But they are relaxing you and saying like what? Even if you pay at least 12% also, still it will be considered as fulfillment of condition only. In second installment, actually to be paid is how much? 45%. But even if they pay 36% also, it is still be considered as what? Fulfillment of the requirement only. But third and fourth installments, there is no such relaxations. You have to pay 75% and 100%. For first and second installments only, there is a relaxation given. Why? Because the estimations may go wrong in the first and second installment. That's why such flexibility tolerance band has been given to us. Okay? How much you, even if you pay 12% also, you can avoid interest. Even if you pay 36% by a second installment also, you can avoid interest. So these are cumulative percentages. By 15th September, 15th June, cumulatively you might have paid 15%. By 15th September, cumulatively you might have paid how much? 45. By 15th December, cumulatively you might have paid 75. And by 15th March, cumulatively you might have paid 100%. Okay. Now, you need to check here actual tax paid. Actual tax paid by 15th June, 15th September, 15th December and 15th March. Now, sir, if the actual tax paid is meets at least the minimum criteria. If actual tax paid meets at least the minimum criteria, then there is no 234B interest. At least meets the minimum criteria. Sir, here minimum criteria is also 7500 and 100 only. In third and fourth, minimum also 75, maximum also 75. Okay, maximum you can pay more, no restriction. Minimum here 75, here is 100. But here, sir, minimum is how much? 1236. So actual you compare whether minimum is paid or not. If minimum is paid, then there is no 234C interest. If there is no minimum amount also paid, then what? This 15% minus actual is the shortfall. Sir, you may do wrong what? 12% minus actual, you will take it as shortfall. No, that is not correct, sir. You need to do what? 15% minus actual tax paid. If you subtract, then you will get the shortfall. Okay? Understanding, sir? We'll go again as per our standard PTR by 100. Again, we'll go. Okay, now. What is the rate of interest, sir? Here also common. 1% per month or part of the month. Next, the timing. Sir, timing here. Every installment we are checking cumulatively, right? So, in case of first installment, you calculate for 3 months. Why? July, August, September. Leave that month and count another 3 months. July, August, September. Then for again 15th September you are checking cumulatively in here. Again from here another 3 months. October, November, December. Then again in December you are checking, right? Then again 3 months only. Jan, Feb, March. Or sorry, it could be like counted in any way. There is no standard rule there because every 3 months installment is there. First installment you check 3 months. Second installment also you should calculate interest for 3 months. Third installment also you should calculate interest for 3 months. But fourth installment you calculate only for 1 month only. Why not, sir? Sir, from 1st April already 234B started. If there is any shortfall of advance tax, from 1st April already we are computing what? 234B interest. So 234C is only till 31st March. So for this last installment, you will calculate interest only for 1 month only. First 3 months, second installment shortfall also 3 months, third installment shortfall also 3 months. But for the fourth installment shortfall, you will calculate interest only for 1 month. Okay. So time period done, rate of interest done. Now again, what we need to do is like what amount? On what amount we need to calculate the interest? That is only crucial here. Sir, again, for 234A and 234B, we are taking assessed income or returned income? for final determination, assessed income. For 234C, you need not to bother about assessed incomes. 234C computation is only on returned incomes. Assessed incomes will not be considered at all. Even though they're given in the question, assessed will ignore, will only focus on what? Returned income. It's okay. Calculate tax plus surcharge and cess on returned income. Returned income, na, whatever the tax liability you get based on self-assessment. From there, TDS, TCS, MAT, AMT, you subtract. Okay, then you'll get what? Tax on returned income. Okay. So we'll go to a question just right away. With the question only I can explain this. Okay. Come to question number 7. Surya Limited, Bhopal has a final tax liability of how much, sir? 15,60,000. After the financial year 25-26. It has paid advance tax in the following manner. Compute the shortfall and pay 234B and 234C. So first time starting with what? 234C. March is the last date till which you can complete calculate interest. Here it starts from where? Okay, 1st April. Sir, what is the first installment to be checked? 15th June. Okay, 1st April also not needed for me. Straight away I'll start with only 15th. 15th June. June, 15th September, then what? 15th December. Okay, so these are the timelines. Sir, by 15th June, actual to be paid is how much? 15%. Minimum to be paid is how much? Okay, so the 15% has to be paid. Installment to be paid is 15%. Minimum paid 12% is also enough. Sir, what is this returned income? Since there are only one liability, the returned liability is how much? 15,60,000. Is there any advance tax TDS given? Nothing is there. So 15,60,000 is the liability. So 15,60,000. Here, how much should have been paid? Actually, 15% means 2,34,000 is 15%. Sir, if you check minimum, how much they should have paid? 12% means how much? 15,60,000 into 12. 1,200,000. How much is the actual paid? Actual paid is 3 lakhs. Sir, here for this 3 months period, we need to calculate interest rate. 3 months period. So what? Which is higher? Actual higher, 12% higher. Minimum actual is greater than 12%. Yes or no? Actual is greater than 12%. So 234C will come or not? So 234C is not applicable for this particular installment. Yes or no? Then by 15th March, how much would have been paid, sir? 15th September. 15% means how much would have been paid? Sorry, not 15. 45% means how much would have been paid? 7,02,000. Sir, minimum 36% means how much would have been paid? 5,61,600. Whereas actual is how much? 5 lakhs. So now actual greater than 12%, actual less than 12%, 36%. Less than 36%. So what will come? 234C will come or not? Yes, 234C is applicable. So on what we need to calculate? We'll have to calculate the difference between the actual and 45%, not the 36%. Okay, so actual minus and 45, what is the difference here? 2,02,000. So take this 2,02,000 into, how many months we need to calculate interest? 3 months into 1%. How much? 6060. Then again here. Okay, then by 15th March. Then by 15th December, how much should have been paid, sir? So okay, I should write here 15th March. Okay, sir, by 15th December, how much should have been paid actually? 75%. How much is 75% means? 11,70,000. How much is the actual paid? 9 lakhs. So actually is less than 75%. Yes or no? So 234C will come or not? 234C will be applicable. So what is the difference? Shortfall amount? 2,70,000 into 3 months into 1%. How much? 8,000. Okay. Then by 15th March, how much would have been paid, sir? 100%. 100% now how much? 15,60,000. So cumulatively, how much is paid by 15th March? So actual is only 13 lakhs. So how much is the shortfall, sir? So okay, again here also actual only less than 100%. So 234C will applies. So what is the shortfall, sir? 2,60,000 into 1 month into 1%. How much? 2,600. So total 234C is how much? 6,060 plus 8,100 plus 2,600. Total equals to 16,760. Okay. So you calculate quickly 234B, sir, here. Here in the question 234B also asked. So you calculate quickly 234B interest. Sir, written at 90%, 13 by 15.6 lakhs. How much percentage, sir? 83 points. So something less than 90%. So advanced tax provisions are applicable. So what we have to do? Total 15,60,000 minus no TDS TCS is there. But already how much ever is the advanced tax paid, that has to be subtracted. Okay. From there, how much we need to subtract? 13 lakhs. What is the shortfall? 2,60,000. So from when to when we need to calculate, sir? He calculated return on 31st October. So till 31st October, we need to calculate from when? 1st April. So how many months? April, May, June, July, August, September, October, 7 months. So 2,60,000 into 7 months into 1%. 18,200. So question number 7 also done. So in 234C only, sir. Now again coming back. In certain cases, 234C is not applicable. Not applicable, applicable but not applicable. Okay. So it's like little tricky, sir. The point is, when you are having dividend income, can you expect or can you foresee that you will get dividend in the next month or the coming next month? It's not completely in your hands. You don't know when the company in which you invested will declare dividend. That you cannot foresee now itself. Okay, since you cannot foresee now, all your 15, 45, 75% you cannot fulfill. In the same way, when you started having a new source of income from business, okay, when you started having a new source of income, sir, that means you are regularly carrying out a business income. But in the process of business, you got some technological advancement and all. Suddenly your income got rapidly increased and all. Okay, so in such case, you got a new source of income suddenly, which you didn't foresee. So in such cases, you have dividend income, you have new source of income for the first time, and then you have casual incomes. You cannot expect when you will get a lottery ticket, lottery prize, or when you will get a horse race winnings and all. So when you have casual incomes, next one, you have capital gain. So again, capital gain also, we don't plan now itself. And even if you plan also, you cannot plan how much capital gain you will get. It depends on the price and all, right. So these are certain 4 points which we cannot expect in the first quarter or in the second quarter or third quarter until they have been happened. Until you realize them, you cannot expect them. They are going to be happen. Sir, salary now you can expect because every month there won't be drastic changes. How rental income now you can expect. Interest you can expect. In a regular business also you can expect how much could be your turnovers or what would be your growth rate and all. But these are certain incomes which you cannot predict or which you cannot expect that they're gonna come. Sir, how can you don't know that dividend will not come? Sir, dividend will come, but you don't know how much percentage they'll declare as dividend, when they will declare as dividend. That uncertainty is there. Nah? So these are 4 incomes where you cannot ascertain clearly. Dividend income, no new source of income is there for the first time. Casual income is there. Capital gain is there. Then what they are saying? It's not completely 234C not applicable. What they are saying now, on these incomes, for these incomes, so that means, let's say you have capital gain income only in the 4th installment. I mean, it happened only in, let's say it happened only in January. So that means, while checking 15th June, it is not there. While checking 15th September, the capital gain is not there. While checking 15th December, this capital gain income is not there. So what you have to do? First, we'll take the return to tax liability, right? So in that return to tax liability, exclude capital gain related tax. Exclude capital gain related tax and check whether 15% has been met, 45 has been met, 75% has been met. When the capital gain is accrued in February, right? So now while checking 15th March, add even the capital gain also, uncheck 100% has been fulfilled or not. Okay. So till the date such income realizes, you need to check that 15%, 45%, 75% criteria, excluding this capital gain income related tax, excluding this dividend related tax, or whatever these 4 points related tax, exclude and check 15, 45, 75 is meeting or not. Okay. Once it is realized, then even include this capital gain also in the total return income and then again recheck whether in that 75 or 100 it is meeting or not. Okay. So you'll understand once we solve a question, sir. Okay. Let me go into next question. So the question number 7, which we solved, is an exam question only, June 2025. One of the easiest question asked, but don't know how many of the students attempted got 7 marks. So now see question number 8. A Limited made the following payments of advance tax during the financial year 25-26. By June 15, they paid how much? 3.7. By September 15, 3.5. By December 15, 10.5. By March 18, 8.8. Return filed shows their business income is how much? 80 lakhs. Long-term capital gain is how much? 10 lakhs. Okay. So compute interest payable under 234C. Okay. So first, we'll compute their liability first. Excluding capital gain, we'll calculate liability. Including capital gain also, we'll calculate liability. So 2 liabilities we'll do. First one. Sir, is it a company or individual? Company. Since they didn't mention tax rate now, we'll assume as what? 30%. So 80 lakhs into 30% means 24 lakhs. 24 lakhs plus cess at a rate of 4%. Sir, more than 50 lakhs, surcharge will not come. Total income more than 50 lakhs. Individuals only more than 50 lakhs. For company it is more than 1 crore. So what? 80 lakhs into 30%, 24 lakhs plus surcharge plus cess. Total how much? 24 lakh. Then including capital gain also if you do, what is the capital gain, sir? 10 lakhs. Sir, don't assume it as 112A. Since they didn't mention as 112A. Sir, what is the difference between 112A and 112? 112A, first 1,25,000 will not tax. But since they didn't mention, you don't assume it as 112A. So how much? 10 lakhs into 12.5%, 1,12,500 plus 24 lakhs. Sorry, 1,25,000 plus 24 lakhs. Total tax how much? 25 lakh, 25,000. Sir, second what we are doing? First one we calculated, assuming there is no capital gain. Second one we are doing what? There is business income and capital gains also. And then again we are calculating tax liability. How much here? 25 lakh, 25,000 plus cess. Total how much? Total amount. 26 lakh. This is including capital gain. Right. This is not including capital gain. Clear, sir, everybody? June 15th September, 15th December, then we need to check what? 15th March. Sir, by 15th June, we should check what? 15%, 12%, and even actual also. At 15th September, what we should check? 45% to be checked, 36% also to be checked, and even actual. And 15th December, simple, sir, we'll check what? 75% and actual. Here what? 100% and then actual. Okay. So now, what is the two liabilities, sir? Including capital gain, how much? Including capital gain, what is the tax liability we have calculated? 26 lakh, 26,000. So 26.26 lakhs. Excluding capital gain, how much? Excluding capital gain, 24.96 lakhs. Sir, when the capital gain has been realized? 1st December. So that means by 15th December, you know or not? By 15th December, you don't know na, that there is capital gain income. When the capital gain accrued, sir, 1st December. If it has happened on 1st December, don't you know by 15th December? Yes. Okay, sir, change the date, sir. It's not 24, 25. Not even, yes, 25. Not 24, 15th December, 25. It's okay. So now, tell me whether by 15th, sir, 1st December only you got capital gain. By 15th December, you know that you are having capital gain or not? Yes, right. So here in 75%, multiply by 26.26 lakhs here. Why 26.26 lakhs? Because by that time capital gain already arised. Here also 100% into what? 26.26 lakhs. Because by these two dates already capital gain has been arised. But when it comes to 15th June and 15th September, do you know that there is capital gain? No. So that's why what you will take here 15% and 12% multiplied with 24.96 lakhs. Here also 24.96 lakhs. Everybody got it, sir? Clear only now? So by 15th December and 15th March installments, you should take including capital gains amount and compare 75% or 100%. Okay. Now, so now we'll go, sir. So now it is like normal only, sir. There's nothing tricky here anymore. Okay. So how much is the actual paid by 15th June? 3,70,000. How much is 15% of 24.96? 3,74,400. How much is 12%? 2,90,520. 99,520. Sir, by 15th June, we couldn't pay 15%, but at least we paid how much here? 12%. At least paid how much? 12%. So again, actual is greater than 12%, right? Greater than or equal to 12%. So 234C will come or not come? Not applies. Then here. Actual how much, sir? By 15th September. 15th September, how much paid? 3.7 plus 3.5 total. 7,20,000 has been paid. But 45% of 24.96 means how much? 11 lakh 200. But 36% means 8,98,000. Did they pay at least 36%? No. So actual less than 36%. So what happens here? 234C will come into picture. 234C applies. So on what amount, sir? Difference between actual and 45%. How much? 4,03,280 rounded off to 200. 4,03,280 rounded off to what? 4,03,280. Yeah. Sir, here then 7,20,000. Here 11,23,000. Sir, 45% into 24.96 means how much? 280. Yeah, okay. So then why we got some? He said like some. If both the numbers are in hundreds, why you got 80? Dharamteja, you said total something with 80 number, right? If both the numbers are in hundreds only, how you got in tens? What is the total now? 4,03,000. So no rounding off, right? Side away also that one only will be there, right? 4,03,200 into 4,03,200 into how much? 3 months into 1%. How much? 12,096. Again, sir, here actual. What is the actual paid by 15th December? What is the actual paid by 15th December total together, sir, cumulatively? 17 lakh. How much is 75% of 26.2 lakhs? 19 lakh 60. Again, what? There is a shortfall. Actual less than 75%. 234C applies. How much is the difference, sir? 2,24,500 into 3 months into 1%. How much? 6,735. Then at last, by 15th March, how much should have been paid, sir? Total 26.26 lakhs should have been paid. But how much paid? 26 lakh? 25,000. You all will lose marks. Okay, same 17,45,000 only paid even by 15th March also, because the fourth installment is not on 15th March, it is paid on March 18th. So you want only how much has been paid by 15th March. Okay, na? So manaki vachesindana oka excitement the last. So actual 100% means how much you are 26.26 lakhs, whereas actual paid is only how much? 17,45,000 only. So there's a shortfall of how much? Actual less than 100%. So 234C will come into picture. What is the difference? 17,45,000 and 26,26,000. 8 lakh 81,000 into 1%. How much? 8, 10. So if you add all the three, how much is the 234C, sir? 27,641. Fine. Question number 8 also done, sir. Okay, so we have did all the models which are available in the 234A, B, C interest, sir. But one more important question, if you need to try, means it is question number 10. Question number 10 also you should try. So, okay, it gives you much more clarity because it talks about self-assessment, processing, and then even about scrutiny assessment also. Then how do you compute it in all the three cases? You'll get a full clarity, sir. Question number 10, I will not explain now in the class. You have to do it on your own, spend some time on this question, just like as yesterday. Then you'll get more clarity towards it. 143 subsection 1 processing, refund granted. Okay. Or at the time of regular assessment, sir, understand what happened means. First you filed return based on self-assessment. Based on your self-assessment itself, refund will not get processed. Then by default, every return has to be processed under 143 subsection 1. Then if any refund is payable, then the refund gets granted. Okay, refund granted. But afterwards, when it is taken for the regular assessment, 143 subsection 3, either no refund is payable or they came to know that what excess refund has been made. Let's say for example, sir, here 143 subsection 1 processing, the refund granted is 1 lakh. Now after the time of regular assessment, they might have said like no refund is eligible, or else the refund amount is only 20,000. If refund is only 20,000, how much already granted? 1 lakh. So you got excess of how much? 80,000. On that excess amount you need to pay back to the government. SSC has to pay back excess refund. Not only that, has to pay interest at a rate of 0.5% per month from date of refund to date of regular assessment order. Date of refund to date of regular assessment order. Okay, what is the interest rate, sir? 0.5% per month or part month. When any excess refund is granted to you, consequent to assessment, if they came to know that excess refund is given, then on that excess amount you need to pay back, and even interest also on that at a rate of 0.5% per month or part of the month. Then 234E, fee for default in furnishing TDS return or TCS return. Okay, fee for default in furnishing TDS return or TCS return. Okay, so what are the due dates for filing TDS returns first? So to talk about the fee for delay or fee for default, first we should know the due dates, right? For TDS, what are the due dates? Are quarterly only TDS or TCS returns has to be filed. April, June, July, September, October, November, December, Jan, Feb, March. Okay, TDS returns, sir. April, May, June quarter. Next month what? So last day, July 31st. Next. For July, August, September. Okay, October 31st. Then for October, November, December. January 31st. Jan, Feb, March. April 30 only there, na? Then go to May 31st. Okay, na? Sir, again coming back. April, May, June. Next month is what? July. 31 days, na? So take July 31st. July, August, September. Next month is what? October. 31 days is there, na? So take October 31st. October, November, December. Next month. January. So take Jan 31st. Jan, Feb, March. Next month. April. Only 30 days are there, na? So leave April and go for May 31st. So those are the due dates for filing TDS returns. For April, May, June, July 31st. July, August, September, October 31st. October, November, December, January 31st. For Jan, Feb, March, May 31st. Okay. TCS return, sir. TCS return, sir. After end of the quarter, TCS return has to be filed. After end of the quarter, I mean in the next month to the quarter, 15th. April, May, June, July 15th. July, August, September, October 15th. October, November, December, Jan 15th. Jan, Feb, March, April, May 15th. Okay. Only for last quarter, instead of taking the immediate month, we are skipping the immediate month and taking the next month. What is the late fee, sir? For delay in filing TDS return or TCS return, 200 per day, or TDS or TCS deductible, whichever is lower. So the TDS deductible is only 1000, but there's a delay of 20 days. 20 into 200 is how much? 4000. But the TDS 4000. TDS to be deductible is only 1000. So which is lower? 1000. So the late fee is only 1000. Then fee for default in filing statements. What? Institutions or funds covered under section 35. Which institutions are? If you remember 35, will do contributions, scientific research related, to a university, college or association, or to a company which objects are main object is research and development, or to a notified university and all for carrying out scientific research. Those institutions and ATG related funds, charitable institutions. Okay, then those welfare funds and all will be there, right? So those people who got those donations, they have to file a statement with Principal Director General of Income Tax. Not with him, sir. He has a system, so you have to file the statement with Principal Director General of Income Tax. Okay, sir. Why here Director General came? So see, understand here. Here two wings will be there in income tax. One goes with like this, or like Commissioner of Income Tax, Principal Commissioner of Income Tax, Chief Commissioner of Income Tax, Principal Chief Commissioner of Income Tax, Commissioner, Principal Commissioner, Chief Commissioner, Principal Chief Commissioner. This is one way of wing, one way of hierarchy. Then this is another hierarchy, sir. Director General of Income Tax instead of Commissioner, Director General. Here PDG, Principal Director General, Chief Director General, Principal Chief Director General. In the place of Commissioner, they included DG, Director General. Okay, Principal Director General, Chief Director General, Principal Chief Director General. Sir, why two wings? Sir, this wing is the normal assessment wing. Normal assessments will be carried out by this wing of officers. Commissioner, Principal Commissioner, Chief Commissioner, Principal Chief Commissioner. When they need to do detailed investigation, nothing but like search relevant kind of cases. Okay, they know that there is some kind of fraud is there, they need to investigate. Then this investigation wing will be into the picture. So Director General, Principal Director General, Chief Director General and Principal Chief Director General. Okay. So now what here? So institutions funds covered under 35, they'll file a statement with whom? Principal Director General of Income Tax. Then once he files this, sir, then he can issue a certificate to the donor by 31st May. Sir, you have to claim donation deduction, right? To claim a deduction under ATG, you should have a proof that you have made a donation. So for that, first they'll file a statement, then they'll give you a certificate to donor by 31st May of succeeding financial year. If they didn't give a certificate, then late fee is there how much? 200 per day, or amount of donation for which default occurred, whichever is lower. 200 per day, or the amount of default or amount of donation for which default occurred, whichever is lower, is the fee. For why this fee, sir? For not giving a certificate to the donee. Sorry, to the donor, not to the donee. So donor is the one who donates money. The one who takes money is called as donee, not donee. D-O-N-E. Okay. So 234G. Okay. A certificate has to be given by these institutions and funds to the donor by when? 31st May of succeeding financial year. Then 244A. 244A. So 244A is about interest on refund. 244A is about interest on refund. Sir, interest on refund, you paid TDS more or advance tax itself more. Then you are after self-assessment, you are eligible for refund. Then if there is a delay in refund, then you have to get interest on that refund amount also. How much? Sir, first rate is 0.5% per month or part of the month. Okay. Period of interest. Two situations are there, sir. Refund out of TDS, TCS and advance tax. I mean, the TDS, TCS advance tax paid itself is more. Second thing, you paid self-assessment tax more. So wrongly computed and paid more self-assessment tax. That excess paid also has to be given as refund. First case, you didn't pay any self-assessment tax. The TDS, TCS and advance tax paid itself is more and you are eligible for refund. Second case, sir, you paid wrongly self-assessment tax, sir. This part B or this situation will come very rarely because nobody will pay self-assessment tax itself more. But this may come most of the cases. Okay, in AP Telangana, we'll see most of the people. Okay, they'll come for what? Refunds only, TDS, TCS and salaried people and all. They'll come for this. So this is much more frequent. So now what? If refund is out of TDS, TCS and advance tax, we need to check return filed by due data or not filed by due data. If return filed by due date, then first day of assessment year to the date of refund, interest has to be calculated. The period, sir. Refund is because of excess payment of TDS, TCS and advance tax. Then the refund, the interest period is, we need to check return filed within the due data, after due data, within the due date. 1st April of assessment year till the date of refund. If return filed after due date, then date of filing return to date of grant of refund. So if you file return within the due date, from 1st April you will get interest. If you file after due date, then from the date of filing only you will get interest. Then for refund out of self-assessment tax, you should take what first? Date of filing return or date of payment of tax. Out of these two, whichever is later. Date of filing return or date of payment of tax. Out of these two, whichever is later is the commencement date for interest accrual till the date of grant of refund. Tax paid date or return filing date, whichever is later. From there, check till what? Date of grant of refund. So this is the period for which interest has to be calculated. Here, sir, first day of assessment year to date of grant of refund. Here, from date of filing of return to the date of grant of refund. Whereas here, date of filing of return or date of tax paid, whichever is later. From there to the date of grant of refund. Okay. However, sir, if the total refund amount is less than 10% of assessed tax, your assessed tax is 2 lakhs and you are getting refund of some 10,000. Your total assessed tax is how much? 2 lakhs and you are eligible for refund is how much? 10,000. So how much percentage is it? 10,000 is the refund you have to get. Total assessed tax is how much? 2 lakhs. 10,000 by 2 lakhs means 5% only. So since it is only 5%, not even 10% of the assessed tax, you will not get any interest. So to get interest on refund, the refund amount should be at least 10% of the assessed tax. Okay, on the above interest not applies where the refund is less than 10% of assessed tax. So the refund amount should be at least 10% of the assessed tax to get interest. Department can set off this refund amount, sir, with the tax payable. If any other tax payable is there, instead of processing this refund can be adjusted with tax payable. But for that, an intimation has to be given to the assessee. If refund is because of any reason, then interest at a rate of 0.5% from date of payment of tax to date of grant of refund. Interest for failure to deduct and failure to remit TDS. For failure to deduct TDS, sir, the rate of, non-deduction of TDS is different, non-remission of TDS is different. For non-deduction of TDS, sir, interest has to be calculated 1% per month or part of the month. Okay, on what? On the amount on which tax is not deducted. From which one? Okay, tax amount which is not deducted. Period. Date on which it is deductible to the date on which it is deducted. See example, a person fails to, okay, sir, 1st June 2025, 5 lakh audit fee has been paid. 5 lakh audit fee paid. So which section, which TDS section will come? 194J. What is the TDS rate? 10%. Okay, has to be deducted at the time of credit or payment. Okay, both on same day only, assume. So on 1st June, they should have deducted how much? 50,000. But they deducted, TDS deducted only on 18th January 2026. And it was TDS deducted only on 18th Jan 2026, and it was remitted to government. And it was remitted to government on 25th March 2026. 25th March 2026. So here non-deduction is there, and then non-remission also is there. Okay. Okay, first. Sir, from when the interest accrual starts? From the day when the TDS has to be deducted. When the TDS has to be deducted? 1st June 2025. When it is deducted? 18th Jan 2026, the TDS got deducted. For all this period, for non-deduction, we need to calculate what? Interest. What happened here? Non-deduction. Non-deduction. How much is the amount not deducted, sir? 50,000. 50,000. How 50,000? 5 lakh into 10% is the TDS rate. 50,000 is the amount not deducted. So that 50,000 into per month how much? 1%. How many months are there? June, July, August, September, October, November, December, January. Total how many months? 8 months. 8 months, sir. Okay, 8 months. So what is the interest? 4,000. Then what is the due date for payment of TDS, sir? Every month you have to pay. It's okay. By when the TDS has to be deposited, sir? 7th of succeeding month. Okay, but except for March. For March alone, it will be till April 30. Okay, for the rest all the months, it has to be deposited by succeeding month 7th. Okay, for this period, no problem. Whether they have paid 7th of succeeding month, by when it has to be deposited? 7th of February 2026, they have to remit. Did they remitted? No. When they remitted, sir? Remitted only on 25th March 2026. So this period is what? Non-deduction, not non-remittance. Non-remittance. How many period is that? So from 8th February, sir. February 1 month, March another month. So how many months interest has to be calculated? 2 months. So 50,000 into 1.5% for non-remittance. For non-deduction 1% only. For non-remittance how much? 1.5% into 2 months. How much is the total? 550,000 into 1.5% into 2 months. 1,500. Okay, so this is the interest for non-remittance. This is for the interest for non-deduction. So understood now here. In 18th Jan it is deducted, but 18th from 18th Jan only will not again start calculating interest. Okay, because if 18th Jan deducted, it has to be paid by when? Next month 7th, February 7th. You wait till February 7th. Is it paid? No, by February 7th it is not paid. So you have to calculate again interest from Feb 8th. So February month, and it was paid in March. So March month, for 2 months if you calculate interest at 1.5%, you'll get 1500. So this is for what? See, date on which, just like 1% for every month or part of the month of the amount of such tax from the date on which tax was deductible to the date on which such tax was actually deducted. And simple interest at 1.5% for every month or part of the month from the date on which tax was deducted. So date on which tax deducted has to be taken. So not this one. So we don't need this due date for payment and all. So from the day it has to be deducted. So 18th Jan it has to be deducted, right? Since on 18th Jan is the date of deduction. So till date of deduction you will get what? Non-deduction related interest. If it is paid within due date, then fine, no interest. If it is not paid within due date, then the interest has to be calculated from the day on which tax has been deducted, not from the next day of due date. In GST now usually we'll do what? From the next day of due date we'll calculate interest. But here sir, not from next day of due date, from the day on which TDS has been deducted but not paid. So that means not 2 months, or how many months it will come? 3 months. So 50,000 into 1.5% into 3 months. If you take total, how much sir it is? 2,250 will come, not just 1,500. Okay. Sir, if a person fails to deduct TDS or remit TDS, then he is called as SSE in default. But sir, I have to deduct TDS. I didn't deduct it. But the other person has, even though TDS is not deducted, he considered that income, he paid applicable taxes, everything, I mean, at the time of his self-assessment. Sir, same here only, sir. Okay. An employer failed to deduct TDS on salary paid to employee. Then employer is what? SSE in default. He has to pay interest for non-deduction of TDS. But that employee, once when he has to file the return of income, he considered the total salary income, he computed tax and paid the applicable taxes. Now government, sir, why TDS has been introduced? To earlier collection of revenue. Ultimately, the tax amount was received by government, which was paid by the employee. Now, interest for employee will not be calculated, employer will not be calculated eternally, because already employer did a mistake, but corrected by whom? Employee, by paying the taxes properly. So the interest will be only from date on which TDS is deductible till the date on which return has been filed by that payee or deductee. So this fellow, without deduction of TDS, he did a mistake. But the other party has considered that income and paid taxes and filed return of income by taking it properly. So even though this default is made for non-deduction of TDS, but the default has been corrected by paying the taxes rightly to the government. So the interest will not go like that only, because, sir, understand, this person who didn't deduct TDS cannot again deduct TDS also. Why? Because the other person will say what? Sir, I already paid applicable taxes, so you cannot again deduct TDS to me. So you don't even have the chance to deduct TDS also. That's why the interest will go from the date on which TDS is deductible till the day when the deductee or payee files his return of income by considering that income. So only that period only. Understand, sir? Sir, ee roju employer has to deduct TDS on, let's say, Jan month salary. Let's say on Jan month salary, it has to be deducted. On Jan 1st, it has to be deducted, employer. But it was not deducted Jan 1st. Then employee considered that income and filed return. Employee filed return of income on 31st July 2026. Where it has to be deducted on when? 31st Jan 2026. Sir, employer didn't deduct TDS even afterwards also. But employee filed return by considering that salary also on which TDS is not deducted and computed taxes, paid taxes, everything properly. So now the interest, sir, usually till when interest goes? Till the day when the TDS is deducted. But here there is no chance of further deduction also. That's why what they are saying, like, start interest from 1st January 2026 until 31st July 2026. Okay. Here there is a default done. But the default is corrected by employee. So you will be relieved for the correct thing did by employee. So you will be calculating interest only from 1st Jan to 31st July. That's what here. Okay. Then TCS interest. For non-deduction or for non-payment, the TCS interest will be only 1%. For TDS only, for non-deduction 1%, for non-remittance 1.5. But for TCS it is both 1% only. Then interest for failure to pay according to demand notice. So what is called demand notice? Consequent to assessment. If you need to pay any extra tax. Sir, in 234 ABC and all we have calculated. What is there? There is returned income, assessed income. So assessed income, now there is an increase of income. Okay, because of that there is liability increase, 234A, B, C, interest also will get increase. So for that, they'll give you a assessment order and even a demand notice also. Once a demand notice is given, see, interest for failure to pay according to demand notice. What they are saying, sir, AO on completion of assessment raises a demand notice to SSE. Then SSE has to make the payment within 30 days or lesser period if it is specified in the demand notice. Usually 30 days from demand notice. If in demand notice they said like only 10 days, now then the payment has to be made within 10 days. Otherwise, interest has to be calculated at a rate of 1% amount on the amount which is specified in the demand notice period from the day immediately after 30 days or time allowed to date on which such amount is paid. So usually 30 days will be given. So that means interest has to be calculated from 31st day from demand notice till the amount actually paid. That is the period. What is the amount? Whatever is the amount payable on as per demand notice, on that amount we need to calculate. What is the interest rate? 1% per month or part of the month. This is under 220 subsection 2 for delay in payment of demand made or delay in payment of demand made. The last one, sir. Waiver or reduction of interest under 234A, B, C. Waiver or reduction of interest under section 234A, B, C. Only when return of income is filed voluntarily. So this waiver or reduction will happen only when the return of income is filed voluntarily. If no return filed, then there is no waiver of 234 ABC interest. Okay. Who is empowered to waive off? Chief Commissioner of Income Tax or Director General of Income Tax. Okay. Board of, okay. Sir, what situations? Sir, you cannot pay advance tax because the books of accounts are taken over by department in such and seizure case. So you cannot compute your income to pay 234A, B or C interest. Then the cash got seized. In such, whatever the cash you have, that cash has been seized and you don't have any money to pay. And whatever the cash seized, you requested them to adjust from that cash seized and they didn't. Even not allowed to adjust with the arrears of tax or advance tax installments. Then in such case, they may waiver. Third one, income other than capital gains arised after first and second installment, which is not anticipated. Sir, for 4 incomes, there is an exception. What are those? Dividend, income accrue, income from a new source of business, capital gains, and then casual incomes. But there is a business income only, but you couldn't foresee that. Unexpectedly, the sales has been jumped. Because of some reason, the demand has been accrued in that particular month. Let's say, sir, because of COVID, in a particular period, the sanitizers business has been boomed. The mask, okay, their business has been boomed. They didn't anticipate that. But suddenly in those 1 or 2 months, their business has been boomed like anything. So in such cases, okay, income other than capital gains arised after first and second installments of advance tax, which is not anticipated. As a result of amendment or because of a Supreme Court decision, there is a retrospective effect. Because of that, you need to pay extra tax, but you didn't foresee that. Then where return filed voluntarily, and these reasons are there, and return has been filed voluntarily, and the delay of filing is due to circumstances beyond the control of SSC. So, okay, if these are the reasons, then may be waived off, sorry, it's not like shall be waived off, may be waived off by whom? CCIT or DGIT, only when the return of income is filed voluntarily. Okay, so 234A, B, C interest can be waived off, only these three. When the books of accounts are taken over by department, cash seized and no amount is there to pay, and you have already requested them to adjust, they didn't adjust it, then income other than capital gains, a new kind of income has been arranged for you after first and second installments and which is not even anticipated as a result of any amendment or Supreme Court decision or when return filed voluntarily, the delay of filing is due to circumstances beyond the control of SSC. In all these cases, the interest can be waived off. Okay, so with this we have completed advance tax and interest, sir.
So central government has notified ICDS. It is applicable to SSCs. Either they are following mercantile system or cash system. Mercantile system, they should be individual and HUF doing tax audit. Others, individual and HUF, if they are doing tax audit, then ICDS is applicable. Others, irrespective of tax audit and all, also ICDS is applicable when they are following mercantile system. Cash system, then ICDS is not applicable. So ICDS, you need not to apply except for PGBP and IFOS incomes. I mean, for house property, salaries, you need not to apply ICDS. Then when there is a difference or when there is a conflict between Act and ICDS or rules and ICDS, which prevails? ICDS will prevail. And when you are computing book profit under MAT or adjusted gross total income under AMT, then in such cases also ICDS is not applicable. So we have total 10 income computation and disclosure standards, 10 ICDS. ICDS 10 is for provisions, contingent liabilities and contingent assets. ICDS 5 is for tangible assets. Then ICDS 4 is for revenue recognition. ICDS 3, construction contracts. ICDS 6, foreign exchange rates. Okay. ICDS 7 is for government grants. And then ICDS 9, borrowing cost. ICDS 8 is for investments or securities. Then ICDS 2 is for inventory. 1 is for accounting policies. So now in order we'll go, sir, once again. ICDS 1 is about accounting policies. Okay. Now what we have discussed there in accounting policies. So I mean AS versus ICDS, if you remove, if you compare, basic accounting assumptions or fundamental accounting policies to be followed. There as per AS, 5 policies, 5 concepts are there. One is like going concern, consistency, accrual. Then additionally in AS, sir, 2 more are there. Prudence, materiality. But prudence and materiality is not recognized under ICDS. Then yes, when an accounting policy can be changed, when Act requires or when a statute requires or when a standard requires, or if with the change it could be presented betterly, then you can go for change in accounting policy in AS. But here, when there is a sufficient reason or sufficient reason is there, then it can be changed. Then it has to be disclosed. When there is a change in accounting policy, significant, all the major accounting policies has to be disclosed. And if there is a change in accounting policy also, it has to be mentioned. Okay. Then even in ICDS also same thing. But if the impact of change in accounting policy is not in this year, if it is going to be there in subsequent year, then in such year, when that impact is going to be there, that year also the change has to be mentioned there. That is about what ICDS 1. Then valuation of inventory. So inventory means it is like finished good, raw material, work in progress. They have to be measured at cost or NRV, whichever is lower. To find out cost, all the CAS4 related, sir. All the manufacturing related, overhead related, service related, all the costs associated has to be included, except selling and distribution costs or admin costs, storage costs, and then abnormal loss. Except these, all the other costs has to be included. Then to find out the cost, which method has to be followed? We can follow FIFO, weighted average, or specific identification method also. Then construction contracts. It covers for construction of an individual asset or group of assets, or services provided only with respect to construction, with respect to demolition, of an asset. All these are covered under construction contracts. So contracts can be of two types: fixed price. Fixed price, na, they'll agree for a fixed price. It may be for the whole contract or per square feet or per unit price also they can fix the price. Plus there will be an escalation clause also. Okay, if there are unforeseen expectations or unforeseen increase in the prices, sir, normally the prices may increase according to the inflation. Let's say 5 years project. Every year some 7% increase, some 8% increase in prices is normal only. But if they increase drastically, just like as the gas prices increasing now or the crude oil price increasing now, okay, those are extreme situations. In that cases, there should be a clause for escalation. Escalation, nothing but increase in the price, and that is called fixed price contract. Next one is cost plus markup. They are called as what? Cost plus contracts. No recognition. How it has to be recognized? When there is a reasonable certainty, of ultimate collection. Construction cost, what should be used? Included specific cost, general cost, and even borrowing cost also. And in construction cost, the revenue has to be recognized based on percentage completion method only. If in any case outcome cannot be estimated reliably, then recognize revenue only to the extent of cost. That also only in the earlier phases of the contract. What are called as earlier phases, sir? Up to 25% of completion of a contract, it is called as early phases. Then contract cost should be reduced with incidental incomes except interest, dividend, capital gains. Then revenue recognition. It talks about sale of goods, sale of services, or using entity resources like a patent, like a trademark, and then paying to the entity some royalty, dividend. All those are covered under revenue recognition. Okay. With respect to sale of goods, when revenue has to be recognized, when significant risk and rewards are transferred. With respect to service, percentage completion or straight line or project completion method. Okay. Then for interest and all, when it becomes due. In material it is there, sir. In notes we didn't wrote. And then for dividend when it is declared. Okay, dividend when it is declared. So I said like received, but actually dividend declared. At the time of declared, we can recognize as income. Okay, then we discuss next about, sir, ICDS 8, securities related. There what? Again, cost or NRV or cost or fair market value, whichever is lower only we are taking. But does it has to be done asset wise? Sir, for securities, we are doing the valuation on the closing day. Nothing but we are recognizing mark to market gain or mark to market loss, because on closing day, even the asset is not sold. But for fair market value, if you are adjusting, means there's nothing but what? Some notional loss or notional gain you are taking, because that is not yet realized. Sir, able to understand, sir? Security purchased at 70 rupees, sir. On closing day, it is 80. So how much gain is there? 10 rupees. But is it realized again? So that means what? Notional gain only. Because again on April 2nd, it may go back to 70. So that's not realized again. That's what? Notional gain. Such notional gains and notional losses are considered as per ICDS in which standard? In securities and all. But do we do asset wise, or do we need to do class wise, or the total investment wise? Class wise, sir. Equity shares separately, preference shares, those class separately. Debentures also, there may be 2-3 separate debentures. 8% debentures are there, 15% debentures are there. For every class of assets, do that separately. Okay, cost or fair market value, whichever is lower. And something like block wise kind of, not individual security wise. Those 5 ICDS we have discussed in the last class. Now we'll proceed with ICDS 5, tangible fixed assets. Tangible fixed assets. So tangible means what? Plant and machinery, land, building, furniture, all this will come under tangible. And to call it as fixed assets, these are not held for sale in the ordinary course of business. So usually, if something we kept for sale in the ordinary course of business, it comes as inventory. Okay. So these fixed assets are used for production of goods or provision of service. Okay. Now, if there is any standby equipment, what they have to be done, sir? Capless. If there are spares, charge to P&L, they will be debited into P&L. Understand, sir? If standby equipment and spares, what is the difference? What is the difference between standby equipment and spares? So standby equipment means it is a second or another plant and machinery which is just kept. We don't know when the requirement for standby equipment comes. Let's say in the process, if one particular machine breaks down, they cannot halt the whole production process just because this machine is not ready. So what they will do? In this place, they'll keep another machine and then continue the process. Then that is called as what? Standby equipment. Okay, in a critical or in a major production process where a 1 hour loss also might be significant. In such cases and all, they'll not waste the time even for minutes also. Once this machine got an issue, then immediately the production process will be shifted to through some other machine, which is a standby machine. Okay, so that standby machine, sir, they'll not use it regularly. 1 day, 2 days they'll use. In the meanwhile, this original machine get rectified. Okay, then again the production process shifts to the original machine only. So those are called as, okay, which are ready for use, and we don't know when they will be or when the necessity to use them will come. They are called as standby equipment. Standby equipments we have to capitalize only. But spare parts are like these kind of cables. Okay, so if there is any issues with them, so those usually will not capitalize them. What we'll do, we'll charge it to P&L. If there are any exchange fluctuations, you purchased a fixed asset or a tangible asset in foreign currency, there is a gain or loss, sir. On year end you will not do any changes, but at the time of ultimate payment with respect to a fixed asset, sir, you purchase for $3,000, sir. Now on the date of purchase, $3,000 into 80 rupees, you have converted, recognized it as asset. But at the time of payment, that dollar value instead of 80, it became 90. Now what? 3,080 means some 2,40,000 initially you recognized, but that is not enough now. Okay, now how much has to be? How much, sir? 24 lakhs, sir. 3,000 into 80. 24 lakhs. So initially we recognize asset value at what? 24 lakhs. But ultimately you have to pay how much to discharge the liability? 90 per dollar. That means 27 lakhs you need to pay. So you have a loss of how much? 3 lakhs. What to do this 3 lakhs loss? Add to asset cost only. Add to asset cost. Okay, if there is a gain, subtract from asset cost only. Okay, exchange fluctuations, gain or loss, adjust to asset cost. Asset acquired for non-monetary benefit. So this point will be there in PPE also. Okay, so you didn't paid money and purchased asset. Okay, for exchange of another asset or for exchange of shares, you purchased a tangible asset. Then there, sir, actually in PPE, as far as I remember, will take fair market value of the asset given away or the fair market value of the asset taken, whichever is more clearly evident. Whichever is more clearly evident. But here what they are saying means you take the fair market value of the asset which is acquired. I mean asset which came in, not the asset which you give away or the shares which you are given. You should take the fair market value of the asset which you have received on acquisition. Okay, but it is contradictory to the normal accounting standards, sir, where it says like you can take any of those, the asset you given away or the asset you got, whichever is more clearly evident you can take. But here they clearly saying like what? Forget about the asset you given away. Okay, only consider the fair market value of the asset you got. Understand? Okay, so let me quickly revise this even in the material also. Tangible assets such as land, building, plant, machinery, furniture, which are held for use in production of goods and services, and they are not held for sale in the normal course of business. Okay, standby and servicing equipment, what we have to do, sir? Capitalize. Whereas machinery spares, charge it to P&L. So this is the format. How do we take the cost of the asset? But this already we did it in where PGBP actual cost section 43 will be there itself. First we'll take actual cost, then duties and taxes non-recoverable. Non-recoverable means on them ITC is not allowed. So non-recoverable means on them ITC is not allowed. If you know anything about GST, the GST element, if you can avail as ITC, then such element will not add to the asset cost. Same thing here also. Duties and taxes, if they are not eligible for ITC, then you can add them. If they are eligible for ITC or eligible for refund, then don't add those duties and taxes. Then directly attributable expenses for making asset ready for use, installation expenses, okay, trial run, okay, those expenses. Then subtract. If any trade discounts are there, rebates are there, subsidies are there, these things we need to subtract. Then we'll get the cost of tangible asset. Then how do we calculate depreciation? 43 subsections. First we'll take opening WDV. Then we'll take what? Cost of additions. So additions also will write separately. More than or equal to 180 days, less than 180 days usage. Then if any assets are sold, that deletions value we gonna subtract. Then we get what? Closing WDV before depreciation. On that we'll charge depreciation accordingly under section 32. Then we'll get closing WDV after depreciation, which will become next year opening. The expenditure incurred after the plant has begun commercial production. With respect to plant only, already the plant has started commercial production. Afterward, if any expenditures incurred, they are like repair expenditures and all, will not capitalize them, will charge it to P&L only as an expense. Then asset acquired for non-monetary benefit. So acquired in exchange of another asset, acquired in exchange of shares and securities. What to do? Fair value of the tangible fixed asset. So acquired. So whatever the assets you acquired, that fair value has to be taken. Differences. AS10 covers both tangible and intangible fixed assets, whereas ICDS covers only tangible fixed assets. Cost term. Here in AS they'll use as generally referred as cost, but in ICDS instead of cost we'll refer it as actual cost. Actual cost is a wording given under income tax 43. From there ICDS also has adopted same wording only. Instead of recognizing the asset at cost, we'll use the word asset has to be recognized at actual cost. Then standby and servicing equipment. AS10 also says capitalization. ICDS also says capitalization. Spare parts. Sometimes in AS10 you can charge it to P&L, sometimes you can capitalize. But ICDS are mostly will be what? Charging to P&L only, unless if it can be recognized as an asset separately, you don't capitalize. Non-monetary acquisition. What will take? Fair market value of asset given or received. But in ICDS, you will take only the fair market value of asset acquired. If any consolidated purchase is there, consolidated purchase means 5-6 assets you purchased as a group. Then how to find out individual asset value? Then we'll apportion it fairly. Okay, that fair apportionment we need to do. This is about what? AS10 versus ICDS. 5. Now we are moving on to ICDS 6, effect of changes in foreign exchange. Effect of change in foreign exchange. Sir, here it talks about three different situations. First one, when you have any transactions in foreign exchange or in forex, then how to treat them. This standard says. Second one, you have a foreign branch. So inter-level branch accounts, if you remember, sir, SSC might have a foreign branch also. Now the foreign branch, after the finalization of branch P&L and all those closings or the branch related accounts will be again converting into Indian rupees and all. Okay, so the foreign operations related, if you need to, sorry, in India we need to report even that foreign bank, foreign branch related also, right? You have a foreign branch, but that revenue also you have to report here. Those foreign branch debtors also you should report here. So to do all that, all those foreign operations related items you need to convert into Indian currency. So how do you do? How do you exchange them? Second one. Third one, you entered into certain forward contracts which involve foreign currency or foreign exchange transactions involving forward contracts. See, transactions in foreign currency, translating the financial statements of foreign operations, or treatment of forward contracts involving the foreign currency. Okay, what is called forward exchange contract, sir? You know already in SFM. Forward exchange contracts. See, simply means an agreement to exchange different currencies at a forward rate. Sir, after 3 months, you agreed to buy $1 at rupees 91. After 3 months, you agreed to purchase $1 at rupees 91. Let's say on that day, if the dollar value is 94, you have a contract to buy at what? 91. But the actual price is 94. So you have a gain of 3 rupees. But by 3 months, the dollar value fell down and came to 89. You have a contract to buy at 91, but actual price is only 89. So you have to pay 2 rupees extra, which is a loss. So those contracts are called as forward exchange contracts. It's an agreement to exchange different currencies at forward rate. Okay. So how do we recognize these foreign currency transactions is what this standard talks about. ICDS 6, effects of change in foreign exchange contracts. Applicability. When it applies to transactions which are in foreign currency, translating financial statements of a foreign unit, or forward contracts involving foreign currency. Effect of changes in foreign exchange contracts. When there are transactions in foreign currency, when you are translating financial statements of a foreign unit or foreign outlet, then forward contracts involving foreign currency. Okay, initially when the transaction happened, you'll recognize that the exchange rate on that day, or you can take average rates also. But when the exchange rate is fluctuating so quick, I mean that exchange rate changes day to day, that also significantly. In such case, you will not take average rate. Okay, we'll not take the average rate, we'll take the actual rate on that day. If it is not so rapidly changing, means we can take average rate also at the time of initial recognition. Okay, sir, let's say you made a purchase of raw material. Initially, you'll recognize that what, let's say on the date of purchase, $1 equals to 90. You'll recognize that what, 90 only. Okay, if it is not changing rapidly, instead of that day, you can take average rate of that week. Okay, then year end, sir, year end, it's not always again we'll take it at closing exchange rate. There are situations where we'll again year end we need to recognize the exchange gain or loss by taking it at closing rate. Sometimes we'll not take also. Let me tell you. First one, what is mark to market loss? See, raw material imported for a credit 6 months when 1st January 2026. For how many dollars? $1 lakh. $1 equals to 90. Initially, you should recognize the creditor at what value, sir? 90 lakhs. Why? Because you need to pay him how much? 90 lakhs. Then closing date on 31st March, $1 equals to how much? 92. So increase of 2 lakhs is the right liability. So this loss, this is nothing but loss. But on 31st March, is it going to be settled actually? When it is going to be settled after 6 months, that means 30th June it is going to be settled. But on 31st March itself, you are recognizing 2 lakhs as loss, which is not even the real loss. It's a notional loss only. So these kind of losses, we call it as mark to market loss. On the closing day, if you adjust your liability according to the market, or if you adjust your asset according to the market value, then such imputed such notional gains or notional losses only we call them as mark to market losses. Okay, now conversion rate. See, so at the year end, what to be done? Initially, what to be done? Year end, what to be done? See, if it is a monetary item, so monetary item now you need to pay in monetary terms only. Let's say for a creditor, you need to pay in monetary only. Okay, there is a bills of exchange, you need to pay it for it monetary only. So initially you recognize at what? Actual rate. And year end, what you will do? You'll recognize it at mark to market by taking the closing rate. If it is a gain, tax it. If it is a loss, claim it as an expense. This is when, sir, on the closing day. Okay, with respect to creditors, which involves monetary payments. Okay, you need to pay money terms only. Then second one also, monetary item at the time of settlement. Sir, monetary items at the time of, okay, let me show you in material, sir. I think it is more clear. Okay. Foreign currency monetary items, example, cash, receivables, payables, etc. Okay. So what monetary items means what? Cash, receivables, payables, etc. Year end also we need to do mark to market. And at the time of settlement also, again, you recompute gain and loss. Okay. So let's say, sir, this example only. Closing day, how much, sir? 31st March 2026. It became $1.92. So loss 2 lakhs has to be recognized. Charge to P&L allowed as per ICDS. Now, on 30th June 2026, $1 equals to 89. Now, how much you need to pay ultimately to settle the liability? 89 lakhs is enough, right? Okay. Now, originally in your book, by that day, how much is the liability recovered? 92 lakhs. Sir, not 90, because first originally 90. But by the 31st March, you increase your liability to 92 lakhs and 2 lakhs you booked as loss. Now, what is the book value, sir? 92. But actual settlement you need to be made is what? 89 only. Now, again, what you will do? 3 lakhs you recognize as income. This is real income, sir. Okay, sir, real income 1 lakh only. Sir, real income 1 lakh only, but you already claim 2 lakhs as loss. That 2 lakhs has to be offset, and extra 1 lakh real gain you are having, that gain also has to be recognized. Okay, so what is the point they are saying, sir? At the year end, recognize it again at what? Closing value. Whatever the gain is there, recognize as income. Whatever the loss is there, claim it as expense. Then again at the time of settlement, do again and find out gain or loss. This is with respect to what? Monetary items. If it is related to a non-monetary items, if it is related to foreign currency, non-monetary items, fixed assets, investments, inventory, etc. Okay, so these things are originally will recognize at initial value. Year end and all will not change. Only if it was settled, I mean it was sold and actually it is getting settled, then only we need to do. So year end for monetary assets only, year end also will do gain or loss calculation. For non-monetary items and all, year end will not do any mark to market loss computations, only at the time of settlement. Then this 43A and 43AA, both these are related to PGBP only. We already discussed that. 43A is about if there is any foreign exchange fluctuations with respect to asset, tangible asset. Sir, we already discussed even today also. With respect to asset, non-monetary assets, if any gain or loss is there, what we need to do, sir? Gain add to asset cost, sorry, gain subtract from asset cost, loss add to asset cost. That's what only there. Treatment of forex difference, adjust to block, loss add to block, gain reduce from block, items covered are what? Capital assets only. Then 43AA. 43AA is with respect to other than tangible assets, other than fixed assets, something. All other differences. Treat them as what? Income or loss. Loss allowed as loss, gain allowed as income. Okay, here capital assets covered, here monetary and non-monetary items, foreign operations, forward contracts, etc. Then relation between these sections. There's no direct relation, sir. 43A is not applicable, then 43A will come into picture. Understand, sir? So now we are moving on to government grants. Sir, government grants include any subsidy given, duty drawback you got, cash incentives, waivers, concessions, reimbursements, all these will come under the government grant. So grant means a lump sum amount given or even a subsidy given also. Both will be considered as what? Government grant only. Subsidy. Sir, what is subsidy? How subsidy works? In a 1 crore machinery, you need not to pay 1 crore. You pay 60 lakhs, you pay 50 lakhs is also enough. That's called what? Subsidy. What is called grant kind of? You pay first 1 crore. Then government may give you the 50 lakhs or 70 lakhs or whatever the support they wanted to give, that will be given as an amount. That's called reimbursement or as a grant kind of reimbursement. Here it is what? Subsidy. If any duty drawback, refund is given, any cash incentives are given, like what? Cash incentives now, RODTP. Okay, those under FTP we have discussed, sir, RODTP, remission of duties, taxes and all. So there is incentives given, rewards given. They will come under government grants. If any waivers are there, concessions are there, all these will come under government grant. Okay. Sir, when to recognize a government grant? And there is a reasonable assurance that what are the conditions attached to the grant? Okay, whatever are the conditions attached to the grant, person shall satisfy with conditions attached to the grant, and the grant should be actually received. You already received money, and you are certain, you are sure that you are going to satisfy the conditions attached to the grant. Then recognize such government grant. Recognition of government grant shall not be postponed beyond the date of actual receipt of grant. So once you receive, if you could satisfy all the conditions, then you need to recognize it as a grant. Okay, what to do this? If it is a depreciable asset, the grant amount has to be reduced from actual cost. Depreciable asset only, it's not given directly, it's given indirectly. So then apportionate the grant fairly for each asset, and that amount reduced from the written down value. If it is related to non-depreciable asset, let's say related to land, some grant has been given. Now what to be done? Recognize. So that grant, you'll keep it as a separate item, and every year some amount you'll bring it to P&L over the period of the benefit. Okay, let's say, sir, the grant conditions are attached for 10 years. Okay, and it is not related to a depreciable asset to reduce from actual cost. And what you will do? Every year that grant 1 crore you received. Instead of recognizing whole 1 crore as income in 1 year, since it is related to 10 years, the conditions has to be fulfilled in 10 years. So every year 10 lakhs, 10 lakhs, 10 lakhs you'll recognize as income. Standard only, sir. Yes, also says same thing. Non-depreciable asset, recognize as income over obligation period. Sir, you already incurred some past expense or loss. Okay, let's say, sir, because of this increased crude oil prices or increased gas and all, ceramic industry, okay, is now suffering so much of losses. Restaurants are suffering, and because of ceramic, the tiles and all, maybe they has to be burned. Okay, some coatings has to be done, maybe fire related. That's why. So the current industry which is suffering more because of non-availability or scarcity of LPG is this ceramics industry, ceramics, na, this tiles related, the wash basins, okay, commodes. So those are manufactured, those are called as what? Ceramics. So those industry required gas, maybe to heat them and to mold them into certain shapes. So that industry is going to suffer so much. Now they are incurring heavy expenditure. Later on, government thought to give some grants so that their past losses can be recovered. So that such kind of grants are given, they are to be recognized as income in the year of receipt itself. Then non-monetary grant. So non-monetary grant, I mean an asset itself has been given to you. Then how much ever you pay, that amount only recognized as actual cost. For freely it is given, sir. Freely it is given. Let's say government only given to BCCA some 30 TVs, okay, to make it a digital education and all. Freely it is given. Then the actual cost of all the TVs will be 0, or notional value 1 rupee, nominal value will recognize. Okay. Let's say they said like 50 rupees TV, you pay 5,000. Then what value we should recognize, sir? 5,000 only we should recognize. So there's nothing but something like subsidy. This is something like subsidy. The last one, any other grants recognized as income over the matching periods. Sir, if it is related to depreciable asset, reduce from it and depreciate it the balance amount. If it is not related to non-depreciable asset, right? If it is related to non-depreciable asset, then recognize that as income throughout the conditions or throughout the obligation period. The next one, sir, if it was as a compensation for the past expenses or past losses, then recognize as income in the year of receipt itself. Okay. Then refund of government grants. Let's say, sir, they have attached some conditions, but later on you cannot satisfy those conditions and you need to reverse or you need to repay the government grant you got. Then what to be done? Refundable amount shall be added back to the actual cost or WDV. If it is a depreciable asset. Sir, it's not related to depreciable asset. You already recognize as income. Then what? Depreciation shall, okay. Sir, grant related to depreciable asset means what you will do? Again, add back to the asset cost and on the new value, now you claim depreciation. This is simple only. If grant related to items covered under 0.346, nothing but you already recognize them as what? Incomes. But now the grant has to be reversed. Sir, now you need to check. Is there any unamortized amount kept like that? Because third point, what they said, sir, it has to be recognized over obligation period. The obligation period is for 10 years, let's say. Now, you will be claiming it as income, not in a single year, 10 years. Now, 6th year, you need to reverse the government grant. 5 years later only, you already recognized as income. So, there is still some amount lying in the government grant balance. That amount first you adjust. So, okay, unamortized amount exists. Refund adjust again as such unamortized amount. If no unamortized amount exists or unamortized amount is not sufficient with respect to the grant, then such extra refundable amount shall be charged to P&L. Nothing but recognize it as an expense. Understood, sir? Okay, this is about what? Government grant. Then securities, we already completed, sir. So we are starting with our next topic, ICDS, sir, Income Computation and Disclosure Standards. Sir, here this question says, so question number 2, the slot reserved for PGBP, assessment of companies, and even trust. These 3 chapters has the scope under question number 2. We completed PGBP and we completed assessment of companies. Then question number 3 is always about tax planning. So 2, 3 related we have completed. Okay. Then question number 6, 7 are related to transfer pricing. Question number 6, 7 are related to transfer pricing and transfer pricing and DTA. 8B also related to transfer pricing and DTA. Okay. Now what else we have? 4, 5. Sir, question number 4 is related to business restructuring and NR taxation. One question will come from business restructuring, another question will come from NR taxation. In 5 also, sir, 2 sub questions. One question mostly it will come from ICDS and advanced tax, and 5B it will be from appeals, mostly appeals only. If not, then such assessment, that concept also may be there. Okay. So now we are targeting this 5A, sir. Okay, 5A. So today in this session we're going to complete ICDS part. Tomorrow we're going to discuss advanced tax part. From day after tomorrow again we'll go into DTA and transfer pricing slot. Okay. So in 4 or 5 days if we complete these 2 chapters, DTA and transfer pricing, then we'll be going back to business restructuring and NR taxation. Towards the end, last 3-4 classes we'll be discussing assessment, such appeals. So they are like each day, each chapter kind of only. Okay. So plan. Okay. It's fine, or else you want a business restructuring or NR taxation to be taken forward and transfer pricing to take afterwards. Transfer pricing only first, right? Okay. ICDS. Okay, ICDS, central government has notified ICDS. In ICDS means what, sir? Income Computation and Disclosure Standards. But there are only currently 10 standards are there. These are applicable to SSE. If he is following mercantile system only, if he is following cash system, then this is not applicable. In mercantile system, that also when it is applicable, if individual and HUF tax audit applicable, then ICDS has to be followed. Others, irrespective of tax audit, ICDS has to be followed. Okay, so understand? Mercantile system, cash system. Cash system, no requirement of ICDS. Mercantile system again, SSE is who? Individual and HUF. If SSE is individual and HUF, again, tax audit also has to be applicable to check about the applicability of ICDS. Okay, I mean ICDS applicable only when tax audit applicable to individual and HUF. Others, irrespective of tax audit, ICDS are applicable. Okay, why? Sir, these ICDS are applicable for the purpose of computation of income under that PGBP and even under IFOS. Okay, for computation of income under these 2 heads, PGBP, IFOS. Okay, sir, if there is any contradictory between ICDS and Act, which prevails?
Act only prevails. Okay, if there is any contradiction between ICDS, Act and rules, ICDS versus Act, Act only prevails. ICDS versus rules, rules only prevails. Okay, then so that thing, but ICDS, this disclosure standard should be in line with the Act and rules. Okay, the standard cannot bring something rational which is not as per the Act or which is not as per the rules. So ICDS not applies when you are computing MAT or AMT. With respect to computation of MAT or AMT, ICDS means what? Income computation disclosure standards are not applicable. So then, how many accounting ICDS are there, sir? 10 are there. First one, ICDS 1 is about accounting policies. Just like as AS1, here ICDS 1 is also about accounting policies. Then ICDS 2 is about inventory. There also AS2 is about inventory. But ICDS 3, sir, it is about construction contracts. It is a change. There 3 in a cash flow. Okay, here ICDS 3 is about what? Construction contracts. 4 is about revenue recognition. 5 is about tangible fixed assets. Whereas in accounting standards are 10. So the corresponding accounting standard for this is what? AS9. For construction contracts, AS7. For tangible fixed assets, it is like AS10. PP. Then ICDS 6 is about effect of change in foreign exchange. AS11. Then ICDS 7 is about government grants. AS12 only. AS12 only. Then ICDS is about 8 is about securities. This is about investments. AS13. Then borrowing cost. This is about what? AS16. Okay. Then ICDS 10 is about provisions, contingent liabilities and assets. AS28. AS28. Okay. Understood, sir? So what are the corresponding accounting standards? ICDS 1 corresponding accounting standard is AS1. ICDS 2 is about what? Inventory. Corresponding accounting standard is what? AS2. Construction contract corresponding standard is AS7. Revenue recognition corresponding standard AS9. Tangible fixed assets is the 5. Corresponding accounting standard is AS10. Effect of change in foreign exchange rate corresponding standard is AS11. Government grants corresponding standard is AS12. ICDS 8 securities nothing but investments corresponding standard is AS13. Okay, borrowing costs are corresponding standard is what? AS16. And provision contingent liabilities and assets corresponding standard is AS28. AS28. Okay, so forget about AS numbers, we'll remember ICDS numbers now. 1, 2 you can remember, sir, same as like AS. 1 is about what? Accounting policies. 2 is about what? Inventory. 1 accounting policies, 2 is about inventory. Then 5 can be remembered easily. What is AS5? Tangible fixed assets, 5. Okay, and the last one is about what? Provisions, contingent assets and liabilities, ICDS 10. So 4 you can remember easily. 1 is about what? Accounting policies. 2 is about what? Inventory. Then 5 is about tangible fixed assets. 10 is about provisions, contingent assets and liabilities. Okay, so now we'll remember 3, 4. 3 is about what, sir? Construction contracts. 4 is about revenue recognition. 3 construction contracts, 4 revenue recognition. Now first 5. 1 is accounting policies, 2 is inventory, 3 is construction contracts, 4 is about revenue recognition, 5 is tangible fixed assets. Right. Now 6 is about foreign exchange rates, change in effect of foreign exchange rates. 7 is about government grants. 8 is about securities. Sir, if you see these 3 are like these 4 standards, same in the AS order only. 5, 6, 7, 8. There also 10, 11, 12, 13. What is AS10? PP. Here ICDS 5. Then 11th is what? Foreign exchange. Here 6. 12th is what? Government grants. Here it is 7th. 13th is what? Investments. So here it is about the same corresponding standard is what? ICDS 8. Okay. Then the last, the 9th one is pending, sir. Borrowing cost. 9th one is about borrowing cost. Okay, na? So what are not covered here ICDS with respect to amalgamation, segment reporting, business combinations, consolidation, those standards were not included into the ICDS part. Okay. The rest all normal accounting transactions. Sir, amalgamation is a specific case. Consolidation is a specific case. So they didn't consider those specific situations. In general, these are the standards. So the general standards they have even introduced into the ICDS also. Okay, na, sir? So what is ICDS 10? Provisions, contingent assets and liabilities. ICDS 9. ICDS borrowing cost. ICDS 8. Okay. ICDS 8 is about what, sir? Securities, investments and securities. ICDS 7 is about what? Government grants. ICDS 6 is about what? Foreign exchange rates. ICDS 5 is about what? Tangible fixed assets. ICDS 1 is about what? 2 is about what? Inventory. 3 construction contracts. 4 is about revenue recognition. Then again ICDS 9. ICDS 9. Borrowing cost. ICDS 9 is about borrowing cost. Then ICDS 7. ICDS 7. Government grants. ICDS 8 is about what? Investments and securities. ICDS 5 is about tangible fixed assets. ICDS 10. Provisions, contingent assets and contingent liabilities. Then ICDS 3. Construction contracts. Then ICDS 7. Government grants. Okay, done. So ICDS 1, it's about accounting policy. It says like what? The policy adopted, the accounting policy adopted should represent true and fair view of incomes from business or profession and the statement of affairs also. Treatment and presentation should be on substance over form. What does it mean by substance over form? Okay, you shouldn't believe what you see. There is something beyond what we see. You don't know substance over form means, but you don't know how to explain. Substance over form. So okay, accounting policy means policy adopted. Okay, what are the policy adopted? It should be what? Represent true and fair view of what? The income under that PGBP and even the statement of affairs. Then when in any treatment and presentation, we should consider what? Substance over form. Substance over form. substance over form na, sir. I said an example, if you remember, companies will be giving loan to its shareholder who is having substantial interest. Instead of declaring it as dividend, they are giving it as what? Loan. If you look at substance only, it is loan. But if you go beyond substance and analyze, it is not loan, it is dividend rooted in the form of loan. That's called what? Substance over form. It's okay, on record it may show something, but actually it is a different thing. Then we have to see what? Substance over form. Okay? What? Okay, political parties, what they give in manifesto is substance. What they do actually is over form. So, okay, we should vote not based on the manifesto they given. We should think of what actually they couldn't do or what actually they did past. So based on that only. So we need to think of what? Substance over form. Then mark to market loss. We're going to discuss in different standards, sir. Fundamental accounting assumptions here. Going concern. What does it mean by going concern, sir? We putting alarm in the early morning or in the night when we are sleeping. If you put alarm, it's called going concern because you have a belief that you'll wake up tomorrow. That's why you are keeping alarm. So right. So every day we think like what will be continuing only. That's why you are keeping alarm. And I'm updating schedule in the class. I mean in the WhatsApp group. So it's all about what? Going concern. So okay, the business will be going forever. So okay, the thing. So that's called what? Going concern. Then consistency. That also again. Just like as our DT fast track class every day. Consistency. Then accrual. Sir, accrual means what? Okay, irrespective of receipt, when it becomes due, we'll recognize it as an expense. So that's called what? Accrual. So going concern, consistency, accrual. Then next one is what? Prudence and materiality, sir. These are actually the concepts recognized in AS1. Those are also fundamental accounting assumptions, prudence and materiality. But ICDS 1 didn't consider prudence and materiality. Prudence means what? Expect future losses, but not the future gains. Expect the future loss and recognize as an expense now itself, but not the future gain. Don't expect now and recognize it as income, but future loss, expect now. Materiality. So there's a concept called materiality, sir. Sometimes the item value important, the value would be less, but the impact might be more. Okay, so those comes under what? Materiality. Then change in accounting policy. When we can change an accounting policy, sir? When there is a reasonable cause. What is reasonable cause? Nowhere defined. Okay, you have to change an accounting policy only when there is a reasonable cause. What is reasonable cause? It depends on case to case only. Disclosure. What has to be disclosed, sir? All significant accounting policies you have followed has to be adopted. And if any change in the accounting policy, you need to mention that in the year of change and even in the first year in which change has impact, material impact, in which the change has material impact. Okay, in that first year also you need to show. Okay, so once again, sir, ICDS 1. ICDS 1 is what about what? Accounting policies. What does it say? Accounting policy should represent true and fair view. And then true and fair view of what? P&L account there, but we will not have P&L, right? So income from business or profession and statement of affairs. And then we should consider substance over form. The fundamental accounting assumptions are 3 only here. Going concern, consistency, accrual, which is missing, sir, here. Prudence and materiality are missing. Then can we change an accounting policy? Yes, but there is a if there is a reasonable cause. Then disclosure. All the significant accounting policies has to be disclosed. If there is a change in accounting policy, in the year of change also disclosed. And in the first year from which the impact of such change materializes. Sorry, today you change an accounting policy, but the impact may not be today. After 2 years, 3 years, the impact starts. So then in the first year of such impact also, you need to show this policy we changed 2 years back. Because of that, this is the impact that has to be mentioned in that has to be disclosed also. Okay. Accounting policies adopted should represent a true and fair view of statement of affairs, income of business, or profession or occasion. Then treatment and presentation shall be governed by what? Substance over form. Mark to market, again we'll discuss. Then fundamental accounting concepts are what? Going concern, consistency, accrual. Okay, they are assumed to be followed and has to be disclosed if they are not followed. Change in accounting policy not to be changed without reasonable cause. Disclosure of accounting policy. All significant accounting policies has to be adopted, has to be mentioned. And change in accounting policy which has material effect. Disclose quantum of effect. Where you cannot disclose the impact of such change, then at least disclose the fact that we cannot calculate or we cannot figure it out how much loss or how much impact that is going to be there because of this change in accounting policy. Then this one, sir. The difference between AS1 and ICDS1. Sir, ICDS1. Sorry, AS1 talks about concept of prudence. Prudence means what? For all known liabilities and losses, you make estimate and create provisions. Anticipated profits are not recognized. Okay. Here ICDS1 says like what? Mark to market loss and expected losses not to be recognized. And even ICDS is silent on recognizing anticipated profits. Materiality is an accounting policy under AS1, whereas under ICDS it is not an accounting policy. Change in accounting policy, sir. Okay. In ICDS what it was said shall not be changed without a reasonable clause. But whereas in AS it is said like what? Change is allowed only if it is required by statute, required by AS, or for more appropriate presentation of books of, P&L or statement of affairs. For a better presentation, or if it is required by a statute or AS, then only you can change accounting policy. But here in ICDS, they didn't mention that. They simply said like what? When there is a reasonable cause. Disclosure. Disclosure is required in period of change if impact is not material in just a current period, but material even in later years also it has to be mentioned. Here, sir, required in period of change, also required in first year in which change has material effect. If impact is not material in current period, but material in latter period, then in the latter period in the first year of change, you have to mention that also.
This is about what? ICDS 1. Then we are going on to ICDS 2, valuation of inventory. So what is called inventory? Sir, inventory means the finished goods which are held for sale normally in the course of business. The goods which are in the process of production for sale, nothing but work in progress, and even in the form of materials, raw material. So inventory means raw material, work in progress, finished goods. Finished goods now which are held for sale. Okay, they are process of production now, work in progress. Measurement. How do we measure inventory, sir? Cost or NRV, whichever is lower. Cost or NRV. NRV means what? Net realizable value. But how do we find out cost is the next question. Okay, for finding out cost, sir. For finding out cost, again, we have three methods which can be followed. What? FIFO method, weighted average method, or specific identification method, which is not allowed. LIFO is not allowed. FIFO, weighted average, specific identification method is allowed. Then, while finding out cost, sir, if any abnormal loss is there, such thing will not consider in the cost. If any storage cost, selling and admin overheads, these are not part of cost. What are not part of cost, sir? Abnormal loss, storage cost, selling and admin overheads. So measurement in case of special cases. When a firm or AOP is being dissolved. Firm or AOP is being dissolved. Sir, if it is a going concern, what we are saying, cost or NRV, whichever is lower. But the firm or AOP is being dissolved. Since it is being dissolved, obviously we'll take at what value, sir? NRV, net realizable value only will take. Next. Sir, dissolved, a firm is being dissolved due to death of partner or reconstitution of a partner. Firm. I mean, new partner is being added, or one of the partner is retiring and a new partner is being added. For such purpose, the existing firm is dissolving, and it is certainly known that what? Again, the firm will be reconstituted with new sharing ratios or with new partners. In such case, sir, yes, substance, if you see, firm is dissolving. But if you go beyond the substance over firm continues only, but with a change in partners. So that's why what they are saying, like in this case also you follow cost or NRV, whichever is lower. So technically it is also a dissolution, firm getting dissolved. But what we know, that is for a technical purpose only, firm is being dissolved. Afterwards, one or two partners may add, and again the firm may get continues. So that's why you take what? Cost or NRV, whichever is lower only. If it is a permanent dissolution, then value at NRV. Okay. So now cost has to be found out at what? FIFO method, weighted average method, or even specific identification method. Inventory has to be valued at what? Cost or NRV, whichever is lower. So the standard stands for applied for valuation of inventories except for work in progress under construction contract, because that is covered by ICDS 3. If the inventory is like shares, debentures and instruments, then they are covered by ICDS 8, investment and securities. Then if it is livestock, agricultural, forest produce, mineral oil and gas, then for them also this is not applicable. Machinery spares are not inventories, sir. They have to be counted under the ICDS 5 because they are part of tangible fixed assets. And work in progress, which in any case is dealt by other standards, those will not consider here under ICDS 2, which are not covered, sir. Inventory as per construction contracts. Securities held as inventory covered by ICDS 8. Okay, if any spare parts of fixed assets covered by ICDS 5, then any livestock, mineral and oil reserves, those are not covered here. And any other work in progress dealt by other standard, those are also not covered under ICDS 2. What is ICDS inventory, sir? Finished good which is held for sale. Work in progress which is in the process of production. Form of materials or supplies to be consumed in the production. What is the measurement, sir? Cost or NRV, whichever is lower. What is NRV? Estimated selling price minus estimated costs and expenses incurred for sale. Sir, let's say you know that you can sell it for 10,000. But to sell it 10,000, you need to pay commission of 1,000 rupees. Okay, you need to pay some other extra charges to be in. Then NRV means that 10,000 expected selling price minus expected cost to sell 2,000. Subtract. What is NRV? 8,000 is the NRV. Then special cases. Valuation of inventory in case of dissolution of firm. What's valued at NRV? But it is dissolved and surviving partners reconstitute, and it is going to be continued as a it is to be continued as a going concern only. Then we should take what? Cost or NRV, whichever is lower. So cost of inventory, we should take cost of purchase, cost of service, cost of conversion, and even other costs also. All these are normal costs incurred has to be included. What has to be excluded? Abnormal costs, storage costs, selling and admin costs has to be excluded. What has to be included? See, purchase price. Taxes and duties on which IDC is not available only has to be included, sir. If IDC available now, we shall not include them. Direct expenses, exclude any discounts and rebate. Labor and other costs include. Conversion, cost directly related to units of production and allocation of fixed and variable production overheads. Any other costs which are related to conversion to the extent that they are incurred in bringing inventories to the present condition. All those costs has to be, sir, cost sheet you do. Except selling and CAS 4 suggestion, sir. Cost accounting standard 4 suggests how the cost has to be calculated. There will not take any selling and distribution overheads, and even administration overheads also, which are related to factory only will consider, related to office will not consider. So only that way only cost has to be calculated here. In that cost also we should ignore what? Normal cost, storage cost, selling and administration cost. What is the method of valuation, sir? Specific identification method, FIFO or weighted average method. Okay. Differences, sir. In AS2 for opening inventory there is no specific provision. But in ICDS 2, the value of opening inventory of business is nothing but same as the closing of last year. That he has to say now. That we all know. The current year closing only will become next year opening. Okay, that was not mentioned in AS2, but that was clearly mentioned in where? ICDS. This year closing inventory will only has to be taken as the opening value of next year. If it is a new business, whatever is the cost, that only has to be treated as what? The opening value of inventory. For inventory valuation in case of dissolution, in AS there is no specific provision. But in ICDS, what they said, in case of dissolution, it has to be taken at what? NRV. But in case of death, and again it is going to be reconstituted, then cost or NRV, whichever is lower only. Sir, ICDS 1 to 2 differences, if you remember, sir, it's mostly done. In ICDS 1, what are the differences? Prudence there followed. In ICDS, no prudence. There materiality is there. Here, no materiality. There change in accounting policy, sir, when statute says or any standard says or for better presentation. Here, there is just a reasonable cost. Okay, those are the main three differences under ICDS versus AS 1. Then 2, inventory related. Inventory related what, sir? There, with respect to opening value to be taken, the stock opening value, there is no provision in AS. But ICDS says like what? Last year only has to be taken as the current year opening value. Last year closing only, current year opening. Then, in case of a new business, whatever is the cost, that will be taken as the opening value. Then, in case of dissolution, there is no specific provision in AS, but in ICDS what? Take NRV as the closing value. If it is firm just dissolved because of a death of a partner and it's going to be reconstituted, cost or NRV, whichever is lower, has to be taken. Understand, sir? The rest all are same. They are also in AS, cost or NRV, whichever is lower only. How do you find out cost? Now, same thing only. The methods for finding out cost also same only. FIFO method, weighted average method, specific identification method. Now, ICDS 3, it's about what? Construction contract. It should be applied in determining the income of what? Construction contracts entered into it by contractors. It's one that specifically negotiated for, sir, the construction. Okay, let me show first here in the notes. Construction contract, this standard is applicable in relation to construction of a single asset or even group of assets. Okay, your contract is to construct a single asset or your contract is to construct a group of assets. Then also it can be called as what? Construction contract only. Coverage is under ICDS 3. Service contracts related to construction, that also will come. Contract related to demolition will also come. So demolition contracts, construction contracts, and even only service related contracts with respect to construction also has been covered. Now contracts can be determined into two types. Fixed price contract, cost plus contract. If it is a fixed price contract, now what we should take, sir? Fixed price plus escalation clause. If it is a cost plus contract, now what we should take? Cost plus markup. Fixed price contract, what we should take, sir? Fixed price plus escalation price. Cost plus contract, now we should take what? Cost plus markup. Cost plus markup, here fixed price plus escalation clause. Sir, what is this escalation clause? Because of inflation or because of, sir, let's say, sir, this war came now. Because of that, the crude oil prices are increasing drastically. Okay, now if you see most of the hostels or most of the restaurants, they are increasing the prices because of this escalation clause. Okay, why? Because they didn't foresee that the gas prices will increase. So because of those unforeseen situations, okay, there are drastic increase in the prices. Then to increase the price or increase the contract value, they may insert what? Escalation clause. Okay, usually it is what? Cost plus markup, one type, and the next one is what? Fixed price plus escalation. These are the two types. Okay. When to recognize revenue? When there is a reasonable certainty of ultimate collection. Okay, you think like you don't get anything from that project, then you cannot recognize it as revenue. Only if there is what? Reasonable certainty of ultimate collection, then only recognize it as revenue. Construction cost. What is construction cost? The specific building cost. If any general cost to be apportioned to it, and even the borrowing cost. All this together is called as what? Construction cost. Okay, cost and revenue has to be recognized on what basis, sir? Percentage completion method. How much are the percentage completed? That much cost you recognize and that much revenue also you have to recognize. Outcome to be estimated reliably. That means recognize revenue only to the extent of cost. Sir, if outcome cannot be estimated reliably, you don't know how much money you're going to get from the completion of the project also. Then you recognize revenue only to the extent of your cost. But that also, sir, only in the early stages. This way of recognizing only to the extent of cost applies only in the early stages. Early stage means what? Up to 25% of project completion only, it is called as early stage. So in early stage, you are not certain how much revenue you're going to collect. So even in such case also, you should recognize revenue to the extent of completion or to the extent of your cost, you should recognize as revenue, even though you are not sure how much you're going to realize also, but to the extent of cost, you recognize as revenue. So the project takes 10 years. So else the project takes 20 years for construction, the total project. Something like a irrigation project kind of, it takes 20 years for construction. Early years, you are not certain. Sir, yes, the project estimated cost is 40,000 crores, but you are not sure. Why you are not sure? Because if the next government comes now, then their priority may be this project or they may change the priorities. So you are not sure about ultimate collection of the total project revenue. Okay, you cannot estimate now currently reliably. So let's say Polavaram project is being constructed. Who can estimate it reliably? We don't know. Okay, one government says like this is our priority, one government says like this is not a priority. I mean, they may not say it is not our priority, but simply they will not allocate funds for it. So understand the point, sir. So when you cannot recognize the revenues, in the earlier stages of the contract period, you recognize revenue at least to the extent of cost. At least to the extent of cost. For what is called earlier stage? Out of the total project duration, up to 25% duration it is called. I mean 20 years project now, first 5 years is called as what? Earlier stages. Sir, after 5 years what to be done? Normal percentage completion only we have to follow. Okay. Contract cost should be reduced with any incidental incomes. So during the process, if you get any incidental incomes, that incidental incomes has to be reduced except interest, dividend and capital gain.
So construction contract means it may be for a construction of an asset or group of assets that may be related to design technology, and also include service contract related to construction and demolition contracts also. Construction contracts are of two types: fixed price contract, cost plus contract. That means what? Defined cost plus markup. Cost plus means fixed price means contract agrees to a fixed contract or fixed rate per unit, square feet this much amount. Usually in construction that happens with square feet only, sir. So for square feet 3,000 for construction, or for square feet 2,500, like that the construction cost will be there. That is the fixed price plus escalation clause. Escalation clause, why? Because if there is an unforeseen disturbance or unforeseen price increases are there, then this is kept to maintain their minimum profits at least by the construction contractors. Escalation clause. Contract revenue. Contract revenue shall be recognized when there is a reasonable certainty of its ultimate collection. Contract revenue, initial amount of revenue agreed in contracts including retention amount. So contract cost means specific cost, general cost and other costs. Recognitions are usually has to be recognized as what? Percentage of completion method only. If it cannot be relied estimately, then what we should take, at least to the extent of cost, will recognize as income or revenue in the earlier stages. What is called earlier stages? Up to 25% of completion. Sorry, sir, I said one thing wrongly here, I think. Sorry, it's not up to 25% of duration. Up to 25% of project completion, it may take 10 years also, but still it will be called as what? Earlier period only. Okay, once the completion is more than 25%, then we will not call it as earlier stage. It's not about duration, it's only about the total completion only. So look at the differences, sir. AS7. Recognize revenue only if the outcome can be reliably measured. ICDS what, sir? There is no point of reliable measurement and all. Then AS7 says what? Foreseeable or expected losses are allowed fully. Here also losses, here in ICDS 3, sir, losses allowed also only to the extent of percentage completion method only. Okay, if any incidental incomes are there, that has to be reduced. Even here also incidental incomes has to be reduced, but except interest, royalty, and interest, dividend and capital gains. Earlier stage contracts, here recognize only to the extent of cost. Here also recognize only to the extent of cost. But the only point is what? Earlier stages means what? Up to 25% of completion. Contract work in progress. Contract cost related to future activity recognized as asset only if recovery is probable. Here the contract cost already incurred, sir. It has to be always recognized as what? Asset. Retention money. There is no treatment about retention money in AS7, sir. But if any retention money is there in ICDS, that also has to be treated as what? Part of contract revenue. So retention money, they'll make a deposit with you first. The deposit money you're not gonna refund it also. That's called what? Retention money. Such retention money also has to be treated as what? Revenue only as per ICDS. Okay, so this one is what? Same one, sir. AS7 versus ICDS 3. Okay, theory, I'm not going to read it out also. Question number 6 is what, sir? Straight theory only about what? ICDS 1. Question number, okay, there's a mistake in question number. ICDS 2 with AS2, that also same, nothing to be discussed. So 5, 6, 7, nothing to be discussed, sir. Just the straight theory questions only. Then come to ICDS 4. It's about what? Revenue recognition. When there is a sale of goods, revenue with respect to sale of goods, with respect to rendering of services, or with respect to using entities' resources by another person and yields interest, royalty, dividend. Sir, we need to recognize revenue on sale of goods, on rendering of services, and use of entities' resources by other person, yielding, sir, I mean nothing but what? You are allowing someone to use your properties, like a building, or your money, or your copyright, then you will get what? Interest, royalty or dividend. Okay, these incomes, sale of goods, rendering services, or even this interest, royalty kind of incomes also has been covered here. How do we recognize revenue? Sir, recognition with respect to sale of goods when significant risk and rewards and ownership has been transferred. To recognize as a sale of good, 3 has to be transferred. Risk has to be transferred, reward has to be transferred, ownership has to be transferred. Okay, but in most of the cases, sir, when risk and rewards are transferred, ownership legally, even though if it is not transferred, will look what? Substance over form. Sir, you got the total money for a bill. You purchased a house. I sold a house. I got all the money. I hand over the keys to you. Everything is within your possession only. So risk transferred, reward transferred, but only thing pending is what? The title document registration alone is pending. There may be some technical issue. That's why it was kept on hold for some 1 month. But still substance over form, what it is, sir? On record, maybe I am the owner, but you are the actual owner, right? I mean, you are actually the owner because you already purchased the asset, you already got the ownership, you already got the reward, everything you only got. So that's why when significant risk and reward are transferred, then it is what? Sale of good. Service. Service has to be recognized what? Either percentage like completion or like straight line every year this much amount, or as a project completion. It depends on service to service. That only. So see, sale of goods you need to recognize when revenue, when significant risk and rewards are transferred. For services, percentage completion method. Interests are usually on what basis? Due basis. But if it is interest on refund of tax duty fees, government related interest on refund. So income tax refund also, on income tax refund will get interest. On GST refund also, if there is a delay, will get interest. On customs refund also, if there is a delay, will get interest. But such interest we need to recognize as income only when it is received. Normal loans, borrowings related, loans and advances related, now you recognize when it becomes due. Okay, but with respect to the statutory dues to be refunded, with respect to those statutory payments, if they are being refunded, on that you are earning interest now. Such interest you recognize only when it is received. Royalty, okay, recognize as per the terms of agreement. Dividend recognize as per the provisions of
Act. So nothing but whenever it is received only, sir, will recognize dividend. Revenue certainty, sir. ES9 says what? Postpone if there is significant uncertainty. Whereas ICDS 4 says like recognize only when there is reasonable certainty. Service contract, proportionate or completed. Whereas under ICDS it is what? Percentage completion. Disclosure, only postponed cases where any case revenue recognition is postponed, those has to be disclosed in the ICDS 9 or, ICDS 4 or ES9. So then, come to ICDS 8, sir, because ICDS 8 is one of the important ones. Last attempt the question asked is also on ICDS 8 only. ICDS 8 deals with securities which are held as a stock in trade, securities. And it does not apply to recognition of interest and dividend on securities, because that was covered by what? Revenue recognition standard. Interest on dividend on securities. Then securities held by insurance companies or securities held by banks, mutual funds or venture capital funds are also not covered here. So general people, if they hold securities, then that is covered under the ICDS 8. And that also if they earn any interest and dividend, that is not covered here. Held by insurance businesses, not covered by here. So recognition and initial measurement. Usually, this has to be recognized at actual cost. What is actual cost? Purchase price plus acquisition charges, nothing but brokerage fee, tax, duty, generally. When they are exchanged for any other asset, when they are exchanged, you didn't pay money. Because of exchange, you got a security. Then fair value of security exchange is the actual cost. Fair value of security, nothing but fair value means what? Market value of the security got exchanged. Then unpaid interest accrued included in price. Sir, there is a debenture which pays interest on 1st January and on 1st July. Okay, it pays interest on 1st June and on 1st July. Now you paid that, you purchased that security on 1st April. Then what happened? For the first 3 months related interest already accrued, right? If it is accrued now in the share price or in the debenture price, the first 3 months related interest is also included by the time of your purchase only. Sir, this is where it is mentioned. It will be there in ICDS, AS13. If you remember inter-level those questions now, you will get some clarity. X in, that only. Common interest, X interest, those kind of calculations will be there. Okay, that only. So here, sir, you are purchasing on 1st April, now, that is what? Including interest for the 3 months. Okay, so that is nothing but what? Unpaid interest for the first 3 months, because the interest is payable only on again 1st July, but you purchased on 1st April. So 1st April, by the time what? Jan, Feb, March related interest already accrued. April, May, June related interest is yet to be accrued. So for the first 3 months, it is unpaid interest accrued and included in the price. What to be done? Such unpaid interest is apportioned into pre-acquisition. If it is pre-acquisition related, pre-acquisition Jan, Feb, March, what? Reduce from actual cost. Post-acquisition simply recognize it as what? Revenue. So nothing but Jan, Feb, March related interest element you reduce from cost. Whereas March, April, May, June, after purchase only, now you simply recognize it as what? Revenue. So how do we recognize them? At the end of the previous year, sir, we recognize them as actual cost or NRV, whichever is lower. Sir, I have 50 securities, sir. Every security I have to take cost or NRV, whichever is lower. No, they have to be done category wise. Category wise, na shares. I might have 50 different company shares. For every share, you need not to do cost or NRV. For all the total shares cost, all the total shares NRV, cost or NRV, whichever is lower. Then again, we have debentures. 30 debentures are there, different debentures. All the 30 debentures cost, all the 30 debentures NRV, you have to compare cost or NRV, whichever is lower. So cost or NRV, whichever is lower, we need not to do asset wise, debenture wise, share wise. We need to do class of asset wise, nothing but block wise. In depreciation, we do block now. Here also such kind of blocks. What are blocks? Shares one block, debentures one block, securities one block, convertible securities another block. So every block wise you have to take cost or NRV, whichever is lower, not individual asset wise or total cumulatively investment wise. Class wise you have to do. If those securities are not listed or not traded, then take what? Actual cost. Okay. So what is the difference, sir? AS13 covers investments. ICDS 8 covers securities which are held as stock in trade. Okay. AS13 says what? Cost. Fair market value of security issued in case of exchange and asset given. Here also same thing. Fair market value of asset acquired. Then valuation, sir. LCM, so lower of, write down, sir, lower of cost. Least cost method, okay, lower of cost or NRV, whichever is lower. Individually has to be done and category wise also, yes, 30. But ICDS 8 says what's our cost or NRV, only what? Category wise only. Unlisted security is not specified in AS13, but ICDS 8 says like what it has to be done, you have to take only actual cost. Okay, now there are few. So look at question number 5, page number 12.4. What is that? SG Securities Private Limited engaged in the business of trading in shares and securities. The details are of shares held in stock in trade as on 31st March 2026 are given below. Sir, cost of the shares. Sir, we need to do individual asset wise or category wise? Category wise. So 500 into 50. Tell quickly. 500 into 50. 25. Okay. 500 into 65. 30. 500. Then 200 into 35. 200 into 32. Then here 300 into 125. 37. Then 300 into 110. 33,000. 250 into 25. 250 into 40.
10,000. So now we do total. 25 plus 7, 32, 32 plus 37,500, 69,500 plus 45,000, sorry, not 75,750 only, na, first case. 75,750. Whereas second case, 32,500 plus 6,400 plus 33 plus 10,000. So what we have to take? Cost or NRV, whichever is lower. Cost is only lower. We'll take how much? 75,750. Then question number 4 also, sir. Same only. ICDS 9 on securities held as stock in trade shall be valued at actually cost or recognized as NRV at the end of previous year, whichever is lower. Okay, part 10 of para 8 of ICDS 8 requires the said exercise to be carried out category wise. How the same shall be computed. Okay, so illustration, sir, they asked like a theory question, sir. So they taken an illustration and explain. For subsequent measurement of securities held as stock in trade, the securities are first aggregated category wise. The aggregate cost and NRV of each category of security are compared, and lower of the two is to be taken as carrying value as per ICDS 8. Okay, so here if you see shares 4 are there, debts 4 are there. So instead of comparing each security, each share wise, we need to take shares total, debentures total. What is the total of shares, sir? 560. Total of shares NRV is how much? 535. Whichever is lower, na? 535. So we should take what? 535. Then for debts also, total of cost is how much? 600. Total of NRV 615. Whichever is lower, na? 600. So we should take what? 600. Sir, what is this 505, sir? If you take individually, individual asset wise, if you take 100 or 75, 75, 120 or 150, 120, 140 or 120, 120. But this step itself is not needed. We need not to do individual asset wise lower of cost or NRV. Okay, but they did. Okay, that is not even needed. We need to do what? Class wise or category wise only, cost or NRV, whichever is lower. Okay, so now we'll proceed with ICDS 5, tangible fixed assets. Tangible fixed assets. So tangible means what? Plant and machinery, land, building, furniture, all this will come under tangible. And to call it as fixed assets, these are not held for sale in the ordinary course of business. So usually, if something we kept for sale in the ordinary course of business, it comes as inventory. Okay. So these fixed assets are used for production of goods or provision of service. Okay. Now if there is any standby equipment, what they have to be done, sir? Capitalize. If there are spares, na, charge to P&L, they will be debited into P&L. Understand, sir? If the standby equipment and spares, what is the difference? What is the difference between standby equipment and spare parts, spares? So standby equipment means it is a second or another plant and machinery which is just kept. We don't know when the requirement for standby equipment comes. Let's say in the process, if one particular machine breaks down, they cannot halt the whole production process just because this machine is not ready. So what they will do in this place, they'll keep another machine and then continue the process. Then that is called as what? Standby equipment. Okay, in a critical or in a major production process where a 1 hour loss also might be significant. In such cases and all, they will not waste the time even for minutes also. Once this machine got an issue, then immediately the production process will be shifted to through some other machine, which is a standby machine. Okay, so that standby machine, sir, they will not use it regularly. 1 day, 2 days they'll use. In the meanwhile, this original machine get rectified. Okay, then again the production process shifts to the original machine only. So those are called as, okay, which are ready for use, and we don't know when they will be or when the necessity to use them will come. They are called as standby equipment. Standby equipments we have to capitalize only. But spare parts, na, sir, like these kind of cables. Okay, so if there is any issues with them, so those usually will not capitalize them. What we'll do, we'll charge it to P&L. If there are any exchange fluctuations, you purchased a fixed asset or a tangible asset in foreign currency, there is a gain or loss, sir, on year end you will not do any changes. But at the time of ultimate payment with respect to a fixed asset, sir, you purchased for $3,000, sir. Now on the date of purchase, $3,000 into 80 rupees, you have converted, recognized it as asset. But at the time of payment, that dollar value instead of 80, it became 90. Now what? 3080 means some 2,40,000 initially you recognized, but that is not enough now. Okay, now how much has to be? How much? 24 lakhs, 3,000 into 80? 24 lakhs. So initially we recognized asset value at what? 24 lakhs. But ultimately you have to pay how much to discharge the liability? 90 per dollar. That means 27 lakhs you need to pay. So you have a loss of how much? 3 lakhs. What to do this 3 lakhs loss? Add to asset cost only. Add to asset cost. Okay, if there is a gain, subtract from asset cost only. Okay, exchange fluctuations, gain or loss, adjust to asset cost. Asset acquired for non-monetary benefit. Sir, this point will be there in PPE also. Okay, so you didn't paid money and purchased asset. Okay, for exchange of another asset or for exchange of shares, you purchased a tangible asset. Then there, sir, actually in PPE, as far as I remember, will take fair market value of the asset given away or the fair market value of the asset taken, whichever is more clearly evident. But here what they are saying means you take the fair market value of the asset which is acquired. I mean asset which came in, not the asset which you give away or the shares which you are given. You should take the fair market value of the asset which you have received on acquisition. Okay, but it is contradictory to the normal
accounting standards, sir, where it says like you can take any of those, the asset you given away or the asset you got, whichever is more clearly evident you can take. But here they clearly saying like what? Forget about the asset you given away. Okay, only consider the fair market value of the asset you got. Understand? Okay, so let me quickly revise this even in the material also. Tangible assets such as land, building, plant, machinery, furniture, which are held for use in production of goods and services, and they are not held for sale in the normal course of business. Okay, standby and servicing equipment, what we have to do, sir? Capitalize. Whereas machinery spares, charge it to P&L. So this is the format. How do we take the cost of the asset? But this already we did it in where PGBP, actual cost, section 43 will be there itself. First we'll take actual cost, then duties and taxes non-recoverable. Non-recoverable means on them ITC is not allowed. So non-recoverable means on them ITC is not allowed. If you know anything about GST, the GST element, if you can avail as ITC, then such element will not add to the asset cost. Same thing here also. Duties and taxes, if they are not eligible for ITC, then you can add them. If they are eligible for ITC or eligible for refund, then don't add those duties and taxes. Then directly attributable expenses for making asset ready for use, installation expenses, okay, trial run, okay, those expenses. Then subtract, if any trade discounts are there, rebates are there, subsidies are there, these things we need to subtract, then we'll get the cost of tangible asset. Then how do we calculate depreciation? 43 subsections. First we'll take opening WDV. Then we'll take what? Cost of additions. So additions also will write separately. More than or equal to 180 days, less than 180 days usage. Then if any assets are sold, that deletions value we gonna subtract. Then we get what? Closing WDV before depreciation. On that we'll charge depreciation accordingly under section 32. Then we'll get closing WDV after depreciation, which will become next year opening. The expenditure incurred after the plant has begun commercial production. With respect to plant only, already the plant has started commercial production. Afterward, if any expenditures incurred, they are like repair expenditures and all, will not capitalize them, will charge it to P&L only as an expense. Then asset acquired for non-monetary benefit. So acquired in exchange of another asset, acquired in exchange of shares and securities. What to do? Fair value of the tangible fixed asset. So acquired. So whatever the assets you acquired, that fair value has to be taken. Differences. AS10 covers both tangible and intangible fixed assets, whereas ICDS covers only tangible fixed assets. Cost term. Here, in AS, they'll use as generally referred as cost. But in ICDS, instead of cost, we'll refer it as actual cost. Actual cost is a wording given under income tax 43. From there, ICDS also has adopted same wording only. Instead of recognizing the asset at cost, we'll use the word asset has to be recognized at actual cost. Then standby and servicing equipment. AS10 also says capitalization. ICDS also says capitalization. Spare parts. Sometimes in AS10, you can charge it to P&L, sometimes you can capitalize. But ICDS are mostly, you'll be what? Charging to P&L only, unless if it can be recognized as an asset separately, you don't capitalize. Non-monetary acquisition, what will take? Fair market value of asset given or received. But in ICDS, you will take only the fair market value of asset acquired. If any consolidated purchase is there, consolidated purchase means 5-6 assets you purchased as a group. Then how to find out individual asset value? Then we'll apportion it fairly. Okay, that fair apportionment we need to do. This is about what? AS10 versus ICDS. 5. Now we are moving on to ICDS 6, effect of changes in foreign exchange. Effect of change in foreign exchange. Sir, here it talks about 3 different situations. First one, when you have any transactions in foreign exchange or in forex, then how to treat them. This standard says. Second one, you have a foreign branch. So inter-level branch accounts, if you remember, sir, SSC might have a foreign branch also. Now the foreign branch, after the finalization of branch P&L and all those closings or the branch related accounts will be again converting into Indian rupees and all. Okay, so the foreign operations related, if you need to, sorry, in India we need to report even that foreign branch related also, right? You have a foreign branch, but that revenue also you have to report here. Those foreign branch debtors also you should report here. So to do all that, all those foreign operations related items you need to convert into Indian currency. So how do you do? How do you exchange them? Second one. Third one, you entered into certain forward contracts which involve foreign currency or foreign exchange transactions involving forward contracts. See, transactions in foreign currency, translating the financial statements of foreign operations, or treatment of forward contracts involving the foreign currency. Okay, what is called forward exchange contract, sir? You know already in SFM. Forward exchange contracts. See, simply means an agreement to exchange different currencies at a forward rate. Sir, after 3 months, you agreed to buy $1 at rupees 91. After 3 months, you agreed to purchase $1 at rupees 91. Let's say on that day, if the dollar value is 94, you have a contract to buy at what? 91. But the actual price is 94. So you have a gain of 3 rupees. But by 3 months, the dollar value fell down and came to 89. You have a contract to buy at 91. But actual price is only 89. So you have to pay 2 rupees extra, which is a loss. So those contracts are called as forward exchange contracts. It's an agreement to exchange different currencies at forward rate. Okay. So how do we recognize these foreign currency transactions is what this standard talks about. ICDS 6 effects of change in foreign exchange contracts. Applicability. When it applies to transactions which are in foreign currency, translating financial statements of a foreign unit, or forward contracts involving foreign currency. Effect of changes in foreign exchange contracts. When there are transactions in foreign currency, then you are translating financial statements of a foreign unit or foreign outlet. Then forward contracts involving foreign currency. Okay, initially when the transaction happened, you'll recognize that the exchange rate on that day, or you can take average rates also. But when the exchange rate is fluctuating so quick, I mean that exchange rate changes day to day, that also significantly. In such case, you will not take average rate. Okay, we'll not take the average rate, we'll take the actual rate on that day. If it is not so rapidly changing, means we can take average rate also at the time of initial recognition. Okay, sir, let's say you made a purchase of raw material. Initially, you'll recognize that what, let's say on the date of purchase, $1 equals to 90. You'll recognize that what, 90 only. Okay, if it is not changing rapidly, instead of that day, you can take average rate of that week. Okay, then year end, sir, year end, it's not always again we'll take it at closing exchange rate. There are situations where we'll again year end we need to recognize the exchange gain or loss by taking it at closing rate. Sometimes we'll not take also. Let me tell you. First one, what is mark to market loss? See, raw material imported for a credit 6 months when 1st January 2026. For how many dollars? $1 lakh. $1 equals to 90. Initially, you should recognize the creditor at what value, sir? 90 lakhs. Why? Because you need to pay him how much? 90 lakhs. Then closing day on 31st March, $1 equals to how much? 92. So increase of 2 lakhs is the right liability. So this loss, this is nothing but loss. But on 31st March, is it going to be settled actually? When it is going to be settled after 6 months, that means 30th June it is going to be settled. But on 31st March itself, you are recognizing 2 lakhs as loss, which is not even the real loss. It's a notional loss only. So these kind of losses, we call it as mark to market loss. On the closing day, if you adjust your liability according to the market, or if you adjust your asset according to the market value, then such imputed such notional gains or notional losses only we call them as mark to market losses. Okay, now conversion rate. See, so at the year end, what to be done? Initially, what to be done? Year end, what to be done? See, if it is a monetary item, so monetary item now you need to pay in monetary terms only. Let's say for a creditor, you need to pay in monetary only. Okay, there is a bills of exchange, you need to pay it for it monetary only. So initially you recognize at what? Actual rate. And year end, what you will do? You will recognize it at mark to market by taking the closing rate. If it is a gain, tax it. If it is a loss, claim it as an expense. This is when, sir, on the closing day. Okay, with respect to creditors, which involves monetary payments. Okay, you need to pay money terms only. Then second one also, monetary item at the time of settlement. Sir, monetary items at the time of, okay, let me show you in material, sir. I think it is more clear. Okay. Foreign currency monetary items. Example, cash, receivables, payables, etc. Okay. So what monetary items means what? Cash, receivables, payables, etc. Year end also we need to do mark to market. And at the time of settlement also, again, you recompute gain and loss. Okay. So let's say, sir, this example only. Closing day, how much, sir? 31st March 2026. It became $1.92. So lost 2 lakhs has to be recognized. Charge to P&L allowed as per ICDS. Now, on 30th June 2026, $1 equals to 89. Now, how much you need to pay ultimately to settle the liability? 89 lakhs is enough, right? Okay. Now, originally in your book, by that day, how much is the liability recovered? 92 lakhs. Sir, not 90, because first originally 90. But by the 31st March, you increased your liability to 92 lakhs and 2 lakhs you booked as loss. Now, what is the book value, sir? 92. But actual settlement you need to be made is what? 89 only. Now, again, what you will do? 3 lakhs you recognize as income. This is real income, sir. Okay, sir, real income 1 lakh only. Na? Sir, real income 1 lakh only, but you already claimed 2 lakhs as loss. That 2 lakhs has to be offset, and extra 1 lakh real gain you are having, that gain also has to be recognized. Okay, so what is the point they are saying, sir? At the year end, recognize it again at what? Closing value. Whatever the gain is there, recognize as income. Whatever the loss is there, claim it as expense. Then again at the time of settlement, do again and find out gain or loss. This is with respect to what? Monetary items. If it is related to a non-monetary items, if it is related to foreign currency, non-monetary items, fixed assets, investments, inventory, etc. Okay, so these things are originally will recognize at initial value. Year end and all will not change. Only if it was settled, I mean it was sold and actually it is getting settled, then only we need to do. So year end, for monetary assets only, year end also will do gain or loss calculation. For non-monetary items and all, year end will not do any mark to market loss computations, only at the time of settlement. Then this 43A and 43AA, both these are related to PGBP only, we already discussed that. 43A is about if there is any foreign exchange fluctuations with respect to asset, tangible asset. Sir, we already discussed even today also. With respect to asset, non-monetary assets, if any gain or loss is there, what we need to do, sir? Gain add to asset cost, sorry, gain subtract from asset cost, loss na add to asset cost. That's what only there. Treatment of forex difference, adjust to block, loss add to block, gain reduce from block, items covered are what? Capital assets only. Then 43AA. 43AA is with respect to other than tangible assets.
other than fixed asset something. All other differences, treat them as what? Income or loss. Loss na allowed as loss, gain na allowed as income. Okay, here capital assets covered, here monetary and non-monetary items, foreign operations, forward contracts, etc. Then relation between these sections. There is no direct relation, sir. 43A is not applicable, then 43A will come into picture. Understand, sir? So now we are moving on to government grants. Sir, government grants include any subsidy given, duty drawback you got, cash incentives, waivers, concessions, reimbursements, all these will come under the government grant. So grant means a lump sum amount given or even a subsidy given also. Both will be considered as what? Government grant only. Subsidy. Sir, what is subsidy? How subsidy works? In a 1 crore machinery, you need not to pay 1 crore. You pay 60 lakhs, you pay 50 lakhs is also enough. That's called what? Subsidy. What is called grant kind of? You pay first 1 crore. Then government may give you the 50 lakhs or 70 lakhs or whatever the support they wanted to give, that will be given as an amount. That's called reimbursement or as a grant kind of reimbursement. Here it is what? Subsidy. If any duty drawback, refund is given. Any cash incentives are given. Like what? Cash incentives now, RODTP. Okay, those under FTP we have discussed, sir, RODTP, remission of duties, taxes and all. So there is a incentives given, rewards given. They will come under government grants. If any waivers are there, concessions are there, all these will come under government grant. Okay. Sir, when to recognize a government grant? When there is a reasonable assurance that what are the conditions attached to the grant? Okay, whatever are the conditions attached to the grant, person shall satisfy with conditions attached to the grant, and the grant should be actually received. You already received money and you are certain, you are sure that you are going to satisfy the conditions attached to the grant. Then recognize such government grant. Recognition of government grant shall not be postponed beyond the date of actual receipt of grant. So once you receive, if you could satisfy all the conditions, then you need to recognize it as a grant. Okay, what to do this? If it is a depreciable asset, the grant amount has to be reduced from actual cost. Depreciable asset only, it's not given directly, it's given indirectly. So then apportionate the grant fairly for each asset and that amount reduced from the written down value. If it is related to non-depreciable asset, let's say related to land, some grant has been given. Now what to be done? Recognize. So that grant, you'll keep it as a separate item and every year some amount you'll bring it to P&L over the period of the benefit. Okay, let's say that the grant conditions are attached for 10 years. Okay, and it is not related to a depreciable asset to reduce from actual cost. Then what you will do? Every year that grant 1 crore you receive. Instead of recognizing whole 1 crore as income in 1 year, since it is related to 10 years, the conditions has to be fulfilled in 10 years. So every year 10 lakhs, 10 lakhs, 10 lakhs you'll recognize as income. Standard only, sir. Yes, also says same thing. Non-depreciable asset, recognize as income over obligation period. Sir, you already incurred some past expense or loss. Okay, let's say, sir, because of this increased crude oil prices or increased gas and all, ceramic industry, okay, is now suffering so much of losses. Restaurants are suffering, and because of ceramic, this tiles and all, maybe they has to be burned. Okay, some coatings has to be done, maybe fire related. That's why. So the current industry which is suffering more because of non-availability or scarcity of LPG is this ceramics industry. Ceramics, this tiles related, the wash basins, okay, commodes. So those are manufactured, those are called as what? Ceramics. So those industry required gas, maybe to heat them and to mold them into certain shapes. So that industry is going to suffer so much. Now they are incurring heavy expenditure. Later on, government thought to give some grants so that their past losses can be recovered. So that such kind of grants are given. They have to be recognized as income in the year of receipt itself. Then non-monetary grant. So non-monetary grant, I mean an asset itself has been given to you. Then how much ever you pay, that amount only recognized as actual cost. For freely it is given, sir. Freely it is given. Let's say government only given to BCCA some 30 TVs. Okay, to make it a digital education and all, freely it is given. Then the actual cost of all the TVs will be 0 or notional value 1 rupee, nominal value will recognize. Okay, let's say they said like 50 rupees TV, you pay 5,000. Then what value we should recognize, sir? 5,000 only we should recognize. So this is nothing but something like subsidy. This is something like subsidy. And the last one, any other grants recognized as income over the matching periods. Sir, if it is related to depreciable asset, reduce from it and depreciate it the balance amount. If it is not related to non-depreciable asset, right? If it is related to non-depreciable asset, then recognize that as income throughout the conditions or throughout the obligation period. The next one, sir, if it was as a compensation for the past expenses or past losses, then recognize as income in the year of receipt itself. Okay. Then refund of government grants. Let's say, sir, they have attached some conditions, but later on you cannot satisfy those conditions and you need to reverse or you need to repay the government grant you got. Then what to be done? Refundable amount shall be added back to the actual cost or WDV. If it is a depreciable asset. Sir, it's not related to depreciable asset. You already recognize as income. Then what? Depreciation shall, okay. Sir, grant related to depreciable asset means what you will do? Again, add back to the asset cost and on the new value, now you claim depreciation. This is simple only. If grant related to items covered under 0.346, nothing but you already recognize them as what? Incomes. But now the grant has to be reversed. Sir, now you need to check. Is there any unamortized amount kept like that? Because third point, what we said, sir, it has to be recognized over obligation period. The obligation period is for 10 years, let's say. Now, you will be claiming it as income, not in a single year, 10 years. Now, 6th year, you need to reverse the government grant. 5 years later only you already recognized as income. So there is still some amount lying in the government grant balance. That amount first you adjust. So, okay, unamortized amount exists. Refund adjust again as such unamortized amount. If no unamortized amount exists or unamortized amount is not sufficient with respect to the grant, then such extra refundable amount shall be charged to P&L. Nothing but recognize it as an expense. Understood, sir? Okay, this is about what? Government grant.
Then securities, we already completed, sir. ICDS 9 is about borrowing cost. It deals with the treatment of borrowing cost, does not deal with actual or imputed cost of owner's equity and preference share capital. I mean, the only real borrowings related cost will be considered here. But equity also should have some interest element, or equity shall also have some imputed cost. Preference shares also will have some imputed cost, but that is not interest rate. So will not include or will not discuss about their returns or their cost in the purpose of borrowing cost. Sir, let's say, sir, to buy an asset for 1 crore, I pulled 30 lakhs as equity. To buy a plant and machinery for 1 crore, I pulled or I borrowed the money, or I brought the money, how 30 lakhs I brought it as equity. 10 lakhs I brought it as preference. The other, another 30 lakhs I brought by way of debentures. Another 30 lakhs I got by way of a loan. Okay, now, sir, all these will have some imputed cost. Every one of these will expect some return. Bank will expect interest as return, debenture holders will expect interest as return. Same way, preference shareholders, equity shareholders also will expect some return. But for the purpose of borrowing cost, only these two elements related interest cost only we are considering. But the first two also will have some imputed cost. You are bound to pay for them also certain return. Okay, but that element we are not including it into the asset cost. Only borrowings related interest element we are including into the asset value. So that is only covered. See, does not deal with actual or imputed cost of owner's equity and preference share capital. So this also they didn't give me freely. Why they invested here? Because they are expecting some return from this. That return, you need not to consider it as interest and add to the asset cost. Okay. Borrowing cost means interest and other costs incurred, and includes commitment charges, amortized amount of discount or premium, amortized amount of ancillary cost, finance charges. Okay. Qualifying asset. Sir, borrowing cost has to be done only for a qualifying asset. As per AS, what is called qualifying asset? Which takes substantial period of time to complete is called as qualifying asset. What is called substantial period? Then again, not defined properly, sir. Okay, qualifying asset means usually which takes substantial period of time. But here what does it? Qualifying asset means it could be a tangible asset or it could be a intangible asset also. Land, building, plant, patent, know-how, copyrights also. And it could be even inventory also, which requires a period of 12 months or more to bring them sellable. Okay, sir, nothing but the operating cycle will be there, right? From the day you purchase the raw material and to sell it, there is a cycle. Okay, that period, if it is more than 12 months, then such inventories related also, we can account what borrowing cost, because that also fits into the definition of qualifying asset. So tangibles, intangibles, even inventories also, which takes more than 12 months for production. Sir, if it is a specific borrowing, then the total borrowing cost has to be included from the date of borrowing till the date of first put to use asset. General borrowing. Sir, general borrowing, it's not specific for asset. Then what to do? General borrowing cost into average qualifying asset divided by average of total asset. So we are identifying the borrowing cost element related to that particular asset. Sir, I have total general borrowing cost of 50 lakhs. I mean interest cost 50 lakhs. My total average assets is 500 lakhs. Whereas one specific asset is like 80 lakhs. So now out of this 50 lakhs borrowing cost, this asset related only we need 50 into 80 by 500. 8. So 8 lakhs. 8 lakhs only we should take it as what? Borrowing cost out of the general borrowing. Specific borrowing, total interest related to that asset only. General borrowing, not the total interest, or only that specific asset related only we need to count from date of utilization of funds till the date of first put to use. How do we calculate averages? Sir, here they didn't said like take the actual value of qualifying asset. They said asked what? Average. Sir, asset, that qualifying asset is even there in the opening block value. I mean some part completed and there in the opening, and it is still there in the closing. Take opening plus closing divided by 2, which is called average. Sir, it was not there on the first day. I mean in this year, in the middle of the year only it is started. So it's not there in the opening, but it is there in the closing. So take closing balance sheet value and divide it by 2, which will take it as average. Sir, asset does not appear in the last day because in between only such asset got completed. In opening it is there, but in the middle of the year it got completed. Then what will do? Opening value, balance sheet value plus value on date of put to use, take both and divide it by 2. Okay? First day value and at the time of close, I mean when it is put to use, what is the value? Take both and divide it by 2. Okay? You need to disclose the accounting policy adopted for borrowing cost, amount of borrowing cost capitalized also. Okay. So now difference between AS 16 and ICDS. Borrowing cost under AS includes even exchange differences. Here borrowing cost does not talk about exchange differences. Qualifying asset means which takes substantial time. Here inventory more than or equal to 12 months and tangible and intangible assets. Capitalization has to be made only when 3 conditions are satisfied. Here from date of borrowing in case of specific asset, general from date of utilization. Then when there is any income from temporary deployment. Sir, you got loan money 1 crore, but
1-2 months because of some adverse conditions, you cannot start construction. Then if this 1 month, if you park these funds at some other place, then you'll get some income, right? That income has to be reduced from borrowing cost under AS. But here there is no such reduction. Suspension. Sir, sometimes the borrowing cost capitalization or the interest capitalization will get suspended when the construction process is on a halt. So some 3 months, 4 months, you stopped the construction process because of non-availability of cement or because of some other issues, you halted the construction process for 4 months. Now for these 4 months, the interest accrual has to be suspended. Okay, that need not to be added to that 4 months interest element, you need not to add to the asset cost. But in ICDS, there is no such kind of provision mentioned anywhere. Sir, mostly like accounting standard only, sir. Here nothing is there. Okay, then the last one, sir, provisions, contingent assets and contingent liabilities. Okay, provisions has to be recognized when there is a present obligation from past event and there is a probable outflow and you can make reliable estimate. 3 things has to be there, sir. There is a present obligation. You have obligation arising out of past events and there is a probable outflow, not certain outflow, sir. Probable outflow. There is a chance of money going out. Probable outflow is there. And third one, you can reliably estimate that outflow, probable outflow. Then you can recognize it as provision. Okay. Provisions are measurement. You have to measure it at the best estimate at every year end. And recognized only when virtually certain and no discounting. Disclose it as provision and it has to be reviewed at every year. Okay, whether the amount increasing or decreasing, so every year you have to review in case of provision. Contingent and assets and contingent liabilities generally will not be recognized. Contingent asset recognized only when the inflow becomes virtually certain. No measurement unless recognized. Contingent liability will be disclosed, sir, will not be recognized. Okay, contingent liability will be, sir, what is about recognition and disclosing? Recognition, in P&L also you'll charge it as an expense, provision and all. But contingent liabilities you'll not charge them as expense. Then where you'll show? In the footnotes to accounts only you'll show contingent liability, disclose unless remote. Contingent also disclose only if it is probable. If it is not even probable, then don't even disclose also. Okay, then reviewed at the end of each and every previous year. So this is about ICDS 10. So now whether all these standards are important, sir, ICDS 8 important, foreign exchange related important. These 2 are of most important, sir. Tangible fixed assets also mostly like standard only. There is nothing big difference there. Borrowing cost, no big difference. These 2 only, sir. Mostly important, these 2. Question number 2. Discuss the disclosure requirements under ICDS 6. Nothing but government grants related disclosure requirements. We need to recognize the nature and extent and whether it is reduced from the actual cost of asset or assets or how it is recognized during the previous year. If any government grant is not recognized. Okay, okay, make it as 7. Sir, there are 2 types of government grants. One kind of government grant is which has to be adjusted to the asset cost if it is related to depreciable assets. If it is not related to depreciable assets, related to non-depreciable assets, what we will do? Related to depreciable assets, we'll adjust to asset cost and then claim depreciation. Not related to depreciable assets, we'll not adjust anywhere, we'll keep it separately and we'll recognize it as income throughout the obligation period. Okay, so 2 points recognition. If they were not recognized in these 2 cases also, okay, why it's not recognized also you have to write. So 4 points it came. For depreciable assets, 2 points, sir. Recognition, why it's not recognized. For even non-depreciable assets also, why it is, how it is recognized, why not it is recognized. So total 4 points are related to revenue recognition. Recognition with respect to government grant. Sir, this security is related. First question. Okay, so look at the question. Julian Private Limited provides the following information in respect of plant and equipment for the year ended 31st March. Opening value is how much, sir? 15 lakhs. Purchase of new plant and machinery, it was put to use. Okay, it should be taken as 25, sir. 25 is how much? 12 lakhs. Trade discount is there how much? 10%. Total amount paid is only how much? 10 lakh 80,000. Expenses for installation how much? 40,000. Cost of standby equipment. Standby equipment, what we have to do, sir? Add. Machinery spare parts, we'll charge it to P&L only. So first opening block value 15 lakhs. Plus assets used for more than 180 days or less than 180 days, sir. Sir, it was acquired on 31st October, but put to use only on 30th November. So that means December 31, Jan, Feb, March, 120 days only, less than 180 days. So less than 180 days, how much value we should take, sir? After discount 10 lakh 80, plus installation expenses we need to add 11 lakh 20,
plus the standby equipment also we need to add. Okay, so total how much again? 12 lakhs only. Okay, so what is the total value, sir, here? 27 lakhs before depreciation. Depreciation also we can calculate, sir. On 15 lakhs, we'll get what? Full depreciation. Okay, 15 lakhs into 15% plus 12 lakhs into 7.5%. How much? 15 lakhs into 15% plus 12 lakhs into 7.5%. How much? 3,15,000 is the depreciation. If you subtract, how much, sir? 23,85,000 is the closing WDV after depreciation. Okay, then it also gives the value of securities held as stock in trade. Sir, for this what we have to do, sir? ICDS 8 securities. What does it say? Class wise we need to find out cost of purchase or NRV, whichever is lower, not asset wise, class wise. Sir, class wise na 100 plus 120 plus 140 plus 200, total how much? 560. Here how much? 535. So what we have to take here? 535. Here total how much? 600. 615. What we have to take, sir? 615. 3,15,000, 23,85,000. Here we'll take what? Equity shares will take 535. Debt will take 600. Sir, question number 3 is not completely related to ICDS, sir. Only one point is related to ICDS, so we cannot answer it now. So rest all the questions we already discussed. So with this, we have completed what? ICDS. So this chapter, appeals and revision, sir, it can be taken into three, it can be divided into 3 parts. So one part is about appeals, second part is about revision, third part is about rectification of mistakes. Appeals, revision, rectification of mistake. It's okay. See, appeals means, sir, first authority name, sir, adjudicating authority. Adjudicating authority means the authority who has carried out the assessment. Like it could be 143, it could be 147, it could be 141, block assessment related, any assessment. The officer who has carried initially. Okay, the officer who has carried initially the assessment, whose order you want to go for an appeal, that order is called as, order passed authority is called as what? Adjudicating authority. Okay, so with this adjudicating authority order, you go for an appeal with appellate authority, appellate authority. Now with this appellate authority order, you can appeal with the tribunal. So original order passed authority is called as what? Adjudicating authority. That order you will appeal with whom? Appellate authority. The appellate authority order you gonna appeal with whom? Tribunal. The tribunal order you can appeal with whom? High court. And the high court order you can appeal with whom? Supreme Court. So this is the order. So first adjudicating authority is the AO who has passed the assessment, who has did the assessment is called as what? Adjudicating authority. His order, you have differences with that order, then you can go for an appeal with appellate authority. So now we're gonna understand here who is the appellate authority, which cases can come to him or which appeals can be made with him, what he has to do, what time it has to be done, any fees is there. The total process will be discussing how this appellate authority is gonna deal with that appeal. Then tribunal, what is tribunal? Which can be appealed before tribunal. Again, how the process, like how tribunal is gonna follow that appeal or treat that appeal. Then High Court, Supreme Court. Sir, regarding High Court, Supreme Court will not have much. We just discuss about when an appeal can go to High Court and Supreme Court. That's what. The process followed by High Court, the process followed by Supreme Court is not covered by income tax. They are separate civil procedures and all. So that we are not going to discuss or interfere. We're going to just discuss when the matter can be taken to High Court, when the matter can be taken to Supreme Court. So major discussion of us is with what? Appellate authorities and tribunal. Okay. So now see. Adjudicating authority issues a order or notice. Then the first level is what? Joint Commissioner of Appeals, Commissioner of Income Tax Appeals. These are called as what? Appellate authorities. Then the second level is what? ITAT. The second level is ITAT. The third level is what? High Court. And the fourth level is what? Supreme Court. Sir, here, the first level, appellate authority, previously only Commissioner of Income Tax used to be there as appellate authority. But going forward, by 2024, there are many appeals coming. For all these appeals, the commissioners are not enough. The Commissioner of Income Tax Appeals cannot dispose all these appeals which were made. There is so much of work burden on them. Okay, so that's why what the government thought, okay, we will even consider Joint Commissioner also as appellate authority. Then what happens? There will be commissioners now, joint commissioners also. So some cases will go to joint commissioner, some will come to commissioner. The workload is shared. Okay, so initially, Commissioner of Income Tax Appeals. Sir, Commissioner of Income Tax, certain commissioners has been designated for appeals. Those are called as what? Appellate authorities. It doesn't mean every commissioner is like an appellate authority. Commissioner of Income Taxes also can do assessment. But certain commissioner of income taxes were delegated only to hear and dispose the appeals. Okay. Now not only commissioners, even joint commissioners also has been delegated as or authorized as to be as appellate authorities. Then tribunal, then High Court, then Supreme Court. So first, Section 246, appeal to joint commissioner or commissioner of income tax appeals. See, first we'll discuss which can be made before joint commissioner, which can be made with commissioner. Okay. Sir, in simple, sir. When you want to make a complaint about someone, you will go and complain with someone with his lower authority or higher authority. Here also, you are going for an appeal with a joint commissioner. Then the original order should be passed by same level or less than his level. Less than his level. Then, okay, in hierarchy wise, if the order passed, the adjudicating authority should be below his level. Then the appeal can lies with joint commissioner. Even with commissioner also. If the matter, the adjudication authority, sir, what is adjudication authority? The original authority, the authority which passed the original order is called as what? Adjudication authority. So adjudication authority, if it is of below commissioner of income tax, then the appeal can lies with commissioner of income tax. If the adjudicating authority is below the rank of joint commissioner, then the appeal lies with joint commissioner. See, order passed by AO below the rank of JC. Which orders? It could be assessment order under 143 subsection 3, 144, 147. It could be intimation under 143 subsection 1, 200A, TDS related intimation, 206 CB, TCS related, rectification order under 154, 155, rectification of mistakes, TDS, TCS order under 201, 206, all these orders can be appealed. Sir, what orders, sir? The normal assessment orders, 143, 144, 147. Sir, which is not there? Block assessment is not there. Why? Because block assessment will be carried out by whom? Not below the rank of deputy commissioner or assistant commissioner. Okay, so not below the rank of. Sorry, if DCAC has been conducted, this deputy commissioner. Search has to be block initiation, block assessment has to be done by whom? AO, not below the rank of AC, DC. Sir, assistant commissioner can do, deputy commissioner can do, above them, joint commissioner, additional commissioner. So if these two did, then it can be taken to joint commissioner also appeals. But if it is done by joint commissioner, then it cannot be taken as appeal before joint commissioner only. So an appeal has to be made with a higher level authority. So it could be assessment order, it could be intimations. Sir, 143 subsection 1 intimation is what? Summary assessment. Same way TDS, TCS also will have that summary things. That one, rectification order under 154, 155, and then TDS, TCS order under section 201, 206 CA. So all these SSE can appeal with whom? Joint Commissioner of Appeals from 1st April. Okay, before 1st April 2023, Joint Commissioner is not authorized. Only commissioner is there. From 1st April 2023 only, even joint commissioner also has been recognized as an appellate authority. Okay, so these orders can be appealed before joint commissioner. What orders, sir? Assessment orders passed by a rank below JC, 143, 147, 144, intimations under 143.1, 200 TDS, TCS related intimations, rectification of orders, and then TDS, TCS orders, all these can be appealed before joint commissioner of appeals. Then, which can be made before commissioner of income tax appeals? An order passed by AO more than JC or equal to JC but less than commissioner. Sir, why less than JC? Why more than or equal to JC? Because less than JC, na, then those appeal can go with JC only. Sir, let's say an assistant commissioner passed. Above assistant commissioner only JC is there, na. So assistant commissioner order can be appealed with JC only. If JC passed an order, then that has to be appealed before commissioner. Sir, again, understand, sir, JC passed an appeal related order. That order again you cannot take to commissioner. Assessment orders we are questioning here. Okay, adjudication orders, not appeal order. Understand which order can be questioned before joint commission, sir? Adjudication. Adjudication means the first done assessment, the first done intimations are called as, that authorities are called as adjudication authorities. These are called as what? Appellate authorities. Okay, so one joint commissioner is also an appellate authority, commissioner also an appellate authority. This appellate authority order you cannot appeal with commissioner. అర్థమవుతుందండి? అది ఆర్డరా అపీల్ ఆర్డరా చెక్ చెక్. నార్మల్ ఆర్డర్ అయితే జేసీ పాస్ చేస్తే, if normal order passed by JC, not in the case, not in the position of appellate authority, normally as an assessment he did pass an order, then such order can be appealed before commission. But JC acting as an appellate authority and passed an order, that order goes with tribunal only, you cannot again take it to commissioner. Okay, so who is the authority here, sir? More than JC or equal to JC but less than commissioner. That means nothing but JC, additional commissioner. Those people's order can be appealed before commissioner of income tax. Okay, so which orders can be appealed? Assessment order under 143 subsection 3, 144, 147, and even block assessment order also. Intimation under 143 subsection 1, 200A, 206 CB. Sir, here there is no specific restriction, sir. Here also 158 BC. 158 BC is nothing but block assessment. That also can be here also done. It's only the point is what he should be below the rank of JC. Okay. So if below the rank of JC passes the block assessment order, then the appeal lies with Joint Commissioner. Here, if the rank of JC and above passes the block assessment order, then the appeal lies with Commissioner of Income Tax. Same thing, sir. See, assessment order. Okay, intimations, rectification order, TP order, transfer pricing order, on any other order passed by AO can be appealed before what? Commissioner of Income Tax appeals. Okay. Sir, before this amendment, all the appeals are with whom? Commissioner. Now already commissioners are having so much workload. Now with amendment, what they introduced? Joint Commissioner also can hear the appeals. Now what this provision says means, those appeals which are pending with Commissioner can be transferred to JC also. CBDT or authority authorized. If there are any appeals before Commissioner of Income Tax under 246 before amendment, they can be transferred to Joint Commissioner of Appeals. Before this transfer opportunity, okay. Before this transfer, opportunity of being reheard must be given to SSC. Once OBH has to be given to SSC, then only the transfer can be made. Okay. Now, without this amendment also, an appeal is made with JC. But JC cannot hear that appeal, or it is something beyond him. Then that case can be transferred to whom? Commissioner. So this is not related to amendment in general. If a appeal is made with JC, such appeal can be transferred to Commissioner also. Okay. This is what pre-amendment related. Before amendment, sir, that means now if an appeal is made with Commissioner, it cannot be transferred to JC. But if an appeal is made with JC, it can be transferred to Commissioner. Understand, sir? Okay. Here, if at all the appeals are made before amendment with Commissioner, then those appeals alone can be transferred to JC. Now if any new appeal is made to Commissioner, such appeal cannot be transferred to JC. But appeal made to JC can be transferred to Commissioner. Okay. Now the process. SSE has to file an appeal. In which form? Form number 35. He has to file an appeal. Within how many days? 30 days. From receipt of notice, order, intimation. That adjudication authority order, that original assessment order, intimation, that TDS, TCS related order, from that day, within 30 days, he has to file an appeal with whom? Joint Commissioner or Commissioner of Income Tax, depending on the authority. Okay. So condonation of delay possible. I mean, even though there is delay for this 30 days, if there is reasonable cause, then these authorities may condone the delay and accept the appeal. Okay. Now, within how many days they have to close this appeal? Sir, for closing the appeal, the time limits are advisory only, not standard time limits. What is the advisory time limit? Dispose appeal within 1 year from end of the year in which appeal is made. Okay. Then they will pass an assessment order confirming, reducing or enhancing. Confirming means what? The past or previous order only they are confirming. Reducing means what? They are reducing the liability. Enhancing means they are enhancing the, increasing the liability. Okay. For appeal, what documents has to be filed? Order against which appeal is made. On which you have dispute, you have difference, that order copy. Statement of facts. So statement of facts means nothing but you will prepare like a Word document explaining everything. So this happened, okay, this is the issue. You narrating the full story is called as statement of facts. Then grounds of appeal. Grounds of appeal, na? Which section? Okay, on what points you are going for appeal? Demand notice. Demand notice, na? Assessment order is different, demand notice is different. Yesterday I said, what is assessment order? If assessment is completed, how they computed is called assessment order. Through assessment, if any extra tax is payable, to pay, to asking you to pay that extra amount, they'll give a demand order also. So that demand also has to be given. If any amount is paid, like appeal fee is paid, that receipt of fee payment, all these has to be submitted. What are those, sir? The copy of order on which you are going for appeal. Statement of facts, grounds of appeal, demand notice, and then receipt of payment. So together, all these are called as memorandum of appeal. All these are called as what? Memorandum of appeal. What is the fee for appeal? When the total income is within 1 lakh, 250, 1 lakh to 2 lakhs, 500, above 2 lakhs. Sir, this is what? Total income computed by AO, not you returned. You might have returned some income. AO might have assessed it to some other total income. When the total income is within 1 lakh, computed by AO, 250, 1 lakh to 2 lakhs, 500, above 2 lakhs, 1000, in any other case. I mean, it is not even related to total income. TDS, TCS case. Then the fee is how much? 250 is the appeal fee for appellate authority. Sir, now there is a tax dispute, right? That's why only this fellow came for appeal. That disputed amount has to be paid or without payment only he can go for appeal. That's the question. Understand, sir? Now what it is saying? Tax payable for admission of appeal before Joint Commissioner of Appeals, Commissioner of Income Tax, appeals. Return of income filed. Pay tax as per returned income. As per return he has paid. Return of income not fed. Sir, I mean,
Disputed amount he need not to pay. In return, what he accepted that if he is paid, fine. If return is filed. Return not filed. Assessment made by AO, best judgment. Sir, if return not filed, how he will do assessment? Best judgment. Pay equal to the amount of advance tax payable by him. If advance tax is payable, how much advance tax he might have paid? That advance tax amount he has to pay, then only go for appeal. Okay. Now, what they can do? They can stay demand order. If any demand order is there, demand order na, asking you to pay the difference amount. So once they have taken for appeal, they can stay the demand order or can exempt payment of tax if there is sufficient reason. Such reason has to be recorded in writing and SSC has made an application. Sir, what is the process? Simple. Appeal is made before Joint Commissioner or Commissioner of Income Tax. SSC in form, if you see form 35, he will make an appeal within how many days? 30 days from the date of receipt of such order, notice or intimation. Okay. Then within what time they have to dispose the appeal? Advisory time limit only 1 year. Okay. End of the year, sir. That also 1 year, not from the exact day. 1 year from end of the year in which appeal is made. They can confirm, reduce, enhance. Okay. What are the documents to be submitted? Order on which appeal is made, statement of facts, grounds of appeal, demand notice, receipt of fee payment. All these has to be submitted. Fee for appeal. The total income computed by AO is within 1 lakh, 250. 1 lakh to 2 lakhs, 500. 2 lakhs above, 1000. In any other case, 250. Now, already, okay, how much tax has to be paid first to go for an appeal? If return filed, in return how much you have declared, that tax you paid, fine. Then next one, return not filed. How much advance tax you might have to be paid? Okay, that amount if you paid is enough. Then stay order. For the demand order, JC and Commissioner of Income Tax can stay the demand order or can exempt payment of tax if sufficient reason is there and that has to be recorded in writing. Now, additional evidence, production of additional evidence. Sir, in movies and all, if you see, first half of the movie, like this court dramas and all, first half of the movie and all, it will be like what? As if the hero side will be losing the case only. Till then, nobody will come to tell the witness, no witness will come, no evidence will come. But the pre-climax to climax time, all the plot twists will come, okay, new witnesses will come and all, the whole story will be in favor of the protagonist, hero, okay. The same thing here, why the witness or evidences has to be prolonged till that time? Sir, if at all the evidences are submitted to AO only, then AO might have considered, right, there is no need for appeal, right? But if you didn't provide certain evidences at the time of assessment, and if you are providing at appeal time, will they have to accept those additional evidences or not is the question here. అర్థమవుతుందండి ముందే అవన్నీ చూపిస్తే if all those evidences are submitted first itself, then AO itself have did not, AO itself has computed normally, right? If you didn't provide it there, and if you are providing at the time of appeal, those are called as additional evidences. Can they be accepted or not? Yes, they can be, sir, but only on certain situations. What are those? First one, you try to provide that evidence before also, but that time AO refused. Okay, this evidence I will not take, he said like, okay, usually, sir, in police station and all, okay, first this victim will go to police station, police officer is the AO. In movie scenes, okay, there police will not accept the complaints and all, so AO refused. That's why you can provide it in the appeal. Appellant prevented from sufficient cause, okay, that time his sister got kidnapped, okay, they are threatening, so okay, that's why he cannot come for the evidence before. So appellant prevented by sufficient cause. Then appellant prevented by sufficient cause, which is specifically called by AO. AO only asked to provide a specific evidence, but that fellow was kidnapped. So okay, that person was kidnapped by the villain gang, that's why he cannot come, so you cannot provide the evidence. Fourth one, order passed by AO without giving sufficient opportunity to produce evidence. Okay, they didn't give time also to produce the evidence because the evidence is in Dubai. Okay, you watched Kaidi movie, Chiranjeevi, Kaidi 150. Okay, those people and all will be like, Anna, man, Dubai lo unnam Anna, and like they'll be, okay, 2 hours the climax they'll share videos, right? So like that, order passed by AO, there is no sufficient time to produce all that. Okay, so when additional evidence can be produced, originally AO refused, ought to have been admitted. Originally you try to provide, but AO refused. Second one, appellant prevented by sufficient cause. Okay, that time, okay, you are in an emergency situation. Okay, normally in movies and all, not emergency and all, that time. Okay, they know the case, but that time they are afraid of telling that. Okay, so only when hero comes, hero gives them, nothing will happen, I'll take care, then they will come to court to give and all, right? That's one. Appellant prevented by sufficient cause. Sir, that evidence specifically asked by AO. But that time what happened? Villain gang kidnapped this person, so he cannot come and give the witness. So that's why evidence cannot be provided that time. Then order passed by AO without giving sufficient opportunity to produce evidence. So in these cases, additional evidence can be given. Okay, normal cases, you might have provided additional evidence in the first instance at the time of assessment only. Okay, only in these exceptional cases, additional evidence is accepted. Okay, so with this we completed what? Appellate authority. Now we are moving on to ITAT. Sir, in GST also there is a appellate tribunal. Income tax also there is a appellate tribunal. Company law also, there is national company law tribunal. So why these tribunals? Sir, every matter you take to court now, court has several other laws also, not only income tax and GST. Okay, so first within the act to discuss about these specific cases only, they are forming a tribunal. So here itself most of the cases gets disposed. If something of really important only will go to High Court or Supreme Court. Understand, sir? Sir, for every matter you cannot go to High Court, right? Understand? Mauli and Bharadwaj has a dispute. Okay, then for their small civil dispute also, can they go to High Court? So as if High Court judges has no other work. Okay, they have so many pending cases. So now you cannot take everything to High Court judges, or you cannot flood up the courts with all these tax related issues. And these issues are not a priority to the court. These are economic related issues, not civil related issues, not criminal related issues. So okay, these are of least priority to the court. Sir, here an appeal to be made with whom? ITAT. SSE will make an appeal. Sir, with ITAT, not only SSE, even department also can make an appeal. When appellate authority passed an order in favor of SSE, department people itself didn't like the, sir, appellate authority is department person only, but still they themselves didn't like that order. So then they can go for what? Appellate, they can take the appeal with ITAT. Okay. Sir, SSE can make an appeal with ITAT in Form 36. Even department also can make an appeal with ITAT. Who will constitute this ITAT? Central government will constitute this ITAT. Within what time the appeal has to be made with ITAT? 2 months from end of the month in which order sought to be appeal has been received. Sir, within what time the appeal has to be made with appellate authority? Appellate authority, not ITAT. Joint commissioner and commissioner, within how many days the appeal has to be made? 30 days. From end of the month or date to date? Date to date. See, 30 days from receipt of notice. Not from end of the month. Here 2 months. From where date? 2 months from end of the month in which order sought to be appealed is received. 2 months from end of the month in which order sought to be appealed was received. There 30 days from the date of receipt of notice. Here 2 months from end of the month in which order sought to be appealed was received. Okay. In which form appeal? 36. Now ITAT has to make a judgment within how many days, sir? 4 years from end of the year in which appeal is made. There 12 months from end of the year in which appeal is made. Okay. Sir, for these 2 months also condonation of delay is there. What is condonation of delay? If you cannot make an appeal within 2 months and there is sufficient cause that you have been prevented from filing an appeal, then they may condone. Extension of time limit will be there for you. Okay. Which orders can be appealed before ITAT? Any order passed by JC Appeals, Commissioner of Income Tax Appeals. AO order based on directions of dispute resolution panel. Sir, if any dispute resolution panel is there in assessment procedures, if you remember, to whom non-resident foreign companies, if they have transfer pricing related adjustments, then instead of finalizing the assessment order, they have to share the draft order to SSE. Then SSE can take it to dispute resolution panel. If DRP gives directions, based on directions, if assessment order is passed, such order cannot be appealed before joint commissioner or commissioner. Why? Because in DRP, commissioners only will be there. So, okay, so commissioner level. So you have to take it to higher authority only. That's why it has to be straight away appealed before ITAT, not with JC and all. Any revision order. Revision orders also, sir, they also done by commissioner ranks only. That's why ITAT only. Any order passed by more than or equal to the rank of commissioner, that has to be taken with whom? ITAT. So in simple, commissioner and above rank passed. Or any appellate authority orders are there. Those has to be appealed before ITAT. Now, once ITAT receives an appeal, what it has to do? It sends a memorandum, it sends a notice to the counterparty. If SSE filed the appeal, it sends a notice to the department. Department files an appeal, then ITAT will send a notice to SSE also. What? All they have raised an appeal stating these are the issues. You also file memorandum of cross objections, nothing but counter appeal. Okay, sir, one side they cannot take decision, right? These people filed an appeal. They'll ask the counterparty also to respond to that by filing a counter appeal. That counter appeal only we call it as memorandum of cross objections. It will be in Form 36A. Okay, for filing appeal only fees. For filing memorandum of cross objection, no fees. Sir, understand? For filing appeal, there will be fees. But for filing memorandum of cross objection, there won't be fees. Why? You are not the first party to take appeal. You are just responding to the appeal. So for him, no fees. And within what time this memorandum of cross objection has to be filed? Within 30 days, date to day, from receipt of notice. Sir, appeal has to be filed within 2 months from end of the month in which order is received. Memorandum of cross objection has to be filed within 30 days from the date of receipt of notice. Okay. Condonation is possible for this 30 days also. Extension of time limit is possible even for this 30 days. Okay. Now, what is the fee? Again, assessed income. Sir, there what are the fees? Assessed income up to 1 lakh, 250. Here 500. 1 lakh to 2 lakhs. There 500. Here 1500. Above 2 lakhs. 1% of assessed income maximum 10,000. 1% of assessed income. Let's say 30 lakhs. Into 1%. How much? 3,000. 30 lakhs into 1%. 30,000. But maximum how much? 10,000 only. So 10,000 is enough. In any other stay orders, petitions, 500. Appeal by department, no fees. Appeal by SSE, only fees. By department, there is no fees. Now, who will be there in ITAT? Sir, ITAT consists of judicial members, accountant members. Why? Because it's a tribunal which is specifically formed to hear income tax issues. Sir, normal judges may not know income tax. The general judges. But they know how to take a judgment, they know. Now, if at all like accounting people were brought, like income tax experts, like chartered accountants has been, or CMAs has been kept there. These people know only tax, they don't know how to take decisions, judiciary how to involve. That's why this bench is a mix of these accounting members, judiciary members. Who can be accountant member? A practicing CA who has more than 10 years. Registered accountant who is being registered account for a period of 10 years, more than or equal to 10 years. He is for a period as registered account, for a period he is a chartered accountant. So nothing but he is doing CA, couldn't clear final. But he is registered himself as a registered accountant and started practicing. After some years he cleared CA and became practicing CA. Together that span is more than or equal to 10 years. Or any other income tax employee or income tax employee only who has worked under Group A with more than or equal to hierarchy of additional commissioner of income tax with 3 years experience. These people can become accountant members. Who can be judicial members? A judicial officer, nothing but a judge who is in practice for, who has been acting as a judge for more than or equal to 10 years, or who has cleared Indian legal service into Indian legal service grade 2 for a period of 3 years, and who has been a practicing advocate for a period of more than or equal to 10 years. So these people can be judicial members, these people can be accountant members. Okay. Usually appeal should be heard by a bench. A bench consists of 2 members, one judicial member, one accountant member. If the total income is up to 50 lakhs only, small issues, then it will be heard by a single member bench. Okay. ITAD will be appointed by whom? Okay, this ITAD will have a president also, will be appointed by central government. Okay, a sitting judge or retired high court judge with more than or equal to 7 years will become president of ITAD. One of the vice president will be, or if he is already a vice president of ITAD, he will also can become president, or else directly a high court judge or a retired high court judge with more than or equal to 7 years experience can become the president of ITAD. Sir, ITAD means it will have multiple benches. It's okay, multiple benches, now there will be multiple, like this 2 members is one bench, right? So there are like some 20-30 benches which will be taking up the cases and all. Teams kind of. Bench now here like teams within the ITAD. Decision at ITAD level. Based on opinion of majority, decision has to be taken. But there are 2 members only. Both the members are not with consensus. Accountant member says one thing, judicial member says other thing. So they did not come to consensus. Okay. Now, let's say the points of dispute are like 5. There are totally 5 areas of dispute. With respect to one, both accept. With respect to first issue, both has consensus, both are under the same opinion. With respect to second also same. With respect to 5 also, both having same opinion. But whereas here, 3 has one opinion, both are having difference of opinions. This 3 and 4 now has to be taken up separately. What? Opinion of majority. Where members differ, they are equally divided on a point. Such point, I mean this 3, 4 alone will be referred to president. Now what president? President refers to hear it by another member or members. Then now take the cumulative majority. Now 1 more member added. Now what? Take majority. 2 more members added. Again take majority. 3 more members added. So based on them, cumulative majority you check. And based on what? You gonna decide. So again here, order of stay on demand. Sir, again, see, appellate authority passed an order. Appellate authority. Once appellate authority passed an order, based on this order, AO will raise a demand notice or demand notice. Now what? You are challenging this order, appellate authority order, and came to ITAT. But this demand order is there, right? It is still live only, right? Sir, the point is what? Appellate authority filed and passed an order. Now based on this order, AO issued what? Demand notice. Why demand notice? Because the tax has to be paid. AO issued demand notice. Now, this order SSE has taken before ITAT. The order has been taken before ITAT. But this demand notice immediately will not get stayed. What is demand notice? Asking you to pay tax. This is given by whom? AO. Okay, just because you went for an appeal, this demand notice will not automatically get stayed. So, that stay also you have to request to the ITAT to stay the demand. Then what? Considering the merits, they may stay the demand order up to 180 days. That also when SSE deposits 20% of disputed tax, interest, penalty, fees or any other sum on this 20% of disputed amount he has to pay. Then only the demand order gets stayed. Sir. You returned originally, okay, as per your returned income, the tax is 5 lakhs you paid. Okay. Okay, then appellate authority has passed an order. As per appellate authority order, you have to pay 8 lakhs. How much extra you have to pay now? This is returned how much? 5 lakhs. Appellate authority has passed an order and saying how much to be paid? 8 lakhs. So now AO has to issue a demand notice for how much? 3 lakhs. But now you are not satisfied with this making 8 lakhs. You went to whom? ITAT. But still the demand notice is alive only, right? The 3 lakhs, the assessing officer will be asking you to pay the 3 lakhs only. Just because you went to ITAT, this AO will not stop. Now what happens means, you have to request the ITAT to stay this demand notice also. How long he can stay it? 180 days. That also when you need to pay. What is the dispute amount? 3 lakhs. On the 20% you have to pay. Once you pay the 20% of disputed tax, interest, penalty, fees or any other sum, then it gets stayed. Okay. Now, sir, 180 days also ITAT didn't dispose the case. So you are asking for what? Extension for stay. 180 days originally given a stay, you are asking for extension. Yes, extension can be made maximum up to how much? 365, including original period and extended period. Okay, so when the stay can be given extra stay, when appeal is not disposed within the stay period, within 180 days, and that if for not completing within 180 days, the delay is not because of SSE. The delay may be because of department or ITAT, not because of SSE. In such cases only, this 180 days stay can be extended to 365 days. Okay, after 365 days, stay order will automatically get vacated. I mean after 365 days also, within 365 days also, ITAT didn't dispose. It may be who SSE's fault or others' fault. ITAT didn't dispose within 365 days, then again the demand order will stand alive. Okay, till now it will go into sleep mode once the stay order is given. Understand, sir? The stay order will be continuing for originally how many days? 180 days. But you can ask extension for another up to 365 days overall. But when the delay is not because of SSE, then it can be stayed till 365 days also. But beyond 365 days, there is no further stay of demand order. It comes back. You need to pay, even though the issue is pending with ITAT. Production of additional evidence before ITAT. Can you go with an additional evidence with ITAT? Yes. If ITAT satisfied that income tax authorities has passed an order without giving sufficient opportunity to SSE to produce relevant evidence, or ITAT require additional evidence or documents to pass an order. First thing is what? Original authority appellate authority didn't consider those evidences. Then ITAT can consider them. Second one, ITAT to decide it want extra information. Then that extra information related evidences can be accepted. Then sir, appeal to High Court, appeal to Supreme Court. Appeal to High Court, when there is an ITAT order, you want to appeal and there is a question of law, you can go to High Court. When if it is a High Court order and involves a question of law, then you can take it to whom? Supreme Court. Understand, sir? ITAT order can be appealed before whom? High Court. But every ITAT order cannot be questioned before High Court, only when there involves a question of law. Okay, every High Court order cannot be appealed before Supreme Court. It can be appealed only when there is a question of law. Okay, within how many days High Court order has to be made? Within 120 days from receipt of order. Within how many days from Supreme Court? 90 days from receipt of High Court order, here ITAT order. What is question of law? Whether a rule, section applies or not, whether something is taxable or exempted. Okay, the interpretation is wise. Or you are questioning the section validity itself. Okay, this section itself is against to the principles or fundamental assumptions of income tax. Okay, you are asking the validity of that section itself. You are questioning the interpretation of that section. That comes under question of law. If it is a fact based, what is fact? You said like your expenditure is 40 lakhs. But AO saying like, no, that 40 lakhs is not an expense. Only 10 lakhs is expense. The 30 lakhs is saying like you have submitted fake bills. So it's about fact. You claimed expense of 50 lakhs. But AO denying 40 lakhs of that expenditure, stating like those are dummy expenses, bogus expenses, fake expenses. Okay, now there is no law involved there. It's only about fact. Whether the invoices or the proof of documents you submitted are genuine documents or some tampered documents or not has to be checked. So if that is the case, that is called as what? Fact related issue. So highest fact finding authority is only ITAT. Fact related cases you cannot take to High Court or Supreme Court normally, but there is something called writ petition in High Court. Writ petition, okay? So I'm not going much deep into them, but through writ petitions, even fact related issue also you can take to High Court. But for our academic purpose, what is enough now? Fact related issues, ITAT is the highest and last. Okay? Normal issues, question of law involved, you can take up to Supreme Court also. Question of fact, only till ITAT. But practically if you want to know, even fact finding related also, even ITAT order also, you can take it to High Court by filing a writ petition. Then sir, we completed first part, then we are going on to revision. Revision is about just 2 sections only sir. 263, 264. Spy Moholi is becoming viral. Yesterday Moholi promised like he'll dance. You said, Bharadwaj, he said or not? He will, Moholi. Okay, he said also. Okay, otherwise I'll not come to class also, he said. Because most of you will come even for IDT fast track. But he is not going to come for IDT. Okay, who else will not come? You also will not come for IDT. She also, okay, you three. వాడికి చాలా క్లాసులు కొత్తలే. Sir, revision of orders, we are having 2 sections, section 263, section 264. 263 is in favor of department, 264 is in favor of SSC. Revision of order which is prejudicial to the interest of revenue. I mean an order is passed, which is, because of that order, government is losing tax revenue. That means prejudicial to the interest of, sir, what is the revenue interest sir here? To maximize the tax income. Okay, if it is prejudicial, against to their main motto, then they can come and revise that order using the powers under 263. If it is prejudicial to SSC, then they can revise it under 264. So 263 is in favor of whom? Mandip. Dance lo gelipaadu. So 263 is in favor of department, 264 is in favor of SSC. Okay, first. Who can revise here? Commissioner and above. Commissioner and above may revise. Sir, if you see, since commissioner and above will revise, revision order will directly appeal before ITAT. Because here revision order is made by whom? Commissioner and above. Appellate authority is also commissioner rank only. So revision order you cannot question before appellate authority. Straight away you have to take it to whom? ITAT. Because commissioner and above levels passed an order, then it has to be challenged before ITAT only, not before appellate authority. So one thing you can make sure here, what? Revision orders also has to be appealed before ITAT. Because revision orders will be passed by commissioner and above level. Commissioner, principal commissioner, chief commissioner, principal chief commissioner. Then even 263 also, commissioner, principal commissioner, chief commissioner, principal chief commissioner may revise on their own motion. I mean, they themselves feel pity about SSC. So, okay, wrongly this order has been passed. So this fellow unnecessarily paying tax, which usually don't happen. But let's say if it has happened and they felt pity about SSC, then they can revise on their own. Or an application is made by SSC. An application is made by SSC. So within what time application has to be made by SSC? Within 1 year from communication of AO's order, not end of end, sir. 1 year from communication of AO's order, not from end of the year. Sir, in assessment to search appeals, you should have one more summary for all these time limits. One time limit will count day to day. 1 year, one certain time limits will count from end of the month. Certain time limits will count from end of the year. So you should be clear. So okay, those things nobody will remember. Only when you by heart, then you will remember. So all of those time limits, write it in one particular page as summary. Then do same, 2 1s are 2, 2 2s are 4. Okay, Commissioner of Income Tax, Principal Commissioner of Income Tax, Chief Commissioner, Principal Chief may revise on their own motion or an application received by SSE. SSE has to make such application within 1 year from communication of AO's order. Here, what is the fees? 250. If applicant SSE wants to revise, he has to pay a fees of 250. For departments, sir, no time limit at all. Okay, no time limit for application. Then, when can revision be taken under 263? When order passed without enquiries, investigation that are necessary. Sir, that AO original AO took some money. That's why he passed assessment order without doing proper enquiries and investigation. He closed the order. He passed the order. Or allowed relief, some deduction is provided without doing proper enquiry. Or such particular order is not in accordance with CBDT directions, High Court or Supreme Court decisions. Then it can be revised. When without doing proper enquiry, investigation, order passed. Certain relief has been provided without doing proper enquiry, or such an order is not in accordance with the High Court, Supreme Court decisions or CBDT directions, then revision can be taken. Here, not specific to any deficiency. If it is prejudicial, then it can be taken. So not only because of these issues and all not there, if because of any issue, it is prejudicial to the interest of SSE, then 264 can be taken. Okay, sir, when 263, sir? 263 can be initiated by whom? Commissioner and above. Okay, on their own. Whereas 264, Commissioner and above, on their own motion or an application made by SSE within 1 year from the date of communication of original order. Fee 500. What reasons initiate 263? The order passed without enquiry and investigation which is necessary. A relief given without enquiry or not followed CBDT directions or High Court, Supreme Court decisions. Here under 264, not specific any deficiencies are there, anything, but it attracts or it is because of that there is prejudicial to the interest of SSE. Then, once they taken up for revision, what? Commissioner call for and examine records available. He'll call for all the data once again to check. OBH has to be given before passing revision order. To whom? SSE. OBH means what? Opportunity of being heard. Commissioner of Income Tax now what? He can enhance the original order in revision, modify the original order in revision, or he can cancel the original order and go ask the AO to do the assessment freshly. Fresh assessment also can be initiated. Here, if SSE applies for revision only, then time limit 30 days for filing appeal before Joint Commissioner and Commissioner. Sir, when SSE can go for revision? Within how many days he has to go for appeal actually? 30 days. If that 30 days expired and appellate authority is not giving the condonation of delay also, then he can come for what? Revision. Okay. So SSE first to have to go for appeal only. If appeal time limit lapsed, then he can come for revision. Okay. So once he applied for revision, Commissioner calls and examines the records and passes suitable order. Time limit for revision. Time limit for revision. Sir, the one we discussed is time limit for application. For applying, what is the time limit? 1 year from the date of communication. Now, time limit for revising. What is the time limit? Within 2 years from end of the financial year in which AO order is passed. So what is the time limit, sir, under 263? 2 years from end of the financial year in which AO's order is passed. AO order passed on 1st September 2026. So when this year ends? From there. That means till 31st March 2029. Whereas under 264, because of own motion, because of application by SSE, we need to check. If it is through own motion, then the order has to be passed within 1 year from date of AO's order. Because of own motion, then the order has to be, revision order has to be passed within 1 year from date of AO's order. Again, not end is there. Here, end of the year. Here, 1 year from date of AO's order. If it is own motion. Sir, I am just explaining. These things you will not remember in class itself. You need to own motion within 1 year from date of AO's order. If it is application by SSE, again see, within 1 year from end of the financial year in which application is made. So revision taken on own motion. Order date from that date to 1 year. Revision asked by SSE. End of the year in which application is made, from there 1 year is the time limit. 263. End of the year in which original order is passed, from there 2 years. Okay. SSE can go for an appeal on fresh assessment order. Sir, here what they can do, enhance, modify, cancel and initiate fresh assessment. But SSE can go for an appeal on fresh assessment order which is consequent to revision. Sir, this order asking to, directing to go for fresh assessment, this direction cannot be appealed. But by following direction, if they do fresh assessment, such fresh assessment order can be again appealed. Sir, first thing cheppalante. Sir, revision of order for appeal order or original order. All these are for original orders only, not appeal orders. Once it went to appeal route, there is no revision. Original orders only. Okay, if they miss to go for appeal, then they'll come for revision. Understand? Okay, sir, here, first, appellate revisional authority. You came for, not you, they only have been taken for revision under 263. Why? Because it is prejudicial to the interest of revenue. Now what revisional authority said, like the original assessment cancelled and asked you to, and asked the AO to go and do fresh assessment. But you don't like, you being SSC don't like again doing the fresh assessment. But still you cannot do anything. You cannot go for appeal also. That fresh assessment order, whatever they do in the fresh assessment, if that you don't like, you can go for an appeal. అసలు ఫ్రెష్ అసెస్మెంటే వద్దు అని నువ్వు అనకూడదు. ఫ్రెష్ అసెస్మెంట్ ఆర్డర్ వస్తే నీకు ఛాన్స్ లేదు, చేయాల్సిందే వాళ్ళు. ఆ ఫ్రెష్ అసెస్మెంట్ ఆర్డర్ ఫైనల్ అయినాక నీకు నచ్చకపోతే ఏం చేయొచ్చు? యూ కెన్ గో ఫర్ ఎన్ అపీల్. అండర్స్టాండ్ సార్? You cannot argue like why fresh assessment, the past assessment only has to be continued like that and all. You cannot argue. If they order for fresh assessment, you don't have a choice. Fresh assessment has to be done. But if you don't like the outcome of fresh assessment, you can go for again appeal. Understand, sir? Then against the revision order, sir, already you lost. First, when SSC will come for revision? If he cannot go for an appeal within 30 days, then he will come for revision. Already this is a something, some extra benefit given by income tax. You already lost the appeal hierarchy or appeal kind of right which you are having. You lost because you didn't file an appeal within 30 days. So now for revision orders, you don't have the chance to go for an appeal again. Revision order you don't like or don't like, follow it. If it is filed under 264, revision order or revision asked by SSC, then SSC has to bound to that revision order. He can't have the option to go for other appeal. Why? Because first itself he lost the right to go for appeal. If he has filed appeal first itself within 30 days, then if he don't like that, he can go to ITAD. ITAD he don't like that, he can go to High Court, Supreme Court. Just because he missed the time limit there, he lost the appeal route. He has only revision, and this revision order cannot be again appeal. Okay? Here doctrine of partial measure, here doctrine of total measure. These points are important, sir. Many questions are on partial measure and total measure only. What is partial measure? An order sought to be revised is taken up for appeal. An order sought to be revised was what? Taken up for appeal. Still revision can be made when the point or matters of revision are not subject matter of appeal. So understand what is called partial measure. First read the sentence once again. Order sought to be revised is taken up for appeal. I mean already the process is under appeal. Now it is again taken for revision. So simultaneously it is under appeal process, it is under revision also. What does partial measure means? Revision still can be taken even though the case, the matter is for appeal. But when the points which you taken for revision are not subject matter of appeal. Sir, appeal means they will not take the total computation for appeal. The disputed 3 or 4 points only they will take as the grounds of appeal. Grounds of appeal. Now revision is not related to those issues. Revision is related to a different issue. So partial measure means what? Appeal issues different, revision issues are different. So no problem. Appeal also can continue, revision also can continue. Total measure means once it is taken for appeal, even though the points to be taken for revision are different issues also, still you cannot come for revision. Okay, see. Example, AO passed an order reducing depreciation claimed from 70 to 50 lakhs. First dispute. What? Depreciation you claimed 70, he reduced it to 50. Then he disallowed rental expense of 35 lakhs. So two things he did. First one, depreciation reduced. Second one, rent disallowed. Okay. Now, with respect to depreciation, appeal made. In appeal is already pending before with respect to which issue? Depreciation only. In appeal, rent was not taken as a point. Now, with respect to rent, revision can be taken. Whereas, even already AO's order is appeal, revision can be made with respect to rent expense since it is not a subject matter of appeal. When it is this case, when partial measure applies. When partial measure applies, only under 263 partial measure applies. When the department taken the appeal under 263, then partial measure. I mean, appeal can continue, revision also can be taken when both the issues are different. Whereas revision wants to be made by SSC. If already that is pending before any, I mean, if it is already under appeal, total measure applies. Even though it is a different issue, still can't be taken for revision. Total measure, AO order, appeal, revision not applicable irrespective of whether it is a subject matter or not. Okay, the last points are now. Okay, last but one. Monetary limits to regulate appeals by department. Monetary limits to regulate appeals by department. Sir, sometimes for a small issue, monetary wise, why they need to take up all these appeals and all? That's why department may regulate themselves considering the monetary terms. Like they may say like, yes, issue is correct only, but still they may direct them to not to go for an appeal because unnecessary time waste and all, that revenue they'll get is less compared to the effort they put in such cases. Okay, for restraining themselves, they'll put certain monetary limits. Department can file an appeal only if tax effect is more than the following amounts. So an appeal can be made to ITAD only when the monetary limit, I mean the disputed amount is more than, disputed tax amount is more than 60 lakhs. To High Court only when the amount is more than 2 crores. To Supreme Court when it is more than 5 crores. Okay, when the amounts are within this, then need not to go for an appeal because unnecessary time waste they feel. Okay, see, can file appeal only if tax effect, not total income. Tax effect, disputed tax effect is more than the following amounts. With ITAT, more than 60, then go for ITAT, no problem. 30 lakhs only. Don't go to ITAT also, leave it. High Court, more than 2 crores, no issue. Above 2 crores. Above 2 crores, you can go to High Court also. Within 2 crores, forget, leave it. Okay, don't go to High Court and prolong it. Okay, Supreme Court, now above 5 crores issue only. Okay, if, sir, it doesn't mean, let's say, for Mandeep, first year, they didn't taken it to ITAT because the tax involved is only 30 lakhs. Second year, the tax involved is 80 lakhs. Then they can go to ITAT or not? Yes, they can go to ITAT. Now Mandeep cannot argue like last year also same issue, this year also same issue. If last year you cannot go to ITAT, this year also you cannot go to ITAT, that argument cannot be made. Why? Last year also issue is same, but why they didn't checked or counted? Because of the monetary caps they are having. Last year they ignored, but current year the amount is more than that. So current year they can go to ITAT. Now Mandeep issue is, or Mandeep related tax issue is like only 30 lakhs. So even though it's a genuine matter, they can go to ITAT, they dropped. Why? Because the amount is within 60 lakhs. But Navneet is having 80 lakhs, same issue. Now Navneet is saying like what? Why partiality? For Mandeep you didn't went to ITAT, for me you are taking to ITAT, so you are biased, partiality, everything is saying. Okay, is it valid? No sir. Why in Mandeep case they dropped? Because it is within cap, whereas here it's not, cap is not applicable, so that only. It shall not stop department from filing an appeal on the same issue in case of same SSC in another year or in case of other SSC in any year. Just because in this case you stop, it doesn't mean you'll stop in any case. Okay, here there is a cap, that's why you are restricted yourself. Then special provisions for avoiding repetitive appeals. Sir, same matter. Why again and again they have to go for appeal? If it is a matter issue for me also issue, for you also might be an issue. If I go to an appeal, you go to an appeal, this many cases. Why? Okay, so for that, see, sir, and I have an issue regarding one particular point. I have a debate. I have a difference between AO and me. That is not for this year. For the last 3 years it is there. And even in the future also, the difference will be there only. Now for every year I need not to go for an appeal. So what happens? See, SSC for a assessment year, it is taken for scrutiny. Same SSC for a different SSC assessment year, matter pending before High Court and Supreme Court. Sir, already for 23-24 related issue, I went to High Court. So already that matter is with High Court. Now for 24-25, 25-26, also same issue. That is under the scrutiny. Now again, SSC need not to pass an order in the way he like, and again I need not to go to ITAT, High Court and Supreme Court. What can be done? Question of law in relevant case. Whatever is the question of law in 23-24 is same even in 24-25, 25-26 also. Then what? Is identical to that of pending matter. Then SSC files a declaration in Form 8 that he abides with the High Court or Supreme Court order. Sir, if 23-24, High Court order favorable to me, then what I did in 24-25, 25-26 is correct only, nothing to be done. In 23-24, what I did is wrong as per High Court order. Then I have to follow the same thing even in 24-25, 25-26 also. Like that I have to give a declaration. Then they'll halt the assessment and wait till the decision comes in the 23-24. See, SSC for assessment year it is taken for scrutiny. But for the same SSC for a different assessment year, matter is pending before High Court or Supreme Court. Now the question of law in the current year is also relevant to that of the past year, which is already pending before High Court and Supreme Court. Now what? AO need not to close the assessment. He just to keep it like what? Yes, halted. Okay, when I use a declaration stating what? Whatever the outcome comes in that High Court or Supreme Court decision, the same outcome I'll follow even for these years also. Okay, now he'll wait till the decision and not raise the same question of law in appeal before relevant case. Okay, so SSC files a declaration in Form 8 to AO. AO may admit or reject. Okay, he didn't convince, like the question of law he didn't felt like identical. That issue is different, this issue is different, he felt like. Then he may reject that. Okay, or else AO may admit that. Once he admits, the case is disposed without waiting. After High Court or Supreme Court decision, such a decision will be applied in the relevant case also. So this is when SSC wise this is. SSC, instead of going for multiple appeals, he files a declaration and asking or requesting the AO what? Wait until this judgment comes. For the other years also, you can just simply apply this judgment only. So till then AO also what? He is waiting, he's setting aside the assessment and waiting for the High Court and Supreme Court judgment for other years also. Now here what? 158 AB. Sir, there is an issue with respect to Navneet. Already, department has filed an appeal, it is pending. Now, the same issue is there with other 30 people. Now, for all the 30 people also, department need not to go for an appeal. So what? See, there are identical question of law pending before High Court, Supreme Court for another SSC. See, ITAT, High Court, order in favor of SSC. ITAT or High Court has given order in favor of SSC. Department didn't like. What it did? It filed an appeal before High Court. When ITAT order on High Court order on Supreme Court, it has made. But identical question of law for another SSC is also there. Same issue, same dispute is there for some other SSC also. Now for some other SSC also, why again they need to take it to High Court, Supreme Court? Unnecessary time waste for High Court and Supreme Court. So now what they will do? Now in the second case, Collegium means it's a group which consists of two or more commissioner of income taxes, principal or chief commissioner of income taxes. So this collegium may decide and inform commissioner not to go for an appeal. That means they will not leave it permanently. They will wait for the outcome in the first one. If the outcome is in favor of department, the same they're going to apply in the other SSCs also. To avoid duplication of appeals, repetitive appeals, they are precluding themselves for not going an appeal. So the last one, sir, rectification of mistake. What is rectification of mistake, sir? Already they passed an order. In that order, there is mistake. Whether that mistake can be rectified or not, if so, within what time it has to be rectified. Section 154 is about rectification of mistake. Who can rectify mistakes? AO, Commissioner of Income Tax, Joint Commissioner, Commissioner of Income Tax, appeals. If order already appealed, then partial measure applies. That means what? If it is already a subject matter of appeal, that can't be rectified. That has to be taken care in the appeal only. If it is not a subject matter of appeal, then those points can be rectified. Partial measure. So what is partial measure? Appeal points alone you cannot touch. The other points you can revise, you can rectify them also. Then that is partial measure. Total measure. If it is taken for appeal, none of the issues in that year you cannot touch. You cannot revise or you cannot rectify. Then that is called as what? Total measure. Partial measure means leave the subject matter or the points of matter of appeal. The other matters and all you can revise or you can rectify. Here what? Rectification is related to partial measure only. So if those are not subject matter of the appeals, then the other points can be rectified. Okay. So which can be rectified? Order passed by an authority, intimation, tedious TCS order or intimation. So rectify a mistake which is apparent on record. Which is apparent on record. What does it mean by mistake apparent on record? That mistake can be identified without any further verification. Like what? Tax calculation mistake is there, sir. For that you need any substantial evidence again. There itself you will understand there is a mistake. Or at one column you took one number, AO only. At one column he took one number, the same amount. Under a different column he took wrongly. Or deduction he took more than the amount allowed. So those kind of wrong calculations he has did. Then that is called as apparent on record. You need not to bring invoices. You need not to bring other evidences to prove that it is wrong. On face itself you can find out that is wrong. Then such mistakes can be rectified. Okay. Sumotoli, whichever the authority passed, they themselves can rectify the mistakes on their own. Within what time, sir? 4 years from end of the financial year in which order containing mistake is passed. What is the time limit, sir? 4 years from end of the financial year in which order containing mistake is passed. Sumotoli, they themselves can pass. If it is applied by SSC, SSC found out that there is a mistake in the order. He applied for rectification. For rectification, no fees and all. Okay, no separate form also. Then what is the time limit for rectification? Within 6 months from end of the month in which application received by authority. 6 months from end of the month in which they receive application. Sumotona, 4 years from end of the financial year in which the original order has been, this order has been passed. Then section 254. 254 is about what? ITAT revising their order. ITAT revising their order comes under 254. Okay, here also partial measure only. That means already that particular matter taken to High Court. If the High Court subject matter of appeal, that cannot be rectified. If there are other matters which are not subject matter of appeal, they can be rectified. Again, Sumoto, ITAT only found out that there is a mistake in the order. So they themselves can revise within 6 months from end of the month in which ITAT order is passed. Within how many years? 6 months from end of the month in which ITAT order is passed. Whereas applied by SSC, within 6 months from end of the month in application is made by SSC. Sir, these two correct. Same only, almost. Here 6 months, here it is what? 4 years from end of the financial year in which order containing mistake is passed. Normal IT authorities. Whereas ITAT, within 6 months from end of the month in which ITAT order has been passed. Okay. Sir, this section nothing to understand. It's about within what time they have to rectify their mistake. Time limits only you have to by heart. And there are, sir, understand, remembering these time limits is not an easy thing. Only when you revise multiple number of times, then only you can revise the time limits. So one sincere suggestion is like what? Write down all the time limits at one place. And with one reading you will not remember. Okay, I said like you to you like yesterday or day before yesterday. Every day 45 minutes allocate for DT. Okay, in that 45 minutes of time, some 10 minutes, 15 minutes for these kind of things. Okay, you will be every day doing that. So once you do every day, then effortlessly you will remember by 5 days, 6 days, 7 days, you will remember. Okay, day before exam, how much effort you put, how much ever you try to remember this. In exam again, you'll get confused. It's not like you'll completely forget, you'll get confused. You'll be applying one time limit. So these requires from now on itself, you need to revise them number of times. Sir, another 15 minutes I'll take, sir. IDT class will delay it. Sir, question number 14. Page number 15.12. Assessment of Bhajan was completed under 143 subsection 3 with an addition of how much? 15 lakhs to the returned income. SSE company preferred appeal before the Commissioner of Appeals, which is pending now. Preferred appeal before Commissioner. So already the appeal is pending before whom? Commissioner. So in this backdrop, answer the following. Based on fresh information that there was escapement of income for the same assessment year, AO initiate reassessment proceedings when the appeal is pending before Commissioner of Appeals. Sir, this is related to 147, sir. This total question is from CFNL, so little depth will be there. See, I wanted to include this point, that's why I brought this question. As per the third proviso of 147, assessment, AO may assess or reassess such income other than the income involving matters which are the subject matters of any appeal, reference to revision, which is chargeable to tax and has escaped assessment. So nothing but, here also what they are saying like partial measure. Already it is went for appeal, but you wanted to start a fresh assessment. Then if it is not a subject matter of appeal, you can do what? For those issues, fresh assessment also no issue. So look at the question. Based on fresh information that there was escapement of income for the same assessment. Okay, when the appeal is pending before Commissioner, what they are saying, see, read this point, sir. As per third proviso, AO may assess, reassess other than income involving matters which are subject matter of appeal, subject matter of revision. Okay, then they are chargeable to tax and has escaped. Nothing but doctrine of partial measure will apply. Therefore, even when appeal is pending, AO can initiate reassessment proceedings in respect of income chargeable to tax, which has escaped from assessment. Can the AO pass an order under section 154 for rectification of mistake in respect of issues not being subject matter of appeal? Sir, rectification of mistakes, you can see here. Partial measure, rectification of mistake, partial measure. What does it mean by partial measure? Subject matter of appeal can't be rectified. Other than subject matter of appeal can be rectified. So here see the question. Can AO pass an order under 154 for rectification of mistake, not a subject matter of appeal? Yes, he can pass because it is not a subject matter of appeal. What is applicable here also? Partial measure. Next, can SSE seek revision under 264? So 264 means favor of SSE, not department. SSE, 263 is in favor of department. Can SSE company seek revision in respect of matters other than those preferred in appeal? Sir, for 264 total measure applies. For 263 only partial measure. So here total measure, even though it is not a subject matter of appeal, you cannot revise. Whereas here, can the Commissioner make a revision under 263? Yes, even though they are in respect of matters covered in appeal and other matters, no. Only with respect to the matters which are not covered by appeal, they can take up for revision. If they are matters of appeal, can't be taken for revision. So here partial measure, here total measure. Sir, avoidance of repetitive appeals, straight theory question only. See, Dhruv, resident India, served an intimation under 143. What? Relating to assessment year 26-27. He came to know only that he has omitted to claim deduction under 80IA, which he is eligible to claim. What he missed? He is eligible for 80IA, but he missed to claim. Now he wants to file a revised petition before Commissioner under 264. Okay, the tax manager of his concern opines that information is not an order eligible for a new revision. No, sir, but still he can go for revision because it is prejudicial to the interest of department. Okay, but understand, the question is also important, sir. See, there is no mistake in the assessment order. He missed to take the deduction. So he came to know only then. So he didn't, there is no mistake in the order. He didn't have information that he can claim 80IA. Okay, sir, revision means what? If any AO order is prejudicial, then he can go to revision. Here AO order is not prejudicial because he didn't claim 80IA. Okay, but the point, understand, sir, here what does it say means, in carrying out assessment generally, even if SSE with his ignorance, he cannot claim any deduction also. AO, if he knows, he has to provide that deduction. He cannot think like, I should be only in favor of department. If no deduction claim night is beneficial to the revenue only, like that he should not think. If any deduction or if any exemption missed by SSE, that has to be provided by AO in the process of assessment. So the missing information also shall be counted. He is eligible for revision. See, issue involved. The issue involved is whether intimation served can be regarded as an order which can be revised. In the other words, whether intimation is an order. Provisions. As per 264, any order other than under which 263 applies, either on his own motion or on application of by the SSE, make an inquiry, cause an inquiry and may pass such order. So 264 says any order, hence it would apply to anything. Okay, therefore the correct errors, it does not limit the power thereunder to correct errors committed by subordinate authorities, but could even be exercised where errors are committed by SSE. So this is an error committed by SSE. Still revision power can be taken to revise even the errors committed by SSE. So it would even cover situation where SSE, because of an error, has not put forth a legitimate claim at the time of return, and the error is subsequently discovered and raised. Okay, so this also can be taken up. Sir, June 2025 question, sir. Except second point, rest we can answer no. SSE has preferred appeal against certain editions regarding assessment year 22-23 and did not contest a few other editions. Sir, for 22-23, there are several points. What he did? Few points he contested. Few points he didn't contest it. When the appeal was pending before the commissioner, commissioner invoked 263. Sir, 263 means what? Favor of department or favor of SSE? Favor of department means partial measure or total measure? Partial measure. So here what? Already appeal pending. Now it is taken for what? Revision. So Commissioner of Income Tax invoked 263 in respect of certain other issues not dealt with the assessment. The tax council says that what? Doctrine of total measure will apply. Therefore revision is bad in law. Correct or wrong? So read the question, sir. They invoked revision under which section? 263. But their tax team is arguing that what? Here total measure is applicable. They cannot revise. Is it correct or wrong? Wrong, sir. Because why? 263 partial measure only. If it is not a subject matter of appeal, they can revise. Sir, question number, this point is about advanced ruling. We not yet discussed. Here see. For the assessment year 22-23, AO made an addition of how much? 180 lakhs on account of excessive depreciation and 150 lakhs by way of disallowance. So two disallowances he made. One is depreciation and the other one is what? Some expense. Company filed an appeal before commissioner regarding depreciation. Okay. In respect of disallowance, they didn't file an appeal, but they want to file a revision under 264. Possible? Sir, he has two issues. Depreciation issue, an expense issue. He went to appeal for what? Depreciation issue. Now they wanted to ask for revision under 264 with respect to expense. 264 means what? Favor of SSE. Total merger or partial merger? Total merger. So total merger means even though it's not a subject matter of appeal, revision can't be made. So here revision not available, here revision available. Sir, this is also revision only, sir. Same kind of will be there. Sir, in SSE, aggrieved by all of the following orders. Desirous to know what he has to do if he is aggrieving with order. Sir, he is aggrieved with 143 subsection 3 order. Then he can go to what? Appellate authority. Within how many days? 30 days from date of such order. Okay. He is aggrieved with revisional authority order 263. Revisional authority means whom? Commissioner. So commissioner means already appellate authority level. So you cannot take to appellate authority. You need to take it to whom? ITAT. Within how many days? Within 2 months from end of the month in which the order has been passed. 272A. Passed under section 272A. Sir, 272A is like a penalty order, sir. In SSE, aggrieved by the order passed under 272A by Director General. Sir, simple, sir. Director General means he is before with, he is the order less than commissioner or more than commissioner? More than commissioner only. So obviously the appeal revents with whom? ITAT. Okay. But the time limit 60 days. Why 60 days? Okay. Let me show you, sir. The time limit, not 2 months, I think. 60 days only. With ITAT. ITAT 2 months, but he wrote here 60 days. Why? Sir, this also make it as like, this also should make it like 2 months only, sir, not 60 days. Okay, this is an amendment, sir, actually. Previously, it used to be 60 days, 1 year back. But then it was changed to 2 months. So 2 months only, correct. Make it as 2 months. Page number 15.8, it's not 60 days, 2 months. Before ITAT, na, 60 days. Then, order of ITAT can be appealed before whom? ITAT order can be appealed before High Court within 120 days from the date of order. But they should involve what? Question of law. This is June 24 exam question. The last question, sir. The rest all, this is like straight question. All are like straight question only. We have solved exam questions just to make sure that exam questions, if you are able to do means, then other questions will be within that range only. Income tax assessment of Murali was completed on 20th November. There were 3 editions. What are the 3? 5, 4, 3. SSE filed appeal against 5 and 4. How many are there, sir? 3. 5, 4, 3. But he made appeal with respect to first 2 only. This 5 and 4. When the matter was pending in appeal, the commissioner invoked 263. 263 means department. So favor of department, revision in favor of department, prejudicial to the interest of revenue, then 263. Partial measure or total measure? Okay. In respect of. So they took revision not for the first and second. They took only revision for third edition. Sir, which are subject matters of appeal? First and second matters are subject matter of appeal. But third one is not a subject matter of appeal. So they are correct in taking the revision. So is this action of commissioner tenable in law? Yes, tenable. What would be our answer if SSC filed revision under 264? 264 is what? Total merger. So all the three cannot be taken for revision. Okay. So that is about question number 8. Understood, sir? So in appeals, mostly they focused on what? Revision orders, they have focused much. Okay. In 4 exam questions, 3 exam questions consist of revision related only. So revision, you focus more than time limits if you focus. Okay. Here, if you see this question, June 2024, you need to know time limits. It's okay.